higher and pressured stocks. And on Friday, Treasury yields retreated from highs as Trump ramped up his trade war. Listen in to Subhadra Rajappa of Societe Generale give her views on bonds and yields.
We're definitely at levels that we should be concerned about, 5% in 30 years. And if for some reason, if we start seeing a continued sell-off in the 10-year towards that 5% level as well, that I think is a bit of a concern. But this is not just a U.S. phenomenon. You're seeing global bond yields rise. You're seeing this unraveling of correlations between all the different assets. I mean, typically when equities sell off, investors flock to the safety of bonds and the dollar. That's not happening. So you're seeing this kind of very, difficult picture, if you will, for bonds globally.
That's all we have on the global market action, but how will all of these overnight cues impact our own markets? Our research team is now joining in with the trade setup, the stocks that are likely to be in the news, and of course the setup on the F&O side of things as well. First up, Vinny joins in to get all the market cues that we need to watch out for today. Vinny, good morning. Looks like we are building on to Friday's gains is what the GIFT Nifty is indicating, but what are the cues that you are picking up?
Absolutely hoping for a build-up in terms of Friday's cues that we have. Now, obviously last week, though the markets closed at the negative front, we had Sensex and the Nifty both were down 1% each overall for the week. Now on Friday specifically, obviously we did see a bit of a recovery coming in and a bounce back coming in. Nifty up 243 points, Nifty Bank up 456 points, almost 1% in terms of gains for both these, but the Nifty as well as the Nifty Bank. Now in terms of FIIs, they have seen a bit of a buying coming in. 1,795 crores is what FIIs bought. DIIs also continue to buy. 300 crores buying coming in from the DII front. Important factors that we're keeping an eye out on, obviously RBI dividend that was announced on Friday as well. So that is what we're watching out for. 2.69 lakh crores is what they have announced as dividend. It's in the range of what we were expecting. Earnings season, that's going to be continuing. Last leg of earnings season, so maybe some bit of a move on that front. Monthly expiry this week, so maybe that's important to watch out for, given that we have economic data, the GDP data in India that will be coming out on 30th of May. So that is something to keep an eye out on. And overall, Trump commentaries, a lot of commentary that have come in from Trump over the weekend. So in terms of tariff threats, sanctions, then he's spoken about, delaying the imposition of that 50% tariff on EU as well till 9th of July. So these are key commentaries that we are keeping an eye out on. Still a lot of uncertainty in terms of commentary coming in on tariff front. But as of now, what the Nifty implied open is indicating, a bit of a mild positive start is what we could watch out for.
Indeed, 60-point uptick is what the implied open is suggesting. Vinny, thanks a lot for that. Of course, there are plenty of stocks that you need to keep an eye out for because there were results that were reported over the weekend, a lot of other news flow as well. Vamakshi, what are you picking up here?
Well, absolutely, Vamakshi. Let me first start off with JSW Steel. The company reported largely inline set of numbers. Standalone EBITDA per ton came in at 8,783 rupees. This is largely in line with what the poll was suggesting. The overseas operations losses also were declined, led by USA. The net debt reduced on cash generation as well as release of working capital. Apart from that, keep an eye out on NTPC as well. Overall numbers missed consensus estimates. Revenue saw an uptick of 4.6%. The margins have declined marginally to 29.6%. But the net profit has seen an uptick of 23.5%, and this is largely coming in from higher contribution from JVs as well as some of its subsidiaries. GE Vernova, on the other hand, reported a good set of numbers, especially on the operational front. EBITDA margin came in at 21.9%, the highest seen among some of the high voltage transformer peers. Order inflow was very strong, an uptick of almost 125% on a year-on-year basis, and the management says that 1 to 2 HVDC projects will be ordered out in FY26. Balkrishna Industries reported flat volumes at 82,000 tons. Margins have declined to 24.8%. The net profit is down almost 26%, mainly on account of forex losses. Glenmark Pharma revenue came in below estimates. The margins have improved on a year-on-year basis, but is much below what the poll was expecting. India's performance was flat, while North America saw a dip. Ashoka Buildcon reported an uptick of almost 12% in its revenue. Margins have improved substantially to 28.9%, and the net profit saw an uptick of almost 73.2%. So those are some of the earnings that you should watch out for. But Mangalam is now joining in with cues from the F&O space. Good morning, Mangalam.
Good morning. So, if you look at Friday, there was a bit of a bounce back that we saw on the indices after the big cash that we saw on Thursday, and that is likely to continue. That's what the GIFT Nifty is indicating. But the question is, what exactly do we do from here since we've started in the expiry week? Two things we'll be watching out for. One would be the flows from the FIs in cash market, and the second would be the flows that we see in index futures. So in the cash market, their purchase resumed. 1,800 crores is what they bought on Friday's trading session, with DIS pumping in another 300 crores, so a net inflow of close to 2,100 crores. In index futures too, there was a mild purchase that we saw after big selling in the previous two trading sessions. So 150 crores is what the FIs bought. They added about 3,700 longs and 2,500 shorts, though a large part of those purchases were towards the Nifty bank. So that's something we'll watch out for. Over the previous trading session, there hasn't been much of a change in their long positioning or their net contracts. Long positioning stands at about 33%. The other thing we'll be watching out for is the put-call ratio. The put-call ratio has moved back above 1, closer to 1.1. Remember, it's between 1.2 and 1.3 where the market gets into slightly overheated zones. So for this expiry week, what is it that the option writers are positioning themselves for? 24,900 call. A fair amount of writing out there for a premium of nearly 200 rupees. At the lower level is the 24,800 put, which has some premium added as well, with about 170 rupees on offer. So what is it that the option writers are expecting on the Nifty? Support between 24,600 and 24,650. On the way up, congestion between 25,000 and 25,050. And that brings us to our first congestion when we open today itself. For the Nifty bank, support seen at 55,000, which also is the 20-day moving average. Resistance at 56,000, the previous all-time high. In terms of stocks, watch out for Chambal Fertilizers and Hindustan Copper. Both of them have entered F&O bands.
Indeed, 6 stocks in the F&O band today. Mangalam, thanks a lot for that. Take a short break here on Power Breakfast. Up next, we get you updates on the Reserve Bank of India's dividend announcement for the government. Stay tuned. Back on the other side.
Well, welcome back. You're watching Power Breakfast on CNBC TV18. In a major fiscal boost to the centre, the Reserve Bank of India approved a record dividend payout of 2.69 lakh crore rupees to the government for financial year 24-25, which is a 27.5% increase from the 2.1 lakh crore rupees transferred in FY24. Ritu is joining us with all the details. Ritu?
Well, record high surplus transfer from the Reserve Bank of India to the central government coming in at 2.69 lakh crores, which is an increase of more than 27% from last year's dividend transfer of 2.1 lakh crores. Now, this number, although large, is a tad below what the market was expecting at 3 lakh crores plus, and that is because the RBI board has also adopted a revised economic capital framework under which the contingency risk buffer was hiked to 7.5% at the upper end. Now, without this large buffer, the surplus transfer could have been even higher and perhaps closer to market expectations. Now, the contingency risk buffer is nothing but the buffer that is maintained by RBI to cover any unexpected and unforeseen financial risks. And previously, it was at 5.5 to 6.5% of RBI's balance sheet, and that has now been widened to 4.5 to 7.5% under the revised framework. Now, RBI says this revised framework provides some flexibility to be able to maintain risk buffers, keeping in mind the prevailing macroeconomic and other factors, while also ensuring the needed intertemporal smoothing of transfer, which means avoiding any large fluctuations year on year. Now, while we'll get to know the fine print of what really contributed to this large surplus when we get the RBI annual report in the coming weeks, but safe to say the big contributor has been the gains from RBI's sale of dollars, which is probably the highest since the global financial crisis at $400 billion nearly for FY25 compared to just $153 billion in the year before, and RBI has made a profit on every dollar that it sold. Other key factors like interest income on rupee and foreign securities would have also lent some support. Now, a higher dividend payout is good news. It is going to augment the government's non-tax revenues, and it is also likely to improve liquidity conditions in the system as well as potentially ease the short-term interest rates.
Ritu, thanks a lot for that. The big dividend announcement coming in from the RBI on Friday evening with regards to the dividend for the government. Take a short break. On the other side, we get you cues from the commodity space. Stay tuned. We'll be right back. Welcome back. Well, it is pouring outside here in Mumbai, and that's because the southwest monsoon has already covered Goa and has already reached parts of Maharashtra and the South Konkan region. Now, the usual date for the monsoon to reach Maharashtra is the 5th of June, but this year it has arrived 10 days early. The IMD has stated that conditions are favorable for further advancing of the southwest monsoon into some more parts of Central Arabian Sea, some more parts of Maharashtra, including Mumbai, during the next 3 days. Parts of Karnataka, including Bengaluru, Andhra Pradesh and the remaining parts of Tamil Nadu are also expected to witness the monsoon over the next 3 days. And if the monsoon does reach Mumbai by the 28th of May, it will set a new record. Now, according to the IMD, the earliest recorded arrival of the monsoon in Mumbai was the 29th of May, which had occurred in 1956, 1962 and 1971. So, well, Vamakshi, it does look like the monsoons have already arrived, considering the way it's pouring outside. But, well, we do hope that this is a new record that the monsoon is about to set.
Well, absolutely, Hormaz. We're really feeling the Monday morning blues this time around. But moving on then, we now have Manisha Gupta joining in with all the updates from the commodity space. Good morning, Manisha.
Morning, Vamakshi. Thank you for that. Well, absolutely. It's record when it comes to monsoons in India this time. And we did create some heat wave records as well. Remember earlier part of this year? So, well, the monsoons are quite a welcome thing there. But when it comes to the commodities, we are looking at some bit of a risk on coming in. Let me remind you that the U.S. markets are shut. It's a long weekend there. It's Memorial holiday. So you could be looking at volumes slightly suffering because of that. But with Trump announcing delay of 50% tariffs on European Union from 1st of June to 9th of July now, we've seen crude oil prices gain up for a second straight day. Even the base metal prices are trading in the positive. You have copper prices, aluminum, all of that in the positive in Asia right now. The dollar index has declined below 99. The markets also are reacting to China's stimulus measures. So some positives that you can see in case of the commodities there. Not just crude or metals, it is gold prices which gained up 2% on Friday, up 5% in the previous week, and are trading in the positive at this point in time. Well, there are various uncertainties, tariffs on Apple, statements on Harvard, and then concerns on the U.S. government debt levels. Add to that, the Chinese gold imports surged to an 11-month high in the month of April. So very strong buying when it comes to gold and silver as well. So all in all, strong start for many of these commodities in Asia.
As they say, records are meant to be broken, so monsoons are set to break one as well. Manisha, thanks a lot for that. And of course, it is a strong start to a lot of these commodities at the start of this week in what is a truncated week for Wall Street. But in some international updates, then Russia launched its biggest ever aerial attack on Ukraine's capital city, Kyiv, just hours before the last prisoner swap between the warring countries took place. Now, according to the Ukrainian Air Force, Russia launched a barrage of over 370 drones and missiles across the country, killing 12 and injuring a dozen more. President Vladimir Zelensky has called for action from the US and said that the silence of the US and other countries is only encouraging the Russian President Vladimir Putin. He also called for sanctions on Russia after the aerial strike. Now, reacting to Russia's latest aerial attack on Ukraine, here's what US President Donald Trump had to say.
I'm not happy with what Putin's doing. He's killing a lot of people, and I don't know what the hell happened to Putin. I've known him a long time, always gotten along with him. But he's sending rockets into cities and killing people, and I don't like it at all, okay? We're in the middle of talking, and he's shooting rockets into Kiev and other cities. I don't like it at all.
Well, that's all we have on this edition of Power Breakfast. But don't go anywhere because Bazaar Morning Call comes up next.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Well, rains are here. It's overcast. It's cloudy. It's actually a beautiful morning. Earlier the better, as they say, especially on Monday mornings like this one. Guys, good morning.
Hi, morning. Absolutely a beautiful monsoon morning, and it's the earliest onset, I believe, in Maharashtra ever on record.
Yeah.
Because they've come in well ahead of expectations, and yeah, I think we've got some visuals. Maybe we'll also put them up. But yeah, hoping that the good times last. Lots to keep us busy in the markets, the tweets, the developments over the weekend.
Well, beautiful weather, but just stay safe out there. And I think we've got a market to deal with. So, Prashant, let's get straight to that.
Absolutely. And, before I go any further, U.S. markets are shut today. There is no U.S. In that sense, we are going to be sort of trading off the cues which comes our way from everywhere else. But no U.S. In that sense. Cash markets are shut for Memorial Day. So that's point number one. Now, on Friday, and the graphics will start to come up, the Nasdaq was down 1% and the dollar index was down about 1% as well. Actually, there are only two things of consequence which happened on Friday in terms of price action. Equities sold off, there was a bit of a risk off, and the dollar index was down meaningfully as well. And we are now closer to 99 than we are to 100. Otherwise, I mean, yields, oil, everything else was neither here nor there. These were the two clear signals in that sense. And I'm just going to focus, as we did and as we often do on Monday mornings, as we look ahead into the week, just two themes. First is kind of a repetition of what I said exactly Monday last week. Has the good news on tariffs peaked? That is one. Second, will long-end bond yields continue to rise? It's happening in the US, it's happening in Japan, it's happening in the UK as well. Let's just spend a minute each on both these themes. Has the good news on tariffs peaked, right? That's the first one. Now, I think we got the answer. Trump on Friday evening, our time, recommended a 50% tariff on EU as soon as the 1st of June if trade negotiations failed. Now, it's very unlikely that you essentially will have 50% tariffs which actually go into effect at that rate of 50%. But it told us two things. One, the Trump team is very frustrated with the pace at which things are going. And second, tariffs are still the number one go-to tool to try and force the change that the Trump team really wants to get done. Now, after the Trump comment, the Treasury Secretary Scott Bessent came out and said, hope Trump's threat would light a fire under the EU. It's arguable if you want to put it that way, but it did sort of elicit a response. So the EU chief came out and said that Europe, and this was on Sunday, by the way, just yesterday, Europe is ready to advance stocks swiftly and decisively. But then she also kind of said that we need at least till the 9th of July. June isn't going to be possible to get a good deal. In her words, she said that we need at least till the 9th of July. And Trump has responded. And he's kind of put out a social media post saying that he's very pleased. He had a call and he's agreed to extend the 50% tariff deadline on EU to the 9th of July. So, 3 tweets, and I think it's pretty clear. I'm not sure if Trump has got what he wanted, but at least he's got their ears, standing and sort of listening intently. So, I hope possibly the pace of tariff negotiations with the EU will pick up. Now, the other piece of news was Trump threatening to impose 25% tariffs on Apple. And then I think he threw in, for good measure, Samsung there as well. If iPhones in the case of Apple were not made in the US, he's sort of spoken about this, that what you sell in the US needs to be made in the US in the context of iPhones. And now he's, of course, backing it up with this threat of 25% tariffs. Now, again, very, very unlikely he actually goes through with this. But it again kind of shows you and takes you back from, if you're in the markets, has the question, I think, has been answered in the positive that perhaps the good news on tariffs, right? I mean, things are going fast, etc. Perhaps that news flow has peaked a little bit. Now, the second point, of course, is will long-end bond yields continue to rise? And here, just a couple of points. There is, of course, as I said, if you look at the US 30-year, which is 5%, north of 5%. If you look at the UK 30-year, you look at the Japanese very long end bond yields, everything is slowly gathering pace. They're all pushing higher. And looks like, I mean, it's a combination of two things, especially in the US, lack of demand for bonds. And the second, of course, is supply. Supply seems to be coming, and more supply is coming if you just look at that bill which was passed, that spending bill which was passed. Question, of course, is will a breakout in yields hurt stocks? It naturally should in terms of valuations, etc. This week will be important to see if buyers really turn up in big numbers because there is $183 billion worth of supply. Auctions are scheduled on Tuesday, Wednesday and Thursday. The Thursday auction will be closely watched because that's a 7-year bond that the Treasury in the US is trying to sell. So these are the two big kind of items, I think, from a global perspective, which will keep us busy, and we'll have to keep this in mind. Now, just to tie in the levels here on the Nifty, we, of course, on Friday came up very, very sharply and recouped many of the losses. Last week was kind of flattish, which was a good outcome because the week before was extremely good. So you had a very good week, and then you had an okay kind of a week, which is absolutely acceptable. Resistance for the Nifty is 25,116. It's not a new level, it's a swing high. Support stands at 24,462. That's on the downside. Nifty Bank also bounced, by the way, almost exactly from the 20-day moving average on Friday. Here the resistance stands at 55,695 and the support stands at about 54,576. Still in a bit of a range. We'll have to see if there is enough in the tank for the market to continue the breakout that we saw on Friday's session. GIFT Nifty will give you a quick sense of how we are likely to start. About 70 points higher on the GIFT Nifty this morning. Surabhi.
Yeah, absolutely. I mean, it's been an absolutely chaotic, I guess, last couple of days, right, with respect to those tweets, because, and the tweets have been not simple and straightforward as well. They never are when it's Mr. Donald Trump. So he starts out by talking about the EU, and that kind of caught the market by surprise. Remember, I mean, US markets obviously ended negative for the week and on Friday as well. He starts out by saying that the EU has been very difficult to deal with. Our discussions with them are going nowhere. And this coupled with the tweet on Apple as well. And that really, the market was not taking too well to that. And then the reversal that's led to a little bit of a relief. By the way, on Friday, the EU market sold off between 1 and 2% because of these tweets. Not just that, auto stocks in the EU on Friday sold off big time. The auto index was down 3% because of this 50% tariff threat. Now it's been pulled back. On Apple as well, I just want to highlight this because it's telling. Why is the market selling off? Because it's telling the language that's being used. He says, I long ago informed Tim Cook of Apple that I expect iPhones will be sold in the US, will be manufactured and built in the US, not in India or any place else. And then he goes on to, of course, give the threat of this 25% tariff. So all of this has been keeping markets on the edge. This morning, the picture across Asia is a little mixed as well. Some markets like Japan are actually doing well. The mainland Chinese market is also up, but Hong Kong is down. So the picture is not uniform is a short point. Nikkei about 0.5% higher, mainland China about 0.25% higher. Hang Seng is slightly lower. On Japan, more trade talk and tariff talk coming through. And it seems that there is progress with the Japanese because the Japanese PM, Ishiba, yesterday was speaking to the press. And he said that he's seeing progress in the trade negotiations with the US. And he's saying Tokyo is aiming to advance the talks with the US. And they're talking about a lot of areas of possible cooperation, including shipbuilding, repairing US warships, trade routes across the Arctic, and so on and so forth. Not just that, the Japanese market is also up because now this whole US Steel, Nippon Steel merger has finally got the Trump administration's blessing. Donald Trump tweeted on this as well, and he said that US Steel is entering a planned partnership. He's no longer calling it an out-and-out sale or merger. And he's saying the headquarters will remain in Pittsburgh. It'll add, XYZ number of jobs to the US, to the US and the economy. So that's been a talking point. Watch out for geopolitics, and the headlines out of Ukraine are not good at all. It's the largest ever drone strike we've seen on record since the war began in 2022. A total of 367 drones as well as missiles, 13 people dead, including 3 children. So very, very troublesome over there. And again, Donald Trump has tweeted on this as well. The reason I'm highlighting is that all of this is, going to be there for the market to digest. He's saying that Putin has gone, quote unquote, absolutely crazy. And that's one tweet that's come in. He's saying he's needlessly killing a lot of people, not just soldiers. Missiles and drones are being shot into cities in Ukraine for no reason whatsoever. Putin has always said that he wants all of Ukraine, not a piece of it. And if that happens, it will lead to the quote-unquote downfall of Russia. Then he goes on to say that Zelensky is not doing his country any favor as well, and it's causing a lot of problems. I don't like it, etc., etc. He ends this particular post by basically blaming the Biden administration. They're saying that this is Zelensky's war, Putin's war, and Biden's war. It's not the Trump administration's war. So anyway, all of that is going to be on the markets radar. Lots and lots of global news flow. Coming to the domestic cues as well, consolidation week all through last week. The bias was negative, but Friday we saw a perk up, and the flows on Friday have been positive. So let's just look at the flows. Foreign investors were again net buyers on Friday. They bought cash market equities worth almost 1,800 crores. That was a good point. Domestic institutions also, small net buy figure of about 300 crores coming in. The RBI dividend news, by the way, is out. And as Sapna was indicating to us on Friday, the dividend is not as high as what the street expectations were. It's not over 3 lakh or 3.5 lakh crores. It's a far more modest. 2.69 lakh crore rupees that the government will get. Monsoon progress we have already discussed, so it's good news coming in. It's ahead of schedule, already hit Goa, obviously Kerala, and also Maharashtra. Finally, I'll end with some specific, market-specific stocks and news action. There's a lot of IPO buzz today. Watch out for this. 2 new issues are opening. Leela Hotels IPO. And these are all the Leela properties, ex of the Mumbai property, which is HLV Ventures. This is a 2,500 crore rupee fresh issue, 1,000 crores of OFS. Could be interesting. There's a large private equity investor that's backing this entity, Leela Hotels. And then there is AG's Vopak Terminals, and this is a fresh issue of 2,800 crores. It's a subsidiary of the listed AG's Logistics. So IPO action will keep us busy. So will legal action. I know Nigel is going to be keeping a very close eye on JSW Steel because aside of the numbers, there are 2 separate cases. There's one in the Supreme Court and one in the NCLT. As this matter goes, the singles are directing or are pleading that the NCLT should direct the liquidation order that was given by the Supreme Court. JSW Steel is going to the Supreme Court against this, liquidation. So let's see how this plays out. This is a hot story and promises to be fairly lively today as well. Nigel.
Well, for today, the big question is, will the domestic money be strong enough or are they in a great mood to actually take the markets higher? Because we have 2 big equity markets that are actually shut. The US markets because of Memorial Day and the UK markets as well are shut today because the Spring Bank holiday is what we have out there. So foreign participation could possibly be relatively lower. Can the domestic money push the markets up? Well, we'll know later today. What about the FIs? What did they do in the index futures? Well, they added equivalent amount of longs as well as shorts. They continue to remain net short with close to around 67% of their positions on the short side. And if you look at it in absolute terms, the FIs, they are net short with close to around 50,000 contracts on the short side, while the clients, they are net long with close to around 50,000 contracts on the long side. So both of them at opposite ends, as we have been telling. Moving to the options data, then that's pretty interesting actually out there because there is signs that the call writing is continuing. The 24,900 call, well, that was fairly active in Friday's trading session. So a good amount of open interest addition out there. The 24,950 call as well, fairly active. On the downside, though, there was some put writing that did creep back in there. So you had the 24,800 put that did see some writing. So these writers, they'll be hoping that the 24,600 odd mark does hold out. But given the kind of call writing that we have seen, I've been talking about this reference point on the upside. 25,125, that's the important resistance mark. The bears will want to defend that particular mark. But what was encouraging in Friday's trading session is, for the last 6 trading sessions, we were making lower highs. However, that trend broke because in Friday's trading session, we made a higher high after quite a few trading sessions, which is encouraging. Which brings us to the levels. As I mentioned, the high that you're looking at is at around, you want to break this mark, 25,150. That's a resistance level. On the downside, last week's low becomes a bit of a resistance mark. You have the 20 DMA as well in this vicinity. For the Nifty Bank, the important mark is around this 56,000 odd mark. In the last 45 days or so, we have gone there numerous times, but we've not been able to conquer that. The fresh leg for the market moving up starts once we decisively conquer this mark. Stocks that I'm looking at is we have Trump's tweets with regard to UK and the duty is out there. It seems he's going a little bit easy for now. Normally we see that, Tata Motors is a stock that normally reacts to there because you have the Defender, the Discovery, both of them, they are, they're manufactured in EU itself. So I'll keep an eye out on Tata Motors because of what Trump had to say with regard to the EU. So that's a stock to track for the day.
All right, Nigel, thanks very much for that. So that's the setup as we see it. We have William Lee, Chief Economist and Executive Director at the Milken Institute, who's joining us now. William, good to have you with us here on the program. This back and forth with the EU, William, how do you see it? Will it follow the typical thing we've seen, a very high rate threatened, a lower rate, which is then walked back to a low rate and then something in between, and the market cheers because it's not as bad as what markets thought it would be? but it is higher than what it was before. What is your sense, William?
Well, if you look at the pattern of negotiations that have gone on up until now, you found that the partners with the U.S., those are the countries that really want to partner with the U.S., invest in the U.S. and produce in the U.S., like the U.K., Japan, they were received in a very friendly way. Even when there are some complaints about the speed of the negotiations, how they are getting stalled, they really were making steady progress. And then you had competitors like China, and even there, China says, well, we produce stuff so well, we don't want to produce in the U.S., and we're going to import it into the U.S., and we're going to pay these tariff barriers. And even there, you find that the type of barriers you're going to be facing are really quite limited. The minimum 10% tariffs and the fentanyl tariffs, which is a very special case. But now we have the EU. And the EU, I think, came up with an initial offer of, oh, let's go 0-0 tariffs. And of course, that's a joke because the GATT rounds and the rounds of tariff reductions we've had over the decades have reduced tariffs to almost nothing. And the real obstacle to trading with the EU has always been the non-tariff barriers. And the Europeans are masters at coming up with all sorts of legal and bureaucratic ways of keeping people out of their market and protecting their domestic giants. Now, you notice the EU has no tech industry. The EU has no source of real technological innovation of the sort that we see in Asia and of the sort that we have seen in the United States. So in some ways, the EU is just expressing to us the fact that they just are not willing to adjust their regulatory structures and their bureaucratic structures in a way that would be compatible with the kind of innovative investments that we really need for the 21st century high-tech industries. So that tells you something about the nature of the EU market. And I think the negotiations with them will continue to be very, very difficult because they really are very resistant to the kind of progress that a lot of the Asian and American companies really want to see.
William, morning. Thanks for joining in. The other development, I mean, I wonder how you read that. This whole directive, and it's a straight diktat to a publicly traded company, right? I'm talking about Apple, saying you don't make here, you have to make here. I mean, this reminds us of the license Raj era back in India, back in the 70s, and we've come a long way from there. The Apple stock was down 3%. But could this snowball into something bigger, or do you think the market will just ignore it and move on?
I think it's going to be something like what happened with the U.S. Steel and Nippon Steel merger. Donald Trump said, look, you can merge with any other company you want, but come on, this is such an iconic company, U.S. Steel. They reached an agreement where they just have massive amounts of Japanese investments. There's a lot of co-ownership, but it's not called a merger. I think Apple is such an iconic symbol of the tech industry for the United States. There again, it's going to have to be a very special kind of a deal. I think that's not representative of the other tech industries and other tech companies like NVIDIA that's making deals left and right. And I think those are the more representative type of deals that you'll see in the marketplace that the Trump administration is favoring. And Apple really is going to be like Nippon Steel, U.S. Steel. It's going to have to be a special carve out where Tim Cook's going to have to show we're serious about producing in the United States, not just a couple of MacBooks. And he's going to have to come up with some way of demonstrating his seriousness about moving high-tech industries and high-tech jobs into the United States, which is really the message of this administration.
All right. Hi, William. Good morning. Good to see you, Ben. Let's focus on the emerging markets. And India is, the question that I want to pose to you. How do you see things panning out here as an equity market? Well, we've got a little bit more expensive than the last time we chatted. But what's the outlook from here on? India, the longer-term growth story, while China, well, that's a more of a tactical play. Your take?
The Indian partnership, I think, is going to be a very special one. I think the Trump administration and certainly the Vice President Vance has made it very clear that the United States wants to treat India in a very special way. India, in some ways, is one of the few countries that trades with everybody, right? You're trading with the Russians, you're trading with the Chinese, you're buying also oil and all sorts of materials from all over the place. But because India is such an important producer and such an important alternative to China, it will be treated very, very differently. And I think we'll see that progress. For other emerging markets, I have to remind you again of the Lucas paradox. Lucas paradox, the Nobel laureate of University of Chicago said, money flows from where capital is least abundant to where it's most abundant, because in the advanced economies where capital is most abundant, it's also where capital is used most productively. That's where the innovations are. That's where the highest returns are. So in many ways, there may be a lot of portfolio readjustments and people wanting to diversify into emerging markets, but on net, we still see a net capital flow into the advanced economies from emerging markets. And in a way, that's unfortunate, but also it allows the emerging markets to really specialize more in the kind of industries in which it has a comparative advantage, rather than trying to leapfrog into these very, very high-tech, capital-intensive industries. But India, as I said, I think it's going to be a very special case where I think India is going to be allowed to do everything. And I think most investors are investing in India, not just as an emerging market, but perhaps as the one emerging market that's going to leapfrog all the others.
Okay, well, we surely hope that happens, William. Thank you very much for your perspective. Appreciate your time and look forward to a longer chat next time around. Thank you for joining in.
All right, well, time to slip into a short break. We've got a lot of stock-specific action to track for you. Get to that in just a bit in our special Top 10 segment, but I'll run you through the list. We're looking at JSW Steel, JK Cement, Narayana Health, GE Vernova, Jyoti CNC. They'll be reacting to positive news flow. As add to the list, Divi's Laboratory as well, but not what's going to be reacting negatively to the news flow will be NTPC, Glenmark, Eternal, as well as Afcons Infra. We'll keep an eye out on all of these names.
Wait. Welcome back. The picture across Asia is mixed, as we've been telling you, but it's more up than down. One would have to say the Hang Seng is the only market that's slightly lower, which is why the overall pre-open indication for us, that's the market that's actually down. The overall pre-open indication is that we could still be starting off positive. There we go, 66 points on the higher side as far as the implied open is concerned. Now let's talk about stocks, plenty of them as always. So let's straight away get to the CNBC-TV18 list of top stocks to watch. And guys, morning to all of you. Happy Monday to all of you. Nigel, JSW Steel, how does the performance look?
Well, the numbers were in line and the performance will improve from here on. And so that's why I'm going with green. The numbers should come up for you on the screen, what they've reported on a consolidated basis. That compares with our poll, more or less in line out there. The EBITDA number, well, that improved on a standalone basis as much as expected, came in at around 8,800 rupees per ton, which was our expectations. Focusing a little bit more on the standalone business, because that's where the majority of their value does come in from there. The volumes have improved out there, clock close around 5.77 million tons, so a bit of operating leverage has played out. Lower cost as well would have benefited them and some kind of higher realizations. And that's why, in fact, you have the EBITDA number that's improved by around 900 rupees on a sequential basis. So a thumbs up out there. In terms of the overseas business, well, in the US business, the plates and the mill business, it reported a positive EBITDA number, while you have the OI operations where the losses did come down by half. So the US business continued to report a mild net loss, though the losses have come down drastically on a sequential basis. So you like that. However, the Italian business, there was the order that got a little bit delayed, and that's why that reported a little bit of a weakish performance. What's good as well is because they've released some working capital, they've generated a good amount of cash. The debt number has come down to around 77,000 crores, which is a reduction on a sequential basis by around 3,000 crores. On the BPSL asset, they believe that they have strong grounds for availing all legal remedies. So we'll have to wait by to see how that pans out. But going by the numbers and an improved performance coming up in the coming quarter, I'm going with green on that one. In fact, we'll be connecting with the management of JSW Steel later on in the show at around 9:40 a.m. Well, let's go across to Vivek now to tell us about how NTPC's numbers were. Vivek?
Well, good morning. NTPC now slightly subdued state as far as Q4 FY25 is concerned. Now, numbers are restated on a year-on-year basis, but consolidated as well as standalone, a slight miss to the consensus expectations and even to our own poll. But looking at the revenues, largely higher by 4.5% on a year-on-year basis. EBITDA up 4%. Margins coming in quite steady at 29.6%. Profitability up by 24%, largely aided by the strong performance of both the subsidiaries as well as the joint ventures of the company, and this is something that aided the bottom line. Now, talking about the key takeaways from the conference call that the management held over the weekend. Number one, the company has missed the target for commissioning. The company had targeted close to 7 gigawatt of commissioning in FY25, but in line with most of thermal as well as renewable energy peers, the company managed to commission only around 2 gigawatts worth of capacity. Now, however, the company in the call has given a very strong guidance for capacity addition for both FY26 as well as FY27. 11.9 gigawatt of commissioning targeted in FY26. This includes the spillover from FY25 and 9.9, almost 10 gigawatt of capacity addition in FY27. So that is something that should aid. Overall a miss, so expect some red, but the guidance that the company is given should aid the stock performance here on.
All right, Vivek, thank you very much for that. Well, let's talk about Glenmark Pharma, which have been focused on the back of numbers as well. Ekta is here with details. Ekta, morning.
Morning. Well, definitely a miss in terms of Glenmark's numbers this quarter. 3,256 crores is what they've reported in terms of revenue. Margin 17.2%. Street was anticipating close to 19% in terms of margins. And the adjusted profit came above estimates. But if you look at the geographies, that was weak. India was flat on a year-on-year basis. US in terms of dollar terms was down to around $82.4 million versus $91 million year-on-year. Europe did well. It was the only shining star really. It was up 20%. But overall, the companies also missed the FY25 guidance. FY25 revenue guidance was 13.5 to 14,000 crores. They've come in at around 13,300 odd crores. And EBITDA margin guidance of 19%. They've reported 17.6% on an FY25 basis. Their call is at 8:30 a.m. More details there.
Okay, so Glenmark Pharma is going to be in focus as well. Back to Nigel then. Nigel, JK Cement.
JK Cement's numbers were good, actually. They beat Jefferies' estimates by close to 9%, and they beat, most brokerages in terms of, what they were expecting. So on the top line, good growth of close to around 15%. And guess what? The sales volumes numbers actually have come in by close to 16%. That itself is very, very positive. The operating profit as well jumped up by close to around 37%, which is telling you that there was a good amount of margin expansion, which should come up for you on the screen. On a sequential basis as well as on a year-on-year basis, it's up to around 21%, which is very, very encouraging. They've got some benefit because of power and fuel costs coming down by close to around 8%. And the PAT number as well has moved up because the finance cost has been more or less subdued. Now, what stands out is the grey volumes, as I said, grey cement volumes, that's up by close to 16%, which means they've outgrown what the industry has done. They've gained market share as well. And remember, all of this is organic growth. So that gets a thumbs up. The grey cement realizations were up by close to 3% on a quarter-on-quarter basis. That means they're doing something right with regard to the mix. And the standalone EBITDA per ton has clocked 1,265 rupees per ton, which is very, very encouraging. So going with green out here, and for JK Cement, what's good is in the last year, they've been in capex mode, yet the debt number hasn't ballooned up. And also on the EBITDA front, they've reported a more or less flattish number on an EBITDA front for FY25. That's much better than all of their peers. So going with green on JK Cement. But back to Ekta to tell us about Narayana Health. Ekta?
Well, good numbers for Narayana. The revenue was up around 18.4% on a year-on-year basis, 10.6% Q-on-Q in Q4. Margins improved to 26.1% versus 25.3% on a year-on-year basis. And the profit growth was around 3%. India was up around 11% year-on-year. India margins also improved for the company this quarter. The Cayman revenue was up around 50% on a year-on-year basis to 379.7 crores. They have expanded operations there and it's finally showing in terms of the P&L. So good going for Narayana.
Okay, all right. And we will, by the way, hear from the management in just a bit from now on the performance and, of course, the outlook going forward. GE Vernova and Jyoti CNC are the next two we want to focus on. Vamakshi is here with details. Vamakshi, morning.
Good morning, Prashant. Let me first start off with GE Vernova. The company reported a largely good set of numbers on the operational front. When you look at the revenue, that saw an uptick of almost 26%. This is slightly lower than what the street was expecting, mainly on account of the growth that we saw in the exports. The gross profit margin for the company improved by 912 basis points. The EBITDA margin came in at 21.9%, the highest seen among HV transformer peers. The net profit too saw a very strong uptick of almost 181% on a year-on-year basis. In fact, the management said that the endeavor is for the company to sustain the gross margins at this level or improve it further. The best is yet to come. As far as ordering activity is concerned, order inflow saw an uptick of almost 125% on a year-on-year basis, coming in at 2,990 odd crores, and the order book also stood quite strong at 12,660 crores. So given the kind of numbers that the company has given, good growth in ordering activity, going with the green for GE Vernova. The next counter I'm focusing on is Jyoti CNC. Good numbers out here as well. Revenue saw an uptick of almost 28%. The EBITDA margin too has improved substantially to 30.9%. This is the highest that we've seen in the last couple of quarters. But the net profit actually saw an uptick of only 9%, and that is because the effective tax rate was much higher as compared to the same quarter last year. Ordering activity, the order intake was rather weak, minus 17%. Order book, although saw a good uptick of almost 26%, but given the kind of numbers the company has posted, going with the green for this counter.
Okay, all right. So two green stocks coming in from Vamakshi over there. Thanks for that. Back to Ekta then. She is very busy this morning. Ekta, Divi's in news as well. What's happening?
Well, they've signed their third long-term supply agreement, so that's a positive. They've signed their long-term manufacturing and supply agreement, which is with a global pharma company to manufacture and supply advanced intermediates. The company said that they're expecting meaningful revenue contribution from this agreement. They're not permitted to disclose the name, but nonetheless, there will be some amount of capex which will be funded by the company itself, by the global manufacturer who they've tied up with. So overall, definitely positive news considering it's the third long-term agreement signed by the company. But remember that the stock is very expensive, trading at around 67 times FY26, 56 times FY27. So maybe that could, maybe cap a little bit of enthusiasm, but nonetheless, positive news.
Okay, all right. Got that, Ekta. Thank you very much. On to Vivek then. Eternal could be news because of certain index changes and flows. And Afcons, I think, is on numbers again, weak numbers there. Vivek, morning.
Well, good morning. Absolutely right. So first, let's focus on Eternal, or earlier known as Zomato. So in line with what we had anticipated, given the fact that the company had gone ahead and restricted the foreign ownership limit to 49.5%. Both the passive index managers, both FTSE as well as MSCI, have gone ahead and announced weight reduction in the indices for Eternal. So now this particular weight reduction for FTSE will happen on May 27th and is expected to lead to outflows of close to $380 million. The MSCI weight reduction is expected to happen on May 30th, and that is expected to lead to outflows of close to $460 million. Remember, the flow estimates are as per IIFL Capital, but given this particular overhang of passive selling pressure, expect a red on the stock, at least at the open, as far as Eternal is concerned. Now, coming to Afcons Infra, like you mentioned, muted said, first up, if you're looking at the guidance, the company had guided for a flat to marginal growth on the top line. However, for FY25, the company has seen a degrowth of close to 4.5%. But looking at the Q4 numbers themselves, very muted. Revenues lower by close to 11.5%. EBITDA down by almost 17.3%. Margins too compressing almost 60 basis points, and profitability down by 23%. The one solace is the fact that the order book remains quite strong at a little over 36,870 crore, and the order inflow as far as L1 position for the company is too quite steady at over 10,650 crore. Company says that they expect to deliver confident, sustained top-line growth while maintaining a sturdy margin profile In fact, in an earlier call, the company had expected 20 to 25% top line growth for FY26, but at this point of time appears to be a steep ask.
All right, Vivek, thank you very much for that. So lots and lots of stocks on the back of numbers to watch out for. Well, just quickly recapping our list of stocks here. So stocks with positive news flow are JSW Steel, JK Cement, Narayana Health, GE Vernova, Jyoti CNC and Divi's Laboratories. Well, stocks with negative news flow are NTPC, Glenmark, Pharma, Eternal and Afcons Infra. All right, well, let's just quickly tell you the most important news flow around commodities as well. Manisha is here as always. Manisha, morning.
Morning, Prashant. Thank you for that. Well, a couple of things which seem to be supporting or a risk on in case of commodities. One is Trump announcing a delay of 50% tariffs on European Union. And the second is the US dollar index coming off its highs and dropping below 99 right now. That seems to have supported the crude oil prices to gain for a second straight day. But it also has to do with the rising geopolitical risks in Middle East. Israel military says that they are planning to capture 75% of Gaza Strip in next 2 months. So these kind of statements clearly has had a premium building up in case of crude oil prices. But the decline in dollar and the China stimulus measures has been supportive for metals. So right now, copper is trading 0.5% on the higher side, and the support also comes in for aluminum and steel prices. The precious metals also have gained. Remember, we saw gold prices gain up 2% on Friday. Gold gained up by 5% in the previous week, and this was the best week in 6 weeks that the gold has put out. So, well, yet again, the tariff concerns, U.S. statements on Apple, Harvard, concerns on high U.S. government debt, sell down in treasuries, and of course, China importing gold at 11-month highs for the month of April has been supportive as well. So even as the U.S. markets are shut today, it's a long weekend there, we are looking at Asian markets starting quite strong when it comes to many of these commodities.
Okay, all right. Thanks a lot for that, Manisha. For the time being, we slip into a short break. On the other side, we have the management of Narayana Health that's going to be detailing their Q4 earnings. Stay with us.
Investing.
Welcome back. Let's get to some corporate conversations then. Lots and lots of companies have been reporting numbers over the last couple of days, and Narayana Health is the first one that we're speaking with this morning. Now, Narayana reported a strong set of numbers for the fourth quarter. Revenue and margins came in healthy. Growth was driven by higher domestic volumes and better realizations as well. We have Sandhya J, Group CFO at Narayana, joining in now for some perspective on how this year looks like. Sandhya, thank you very much for joining in, and congratulations on what's been a good quarter for you. I think both India as well as the Cayman facility, which is up and running, they've all been firing for you quite well. So let's just break this down. I mean, if you could tell us how much of the growth was driven by higher volumes, I mean, to what extent have you seen volumes rise in the fourth quarter? And how much is pricing led? And again, some indication of where these two trajectories will be as we look at the start of this year.
Good morning. Thank you for having me here. So for this year, like every year, our pricing has two parts. One is the price increase per se, which we have taken on 1st of January. We take a low single-digit price increase. So some of the growth has come from price increase, but a large part of the growth has come from realization. That is better payer mix, more high-value procedures, and volume increase as well. On the volume side, the domestic volumes have been quite healthy, like we've reported out. We did have a significant impact on Bangladesh. So if you look at quarter four alone, Bangladesh was a year-on-year 53% decline, whereas the domestic volumes have been very healthy, upwards of 15%, and that's kind of given us the balance in terms of performance.
Okay. The average revenue per patient apparently is up 13%. I think year-on-year it's up 13%, 9% quarter-on-quarter. Can you give us some sense of occupancies as well, and where you are expecting these metrics to stabilize, say by halfway down this year?
Sure. So our occupancies normally range in between 60 to 65%, and I think that is where we will be, because we don't look at occupancy as the key measure, but more throughput. And you would see that we have not added any bed in the past several years, but you've seen improvement across all our parameters, whether it is our margin performance or our ARPP, ALOS, and all of it is coming because the focus is more on throughput. So from an occupancy point of view, we are not guiding anything different. In terms of ARPP per se, the price increase driven ARPP will be small because we have taken a small price increase. We will continue to show growth like we have shown in the past, driven by higher realization procedures and driven by payer mix optimization.
Okay. Margins, I mean, so is 25% a very stable level that you are at, and do you think it will be here? Or could you actually see improvement this year in the EBITDA margin?
As far as the India margins are concerned, Q4 we finished 21.5%, and as a whole, we do want to continue to expand on the India margin side. So you will definitely see improvement in the India margin going into FY26 also. Cayman will probably stabilize at this level.
At 25%?
Overall, at a group level is 25%, yes.
Okay. So we should expect some stability there. Just a word on the new hospitals, the one in Gurugram, there's one in Dharamshala. What is it that you're expecting there in terms of break-even timelines, throughput levels, as you call it? Just some guidance out there, and some sense of capex that you might be incurring this year also. Just give us a sense of the cash levels in the company and the capex this year. Will it be lower because you've already been, you've launched several new facilities already last year?
From a Gurugram and Dharamshala performance point of view, Dharamshala has broken even. It delivers a reasonably healthy EBITDA. Gurugram has had broken even in Q4, and we are hoping that we will be able to start generating positive EBITDA in Gurugram in FY26. As far as our capacity is concerned, we have added capacity only in Cayman in FY25, and we have announced a large capex plan for the next 4 years. So we have already announced about 2,000 beds at an outlay of 3,000 crores for India, and we are looking at more opportunities. So a large part of those spends will come over the next 3 years. The land acquisitions have happened for many of those investments. So almost 20% of this outlay is already spent because of the land investments we have done. And then the build out will happen. As far as Cayman is concerned, there I agree with you. We have completed our capex, and you will see very, very small maintenance capex in Cayman. But there the capex outlay is completed.
So the total outlay is 3,000 crores over 3 years to add 2,000 beds, right?
Yes, at the moment, yes.
Okay, and how much of that will be incurred in FY26? And against that, what is the cash level? What is the existing debt level?
So our current debt, net debt to EBITDA is 0.15, so which means we're very, very healthy in terms of debt. And we are also holding a high cash balance as a group. So therefore, we will, at the moment for the current year, I don't think we will breach our aspirational net debt to EBITDA of 2. We aspire to stay under it through the capex period, but if there are some periods where we have a very good opportunity that we need to go after, we may temporarily breach that limit. But at the moment, we are looking to stay under a net debt to EBITDA of 2.
Okay. All right, Sandhya, thank you very much. Lots of details there. Quite helpful. Thank you for joining in, and good luck with the rest of the year as well.
Thank you. Thank you for having me here.
Okay, all right. That's Narayana Health at the end of the fourth quarter. Let's move on and welcome in Prakash Diwan. Talk about individual stock ideas, fundamentals as well. Prakash, good morning and happy Monday to you. Since I was just talking with Narayana, let's start there. The healthcare space, hospitals, healthcare. Any interest? Do you like any of the stocks, whether it's Narayana or maybe the larger players like Apollo?
Good morning, sir. Lots of interest in Narayana itself, and NH has been one of my favorites within this so-called crowded space. And what I love about their business is the uniqueness of the business model. While it's been expanding in terms of not just being asset light, it's actually in a way where they have amazing pricing power. They started with very low price points, started moving into higher end realizations, so throughputs. And remember, the percentage of robotic surgery is going so majorly, it's moving up, and that's very high margin. So if that were to kind of continue galloping the way it is, you'll probably still see some improvement happen in the quarters to come. So absolutely right. And this has bucked the trend. You look at whatever happened to the rest of the market, this was still making 52-week highs. We spoke about it at about 1,100 just about less than a year back, and look where it is today. So I think it's something which you should look at seriously if you have allocations deemed for the sector. The rest of the companies in the same space are struggling because of very high capex. Their ROCs are still kind of not as robust. So great franchise, great business model, and great financial metrics. So very, very positive with this.
Okay, all right. Hi, Prakash. Good morning. Let's talk about a couple of these nifty companies that came out with a set of numbers. JSW Steel, the numbers look pretty okay, actually. Good improvement in the EBITDA per ton on a sequential basis. And what's encouraging is they've got some benefit of lower coking coal costs in the past quarter. They'll get another $10 fillip in the coming quarter. And they'll also get a price increase of around 2.5 to around 3,000 rupees per ton, which will make the EBITDA per ton look even better from here on. Your view?
Oh, absolutely, Nigel. Good morning. So it's a company that doesn't make staple steel or regular steel from 100% of its capacity. I think it has the advantage of making special steel as well, and specialized steel is something which will start continually seeing a lot of offtake given how some of the infrastructure growth is happening around. And remember, the global setup is just getting to be much more positive for metals and even steel. It's not restricted to just copper and aluminium. And if the EU is going to struggle to be able to kind of set tariffs, in a favorable band with the US, given whatever is happening, though we've seen an extension and all those. But I think a lot of steel making from India will start kind of making significant strides from a global context as well. So and then some of these companies like Tata Steel, JSW are now fairly well diversified in terms of geographies as well. So you will have some advantages that roll in. So I'm quite positive. In fact, it's a very decent set of numbers given how things could have been on such a large balance sheet. So they managed to kind of pull it off. And I think it also sets the tone for this continuation of improvement to happen. So with this, without any dramatic price hikes and any dramatic increase in the market demand for some of this special steel. So fairly moderate quarter with stellar. That's where the advantage is. The correction that you saw in the steel companies, Nigel, that's in fact the advantage that you had to kind of get in, because this is a sector, once it takes off, it at least does well for about 18 months. So, these numbers tell you that it could probably be good times for most of the steel players, and this could lead that improvement from here.
Okay, all right. What about cement, Prakash? You got JK Cement. The stock is not particularly cheap. It's very close to its 52-week high. The numbers were good. The EBITDA per ton has improved. The net debt, they've kept it more or less at a stable number. And they're already talking about capacity moving to around 30 million tons, which they've already laid out a fixed plan out there. What's your view on JK Cement? And also, I wanted to ask you about the other one that's not very cheap is Ramco Cement. The numbers are disappointing. You had a big fund coming in then buying a few lakh shares at around 1,000 rupees per share. And that's why Ramco, from standing in the red, in fact, went in the green. What's your pick from the pack?
So, no, you're right. JK comes expensive for sure. And I think it's more because the market's looking at what's in store for them. Their commentary has been fairly positive. And, they've probably taken a leaf from the Shree Cement copybook. I mean, keep growing organically without much of debt increase. And that kind of starts paying off. It takes a little bit of time in terms of, execution, all your expansion. But they have access to raw material. They have something which they can do in terms of, a lot of the places that JK is prevalent in. They have access to the backward integration possibility. So I don't see any reason why they will not be able to implement this. And if this is being done with such a low leverage, it's great. Ramco, I don't know. It's probably a bit of that float issue. A lot of buying that comes through, large buying on a particular day, and things look very differently. But the numbers, as you said, are not definitely very encouraging. Out of the pack, over the last few months, what I've noticed is that the larger players have actually started turning out to be much more dependable if you were to make some allocation as the sector starts re-rating itself. There have been some price hikes. You'll probably see much more concerted, east and southern markets kind of rev up. But Shree Cement is something which I want to point out. It's something which has done exceedingly well. It's usually expensive to buy, but it's worth paying that premium because it probably keep improving year on without any blips. So, and then of course you have the ACCs, Ambujas of the world to choose out of. But I would believe it. I would stick with the larger ones this time and not those small Dalmia, Bharat, Sagar. Or there's a lot of activity that was around built around those names. But I think now the focus is going to be on sheer market growth, volume growth, and that's where the larger ones would probably be better off.
Okay, all right. So stick with the big boys. That seems to be the call. Prakash, got it. Thanks very much. Shorter chat today because of lots and lots of earnings,
Yes,
but we'll
no
connect
worries.
again soon. Thank you very much for joining in. Need to take a quick break. On the other side, we have our technical experts joining in. Sudarshan Sukhani joins in with some thoughts and ideas, and we'll be back. We'll have the pre-open as well in just a bit.
Welcome back. Hope you're having a good morning. As promised, let's get straight to our technical expert. Sudarshan Sukhani joins us on the show. Hi, Sudarshan. Good morning. Good to see you in. It's a beautiful rainy day here in Mumbai. But what's your sense with regard to the markets? We had a good trading session on Friday, actually. We continue to remain on the range. The levels you're looking at and the trade on the Nifty.
Good morning. Well, it could be raining in Mumbai, but it's a very dusty, stormy day in Delhi. And you must have read news that, Delhi, once we have 15 minutes of rain, the whole city gets inundated. Well, that's different.
Stay safe, Sudarshan.
I'm sorry?
Stay safe.
Yes. Now, the markets are cheerful. Last week, we had a lot of volatility, and that volatility has ended with the Nifty actually finding support. Now, the support levels had broken down. They bounced back. All that is part of that process where the market is finding its feet. But on Friday, I had suggested that we should be long, and that view continues. See, that doesn't mean we won't see volatility. We could easily see wide, sort of unknown swings. But the broad theme is that the Nifty should slowly inch upward. And I think that this time, this week, and maybe this week and next week, we will see significantly better momentum on the upside. So if you are long, stay long. If you're not long, look for every dip to go long. Your stops, your exit levels are 24,600, below which you say, okay, it didn't work out.
Got that. Sudarshan, morning. In terms of specific trades, what would you have?
Well, I have a lot of buy ideas and one short sell. I'll start with the short sell. Coromandel is an intraday short with a stop above 24.30. ITC is a buy, and that is happening because a lot of these FMCG companies are now coming in the buy list. ITC is just the latest one. Buy with a stop under 430. Bajaj Finserv is a buying opportunity. I've been favoring NBFCs and banks, essentially the financial space, and this is part of that. It's a buy Bajaj Finserv with a stop under 2000, and SBI Life is my fourth and last buying opportunity. Or rather opportunity, buy SBI Life with a stop under 1760. 3 buys, 1 sell, focus on the buys.
Okay, all right. Thanks a lot for that, Sudarshan. Well, for the time being, though, we'll slip into a short break. On the other side, we'll get chatting with the management of Ashok Leyland. Stay tuned for that conversation.
Okay, welcome back. There's about 14 seconds to go for the 14 minutes to go, beg your pardon, for the market open. The pre-open, though, is just a couple of seconds out, and we'll have the rate starting to appear in just a bit. Now, Ashok Leyland reported a good set of fourth quarter numbers. Profits were boosted by tax revenue. Total volumes were up 5% on a year-on-year basis. We are now joined by Shenu Agarwal, MD and CEO at the company, to take some questions. Mr. Agarwal, great to have you with us here as always on CNBC-TV18. Now, fourth quarter was, as expectedly, strong for you. But over FY26, estimates from most auto bodies are not reflecting a bright picture. What would be your estimates for CV industry for this coming financial year, this financial year?
Oh, actually, then I would have to say that our view is very different, because we are very optimistic about FY26. Especially if you look at the momentum that was created in Q4 of FY25, where with the CV industry, the medium and heavy duty industry grew by about 4%. I think that's a signal of the times to come. Right. So overall on FY26 basis, we think there are a lot of factors that are going to move in the positive direction. The interest rates have already come down a little bit, and there is a hope that they will further come down in future. The macroeconomic activity also is in our favor, especially some of the sectors like steel, mining, etc. are going to really grow this year. Also, we are seeing that replacement demand should start showing up this year, because we are sitting at the all-time high aging of the fleets, right? So monsoon prediction is also very, very good this year, right? So I think there are a lot of factors which are going to drive the growth in the industry. FY25, you would recall that Q1 had actually a 10% growth, right? So in Q1, we are sitting on a slightly higher base, and therefore you wouldn't see maybe that much of a growth in Q1 this year. But from Q2 onwards, and last year Q2, I would remind you that last year Q2 had actually degrown just because of the slowdown of the capex in the government and some effects of the erratic monsoon, right? So I think from Q2 onwards, we see a lot of optimism in the way the industry would behave. And therefore, overall on FY26 basis, we continue to be positive.
All right, Mr. Agarwal, good to hear then that you're going to be positive. But do you expect FY26 to be better than FY25 for the entire CV industry? And what would the growth expectations be for the industry?
Listen, it would be different in different segments, right? So I think buses would definitely continue to grow. In the medium and heavy duty segment, especially in some of the segments like tractors and tippers, we think there would be fantastic growth in the industry. But overall, if you say, I would say MHCV should grow in kind of mid-single digits in FY26. But the overall CV industry, including LCV, etc., I am really hoping that it would cross its earlier peak of FY19. And it should cross that 1 million mark that we have been waiting for a few years now.
Mr. Agarwal, morning, sir. Let's also talk about margins and profitability, right? Because in the fourth quarter, you have seen your margin coming towards your midterm target range of around 15%. But overall, for the year in FY25, your margin at 13% was still below your own aspirational trend line. So can we expect margins this year in FY26 to get to that level of 15%?
We would continue to focus on EBITDA margins, and we will continue to increase on year. It still may take us 2 to 3 years to reach that mid-teen EBITDA objective, but I think we are like very much there. At least if not in numbers, because we are still at 12.7, but at least in our path, in our journey, you could clearly see that in last 3 years, we have moved from 4.1 to 12.7. And we would definitely like to continue on that journey. Now, see, our levers are going to be same, right? I mean, what we have used for last couple of years. So we are working on these 3 levers. Number 1 lever is what you said, premiumization, which basically means generating or garnering ability for us to to have a higher revenue per vehicle, right? So that can be done only if we offer extra value to our customers. So customers are happily paying more to us, right? In that sense, we have really worked on a lot of initiatives on the product and technology side. Many of these are already in the market, and many of these you will see that will come to the market over next 1 year or so, right? So that is one part. The second lever is the lever of cost. You know that Ashok Leyland is a cost leader. Our cost per vehicle is the lowest in the industry, and we think it is a great strength, and we don't want to lose on it. Rather, we want to build strength over strength as far as cost is concerned, right? Therefore, even after 3 years of successive good cost savings, both in material and non-material cost, we would continue on that journey, even in FY26. And we still think there is a lot of potential for us available to further reduce our material cost and also some other costs. And the third lever is the lever of after-sales service. We told you last time that we are embarking on a journey or a project we have started within Ashok Leyland, where we want to target delivery of best-in-class service to our customers after the sales, right? So that project is already in action. You will start seeing results over a period of time, but the focus or the strategy is the same. So premiumization, cost leadership, and best-in-class service.
Mr. Agrawal, how is the commodity trend looking in Q1 of FY26 after almost a flat quarter, which we saw in Q4, the quarter for which you've reported numbers?
Yeah, there are some challenges emerging, as far as commodity costs are concerned, especially on the steel side. The government, as you would be aware, they announced a safeguard duty on steel, which has resulted in some increase in the cost, right? And steel being 60% of the commodity that we use in a truck or a bus, it has a significant impact on our cost structure. So there would be some challenges that we will see in Q1, right? But we do believe that this is a temporary phase. Even that safeguard duty that government had announced is only for 200 days, right? So we will see starting Q2, sometime in Q2 or early Q3, we will see it neutralizing back to its original position, right? In any case, some other commodities like rubber, which is also a significant cost to our industry, is it is getting softer a little bit. Last year, rubber had increased by about 7 to 8%, but now it is getting back to its original levels, right? So there is a mix, although there is a concern about steel, but some other commodities, will help in the favorable manner. Also, our internal actions on cost savings, etc., are continuing, right? So we do believe that we should be able to neutralize it, although there would be a little bit of pressure in Q1 maybe. But I think from Q2 or Q3, this whole thing should be behind us.
Okay, all right, got that point. Finally, sir, what's the update on the Hinduja Leyland Finance IPO? Are we going to see it in this year, first quarter?
You are right. I mean, we were really expecting it to list by Q1 FY26, but unfortunately, some of these approvals are still pending. Some of them we have received, but a few are still awaited. Now, every time we give you a call give you a timeline, hoping that these will come, but these are not necessarily in our control, right? But at this point in time, we are again very hopeful that these approvals should come within the next few weeks. And therefore, after that, it will not take us more than 2 months to list the company. Right, so I know we are slightly delayed on that estimate of Q1, but things are progressing well, right? So it will happen very soon. We'll give you more news when we have the approvals.
All right, Mr. Agrawal, we'll leave it there. Good luck as you continue to navigate, the changing environment. But of course, intrinsically, much more optimistic estimates and the way of looking at the industry growth as compared to some of these industry bodies, etc., which we started by citing. Thank you again. Well, Gautam Trivedi is now joining us. He's managing partner at Nepean Capital LLP. Gautam, great to have you with us here on the program as always. You're back from the US. You've been back. You were attending the Berkshire AGM. You attended the Berkshire AGM, but then, of course, spent some time meeting global asset allocators, investors, etc. there.
Yeah.
So the question really is about the feedback that you got with regards to flows into India, which has been strong. Foreign flows have been strong over the last month and a half or so. Is it likely to continue? What is the mood like?
The mood actually at the margin is starting to get a lot more positive than when I first met a bunch of people in New York when I first arrived. And then I was in New York right at the beginning and at the end of the trip. And I think the mood within that 2.5 week period itself actually underwent a pretty significant change. The good news was that the India-Pakistan conflict really was not on anybody's radar. People, of course, were aware of it, but the fact is the local media didn't, report that much of it. More importantly, it got overshadowed by a bunch of domestic news. The U.S. to China tariff wars that was still ongoing at the time, and other local issues really were more important. So as a result, I think the positivity on India, I think, pretty much continues. Now, with respect specifically to your question on flows, and are we going to see significantly more money coming in? Well, the fact is, we did have a dip within the first quarter in terms of the absolute Nifty 50 and the market as a whole. The good news at the time was that that correction led to India becoming a little bit more reasonable from a valuation perspective. But again, it's climbed back up. So unfortunately, we're not cheap anymore. We were cheap briefly, but we're not that cheap anymore. But I see money coming back into emerging markets for sure. So if I look at one statistic, and that's an important one, foreign ownership of the US equity markets is at a record high of 18%. And given the weakness in the dollar that we're starting to see, I think money is starting to flow out. The first stop usually is Europe, so it's not as if it's all coming to EMs. But increasingly, I'm hearing of allocations coming to EMs. And of course, you will see some of that overflow coming into India.
Yeah. Gautam, hi, great to have you on. And I'm glad you brought that up because that was exactly on my mind. Flows coming into India is one thing, but the other part is what's the sense you picked up speaking to all these people in the US about the US market itself? Because look at the tweet storm, right? I mean, every weekend, every other day.
Yeah.
And I just keep going back to the Apple story as an example. It's not just about, whether the Apple stock is going up or not, but it's the administration today, picking up the phone and telling a listed large public traded company what to do and what not to do. So I don't know, what is the overall sense on US equities, and will there be a greater outflow away from US assets, whether it's bonds or equities? What's the sense you got on that?
Yeah, so it's a good thing you brought up the subject on bonds. And one thing that was clearly evident from the 3 weeks that I was there, that inflation is completely raging. I mean, it is literally out of control. Whether it's eating out, whether it's hotels, everything was sold out. And I'm not just talking of New York City because that's a little deceiving because the rest of America doesn't necessarily mean that what's happening in New York is happening in the rest of the US. But the reality is that we went off to a few national parks like Yellowstone. Hotels are sold out. And this is even when we were 3 weeks ahead of the tourist season actually beginning. So travel is booming. We took 8 flights in the 3 weeks that we were there. Every flight, there was not one seat left. So this Memorial Day weekend, which is ongoing right now in the States, AAA estimates that 45 million Americans will travel 50 miles or more from their home. So that itself is a record high. So I think if you look at overall, I don't see the ability of the Fed to actually cut rates. That's my personal view, and that's some of the view that was shared by the people that I met. I think that the feedback that's coming in, if you look at the first quarter numbers of the S&P 500, they were blowout. So first quarter net income growth for the S&P 500 was as high as...
We'll just come back to that point, Gautam, just a second, to whether the economy is continuing to boom or not. Just allow us, I think 20 seconds, I think we're getting into market opening, and the pre-open suggests about 60 points up to begin with at least.
60 points, 200 points in the Sensex, and it's looking like a good open. And we'll have to pick it up from there. So lots of stocks to track, and we'll look at indices as we always do, and then we get down to individual names. About 0.25% higher on the Nifty, 24,900. The Nifty Bank is up about 1/3%, 55,600. The Sensex is up about 0.4, small cap index is up 0.8, and I think the mid cap index will come up on your screen as well, which is up about 300 points there, 0.5% or so. So this is a good-looking start to a fresh new week, and nothing to complain. 20, almost 25,000, by the way, on the index at this point in time after Friday's bumper turnaround. After a couple of sluggish sessions last week, Friday turned it around. And this morning, it looks like there is continuation. So just 3 names on the Nifty are lower. One of them is Indocin. Internal, of course, we highlighted as well. And everything else is starting up in the green. Surabhi.
Okay, up and about. But I must point out the result casualty of the morning is Balakrishna Industries. Look at that stock. It's starting 10% lower. And we'll talk more about the earnings hits and misses in just a bit because it's been a slew of mid-cap earnings. But that is a nasty-looking cut on Balakrishna. Anyway, on the large-cap screen, 130 points higher on the Nifty. That's what we've got. And M&M is in leadership position, 1.5% higher. Power Grid, NTPC looking good. NTPC, despite lackluster fourth-quarter numbers, still looking quite okay this morning, 1.5% up. ICICI Bank, Ultratech Cement, Hindalco, Tata Motors, Nestle, ONGCs across the board, Trent, Titan. You get the drift. It's cutting across sectors and most pockets are looking strong. Banks are definitely helping the Nifty's case because the Bank Nifty is chugging along at an even better pace, 0.6% higher on the Bank Nifty. SBI, for instance, Axis Bank, all these names are on the upside. In fact, there are only 2 stocks that are negative on the Nifty. One is Eternal, and that's a flows issue because the index providers, FTSE and MSCI, have lowered their, their weighting on Eternal. That stock is down 3.5%. Other than that, everything is positive on the Nifty, 160 points and 25,000 on the board. Nice.
Well, that's right. Just take a look at a few stocks, though, that are bursting away from the broader markets. GE Vernova. The revenue was a little bit subdued, but margins are around 21.9%. That's the highest among the high-voltage transformer peers. And that's why that stock is locked up. I think it's up close to around 10% as we speak with pending buy orders. So big move is what we're seeing on GE Vernova. So big one out there. Kolte Patil, another one that came out with a good set of numbers. So that stock as well is flying away. Large volumes, Kolte Patil is up close to around 8%. Transrail Lighting, revenues grew by 40%, EBITDA went up by 41%. They reported the highest ever revenue, EBITDA, PBT, PAT in the history. So that's great news. And they've got a good, healthy order book as well, which will serve them in good stead. So explains why that is up 5.5%. Keep in mind, the stock ran up a good deal, ahead of its numbers, but yet it's higher. A few more stocks that deserve a special mention that are moving up in trade. You have Reliance Power. Actually, the first tick was quite good on rather large volumes. So that one should come up for you on the screen. Let's see what it's doing. Reliance Infra, actually, the numbers were quite good. I don't know what that stock is doing because it already had a big run up, in anticipation of those numbers. So big move is what we saw on that one. Reliance Power is up close to around 4% on large volumes. Reliance Infra actually has come in for some profit taking. And JK Cement, pull up that stock. It's up close to around 5%. I told you the numbers were very, very good. We'll wait for the management commentary as well on the con call later today. But otherwise, the street likes it, up close to around 5% on that one. So good looking screen. Nifty up 150 points. Nifty Bank moving to that crucial 56,000 odd mark. That's the resistance zone. We'll have to keep an eye on that. Advanced decline ratio firmly in favor of the number of stocks advancing.
Absolutely. And, it's looking strong, very, very strong across the board. Just a few other names before we go back to Gautam. You got R Power. Basically, the ADAG, Reliance Power and Reliance Infra were the number 1, number 2 volume lead gainers on Friday. And R Power is back there, 2.5%. It's got humongous volumes for this point in the day. Already. I think we highlighted Divi's. Transrail also is up 7%, 611 on Transrail, again, on the back of numbers which came through. There is MCure, which again reported numbers, and I think have this management later with us today. MCure is up another 8%. It's moved from about 1,070 to $1,400 in basically 2.5 days. I mean, today being the third day. So tremendous gains. Shilpa Medicare is coming up with about a 6% pop. And it's got volumes behind it as well. You just heard from the Narayana management. Narayana is up 4%. Stocks at about 1,800. Narayana Hrudayalaya. NetWeb has been having a pretty decent last few sessions. 3.5 here. 1,862 on NetWeb. We had Nilesh Shah, by the way, of Envision, who was talking about NetWeb as something he likes on the Editors Roundtable on Friday. Phenolics Pipe, ITD Cementation, Shakti Pumps is coming up with a 6% pop. It's got decent-sized volumes as well at this point in time. So, yeah, I mean, there is a lot happening with regards to specific names that you want to look at. Premier Explosives is down about 7%. So that is coming off the high 3 days back was 621. Stock's at $500 now. So it's given up over 100 rupees very, very quickly. But it had an explosive move on the way higher. And HBL Power, HBL Energy basically is down about 4% as well. They do battery systems, etc. A bunch of businesses, 553 or so on HBL. Honasa is the other one on Friday, which had a rocket move, which is giving back about 4% of that move right now. So that's basically the broader markets in focus. 170 points higher on the Nifty. So it's a good start. Surabhi.
Yeah, I just want to add one more stock, Dreamfolks. Bad numbers for the fourth quarter. It's down about 7%. Dreamfolks down about 7%. The other one is GNFC, which had very good numbers. So GNFC is up about 7%, 6-7%. So lots and lots of individual stocks that are moving around today on the back of news flow or on the back of earnings. Okay, let's go back to the conversation with Gautam. Gautam, sorry, we just ran into market opening there, but if you could just complete the point. So from whatever you're describing, it seems as of now the US economy on ground is definitely booming. So I go back to that question. So US equities and bonds, you know, does the money stay or will it keep looking for other homes? And then we hope one of those homes will be India.
Yeah, I think let me complete the point I was making with respect to the S&P 500's net earnings. So the first quarter net earnings grew as much as 12%. Now on the Max 7, but I would say Max 6 because NVIDIA reports on Wednesday, the 28th. So the Max 6 have reported an average earnings growth of 28%. And the other 493 stocks have actually grown by as much as 9%. So that's exceeded consensus earnings estimates by as high as 16%. So that tells you that the domestic equity market is still going very strong. There are no significant signs as yet of it slowing down. But like I said, any weakness in the dollar will prompt money shifting out of the United States and going offshore. So hopefully we should get a slug of that. And, we've seen some of that come through, about $5.5 to $6 billion since the lows in April. So I think there is more momentum for money, valuations notwithstanding.
Okay, all right. Hi, Gautam. Good morning. Good to hear your thoughts as always. Gautam, what's the top theme that you have, as we speak? Because the headline index, it was a little cheapish, but we've had a good 15% run from the recent lows. The pockets of the market still are very interesting and there are longer runway out there. I think power is something that you liked. Some of those EMS companies in the past we've spoken about as well. What's the one top theme that you could share with us?
I think power remains a multi-decadal theme in India, and it's not just driven by domestic power consumption, i.e., electricity and lighting up homes, lighting up, factories. Also by the fact that at the advent of AI, and, I think I may have said this in the past, but a simple Google search, if it takes 1 unit of power consumption, an AI search takes 10x that. So you are invariably going to see a situation in a country like ours where we have 750 million smartphones. Everyone now knows, has an account with OpenAI or with Perplexity or any of the other AI models. So I think consumption of that will significantly go up, or power will significantly go up. The other element that's going to cause the need for power is data centers. And the Indian government is very clear. They want to localize the content of Indian citizens in India and not have it sitting somewhere in Palo Alto or Arizona. So given these complexities, I think you will see the consumption, all aspects of the power industry, whether it's generation, whether it's transmission or distribution, having a multi-decadal growth story. So power would be my number one pick as a sector.
Okay, so power, a powerful theme, says Gautam. Got that point. Overall, Gautam, we've discussed the US in great detail. Overall, while you single out power, what about earnings here? Quality of earning. You just told us that, in the US, earnings expectations are getting beaten by 16%.
That's right.
Here, we are struggling to avoid downgrades, though this quarter seems to have been a lot better. We don't have too many earnings casualties, but what's the sense from a growth perspective? Just looking for growth. What could perhaps stand out over the next 6 to 12 months?
So, Surabhi, you raise a fair point that the growth in the States is as high as I discussed, average of 12% for the S&P 500. So if you're an allocator sitting in the US, you think twice about putting money into other markets when your own home market is giving you such stellar results. But having said that, I think there is a need for diversification. So the money will flow into EMs, will flow into India, no question. As far as domestic earnings are concerned, I think, yes, we still haven't gotten out of the dull phase that we've seen over the past about 6 to 7 quarters, where earnings are not able to climb into the double digit. So my view is that we need still more government spending, private sector spending, with the exception of the top maybe 7 to 8 industrial groups. We're not seeing that much spending. Even if you look at the bank's results, Axis Bank loan growth was 8%. HDFC Bank tepid, loan growth of 4%. So 2 of the biggest banks in India are not lending to corporate India, which means corporate India is not necessarily borrowing. And that sort of is a spiral of why we're not seeing that CapEx hit the ground and generate more jobs, generate more production. So of course you've seen Kotak Bank, which had a great loan growth of 16%, but then again, corporate side is only 21% of the loan book. So I think we still have to hope and wait that the government spending picks up. A lot of the research reports that I've been reading over the past few weeks indicate that should pick up momentum in the second half of this year.
Okay, all right. Well, with that hope, we wind up the conversation this morning. Gautam, pleasure having you on. Thank you very much, and very interesting insights coming in there from your US trip. Thank you for joining in. Well, let's stick with the earnings then, and lots of numbers have been flowing in. BEML is the next management on our radar. The numbers came in slightly higher than estimates for the fourth quarter, but the issue is on the order book growth and the revenue growth, because for the year as a whole, FY25, BEML has been slightly shy of its own sort of projections and earlier indicated estimates. We have Mr. Shantanu Roy, CMD at the company, joining in. Mr. Roy, thank you so much for being with us. Really appreciated. So I just want to highlight for viewers, the order book guidance that BEML gave out at the start of the year was about 18,000 crores. You've ended the year at 14,600 odd crores. And the revenue growth guidance you had given was 20-25%. But revenue growth is very flat. I think for the year, you've not had growth at all. So can we talk about this first? What do you see? Maybe it was lumpiness of orders, had the orders spilled over into FY26. But let's start by talking about growth of the order book and what sort of revenue growth will you expect this year?
Thank you very much. So first of all, let me talk about the order book. Yes, we could not meet the guidance of 18,000 crores, but the silver lining is that the order book as on 31st March 2025 was around 28% more than what we opened the year 24-25 with. And the silver lining was that out of the total order inflow, the 67% contribution was by rail and metro, around 26% by mining. Defense was a dampener. Defense, we could do only around 9%. But if you look at the overall order book position of 14,610 crores against, again, the rail metro sector, it contributes around 63% to it, 24% from 28% from defense, and around 9% from mining construction. There were a few headwinds. The orders, the contracts did not fructify in the last financial year, but we are expecting that in the first quarter, some of them would, and by the second quarter, it would to a great extent. As far as the top line is concerned, you see it was more or less flat, I agree, but at the same time, the silver lining is that the PBT and PAT is at an all-time high. So that's a silver lining.
Absolutely. No, sir. No taking away from that. The margin performance has been very good, and we'll come to that in just a bit.
Let us discuss the top line. The top line, basically, we have 3 business verticals. Last year, the contribution was 43% mining, 38% rail metro, and 19% defense. This year, mining has gone up to 54%. Defense has gone up to 27%. But rail is down by 50%, around 19%. So even though, rail did not perform, but still we managed to have the similar kind of top line. There were certain headwinds in rail, some of the order execution that we were planning, it could not happen because of the proto clearance and other stuff. And also, even though rail is having the highest order book, as I've always maintained in the past as well, there is a gestation period. The gestation period is generally 18 to 24 months before we come out with the first proto. So 25-26, the year when, projects like the Bangalore Metro, even the Vande Bharat, the balanced 9 trains, this will all reach its, Vande Bharat will complete the order. Bangalore Metro will start execution. We are supposed to do 20 trains this financial year. So whatever we could not do last year in rail and metro, it will be made up in the current financial year. And of course, defense, there has been a phenomenal growth. And this year also, we can expect a phenomenal growth in defense.
So, sir, can you just help us put that into some sort of a rough numerical range? Since obviously, these Vande Bharat orders, the metro orders are picking up, you're saying defense is picking up. So for this year, what is the kind of revenue growth we should work with, at least right now? What's the visibility? And what is the kind of order book growth, or maybe an order book number that you can share that you see ahead?
So first, let me talk about the revenue. This is just the beginning of the year. We are in the second month of the new financial year. And what we are looking for is around 20%, again, 20% growth in the revenue. What with the rail projects firing up this year, that should definitely become a possibility. If we talk about the spread or the contribution of different verticals, so in 25-26, we should be having something around 60% by rail and metro and defense and 40% by mining. Order book, as far as the current scenario, what it looks like with some spillover orders in the rail and metro. So the current order book of 14,600 crores as of 31st March, we should be hoping to double it in the current financial year. Again, it will be led by rail and metro. 60% contribution will come from the rail and metro. A lot of metro projects which we have already bid for, it will be decided in the current financial year. Some of the rail projects also, like the track machines and all, which we have already bid for, it will be decided in the current financial year. And 20% each from defense and from mining. That is what, it looks like currently.
And so total order book, we should expect, will swell to about 30,000 crores by the end of the current year, right?
I said doubling it. So doubling it should be around 28,000. And from 28,000, we'll be executing some as well. So we should end up the year at around 22,000.
Okay.
20,000. Got it. All right. Hi, Mr. Roy. Good morning. Good to see you, Ben. Let's talk about the silver lining first, as you were stressing on that. Margins have improved for the year, which is heartening. What is the margin target for this year? If you could give us a rough number. You've been talking about margin improvement, so I wanted to understand where do we end this year with, point number one. Point number two is exports as a percentage of the mix. With that 20% growth, how much will it contribute to your revenues?
So the margin, if you talk about the EBITDA, we have achieved a growth of around 12 basis points. And right now the EBITDA is around 13.2%. So we are looking at a EBITDA improvement of at least 15 basis points in 25-26. Exports contributed around 8% to the top line in 24-25. So we are looking at something around 10% on the exports for 25-26.
Okay, all right. So I just want to clear the point on margins from around 13%, 15 basis points or 150 basis points. Will it be closer to around 14.5%?
Yeah, it should be.
Around 14.5%. So around 150 basis points from around 13%, it improves to around 14.5%. Yeah. Got that out of the way. And just one quick question on the working capital days, that as well has got stretched a little bit. Yeah. Receivable days have moved up, inventory days as well have moved up. On a steady state basis, will this cool off?
It will. It will. That is one of our main focus areas. Our aim is to improve the return on capital employed and the return on equity as well. So the return on capital employed, for that, we need to bring down our inventory, and we also need to bring down the receivables. Unfortunately, the inventory, it was increased because we could not convert, for example, the Bangalore Metro and the Vande Bharat. We were having the inventory, but the sales will start from 25-26. So this year, 25-26, should see a drastic improvement in the inventory levels.
You want to give us the number, working capital days, sir, that it'll take care of the payables, receivables, inventory days. So, if you're talking about improvement, how many days? What does it come down to?
Well, it's very difficult for me to, tell you the guidance for the number of days, but what we are looking at is bringing down the working capital by at least 15% in 25-26.
Mr. Roy, hi, good morning. On defense, could you give us, that's been the topic of a fair bit of intense discussion, whether we're going to see a ramp up in defense business, added thrust on indigenization, and you're very much part of that plan. Could you give us a sense of how that is panning out? What have you seen, especially, what have you heard also from the government after Operation Sindoor?
You see, I mean, this current situation, it has been a revelation. India as a country, we as a country, you know, have again proved our mettle. And as a defense PSU, we have been able to contribute in our own way. There is a lot of emergency procurements which will be supporting the government. And our forte is the land systems, the platforms, and we will be supporting the government by way of the platforms. We can expect more numbers of platforms to be manufactured. And that's the reason, you know, we see at least 20%, more than 20% contribution of defense to the order book in 25-26. Apart from platforms, we are also working on, you know, the combat engineering options like the mine plow, self-propelled mine barrier, mine barrier, and there are other mining mechanical minefield equipment which we are currently doing. So these are all related to our core business in the land systems. And apart from that, we will also be looking at, you know, diversification to the maritime naval. We are already working on some projects as well as contribute to the aerospace sector. So it augurs well for the company. And as a defense PSU, we have ramped up our defense contribution to the top line to an all-time high of 27%. And I can see it growing to at least 30% in 25-26.
And margins here, sir, just 2 points actually. One is on aerospace, what exactly are you doing? Because largely it is land systems, as you said. And second, for this business, will margins continue? Where do they stand, and do you see a continued improvement on EBITDA margins?
Let me first talk about the margins. So margins, as I've already mentioned, definitely there will be improvement. Margins have this year, the margins have been driven by two things. One is we were able to reduce our material cost by 0.8%, and even a 1% reduction in material cost adds to the margin in a big way. Second is our sustenance. The sustenance contribution to the top line has been around 26%, and that has been a huge contributor to the margin. So as we grow our sustenance business, I expect the sustenance business to grow by at least 30% in 25-26. So we can expect even better margins. As far as aerospace is concerned, we are already working on several programs with the ISRO, as well as several programs with companies like HAL, and on development projects, mainly for the aerostructures, for the GHE, GACs. And we expect to ramp up the aerospace numbers in 25-26, especially the order book. First is having the order book, and then, 26-27, the execution will really start for the aerospace.
So just for our understanding, ballpark, I mean, roughly speaking, are your defense business margins lower than metro and rail? I'm guessing metro and rail would fetch you the highest?
Again, that's a very difficult question. Metro is an intensely competitive market. Rail, I would say, commuter rail, the mainline rail, it has got better margins, but metro also, definitely we have the margins, but I would say it is in single digits. Defense, definitely, again, there is intense competition as well. In fact, more than 87% of our top line is from competitive business. So defense, along with high-end mining and the commuter rail plus the sustenance, it adds up to our margins. It helps us in improving the margins. So more we do of these things, better the margin.
The better the profile. Got it. So the commuter rail segment, high-end mining, and some specific defense and aerospace projects.
Specific defense, aerospace and sustenance.
Got that, sir. Thank you very much. Great conversation, and we wish you good luck for the rest of FY26. Quick break right now. Come back on the other side, and we'll have the management of JSW Steel joining in to talk about the fourth quarter performance.
Welcome back. As promised, let's get chatting with the management of JSW Steel. The numbers were in line and the performance should improve from here on. We're joined by Mr. Jayant Acharya, the Joint MD and CEO at JSW Steel. Hi, Mr. Acharya. Thanks a lot for joining in here on CNBC-TV18. Well, let's start off with focus on the domestic front. How is demand on ground? And also tell us how much higher are prices today if I compare it with the past quarter?
JSW Steel has delivered a very strong operational performance, as you rightly said, on the back of a very strong India demand. Last year, the demand in India grew by about 11.5%, incrementally 16 million tons of steel. The pricing improved towards the later part of last quarter. And I think the benefit of that we will see in the quarter one of this year. So we see an improved pricing environment, giving us a positive flip side on the price realizations in the quarter one 2026. It will also be driven by higher volumes from our JVML capacities at Vijayanagar, which has ramped up to about 90%, over 90% plus utilization in March. That will further improve in terms of volume, as well as with stabilized operation, it will be more cost effective than all our other operations in our hot rolled coil business.
If you could give us a number, sir, how much higher prices on an average for this quarter versus the last one?
I think we would be expecting in the vicinity of 3,200, 3,250 rupees per ton.
All right, got that. Let's focus on the other aspect, that's on the cost side. How much lower were coking coal cost in quarter 4? And how much lower will they be, say, in the coming quarter, quarter 1 FY26?
So last quarter, as we had guided, our coking coal prices were lower in the blend by about $15. And we expect about $10 to $15 in this quarter one as well, on the back of better sourcing and blend.
Okay, Mr. Acharya, hi sir, morning. Great to have you on. What is the outlook on your overseas operations?
Yeah, so overseas operations have improved over quarter 3 and quarter 4. I think especially on the back of a better pricing environment in the United States, we will see better, I would say, improved operational performance in quarter 1 versus quarter 4. Italian operations, there was a delay with the uptake of some orders from the rail system. And we also faced a congestion in terms of evacuation of the rails from our plant. So due to which the volumes were lower and that resulted in a lower EBITDA. On an outlook basis, I would say both US operations and Italian operations will deliver positively to the EBITDA in the current year. And the bilateral order from the Italian rail in Italy is in the process of getting signed. So we would see improved offtake in this year from the Italian rail.
Mr. Acharya, but will US and Italian operations turn into the green in this quarter, first quarter of 26?
It should be contributing to the overall EBITDA.
Fair enough. What's the outlook on capex and debt in this financial year, FY26?
Yeah, so we have a plan of spending about 20,000 crores in this financial year in FY26. And as you have seen, our debts have gone out by about 4,350 crores in the last quarter, ending March 25. Going forward, I think rather than a debt number, I would like to say that our ratios, net debt to EBITDAs, which have improved from Q3 to Q4, will continue to progressively improve during this financial year.
All right, sir. I want to question you on the fundraising plans. Any such plans? You'll have taken a couple of enabling resolutions, but will you raise some money?
Yeah, so certain dues which higher cost debt and some things become due, so we keep on refinancing. So those instruments we'll raise through various instruments of the market and refinance those for a better cost-effective interest rate.
All right. Besides the numbers, sir, the focal point is going to be on Bhushan Power and Steel. What is the course of action you all are taking with regard to that particular asset?
Yeah, so the matter is sub judice, so I may not be able to comment too much, but I think it's important to note that we have implemented the resolution plan in full compliance with the law, and we have been able to successfully revive the asset to its present condition where it is today, with increasing operational output, with increase of capacities. The second thing is that we have analyzed the judgment along with our legal advisors, and we believe we have strong grounds for availing all legal remedies available to us.
So it's really important you say that, because I believe that I think there's a plea coming up in the NCLT today from the single side. So what is the current status? Have you approached the courts? Are you planning to do that?
So I think those are under various stages of discussions with our advisors, and we'll be taking appropriate steps at the right time. I may not be able to give you exactly what the status is in the court as of today.
Okay, we'll just wait by for developments on that front, sir. In case this asset comes up for bidding again, if there's a fresh bid, will you be able to participate? Will you participate?
Yes, per the laws, yes.
Okay. And what's the amount that JSW Steel is due to get in case the asset goes for liquidation?
Yes, so two things. On the downside, as per the Supreme Court judgment as well, we are protected from the fact that the refund would come back to us, number one. Number two, the capacity expansions in BPSL have been done from the internal accruals which we generated at BPSL as per the resolution plan.
Okay. All right, sir. But what is the rough amount that JSW Steel is looking to get in case of liquidation?
So we will be getting the refund of whatever amounts we have paid. And I think at this point of time, that is all we can say.
Okay. All right, Mr. Acharya, final question before we let you go. As you said, you'll be eligible to bid if the asset comes up for rebidding. But will JSW Steel be rebidding for the asset? Can we assume you will be going in for it?
I think that is something which we will take a decision at the right point of time. As of now, as I said, we are pursuing all legal remedies which are available to us. We believe we have strong grounds and we have a strong case.
Okay, well, Mr. Acharya, we'll leave it there. Thank you very much for joining us. It's a pleasure having you here on CNBC-TV18. So that is JSW Steel in focus, and of course towards the end that case which is going to be very much in focus going forward as well. Now the 2,800 crore rupee IPO of the chemicals and oil storage and logistics solutions provider Aegis Vopak opens for bidding today. We have Mr. Murad Molidina, non-executive director at AG Swopac Terminals, joining us here in our studios. Sir, good morning. Great to have you with us here.
Yeah, hi. Good morning.
Thank you very much. Strong demand as far as the anchor book is concerned. So
yes.
Congratulations. And I think we'll see what the retail demand is like.
Let's watch.
But it's a specialized business, and we'll get to financials, etc. But for our viewers, if you can just start by, you operate terminals for liquid storage, which is, chemicals, etc., or also LNG, right? Just describe the business for us at a very basic level.
Let me explain in very simple terms what is the business. So business is setting up storage tank terminals at ports to receive, store and deliver liquid cargo as well as LPG, not LNG. And in liquid cargo, we can store various kinds. We can store petroleum, petrochemicals, chemicals, veg oil, and there is a lot of flexibility. This is a very niche business, like you said. It requires special skill set. It's not a plug-and-play business. So you set up at a port. These cargo come in bulk. So it's 5,000 KL. 5,000 KL means 50 lakh liters, or 10,000 or 45,000 also, which is 450 lakh tons, and you have to unload it within 48 hours, store it, and then deliver as advised by the customers, whether by road, filling up road tankers, or rail, filling up rail wagons, or even delivering via pipelines, as the customer would want.
The liquid part is mostly hazardous stuff, or is it?
It's all kinds. Like I said, even veg oil. I mean, these liquids could be of a temperature as high as 300 degrees centigrade. Now, 100 degrees water boils. Or it could be the other way around, LPG, minus 40 degree centigrade, like more than an ice cream. So various temperatures.
So these usually come in these ISO tanks, right?
No, they come in bulk. So the whole ship is filled with those liquids. We have a marine loading arm like a crane, hooks into the ship, sucks the product, jetty pipeline brings it to the middle, which we call stomach part, where tanks are there. And then you deliver.
So I just wanted to understand the competition as well, because there are a lot of port operators with storage facilities. I'm guessing Adani's as well to an extent. They're in the same line of business. How unique? I mean, basically, how strong is the moat? And the customers, I mean, wouldn't they have other options? What about the the competitive intensity?
Let me just start with the customers. If you look at my DRHP, 93% plus are repetitive customers. We are pioneers. 1978, we started this business. And there is a huge customer relationship. My partner, Wopac, has been doing this business last 400 years. 23 countries, very deep-rooted customer relationship. Here, my name, Aegis, is a Greek word which means to protect. So this business is not about competition. This business is how do you build the efficiencies. So we have an in-house infrastructure construction ability to construct the infrastructure quickly and cheaply.
But JSW and Adani, they're big groups. So they do count as your peers and competitors, right?
Yes. So they are a little bit different because they are port. So they will build the infrastructure where they are having their port. I go and put up terminals at various ports. That is the difference which makes us a little different. And also the care. This is not a plug-and-play business. And I would crudely say this is not a business of deep pockets, because you need to be doing this all the time. It's not like a sidekick business. You have multiple business and one of the businesses terminal. So we are not doing anything else. No road, no Swiggy, no Zomato, no EV.
Okay, all right.
Focus.
Full attention.
All right. Good to have you, sir, in the studio. We here at CNBC-TV18 request you to come more often. I think you require an IPO to get the management of Aegis Logistics to the studio. That aside, let's focus on this issue. It's not very, very cheap. I know that the anchor book is strong. But if I do a valuation parameter, not very, very cheap. So we'll have to see, the returns that investors get. But otherwise, the listed stock Aegis Logistics has given very, very good returns over the years. Few basic points now. You're raising some money by the fresh issue. The debt number is going to come down, right? What is the rough interest savings that you will be getting?
Correct. So let me just give you 4 important points of this public issue. One is that bank borrowings are going to become zero. So 2,016 crore are going to be repaid. You take an average 8% interest rate, 160 crores. 9 months number are 85 crore PAT. So you look at the borrowing reduction that is going to happen and how much that is going to change my PAT.
Okay.
Number two is that my 2 liquid terminals have just become operational in March, which is a JNP in Newport, as well as Mangalore expansion. And then 2 cryogenic terminals at Mangalore and Pipavav are getting commissioned in H1 of the current year.
Yes.
So they are like factories. I have 22 working sites. I have developed 225 acres of port land in 6 ports. And these are going to triple my LPG capacity, the 2 cryogenic which is going to come. Plus the fact you just have to understand that these terminals work on turnarounds.
Right.
So if I have multimodal evacuation started, my utilization would step up.
Right.
So we are just getting hooked into Jamnagar-Loni pipeline, Kandla-Gorakhpur pipeline with our existing terminals also. So all of this is happening in the current FY26 and you will see a marked...
So very, very basic question. Gas terminal and liquid terminals. Which fetches you better margins, better ROCE? Just bare basic, brass tacks question.
Let me give you a very easy example for that. Both are crazy. And I'll give you LPG first. LPG, my capex cost under DRHP, CRISIL, independent agency, has reported is one of the lowest, 1/3 than the peers. And it is around 1,200 rupees per metric ton of my capacity. My revenue yield also in DRHP is 1,250 rupees. Okay, 88% is the EBITDA. So I can go up to 80% of my capex cost as EBITDA. So even if I start with a low utilization, it's big EBITDA. And then you grow as the volume grows. In liquid, it's all about change of product mix. It is like this. If you go, and I'll just take a second. If you go and check into a hotel, your checkout time is 12 noon, but your flight is 6 a.m. Will you wait till 12 noon? No. Same here, the product. The rates are monthly. If I find products which evacuate faster, I can get another set of products. Another example, in the same hotel, Virat Kohli checks in, I check in. The rates are different because he needs a little more attention. Similarly, in my terminal, if an acid comes and a petrol comes, different attention, different price.
You're explaining it very well to potential shareholders, I must say.
So you get huge product mix potential.
Right. Mr. Bolina, what are the variables which affect your business? I mean, is it just demand? Is it... And all of this stuff which is coming in, it is for use here within the country, or this is transshipment? I mean, it's going ahead.
So we are, I always tell people, and I say it very crudely, the most 42% on ground is ages, because we are very conservative and risk averse, right? So how we make our infrastructure makes us different. So I said we construct our infrastructure quickly. I take 12 months for liquid, 18 to 24 months for gas. Look at anyone else, they will take far longer. Second, I construct it cheaper than others. So I get back my money faster. Life of the asset is 40 years. Third, what I do is I make it flexible. So I can change product. Fifth, I make this terminal trade neutral also. So I can handle import, export as well as coastal movement. So let's say tomorrow government of India says no more imports. Then what happens to my infrastructure? I can do exports, I can do coastal movement also. Jamnagar refineries will cart their petroleum products all the way to Kochi to distribute. They will not fill up 20-tonner trucks, so many of them, and then it takes so long to... With GST creating a common marketplace, it's been a blessing. So this business is, you have to make it very flexible. You have to ensure that sustainable growth is there for the 40-year life that your asset has. And that is, just lastly I should put in, is that we do not rush into a port. There are 219 ports in India, 19 major, 200 minor. I'm only in 6. I go after demand. When there is a sustainable long-term demand, do I go and put up my infrastructure.
Let's focus then back on numbers. You told us about the debt repayment, the Mangalore cryogenic terminal. 670 crores will be going towards that. So what are the matrices you're working with out there? Volumes, EBITDA contribution, what could that be?
Those are a little bit forward statement, but I can give you this way. That the terminal is capable to do 6 million tons of throughput.
Okay.
My rate of revenue is 1,250 rupees. I have spent only 900 odd crores for that terminal.
Okay.
Now, as the utilization will ramp up in 5-7 years, I would be reaching that peak.
Okay.
So you take your take that what a potential that terminal has,
Okay.
because I will not be able to step into that forward.
All right. So when you list, then we'll push you more for those numbers. But final question, you have said Vopak quite a few times, and that's a big name globally.
Yeah.
This is a fresh issue. But at some point of time, Vopak may want to take some money off the table, or will they be locked in for a few years?
Superb. So we have done a 3 years lock-in sort of inter-se agreement, part of DRHP. So we have taken into account everything.
So Aegis as well as Vopak, both will not sell?
Yes,
3 years.
both
will not sell for 3 years. They're locked in for 3 years.
It's a joint venture.
So then you'll have to find a way you'll have to do another fresh issue to bring down the shareholding from...
Primary. What it does is primary issue resets your debt to zero and makes your eligibility more because equity is pumped in.
Okay.
So it's a double whammy in the sense that you get more eligibility so you can do more capex and then you have again made it.
All right. We have got all those points on board, sir. The only point I would like to say is that valuation is not very, very cheap, but you seem to be having a good pitch, as you've told us. And in fact, we look forward to chatting up with you on
Thank you so much.
Thanks a lot for coming down. Well, time to get in our technical expert. I think we have Sudeep, who's joining in from SBI Securities. Sudeep, it's been a good start, a good Monday morning for the Bulls. What's your take?
Good morning, Nigel. A fantastic Monday followed by a superb Friday. So while we were a bit jittery on Thursday evening while the markets were approaching 24,600, 24,550 zone thereabouts, but taking support from that 20-day exponential moving average, we have seen a stellar pullback from those levels. And what's more encouraging is that the rally has been now backed with, say, select IT names, banking, as well as mid caps and the small caps. So it's kind of a broad-based rally, and that is giving us more confidence that we could see this rally expanding probably towards 25,300, 25,500 on the upside. On the downside now, supports are rising closer to 24,850, 24,900. Looking at the today's morning derivative data, 24,900 as well as 25,000 puts are seeing aggressive writing, as well as we are seeing some serious call unwinding right from 24,750 to 24,950 series. So what we feel is that now the supports are rising and 24,850, 900 could act as a strong support from here on.
Okay, what about individual stocks, Sudeep?
From an individual stock perspective, a couple of stocks are there on my radar. One is from the large cap space and one is from the mid cap space. From the large cap, it is Axis Bank. Since we are seeing Bank Nifty breaking out above 55,500 and seems it's heading towards 56,300. So Axis Bank here post a 3-4 week consolidation between 1160 and 1210 has finally broken out with volumes, and we feel from the current levels this stock is headed up to 1300 1320 levels on the upside, and on the downside 1180 would act as a strong support. The other stock that is there on our radar is Hudco. Now a lot of these names, Hudco, NBCC, are on that breakout list, and today finally we have seen Hudco breaking out with volumes. The stock has sustained above its 200-day moving average since last 5-7 sessions, although it was a bit wobbly and choppy. But today's price action suggests that from here on, the stock is headed up to 250 to 55 levels on the upside and could be bought with a stop loss at 228 on the downside.
All right, we leave it there for now. Thank you very much for joining us. Good getting that perspective on board. And technicals and price action, really. Now, just a reminder, we are excited to unveil our brand new global business news channel. CNBC-TV18 presents an all-new CNBC-TV18 Prime, a channel that will provide live and in-depth coverage of global markets and economic developments through an India-first lens. In our inaugural episode of The Global Reset, it's a show which will air at 12 noon every day. You will listen into Rajiv Jain, who's chairman and CIO at GQG Partners. Remember, GQG is by far the largest foreign investor in India. That's the inaugural first episode, which airs at 12 noon today. Do tune in to CNBC TV18 Prime.
Welcome back. Let's focus on the paint space. And Indigo Paints, well, they reported a pretty much subdued set of numbers on the growth factor for the fourth quarter. The company has witnessed sluggish growth across its segments. To help us out with how things are panning out, Mr. Hemant Jalan, the Chairman and MD at Indigo Paints, joins us on the show. Hi, sir. Good morning. Always good to hear your thoughts. Well, the quarter was a little bit subdued, but the stock price is up close to around 2%, telling you the markets are looking ahead. So give us a couple of guidelines. What kind of revenue volume growth are you looking at for FY26? And if you could help us out with what's the guidance on the margins as well from here on?
The reason why I think the stock market could be possibly rallying despite subdued performance is because you will notice that for all the paint companies, Q4 has been significantly better than Q3. Now, I'm not saying that Q4 are a great set of numbers, but at least the improvement in the demand situation is in sight. And as we speak, when we are more than halfway into Q1 of this year, we see a further improvement in the demand situation and the sentiment happening. So I think we are only a few months away from getting back to the normal demand scenario when the industry would grow by 7-8% and we would grow by more than 20%. So I'm hopeful that that situation would come about from at least Q2 of this year. But I think you'll see improved numbers on the top line from all the paint companies in Q1 is what my expectation would be.
So, and for you, sir, what kind of a revenue growth can be penciling in for the year, given that demand's going to come back? And also, tell us on the profitability. And when we're talking about your margins, ad spends as a percentage of the mix, that obviously comes up because it's around 6%. Where does that number stabilize at? Revenue, margins, ad spends as a percent. 3 points. Please go ahead.
I would be wary of giving a guideline number as far as top line or bottom line growth numbers are concerned, because we are in the midst or just getting out of the longest spell of weak consumer sentiment that anyone has seen in the last 25 years. So although the signs are good, we can see some improvement. Exactly how long it will take for this improvement in the demand scenario to come about is a little difficult to forecast. And therefore, I think we'll have to wait and watch until the demand does come back to its, shall I say, normal levels that used to exist before the last 15 months. Once that comes, we would be happy to give a number guidance. But as far as profitability is concerned, if you notice the whole of last year, I mean, we have only done less than 2% of top line growth, but the bottom lines have pretty much held up. And in Q4, we have done our all-time highest EBITDA number of 23.4% and our all-time highest PAT margins of 15.1%. So I think there is some softening in the raw material prices, which has been continuously happening over the last 5 or 6 months. It looks like that will continue going forward. And that, aided with a little bump up in the demand, I think should see the margins holding fairly steady, if not going up as we move forward.
So, Mr. Jalan, sir, hi, good morning. Two-part question. When you say demand normalizing, because it's been quite a while, several quarters. So when you say normalizing, would you consider 10% growth in a year as normal or single digit as normal? And how far away do you think we are right now from that normal?
So as far as the industry is concerned, and I'm not talking about Indigo Paints, the norm for the industry has been anywhere from a 7 to 9%, top line CAGR, and that has pretty much existed over the last 10, 15 years. So that is what I would call a normal demand scenario, where the industry starts growing at anywhere around, let us say, 8%. Obviously, you have been seeing for 5 quarters in a row, the industry leader has been at negative of 5 to 6%, sometimes a little more than that.
Yeah.
So that is very obvious that.
So do you see, sir, the industry, like you're not giving numbers for Indigo per se, but do you see the industry, paint industry, come back to that growth of at least 8 to 9% this year?
Oh, certainly. I'm hopeful that it will come by the end of the second quarter. We can see the gradual recovery happening. It's not a hockey stick recovery. It's a gradual recovery, but it is consistent. month after month. So I think it will inch back to its numbers by August, September.
Okay.
I'm hopeful that it will happen earlier, but I can't bet on it.
Okay. Last question, sir, before we let you go. Your market share is at around 3%, but you are adding capacity as well big time, the Jodhpur facility. Could you tell us where do you see your market share headed from around this 3% in the next, say, in the next 3 years or so?
The next 3 years, if we can take it to 5%, we'd be very happy.
That would be the aspiration?
Yeah, that would definitely be the aspiration. And all capacity increases are done with a long-term view in mind.
Okay.
And we expect that we would start utilizing those capacities meaningfully in the next 1 or 2 years.
And this expanded capacity, the two upcoming plants will enhance your capacity by 80%. What would that mean in terms of revenue potential?
I don't think in the paint industry you can equate capacity to demand or top line.
Okay.
I think that the two are totally independent of each other. Capacity expansion is done with a long-term view when you feel that 3 years down the road, you may hit a bottleneck. But increase in capacity by itself is never a precursor for increase in top line. It's the other way around.
Got it. Okay, all right, sir. Thanks a lot for joining in and filling us in with all of those details. Looking forward to chatting up with you as the course of the year progresses. For the time being, we slip into a short break. On the other side, we'll be joined by Francisco of Bank of America Securities on global commodities market. Stay with us.
Okay, welcome back. As gold and copper prices came off their all-time highs, which they hit earlier this year, markets continued to react to tariffs and geopolitics. My colleague Manisha Gupta caught up with Francisco Blanch, head of global commodity and derivatives research at BofA Securities, began by asking about the recent correction in precious metals. Listen.
Look, we've been calling for $3,500 gold for the first half of this year. We got there And we feel the market's going through a correction right now that could last a few months. Now we're still bullish longer term. We think longer term, maybe into the second half or into 2026, we'll breach $4,000 per ounce. But we're going through a correction because some of the extreme uncertainty that we've witnessed in recent months seems to be fading. Of course, it could come back. As we know, the Russia-Ukraine war, which was potentially heading into a ceasefire, into some form of peace deal, seems to be getting farther away from that. Also, we've heard about potential additional tensions between Iran and Israel. And then there is the negotiations around the U.S. budget in Congress. So I think we've hit a couple. We've got very close to 2,500 a couple times, but to breach that level and keep moving up, we need some of this geopolitical turmoil, some of this policy uncertainty to creep back up again. And again, we expect it to happen into year end and into 26. But for now, we think it's unlikely we will move up in a straight line from here.
Francisco, I know you do not look at cryptocurrencies or Bitcoin for that matter, but we've seen an all-time high in Bitcoin as well for the week. In relative to other asset classes, and because it's the same money moving everywhere, how do you see this money deployed into cryptocurrencies?
Well, I mean, again, this new Trump administration has been very friendly to crypto, so I think that's likely enticed investors to go into crypto assets. We've also seen, of course, a rotation away, as I mentioned, from U.S. fixed income securities with the U.S. downgrade, U.S. debt downgrade last Friday. And I think also, said frankly, even the equity markets are no longer as attractive as they once were because of the uncertainty around tariffs and the pressure from the White House for companies to effectively eat the margin squeeze and not pass as much of the import cost into consumers. So all of that has created if you like, a bit of a cocktail for investors to look for alternative assets. And I think that's where crypto's been shining, coupled with, like I said, the more lax approach on the regulatory front to crypto.
I want to talk about silver as well now, and a fifth straight year of deficit, but the prices haven't really moved with the fundamentals. The industrial demand also seems to have taken a bit of a backseat, not the same record numbers that we saw in 2024. How do you see the silver demand availability going forward, and what's your price sense?
Well, in silver, we are looking at $40 per ounce. We think silver is one of the better investments because, of course, remember, silver is half precious, half industrial, and the precious aspect of silver has been driving it higher. The industrial side has been taking a back seat, but this will eventually change. Of course, tariffs mean weaker trade conditions, and we had a pretty strong trade window between the fourth quarter and the first quarter of last year and the first quarter of this year, where investors were buying in anticipation of tariffs. Now we have the tariffs, so we're going to go into a slower period, which will last for a quarter or two, and eventually we will see another pickup in industrial activity. And again, if you are to model silver, the main drivers are, of course, the price of gold, because silver is largely a precious metal, but also what's going on with industrial activity. And right now, industrial activity is going to be weaker, so that's one of the reasons silver has lagged on the move up the large upward lifting gold prices. It's really the weaker industrial backdrop we are seeing today. But we like silver. It's linked to solar panels. We still expect enormous investment in solar panels and in the electrification of everything. And we think silver plays a critical role. Remember, silver is the best conductor, the best electricity conductor in the world. So it's going to play a very important role. And we think going forward, once we go back into a more stable industrial activity environment, silver will shine again.
Since you are bullish on silver, Francisco, are you equally bullish in other base metals as well? Copper, for example, or aluminum for that matter, or a zinc, which has absolutely underperformed in 2025 till time?
Right. So those three industrial metals are a little different each. We like copper into next year. We think eventually we'll reach 10,500 and eventually $12,000 per ton. It's more of an 18-month view. The one thing in the short run, as I mentioned, is that we remain concerned about cyclical conditions, right? I kind of hinted at that in my comments on silver, but the cyclical demand drivers are weak, and they're weak because tariffs are sand on the wheels of the global economy. It's hard to believe that after all this tariff turmoil, we are not going to see lower growth. How weaker growth we're going to see is the question. Is it going to be, are we going to lose 0.3, 0.4, 0.5, 0.6 percentage points of global GDP? I don't know, but it'll be somewhere around that level. And this is also likely to impact industrial activity. So in the short run, we are a little cautious on industrial metals. Now, looking out, as I said, we are pretty bullish on copper because we think, again, copper is the second best conductor, and we are electrifying everything. So it's a big demand story. China's also putting a big stimulus program in place to counterbalance the tariffs. And there's true scarcity in ores, right? We've seen the refining charges going negative, meaning that basically miners are just getting the copper ores refined for free, pretty much, right? So it's an interesting market where there's scarcity at the base of the raw material, the copper ore, and therefore that's translated to firm pricing action. So we like copper. Aluminum, a bit of a different story. It's a metal that again is becoming more regionalized. The U.S. has imposed tariffs on aluminum imports, 25% tariffs. These are big numbers, right? President Trump wants to bring tariffs, wants to bring aluminum production to America. The problem aluminum has, is that it takes a lot of power to make a ton of aluminum, exactly 14 megawatt hours. And that's one thing America cannot get enough of because of all the investments in artificial intelligence. We've heard from aluminum smelters in America that shut down a few years ago. They're like, well, will you reopen? They're saying, well, actually, we're thinking of selling our entire facility to an AI data center because it just takes a lot of power. The U.S. would need basically 7 new nuclear reactors to do that. And then for zinc, zinc is used mostly in galvanized steel. And as you know, the steel market has been lagging a little bit. Galvanized steel is basically to avoid corrosion. What's going on with zinc is a little, we have a softer steel market in China. It's linked to construction. Construction in China has been weakening up quite a bit, and there's a little more supply. So zinc hasn't underperformed the rally.
Very clearly. I'll come to energy markets now, and we've seen crude oil prices quite volatile as well. On one side, it was about drill, baby, drill. That's how we started this year. But if you look at the markets right now, the shale gas numbers, the oil and gas rig numbers are not so strong there. We've seen OPEC continue to increase production. The U.S. production is near record highs as well. It's a particular case of more supplies, even a surplus, and a weaker demand. How would you look at the crude oil prices within this?
I think you framed it really well, Maisha. We have a trade war which is pushing industrial demand down, and it's also pushing cyclical drivers down for oil. And on the other hand, we have a price war. OPEC is adding barrels at a time when the market doesn't need those barrels. And of course, next week, we're going to see another OPEC meeting. There's talk about potentially another outsized increase of 411,000 barrels a day. Remember, OPEC's already committed to adding 960,000 barrels a day in just about 3 months. That's a lot of oil. Now, granted, some of it was already there, and some of it is just marking to market what producers like Kazakhstan and Iraq and others are already pumping above quota. So it's not a true increase of that size. But nonetheless, OPEC keeps adding as prices keep falling. Where is OPEC going with this? In my mind, there's 3 reasons why OPEC is adding barrels. Reason number 1 is market share. Reason number 2 is discipline, applying discipline to other members. And reason number 3 is trying to push down U.S. inflation. If you like, OPEC contributing to bring down some of the inflation we've seen in America on the back of tariffs. And which one is the reason? I don't fully know, but there is, I think market share is clearly a very important reason. Saudi Arabia has the lowest market share, not just against the rest of the world, but also within OPEC that it's had in decades, and it's trying to bring its production back, right? Why is it doing it now? Why is it doing it fast? Maybe there's some element of discipline, and why now is maybe there is an element of trying to contribute to reduce U.S. inflation as, if you like, as a gesture to President Trump, which has been asking the group to increase output. So this means U.S. shale supply is going to flatten out. We expect a high oil plateau in the U.S. We expect production to really kind of stop growing. It's not going to fall at these price levels, but it's not going to grow either after 3 years of very fast growth. And at the end of the day, why is OPEC adding production? Remember, main reason is for the last 3 years, we averaged almost $90 a barrel, and U.S. shale production grew by 3.5 million barrels a day. OPEC is saying, enough, we're not going to keep oil this high. Instead, we're going to bring more volume. And rather than having 6 million barrels a day of exports at $90 a barrel, we're going to have 9 million barrels a day of exports at $60 a barrel.
Eternal, the top Nifty loser in an otherwise strong market after FTSE and MSCI reduced their weight on the stock. IIFL Capital estimates an outflow of nearly $380 million on the back of FTSE weight reduction on May 27th and nearly $460 million due to the MSCI on May 30th, causing supply worries.
GE Vernova, that's trading higher with a gain of close to around 10% after posting an operational beat in Q4. The margins come in at around 21.9%. That's the highest among the high voltage transformer peers, and the order inflow as well is much stronger than expected.
Balkrishna Industries falls about 10% after its fourth quarter net profit declines by about 25% due to unrealized forex losses. The EBITDA too falls about 10%. Margin contracts to 22% year-on-year.
Transrail lighting gains in early trade on the back of good Q4 numbers. It's marked by strong financials and a 44% growth in its order book on a year-on-year basis.
More stocks remain in focus on the back of their fourth quarter earnings. We have a bunch of them moving in different directions. On the one hand, we have Kolte Patil and GNFC trading higher post good earnings, while Dreamfolk sees a dip in their margins and a 19% fall in their EBITDA. That stock down by 7%.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. And we've started off the week on a positive note. As you can see, the top key indices that are up for you on the screen, both of them are positive. However, we have come off a little bit, Mangalam, from the highs of the day.
Yes, Nigel, you know, there was supposed to be supply around the 25,050 to 25,100 mark. Let's see whether the market sustains above that or not for an extended up move in the May series expiry week. But no problems for the broader markets. The portfolios would be looking very good. And the Nifty Bank also off highs, but still sitting with a gain of almost 100 points. In this market, let's get you some ideas for profit. Coming in from our colleagues at Money Control Pro, we have Kanchi Shah joining in with the stock. Kanchi.
So today let's talk about Eicher Motors. The company is best known as the manufacturer of Royal Enfield. Let me briefly touch upon its Q4 performance. Royal Enfield's revenue grew by 23% on a YOY basis, which was driven by a volume growth of 23%. Despite the higher sales, the EBITDA margin contracted by 252 basis points due to increase in marketing expenditure and elevated commodity prices. In FY25, Royal Enfield crossed a significant milestone. For the first time, it recorded over 1 million annual sales unit. It currently holds an impressive 88% market share in the domestic middleweight motorcycle segment, which clearly reflects the brand's dominance and customer loyalty. One of the key growth drivers has been the shift in the consumer preferences towards premium bikes. Royal Enfield has successfully capitalized on this trend through a refined product portfolio and a stronger brand positioning. Importantly, we are also seeing a demographic shift with the average age of customers decreasing, indicating a rising interest from younger buyers. On the international front, the company is making strategic moves. It recently inaugurated its first fully owned CKD assembly plant in Thailand. This marks a significant step towards its increase in international footprint. Meanwhile, the commercial vehicle business under the VE Commercial Vehicle, which is a joint venture of Volvo and Eicher Motors, has outperformed industry trends. In a year where the sector grew just by 0.3%, VECV has reported a 5.4% growth. With the projected 15% upside based on the SOTP valuation, Eicher Motor is a compelling stock to accumulate on a longer-term basis.
All right, Kanchi, thanks a lot for that. Let's focus on the primary markets now. We had two IPOs opening today, Aegis Vopak, and the other one is Schloss Bangalore, which owns the Leela Palaces Hotels and Resorts. Here's Dalal Street with a 3,500 crore rupee IPO, of which 2,500 crore is fresh. We are now joined by Ankur Gupta, the Managing Director, Partner and Head of Real Estate for Asia Pacific and Middle East at Brookfield, the owners of Schloss Bangalore. Thanks a lot, Ankur, for joining in. Always a pleasure speaking with you. The fact that you're raising about 2,500 crore for fresh issue implies that there will be a lot of debt repayment. So, you know, let's get a couple of things out of the way first. One, what would be the interest cost savings? What would be the residual debt on your books? I suppose there was close to 4,000 crores on your books before you decided to raise these funds. And the second part, when you look at revenue growth, you have about 13 properties right now. How many of them come on stream, and how do you break revenue growth into, increased number of rooms, increased occupancy, and increased RevPAR?
Thank you very much for having me over, and good morning to everybody from a very rainy Bombay today. So firstly, the primary proceeds of the IPO, about 2,500 crores, which is the primary issuance. A majority of that capital will be used to reduce leverage or debt on the company's balance sheets. As of March 25, the company had cash of about 1,200 crores on its balance sheet. So post-IPO, the net debt position of the company, gross debt minus cash, will be close to zero, which means for a company that did 700 crores of EBITDA, cash EBITDA, over the last 12 months, and the prospects are even stronger getting into FY26. This company will have a lot of liquidity. Right. So the average interest cost was slightly north of 9%, and reducing the debt by 2,300 crores will reduce corresponding interest burden for this fiscal or balance of this fiscal. But most importantly, it primes the company very well for growth using a combination of almost no leverage, cash on the balance sheet, as well as strong internal accruals into the future.
So 150 to 180 crore average annual interest cost savings is
slightly more than that. Slightly more than that.
About 210?
That's correct.
Okay, all right. Good to have you in the studio, Ankur. Thanks a lot for coming down and welcome to the stock markets. I think it's a great time, going by the kind of demand you're seeing with regard for hotels and, the entire leisure space. But a couple of details. As you said, your margins have been very, very strong. Now you'll be debt-free and you'll be throwing up a lot of cash as well.
That's correct.
How sustainable are these margins? Because I'm looking at your peer set from the listed space and you're head over heels among everyone. You're around 49% or thereabouts. Is it sustainable?
So let me break down the margin into a few different components for you and for your viewers. Firstly, the focus of the business is on luxury.
Yeah.
Now, in the hotel business, a large part of your expenses are fixed in nature, which means if you can command pricing premium and if you can invest back in your real estate or your property business with lower fixed heads, which can be sustained, that contributes to your current margin. Second part, in how do you sustain higher rentals? Yeah. I think the second part of the equation is very, very important, which is how you sell, who you sell to, and how do you service them. Our net promoter score is industry leading. So not only do we have highest rents, we have highest margins, but that's on the back of very strong customer affinity for the product. Not just the real estate, the built environment, but also the offering that the Leela Palaces offer. 800 plus touch points for every customer that begins its journey at a Leela Palace, and getting 85 out of 100 in that is almost is work of real labor. I think that is very important, and that is the singular focus of this business, which is luxury, service-oriented, high-quality properties, which constitute the Leela Palaces and resorts.
So sustainable at around this 49%.
I would like to believe.
You would like to believe it. Let's come back to the growth part, because while it is luxurious, you have still 13 hotels only. You do have a pipeline, right? Plus a near 35-40% premium over the industry when it comes to revenue per available room. Going forward, what is the kind of growth that you're targeting? Because the industry is likely to grow at around 10 to 11%. You will have the kicker of increased occupancy in your existing properties, increasing RevPARs, and newer properties coming on stream as well. So will you grow at 2x the industry?
So just to put some things in context, when the US GDP grew from similar levels like India, some slightly north of $3 trillion into 7x. So when the GDP grew 2 times over a course of a short period, this was in the 70s and 80s, and same as the data for the European Union as well. Chains like Marriott, Accor, etc., grew at 4 to 7 times, which means the hospitality segment gets a disproportionate share of underlying GDP growth. That's because business activity picks up, per capita GDP goes up, affluence levels goes up, etc., etc. So we are very confident that the luxury industry has very strong demand characteristic. At the same time, supply is very limited. India is just home to 30,000 odd luxury hotel keys. Leela's market share is more than 10% of that. I would like to believe that under the Brookfield ownership, we've grown from 8 hotels to 13.
Yes.
We've increased the margin between us and the comp set 2x. So we are commanding 20% premium. We are now at 40% premium. I think the way that the business has been established is being built for perpetuity, which means that this growth should sustain. The management team is professionally run. Our board is composed of very eminent personalities. So through a combination of focus on luxury segment, good access to capital, and an amazing brand that's been there for 40 years. Yeah. And I would also like to believe that the India story on luxury hospitality is now very well recognized in the world. We have a mass movement of domestic customers aided by return of foreign travelers. It's creating a perfect storm in many ways, which Indian hospitality has not seen for many decades.
Okay, all right. Quick couple of questions then. A couple of your properties are still, struggling, like the Chennai property, I think so. It's yet to break even, if I got that correct. Could you tell us what's the outlook there? What's the turnaround strategy for a couple of these projects? And also, are you planning on re-entering other geographies like, say, Goa?
Yeah. So let me answer your first question. Chennai property commands an amazing positioning in Chennai. It's a beautiful property on the marina in Chennai. And it commands probably one of the highest ADRs in the city.
Okay.
And at good, healthy EBITDA margins. Oh. So Chennai property is doing well. In fact, since 2019, the EBITDA has grown substantially at the Chennai property itself. But not to single out on one property itself. The growth pipeline, as you see, Yes, Goa is on our radar, but we've also expanded a lot into places like in Mumbai, like in the hills. We have a hotel coming up in Srinagar. We have a hotel coming up in Sikkim. We've entered the spirituals to tourism sector. We all saw what happened.
To the specific question, there are still losses at Chanakya in Chennai, right?
I would say, those losses are on a net basis. On an EBITDA basis, these properties are contributing very, very well to the
When do they start turning around on a net basis?
As I said, our net debt on a consolidated basis.
So once you become debt-free, these will become net profit as well. And final question, business travel. That is what proportion of your sales? That's structurally down post-COVID, right? So how has that mix changed?
I would say that business travel has structurally changed. I would not say it's down.
Got it.
Business travels have become more, I would say, unified with personal travel. People are using the shoulder days a lot more. So the Thursdays, Fridays, and Mondays.
Got it.
Leela business on the back of 250 people who constitute our sales team is very, very hard to replicate. I'm not sure that any luxury brand exists beyond hospitality sector with such a large dedicated sales force. So I would say that the true value of the business lies in talking to a customer, both in terms of outreach as well as service.
All right, Ankur, we appreciate you coming down and detailing all of that for us. We wish you all the best with regard to the IPO. And on listing, we re-invite you to join us on the show. We'll squeeze you a little bit more for some numbers. Thanks a lot.
Thank you very much
for joining in. Well, time to slip into a short break. On the other side, we'll be joined by the management of Glenmark. Stay with us. Welcome back. You're tuned into Chartbusters here on CNBC-TV18. The next management then that we have is Glenmark Pharma. They've reported a steady set of numbers. The problem was that in the past quarter, they couldn't achieve the guidance that it set out for the year. However, what's the way ahead? Well, we're joined by Mr. V.S. Mani, the ED and Global CEO at Glenmark Pharma. Hi, Mr. Mani. Good morning. Thanks a lot for joining in. Well, you're guiding for around 10 to 12% growth on the top line. Sure. Could you tell us what's the breakup? How much are you factoring in terms of a growth with regard to the United States? Because plenty of uncertainty out there. And what about the Indian operations? What is the growth number you're factoring in? And also on margins, last year you fell short. This year you're sure you can achieve the margins you've guided?
Sure. So thanks for the question. Let me set some context. So in the current year also, we had a turnover of about 13,300 odd crores with a growth of about 12%. And obviously the margins were for this quarter looks a little lower. For the full year is about a little more, about 17.7%. So obviously the margins were a bit lower on the back of mainly the US business. Some of the we did not get any key big launches. So obviously those had a play in that. Now going forward, obviously the next year we have spoken about a business growth of about 10 to 12%. But giving it a business-wise breakup, we would probably keep it to a later date. We're planning to have an investor day, so at that point of time, we'll do that. And we have guided to about a 19% margin next year, and obviously that will be more on the back of improved performance in the US, as well as some growth in royalties, as well as some efficiency. So all put together, we should see closer to 19% that we guided.
All right, so 19% margin, you're comfortable with 10 to 12% growth in India is what you've said. Overall revenue...
I said the overall business growth is about 10 to 12%. I have not broken it up business-wise, India or the US.
Okay, not quantitatively, but if you could qualitatively tell us what would grow faster? I mean, do you think US would be the one driving this growth, or would it be India? Because there are uncertainties everywhere, right?
I appreciate. So let's look at the current year for some, way forward. So the Europe continues to do well. And it did about 17-18%, so we see that doing pretty well. India would be pretty steady. Obviously in IQVIA, etc., have been growing at about 10% or so. And then again, if you look at the emerging markets, while we had some currency losses, etc., otherwise the growth has been in excess of about 10%. So I think in the US, obviously we are, looking at some approvals in terms of the respiratory ones that we are expecting in the quarter to end or and also the second half. These are all more in terms of the Flovent. So if these all come together, then obviously we see achieving the growth of 10 to 12%.
And you expect margins to improve in the US despite the uncertainties that we're seeing around tariff and pricing, right?
We are looking at these critical launches. So these happen, then obviously then your margins would definitely improve. Yeah. But besides that, also the rest of the businesses seem to be having a decent margin. So I think with all in all, with this royalties, some bit of improvement in the US as well as some efficiency all put together, we should be close to what we are projecting.
All right, royalties, I think you're guiding for around $100 million, right, in this year?
Yes.
And what is the glide path? Because in the past, you'll have mentioned that in the next few years, you expected to move to around $200 million. Yeah. By when?
Yes. So just again there to give some color, royalties, which was 40 million last year, touched about 80 million in the current year, and we're expecting to touch 100. We already have commercialized it in 45 geographies, and obviously we're looking at 10 to 12 more geographies. It's doing well in all the markets where we are present with our own footprints, as well as in partnered markets like Menarini with Europe, as well as with South Korea, etc. We are doing quite well. So I think going forward, we expect in next 3 to 4 years to at least close on to the 200 million. Yeah.
All right. Next 3 to 4 years, $200 million out there. What is the update on both Monroe and Pithampur plants? You have indicated that there could be an inspection anytime soon. Is it possible for you to give us a timeline? Maybe by, say, the next couple of quarters, you expect some sort of resolution, if you could give us a sense?
It will be difficult to give a timeline and resolution, but I can say that Monroe, obviously, we have done enough work and we expect the agency to come sometime. As well as the Pithampur goes, we are working with the agency to resolve the issues. And there are no major launches out of there. The critical launches in the current year and couple of years are from Aurangabad, which, as you know, got inspected a couple of months ago and it had a 0483s. So I think all in all, we'll wait for the agency to come for these two other plants.
So these aren't very material, even if they weren't.
They would not impact your business. They are not impacting the business in such a way commercially, but obviously we would like them to be inspected. And
yeah, so your 10 to 12% growth guidance and 19% margins aren't, predicated on the outcome of US FDA, results for these two facilities. Let's put it that way.
That's right. They're not impacting the business so much. Yeah.
Okay. All right, Mr. Mani, how about your balance sheet? How is that looking?
Balance sheet is looking quite okay. I mean, if you ask me, we ended the year with almost like a 1,000 crore addition to the reserves, and while our debt did go up by 1,200 crores, but that was mainly on the back of increased requirement for working capital, which was really down. Now we are pretty much very close to the peer where they have average days of 100 to 110 days. We'll be there close to that. So I think balance sheet looks quite okay.
What about ISB 2001? I mean, you did receive a fast-track designation by the US FDA for multiple myeloma. Are there any out-licensing talks going on here?
Yeah, we are in touch with a number of potential, interested parties, and we are hoping that we could have something come up with a positive outcome quite shortly. Yeah.
What's the roadmap for this asset?
Roadmap is obviously you would work on that, and then you'd work with the partner, and then you'll take it forward, and it looks good right now.
What we wanted to understand, sir, was what the financial roadmap,
The financial roadmap, we may not be in a position right now to give you, but all we can say is once this is done, after that, IGI would not obviously have to look at Glenmark for any funding or anything like that. And going forward, at least 3 to 4 years, the funding would be taken care by this. Yeah.
All right. Since the balance sheet is in much better shape, any inorganic growth plans?
Not at the moment, but obviously we continue to keep doing in-licensing deals. As you have heard, in India also we did this Beijing deal, and then we also had Winlevi, etc. So we continue to in-licensing transactions, but not looking at M&A right away.
India was flat this time around, perhaps due to seasonality in respiratory, which did impact the portfolio, one would assume. What led to the weakness in the diabetes portfolio? I mean, how did key drugs such as liraglutide do?
So liraglutide continues to do quite okay. I mean, in the sense we did have some supply issues there, but otherwise it's doing quite okay. It's the the earlier products that we had of Remo and teneligliptin, those seem to have slightly degrown in this quarter, etc. So that's the reason why it is. But just to give you some color on the India business also, we had guided the street to about a 4,500 crore turnover in the current year, which we achieved. Obviously, the first half was much better than the second half, and as we already sort of guided that in this quarter we had some challenges with the acute respiratory as well as the diabetes portfolio, and I think let's see how things work out.
The final question, because everyone's been talking about this for the last couple of years, and this has been the buzzword, and it goes off patent as well. Semaglutide. Are you eyeing this as an opportunity?
Yeah,
what
we are
plans do you have here?
Yes, we are also looking semaglutide as an opportunity, and obviously, like we have already, we're already working with liraglutide. We'll obviously add semaglutide as well, and it will help us to probably, to do.
How are you participating? I mean, have you spoken to some?
We are working with a couple of people, and we'll announce at the right time. Yeah.
By when?
It'll be a couple of weeks or months. Yeah.
Couple of weeks or months. We'll keep an eye out on that. Thank you so much for joining in and giving us all those details. I think, the street did not like what you had reported, but the commentary is something that the street is now coming to terms with, as a result of which, after opening a lot lower, the stock has seen a bit of a recovery, currently sitting with a cut of about 1.5%. At some point, did move into the green as well. That's Glenmark Pharma. But we are excited to unveil our brand new global business news channel. CNBC-TV18 presents an all-new CNBC-TV18 Prime. Now, this is a channel that will provide live and in-depth coverage of both global markets and economic developments through an India-first lens. On our inaugural episode of the Global Reset, we will be speaking with the chairman and CIO of GQG Partners, Rajiv Jain, today at 12 noon. Do tune into CNBC-TV18 Prime. You're watching us here on Chartbusters. As you can see at the top of the screen, market now indicates a fresh paint of green across the frontline indices, though mildly off highs, nothing really to worry about. And if you're looking at your portfolios, incredibly strong, because a lot of stocks which opened well are seeing a lot more gains, and a lot of stocks which opened flattish are piling onto those gains as well. There are a bunch of names. We could take that, but we're running out of time. So what we'll do is leave it to the team of Trading Hour, which comes up next.
Good morning and welcome to a brand new episode of Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Hormuz Fatakia. And there's a lift in the markets. The Nifty is inching towards that 25,000 mark. It's 125 points up at 11 o'clock on the Nifty, with the Sensex surging close to about 450 points. And the big gainers are the ones exposed to the global markets. You've got auto and IT. And the fact that the Trump administration has delayed the EU tariffs of 50% to 9th of July has lifted stocks like Tata Motors, for instance. So Tata Motors is higher in trade. But other than that, even other auto names like a Hero MotoCorp. Hero MotoCorp has actually moved up 14-15% this month. So there has been buying interest in Hero MotoCorp. And today, it's in fact amongst the top gainers, and IT is doing pretty well.
You know, it was pouring outside just a few minutes ago. I guess it's still pouring outside, but it was pouring gains as well on the street. But you're slightly off the highs of the day. Now, of course, you can't complain about the fact that there is still some hesitation above that 25,000 mark for the index. 25,079 is the high of the day today. So almost around 110 points off the highs, but still holding on to gains of around 120 points as well. We are counting down to a very crucial monthly expiry as well. There are a lot of rebalance. There is a lot of rebalancing that has to take place this week in various stocks. So those need to be in focus. Earnings season draws to a close. So those need to be in focus as well. And it is the banks that are leading this cool off from the highs of the day, especially the Nifty bank at one point had almost slipped into the red. Still around the flat line is where the index is closing in on its record high levels as well as the Nifty bank. So keep an eye out on that. Of course, can't not ignore the earnings reactions that are taking place in today's trading session as well. GE, Vernova, T&D India, that is the earnings reaction of the day. The revenue was a miss on expectations, but the other parameters were very well. The order inflow was good. Margins were the highest among its peers. So the stock is in a 10% upper circuit in today's session. Phenolics Industries is one of them as well, 7% higher on that stock. And Emcure Pharma was higher on Friday, was higher on Thursday, and it's building on to those gains in today's session as well. So another 5.75% on Emcure Pharma. So third straight day of gains for that company as well. And the last name that I wanted to mention on the flip side, though, was Sarda Energy. Sarda Energy is down 7%. Nigel was mentioning that although on a year-on-year basis the numbers were good, the margins were lower on a sequential basis. But of course, the big story of the morning is the monsoons, and they have reached Kerala 8 days before the usual date, which is also the earliest arrival since 2009. Manisha is joining in with all the weather updates and the forecast of the Met Department. Manisha.
Oh, well, absolutely. Records are for breaking, aren't they? And this is an important one because while, of course, we are looking at an above or normal monsoon, that is something that SkyMet and IMD both told us the forecast of anywhere between 103 to 105%. The expectation also has been about an initial or early onset of monsoon, and that's exactly what we are dealing with. While IMD did talk about 27th of May, we have the onset confirmation on Kerala for 24th of May itself. And this is the earliest onset since 2009. So we clearly are looking at earlier onsets. Remember, the pre-monsoon showers started as early as April end itself. And that's exactly what we are dealing with. So now this is what monsoon numbers really are. The usual date for onset is 1st of June. And the monsoon covers all across country. That is by 8th of July. And we are looking at early progress of monsoon as well this time around. So when you look at the numbers itself, the monsoon is advancing into parts of northeast versus the usual date of 5th of June. Remember, monsoon does come into Maharashtra by the date of 7th or 8th June, but we have seen monsoon already cover entire Goa and parts of Maharashtra and Karnataka as well. So much so that we are dealing with a red alert right now in sense of rains in most parts of Maharashtra and in Mumbai, Palghar, Ratnagiri, Sindhudurg, etc. The monsoon also has reached into the northeast areas of the country. Mizoram, Manipur, Nagaland are some other areas where we have seen monsoon continue to be in there. Also, when you talk about Maharashtra itself, we usually see monsoon come in by 7th of June. This has happened on 25th of May itself. And Mumbai usually gets an onset by 10th of June. And we're looking at 26th of May for this as well. So really onsets for Maharashtra, for Mumbai especially, this could be the earliest ever onset into the city there. When you talk about the alerts then, and IMD has put out various alerts right now. There's an orange alert which has been converted into a red alert right now. And that yellow alert also has been converted into a red alert when it comes to Mumbai, Thane, Palghar and all of those cities and districts as well. Moderate to heavy rainfall is what is anticipated until 1 p.m. and then would continue for the rest of the day and couple of next days as well. Next 2 to 3 days could actually be looking at heavy monsoon as per the IMD forecast there. When it comes to a moderate rainfall, that is what you're anticipating in Karnataka. There are school closures that have been announced in Mysuru and Kodagu. Northeast states also are expected to see hailstorms, scattered rainfall, etc. There are some rainfall alerts also happening in Gujarat, in Haryana as well. And the current present active monsoon is expected to continue until 2nd of June, and that is perhaps when after that is when we will see a break. But until 2nd of June, the expectation is that you are going to be looking at very heavy monsoons or rainfalls there. To take this discussion forward, we are now joined by Mr. G.P. Sharma from SkyMet. Mr. Sharma, hi, thank you so much for joining in. Clearly, you've been talking about on how we could be expecting or could be looking at very heavy rainfalls this time around, and we've seen that as well. Are records being broken now? Is this the earliest ever in Mumbai?
Yes, it is likely. Okay, I think in another day or so, we will have the monsoon in Mumbai. It's raining. It's already there. I will say the monsoon is already there. Its official announcement has to be made and could be possibly, I think it will be the earliest. It was on 29th of May on 3 years. That is 1956, 1962, 1971, when it arrived on 29th of May, the earliest. And if it is now, possibly all time. At the earliest arrival of monsoon over Mumbai, that will be a record as such. It has been, like you said, 8 days before over Kerala, even 15 days before, 15 days before over Andaman Sea also. Similarly, Northeast India, simultaneous arrival. this monsoon has got many firsts. Like it was a strong onset. Okay, unlike many a times it makes a soft landing. It happened last year also. It happened last year. But then before time arrival, strong arrival. In the first burst itself, it covered large area. Second day itself, rapid advancement, entered Goa and even just touched southern tip of Maharashtra as well as. So it's many of these firsts are there in this year's monsoon, but then it happens like that. As you said, I hope the next few days, 1 week or so, yes, activity will go on because the system, basically for Maharashtra and particularly for Mumbai, that's a system which is still persisting as a low pressure area closer to the coast, Konkan coast. That's the one was responsible for causing these rains and pulling the monsoon current up or across the north coastal Karnataka, Goa, and that adjoining parts of Maharashtra. That's going to slow down tomorrow. Okay, sometime late tomorrow.
Okay.
Today the rains are going to carry on. I will think about next 4-6 hours or so. Mumbai will have. Though the southern parts will have more rains, like Sindhudurg, Ratnagiri, Hanai, as we go towards Mumbai, possibly Alibag or so, and further north of Mumbai, the showers will be a little less intense as compared to the southern parts, but they are going to continue. Yeah.
Point taken. Mr. Sharma, I have a two-part question here. One, it usually is by 8th of July that we see all India covered. But with the kind of progress that we're looking at right now, do you see that record also broken? That's one. And second is, while we do understand that the water reservoirs are getting supplied right now, but what does this really mean for agriculture? And are you also looking at a big break in the monsoon as it after its onset in the first and second part of June, really?
Yes. Firstly, early onset, in any case, there is no assurance that it's going to cover the country before time. Like 8th of July, you said the border post of Rajasthan, West Rajasthan, no surety. Okay. Monsoon, in any case, it doesn't keep the same pace or steady pace for a very long time. It could be about a week or 10 days, which will happen even this time also. After about another 1 week or so, I had mentioned it earlier also on your channel in discussion with you that we expect the monsoon to slow down after the initial onset. We'll see some bumps, we'll see some breakers. Definitely in the first week of June itself, you will find it won't maintain the same pace. Yes, Northeast India, it is already there now. Adjoining parts of eastern states, say some eastern parts of Bihar, West Bengal region, possibly it will arrive. Normally, Kolkata and Mumbai, they have the monsoon simultaneously. It may not happen this time. Okay, Mumbai will have much earlier than Kolkata. After it has covered that much of a distance in the next about 4-5 days, main activity is because another system is coming up in the Bay of Bengal, which is West Central Bay, off the coast of Odisha, North Andhra Pradesh. That will carry the activity further inland. That will, the monsoon progress will be there. But after it fizzles out or it is slowing down also, then thereafter we find some break when the monsoon will take some time to advance further over the central parts of the country, over the parts of Madhya Pradesh, over parts of Uttar Pradesh also. I may not call it as a stall as such, but something similar to that for at least about a week or so, you will find that thing happening. So therefore, and when does it revive? Nothing can be said at this moment. The revival is normally when some system forms either side of the coastline, both Arabian Sea, Bay of Bengal, but more of Bay of Bengal. Arabian Sea doesn't see much of a purpose. So that's what the activity, next 1 week, very active. After that, slow down. Yeah.
Okay. Mr. Sharma, so very quickly, your forecast is for a normal monsoon, 103% of the LPA for this season. That stays? That stays, 103%. And June, you're at 96%. Now, considering that after 1 week, which is the first week of June, things start slowing down, is there any change in assessment to that?
See, whatever rains now, in any case, it is one of the rainiest month May we have. But unfortunately, none of these rains will be counted against the monsoon because the count starts on 1st of June. Okay. As I said, the beginning itself, after about 2nd of June, we will have a little sluggish current going into the central parts of the country, means the rainfall, but rainfall in the month of June on daily basis, it is not much. To start with, just about 2.5, 3 millimeter per day, going then 4 millimeter, 5 millimeters. So it's not much. So the deficiency may not be very large, but then definitely the monsoon is going to slow down. And I still maintain my forecast that in the month of June, possibly we will have a little less than normal rainfall, 96% we have given. And that is mainly because of a slow current over the North India, Northwest India, where monsoon becomes a little sluggish as soon as as and when it reaches there. There is no great push for the monsoon to reach those parts, intrude those parts, western parts, the borderline cases of Punjab, Haryana, and those parts. You need a strong western disturbance at the same time when the monsoon current is there to take the monsoon to the interior part. Okay, if it happens, it goes. If it doesn't happen, it waits for some time. Wait could be even about a week or so. But then for the agriculture point of view, Manisha had asked, okay, basically the Kharif season, sowing starts, and farmers, they plant with the first monsoon rain over different parts. Means for Kerala, South Interior Karnataka, since the normal date is about 1st of June or so, the sowing is planned around that time. Okay, this time is a little early. Early monsoon, good, because it leaves a lot of soil moisture, it leaves some humidity in the air, which is good. Okay, so, but North India, we have to, still wait and
right.
Mr. Sharma, sorry to cut you in. You know, for us here in Mumbai, there are a couple of pertinent questions that our citizens would want to know. There are various unconfirmed reports of a cloud burst. Would you like to verify that? One. And two, a lot of Mumbai, all of it relies on the 7 lakes for its water supply for the entire year. Do you think that this normal rainfall forecast that you have, above normal forecast, will be applicable to Mumbai as well? Will we get enough rains this season for us to last until the next monsoon?
Sure. Month of May has been very good. Actually, normal rainfall for Mumbai in the month of May is just minimal, just about a single-digit rainfall. Okay, it is only when years like this, it rains heavily in the month of May, the average is about double-digit, 10, 11 millimeter or so. So it is a bountiful rainfall this season, and which is good for all the water bodies which are across the city, adjoining areas. They will be full. Cloudburst is basically, it's a very heavy rainfall amounting to about 100 millimeters in about an hour's time. That is the time we call a cloudburst. There are occasions when in the cloud cluster which we have at the moment, it is there. Radar picture, you can see it's around Mumbai within a radius of about 100 kilometer, thick and dense clouds are there. Okay, but then I don't foresee any situation of any cloud burst as such, but the rains are going to continue, which may hamper your operations, even air operations also. The strong winds are there. Water logging will be there. All that is there, but then the cloud burst I don't see. And good news that possibly Mumbai will have a good monsoon this year. Yeah.
Okay. Thank you, Mr. Sharma. So we'll take it as bountiful rain in Mumbai, but can't classify it yet as a cloudburst. Thank you very much for joining in. Get into a break. On the other side, Ravi Jhakar, who is the Director of Strategy and the Group CFO at All Cargo Group, will join in to discuss the Q4 performance. Welcome back. All Cargo Group, which comprises of All Cargo Logistics, All Cargo Gati and All Cargo Terminals, reported their Q4 numbers. Now, while All Cargo Logistics saw a revenue surge of about 24%, for the other two businesses, Gati and Terminals, the revenue growth was in low single digits, but All Cargo Gati did see an EBITDA surge of nearly 34%, while All Cargo Terminals EBITDA went up by nearly 10%. Ravi Jakar, who is the Director of Strategy and the Group CFO at the All Cargo Group, is now with us. Ravi, thank you very much for joining in. So let's start first with the All Cargo Logistics business. While the top-line growth was strong for FY25 with a growth of about 24%, the EBITDA margins contracted 3.2% versus 3.6%. What explains that and what is the guidance, the number for FY26?
Hi, sorry, it seems like I got disconnected in between, but making this of your question around the trend of the last quarter and the trend going forward.
So we wanted to specifically focus on All Cargo Logistics. If you could explain what led to the dip in margins and the guidance for FY26 on margins for the logistics business.
Yeah. So on the All Cargo Logistics, which is primarily driven by the international supply chain business, I would say one needs to look at the absolute numbers because a large part of revenue is a pass-through cost. And if you see on a quarter basis, on a year-on-year basis, we saw both revenue and EBITDA on consolidated basis expand by about 17 and 18%. For the full year, we saw revenue go up by 24%, reflecting more on the average freight rates. And the EBITDA went up by about 12%. And the gross profit is also about in the same range. What we observe is that there has been quite a lot of volatility with the tariff and trade deal announcements over the last few weeks. It seems to be settling down now. There seems to be more of a narrative of reconciliation, and that should bring in stability in the long term. That's our expectation. In the immediate period, since there was a few weeks of sailings missed on China to US Trans-Pacific trade, we are now seeing a significant revival. So there's almost like a 65% decline in China-US trade, which has now rebounded sharply as well in the week gone by. So we believe that there could be some near-term volatility for this quarter, but beyond that, things should stabilize and we should see, trade recovery happening. And that should mean that we should see volume growth. Freight rates may remain slightly higher because of these disruptions in the coming months and then the ensuing holiday season to start with.
Ravi, good morning. Thank you for joining in. So with all of this, tariff uncertainties and with some recovery and some not, what are the kind of volume growth targets that you're penciling in for the logistics business in FY26? And add the margins bit as well, because compared to FY24, your margins were slightly narrower in FY25. So do you expect that to improve as well?
Yeah, so I would say that, if you look at the growth in the FCL business, the industry addressable market for us grew in the range of about 5%, while we grew by about 7%. The addressable LCL consolidation market, in our view, shrunk last year, and which is why we have seen some of the competition, reporting. It's not in listed space, but in the private space, we believe decline. We have seen about 1% growth. What we expect for the year coming by is we believe that the LCL growth rate and FCL growth rate both should be normal, which means that, FCL growth rate, adjusting for the tariff impact, should be about 3 to 4%. LCL could be about 4 to 5%. And in both these segments, we would outperform the market. FCL possibly in the similar proportion as this year, and LCL also. Because if you see our growth across small forwarders has been very good in the last year as well, almost close to double-digit numbers. So therefore, I would say that in both LCL and FCL, possibly we can expect high single-digit growth coming in the year. As far as the profitability is concerned, we have held on to the yields. Yields for us is profit we make on every unit of cargo carried. So from that perspective, the gross profit should do well. We are also looking at the year 2025 as a bit of a year of consolidation. We're looking at a lot of initiatives in terms of restructuring, bringing in technology, optimizing operations costs. So there'll be a little bit of flux on the SG&A costs, but directionally, if I look at FY26 towards the exit numbers, we should see similar or lower SG&A costs and much enhanced gross profit. So from an exit FY26 perspective, we should be seeing much stronger profit numbers, would what my expectation would be.
Okay, so exit margin should be higher. So EBITDA exit could be 3.6%?
Like I said, percentage terms may be misleading, but on absolute terms, we should be
So
seeing.
what are the yields then? Fair enough. What are the yields? You said you managed to hold on to yields.
Yeah, so yield is, the gross profit that we make on every unit of cargo that we carry. That's how we typically measure our top line performance, not by revenue. And like
Is there a number on
no,
yields?
there's no specific number per se that we share. But if you look at the gross profit that we report, and if you look at the volumes that we report a combined number. Directionally, since both segments would see a sustenance or improvement, therefore the gross profits should grow more or less in line with the volume growth that I've indicated earlier in my comments.
What's the target revenue mix for all cargo logistics between air volume, contract logistics and express logistics?
So we have the international business in which air is about 5% and LCL is majority more than 60-65%, and the rest is full container load. On the domestic side, we have express and contract logistics. We believe that contract logistics, we should be in the range of about 25-26% on the domestic side, while express should comprise almost 75% of our revenues for FY26.
What about Gati, Ravi? Your FY25 EBITDA grew 34%. Margins were also up 100 bips. So growth is visible for Gati. Does that momentum sustain in the new financial year as well? What are the kind of plans that you have here?
Yeah, so if you see on the Gati side, we have seen a flattish revenue, but a strong growth in EBITDA. And that has been, the mixing up of the revenue. We are kind of letting go some business which is of low quality, and which is why in the preferred business we have grown, even though the overall revenue shows flat. So we believe that now with operations being very stable over the last more than 12 months now, we should be in a position to ride on the market growth and perhaps see a good, strong sales performance in FY26 as well. SG&A is a sharp focus. You would have seen the numbers. We continue to contain them. We do not see them growing much. So therefore, operating leverage should continue to play out. And what trends you have seen in this year should continue in FY26 as well on the express business side. On the contract logistics business, you would have seen a strong revenue growth. However, I would say the EBITDA impact was not in line with that. And that was primarily driven by a high degree of white space than what we would be usually comfortable with. Now, we have a few specific leases coming to an end in this financial year. So we believe that once that is done, we should be able to normalize the white space as well. So a normalized white space would mean that we do not have a wasted operational cost, and that should also help translate the entire revenue growth. It's almost been 48% growth that we have seen in contract logistics business. That should also translate into a bottom line impact in the coming year.
One final question, Ravi. Then what is your market share currently for the all cargo terminals business, and what are you targeting for this year? And if you could also tell us what are the kind of volume improvements that you're expecting for Gati, considering the fact that there are eight new hubs that are coming up in the next 2 to 3 quarters?
Yeah, so we believe that, in Gati, we are hoping for a double-digit growth on the top line, which should be in line with the volumes. We believe that yield should also improve. All Cargo Terminals is a separate listed company, just to clarify, though it's part of the same group. It does not come under the All Cargo Logistics entity. On All Cargo Terminals, we are the largest CFS operator, and I would say we had a good problem in the past. Our yards were fully utilized, and therefore we were looking for additional capacity. We expect to find some strategic opportunities to expand capacity and thereby grow revenue. And we're also working on our inland container depot, the ICD in NCR, which should also pick momentum in terms of the construction and development in the coming FY26. So overall, All Cargo Terminals has been generating strong cash flows, and we believe that business has opportunities to continue to grow in CFS and also now in the ICD and NCR.
All right, Ravi, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. All Cargo Group there. Various growth plans across business entities. Take a short break, but just before we do that, we are excited to unveil our brand new global business news channel, the CNBC-TV18 and all new CNBC-TV18 Prime, a channel that will provide live and in-depth coverage of global markets and economic developments through an India-first lens. In an inaugural episode of the Global Reset, we will be speaking with Chairman and CIO of GQG Partners, Rajiv Jain, today at noon. So do tune in to CNBC TV18 Prime. Welcome back. Still around about the 25,000 mark is where the index is. So still some hesitation at the higher levels. The dips are being looking to be bought into, but around 24,970 is where the index currently lies. Rohit Srivastava from IndiaCharts.com is joining in now. And Rohit, good morning. Thank you for joining in. You were mentioning that you are expecting this move to go up to 25,300, which is the 78.6% retracement of the entire fall that we've seen from September last year. If we do end up making new highs, where do you see the index going to, and by when do you expect the new highs to be formed?
So broadly, I think we should consider that we are in an uptrend that can last for several weeks and maybe even months. Typically, this period, when you start from March all the way into June or July, tends to be bullish. So we are in a seasonally bullish phase, which may continue to see us make higher highs and higher lows. So we cannot really bet on speed. What we can bet on is that the direction is likely to be upwards, and we are slowly going to gravitate towards making a new high. So 25,300, which I mentioned, is just the first important hurdle from a retracement perspective that we need to really get past. The odds of that happening have slowly been increasing, especially if Bank Nifty is able to pull off a breakout above 55,700, then I think the possibility of that happening increases, which means then the Nifty also would stretch towards the 26,200 mark, where we made an all-time high. So we do need, of course, various sectors to participate, but I think there's a rotation from one segment to the next segment slowly happening, and that is what will keep driving this move higher.
Okay, once this 25,300 mark is crossed, then the all-time high is what, 1,000 points away from that level, 26,277. Rohit, what about the global setup? You look at the global indicators very closely, the S&P 500, the dollar, the yields. Now, most of them, generally there was risk on in the global markets on the back of the tariff de-escalation narrative. Yeah. But now trade fears appear to be back. So what's the setup? Is it supportive of things looking up and rosy, at least till July?
So I'm not sure trade fears are really back, because, even what he did today in terms of Europe pushing the tariff discussions further down the line, I think that's going to be the process, because it takes time. One thing is to say that you have a 90-day time horizon, but essentially you want things to work out. You don't want things to fall apart. And so if it takes time, dates are going to get pushed ahead till you get what you want. So I think broadly it's accepted that, the US wants to collect a 10% on the face of it, fee for all the imports that they are doing. And apart from that, they may have various, requirements or things that they want to achieve, which is what they will try to negotiate. So I think broadly it's moving in a positive direction for the market. Now, if we just remove tariffs and we remove geopolitics like the war or Russia, Ukraine, etc. from the picture, then we are left with only one macro risk, and that has been the bond market. So that is the only thing people are worried about, because bond yields were rising. Now remember, we are at the level at which the 30-year bond yield, the last time it was here was in October of 2023, and then moment it backed off, you saw one of the strongest rallies in the market in PSU stocks, etc. And we are back at the same level, except that this time the downward momentum in the bond market is very, very slow. So somewhere, the bond market is also losing its downward momentum. It's got some reaction, but the reason for that would be that you can hear that the Fed is eventually going to move towards lowering interest rates. And since they've already moved to cutting QT, means at some point of time, they may even have some kind of a bond buying program, whether the same or with a new name. And that, I think, expectation is why the bond market is not exactly falling apart. The hope is that first, the other countries, you've already seen Germany and China start stimulating and cutting interest rates. India started to do that from February.
Right.
Now the question is, when does the US do it? Because that's the last man standing. And it's becoming slowly and slowly more visible that we are closer to that point that they will flip. And so that is why the last risk that was there for markets, which is some kind of turmoil from the bond side, is likely getting moved out. And I think that's why risk is coming back to markets.
Right. One final question, Rohit. You'd mentioned that the Nifty Bank is positioning itself for 61,000. By when does that happen? Once it breaks above 55,700? And two, being that you mentioned PSUs are one space where you find value, being the low risk exposed sectors. Where within the PSUs are you finding value? Be it railways, defense, OMCs? Where are your picks here?
Yeah. So first, the Bank Nifty typical rallies, what we've seen at least since March has been, 2 to 3 weeks for each leg. So I will give it around 2 to 3 weeks to, get past 60,000 as far as the Bank Nifty is concerned. Now within PSUs, so they broadly, these are areas where you've seen a huge correction also. If you just go by the PSU index, the RSI indicator at one point of time being, well over 90 at the weekly level is now, fallen all the way to 30 and then started to bounce from there. So broadly, I think PSU stocks are done with their correction. And it's been a pretty broad-based participation. So it's not like one segment or the other. Various segments have participated in that move, whether it's the power finance companies, whether it's those related to the commodities sector. So that includes the metal names. It does include OMCs. It includes sort of a lot of stuff. And most of them are core sector industries, right? So what we are really looking at is a turnaround in the core parts of the economy. And somewhat driven by the metals cycle also. So, when we talk about bond yields and the dollar, what we're really looking at is a falling dollar triggering rising commodity prices. So we saw copper prices jump up quite a bit on Friday, which is why you're seeing some enthusiasm again in metal stocks, not just the steel companies that were doing well last week, but also those in the aluminium and
Right.
copper space specifically. So I think it'll become pretty wide when you think of the PSUs also, because various segments are parts of the economy which will start moving.
Right. All right, Rohit, thank you so much for sparing time and joining us today. Looking forward to having you more often on the platform. Rohit Srivastava of IndiaCharts.com. Take a short break. Up next, we get you a quick chart check and some trading ideas with Aditya Agarwala of Invest for Edu on the other side. Stay tuned.
Welcome back. Aditya Agarwala is now with us for a quick technical check on the markets. The Nifty is still going strong with more than a 100-point gain for itself. Aditya, what are the charts telling you now? And banks are trailing. Will it continue to underperform? Is there a trade? And your stock calls?
Hi, good morning, Reema. Thanks for having the show. If we take a look at the market, I would also like to draw the attention towards the India VIX. That is something which is surprisingly up 6%. And it's sustaining above the mark of 18 now, Reema. So that is something which traders and market participants should keep a close eye on. One should not lose sight of the India VIX because a move above 18 is something which is a little scary in the market if you are a pure play bull in the market, and anything above 19 will actually lead to a more volatile move in the market. Now, keeping that in mind, yes, we are witnessing an up move both on the Nifty and the Bank Nifty. Let's first talk about Bank Nifty. Bank Nifty failed to take out that key hurdle of 56,000 on the upside, and from there, it's witnessing some kind of a profit taking. My sense is in the coming trading sessions, you will continue to see this range-bound movement both on the Nifty and the Bank Nifty. As far as Bank Nifty is concerned, 54,500 on the downside is a good support area. On the upside, 56,000 is a resistance area. And I wouldn't be comfortable with a long without any hedges till the time this India VIX is below the level of 16. Till the time it's trading above the level of 18, I would like to take long bets with some hedging positions as well. Same holds true for Nifty as well. 25,100 on the upside, Reema is acting as a hurdle. On the downside, 24,400, 24,200 are key support areas. So my sense is both the Nifty and the Bank Nifty will continue to consolidate, while you will see a stock-specific and sector-specific rotation happening in the market. Money is not clearly flowing out, but yeah, it's more of a sector rotation that we are witnessing in the market. So I think IT and FMCG are the two hiding spaces right now, while markets might just turn volatile towards the second half of the trading session. So keeping that in mind, I've got a couple of buy recommendations for the viewers. The first one is, again, from the IT space, Coforge, mid-cap IT name looks very strong to me on the chart setup, on the verge of a breakout from a bullish cup and handle pattern. On the upside, for a target of 9,000, I'll be a buyer in Coforge, keeping a stop loss at 8,100 on the downside. The second stock is Nestle from, again, FMCG pack. I think this is one stock which has formed its base and now it's looking to head higher, while markets may turn a little volatile in the next few trading sessions. So for a target of 2550, I'll be a buyer in Nestle, keeping a stop loss at 2,400 on the downside.
All right, Aditya, thank you so much for sparing time and joining us today with your views on the index and on specific stocks as well. If the outside weather was not an indication enough, it's official now.
It's official now, but you heard it first from Manisha.
Oh, of course, you heard it first from Manisha. And yes, it is official. The monsoons have arrived in Mumbai 17 days before the official onset of the monsoon. And this is, of course, breaking multiple records. This is the earliest ever onset of monsoons in the city. And the last time the earliest date of arrival was on the 29th of May, and that had happened in 3 different instances, of course, with records available from 1951. So, of course, so good. You heard from SkyMet as well just a few minutes earlier. There will be an initial spurt of rains, but they will take a break in the first week of June. But the monsoons there have arrived 17 days before the official onset date in Mumbai. And today is that day. And of course, we all request our citizens to stay safe in these rains as well. Take a short break. The management of Max Estates joins in on the other side. Stay tuned. Welcome back. Continuing with corporate conversations, the management of Max Estates is now joining in on the show. Mr. Rishi Raj, who is the COO at Max Estates, is now joining in to discuss the road ahead for the company. Mr. Raj, good morning. Thank you so much for joining in. You know, your lease rental income saw good growth, but you fell short of the 130 crore guidance that you had this year. What's the road ahead for FY26? What is the kind of figure that you are penciling in?
So the lease rental at the current run rate, where almost all our assets is 100% occupied, Max Square, the latest one at 99%, the run rate is 155 to 160 crores. That is what we are looking at in this FY26.
155 to 160 crore will be the lease rental income for FY26. Commercial volumes, sir, have been on the rise. What's the outlook for FY26 and the split between commercial and residential?
So, Rima, if you look at our portfolio, we have curated a 17 million square foot of portfolio, growing from 8 to 17 in last financial year. 6 million is commercial and 11 million is residential. Of that 6 million, 2 million approximately is already delivered and leased. Our balanced commercial, almost 3.6 million square foot, is under construction, and that will come online by calendar year second half 2027. And intrinsically, I would like to tell your audience that with the acquired commercial portfolio, we have an annuity rental income potential of 700 plus crore. And this you will start seeing clocking up from FY 2029 onwards to FY 3031. So in total, today we already have 6 million square foot with 700 crores plus potential of annuity rental income.
So what is the on-ground situation when it comes to demand that you are witnessing, Mr. Raj? We are halfway through the first quarter of FY26. What's the demand scenario looking like, especially in your micro markets like Gurgaon and Noida?
Very positive. If you look at 2024, Pan-India, we did 18% more than 2023 and passed the peak of 2019. If you look at first quarter 2025, if I focus on Delhi NCR, Delhi NCR has done 3 million square foot, which is 17% higher than first quarter of 2024. Actually, commercial office leasing traction in Gurgaon as well as Noida is going extremely strong, particularly for grade A plus, developer-owned, developer-managed quality building, which we have developed and is clearly reflected in our occupancy as well as 30% plus premium on rentals that we are commanding in all of our 3 developments.
What geographies are you targeting for new acquisitions if you need to meet your FY28 pre-sales target? So say in the next 1 or 2 years, what more needs to be done and the geographies you're looking at?
So Rima, I'll answer that in 2 parts. If you look at our track record so far on the residential side, which I guess what you are asking me for, we started our residential journey in FY24, did a booking value of 1844 crores. FY25, we have done three times of that, 5,300 crore between Noida and our first residential launch, Estate 360 in Gurgaon. Our guidance to market for next year is 15-20% higher, 6,000 to 6,500 crores. And over FY26 to 28, our guidance is of 21,000 crore. And I would like to share with your audience that of that 21,000 over next 3 years, we already have secured 14,000 crore worth of booking value in our portfolio. So from a business development perspective, we are very sorted for next 2 financial year. Having said that, we would like to grow our 17 million square foot of portfolio with 11 million residential year on year by at least 3 million, 2 million residential, 1 million commercial. And our focus, to answer your question, is going to be Gurgaon, Noida, and Delhi. Delhi is going to be a priority from a residential perspective, given that we have a commercial footprint in Delhi, but we are looking to add residential footprint as well. We are always on the lookout for New York market, which we are keeping a close watch on within Delhi NCR. But at this moment, our focus is Gurgaon, Noida, and Delhi.
All right, Mr. Raj, thank you so much for sparing time, joining us today. Wish you good luck for the rest of the year as well. The management of Max Estates on the road ahead for the company. Take a short break. On the other side, put the spotlight on PSU banks and how they performed in the March quarter. Stay tuned.
Wait.
Welcome back. The Nifty's back at 25,140 points up, but it's curtains down on trading hour. But as we do that, let's put the spotlight on financials. In our special offering, FinStreet, Abhishek Kothari highlights the performance of PSUs and private banks in Q4 FY25.
In Q4 FY25, PSU banks have reported their highest ever quarterly profits. The gap to private bank is now the highest ever at more than 6,600 crore rupees. This is largely due to better top-line growth than private banks on a sequential basis that they have seen. So the net interest income growth for PSU banks was around 2.2% YOY and about 1% sequentially, while that for private counterparts was about 4.5% on a YOY basis and just 0.1% on a sequential basis. Other income has also helped PSU banks on their operating profit growth this time around. So PSU banks have seen robust other income growth on a sequential basis, which actually helped their operating profit growth as well. They saw an operating profit growth of more than 13% YOY and about 16.3% on a quarter-on-quarter basis. This compares to a 5% decline in operating profits on a YOY basis for private counterparts and about 1.9% sequential decline for private banks on their operating profits front. Now, IndusInd Bank is the only lender to report operational net loss in Q4 FY25. Profit after tax growth for PSU banks was stronger than that of private counterparts. Profit after tax growth for PSU banks was around 13.5% YOY and about 8.7% on a sequential basis, while private banks saw their PAT decline by 6.7% YOY and about 1.5% sequentially. Now, three private lenders, IndusInd Bank, ISAF SFB and Suryodaya Small Finance Bank actually reported a net loss in Q4 FY25. Slippages increased for the sector marginally in Q4 FY25. For the sector, slippages increased by less than 12% on a quarter-on-quarter basis, but this was led by PSU banks, wherein the slippages increased more than 36% on a sequential basis, while that for private banks actually declined more than 1% on a quarter-on-quarter basis. So annualized slippage ratio for PSU banks continued to remain below 1% level. Annualized slippage ratio of private banks was around 1.9% when compared to 1.96% in the previous quarter. Asset quality, gross NP ratio of PSU banks has declined to 2.6% versus 3.5% on a year-on-year basis. So gross NP ratio of private banks was around 1.83%, which is flat on a YY basis. Net NP ratio of PSU banks has fallen below that of private banks for the first time ever. So PSU banks' net NP ratio is at 0.5% when compared to 0.52% for private banks. IIFL CAP has released their note wherein they have shared their views. They say that following calendar year to date outperformance and earnings degrowth in FY26, they expect the sector to take a near-term breather. However, as the deposit cost catches up with a lag, they expect high teens EPS growth in FY27 for the banking sector. While banks' loan growth is sluggish, overall credit growth is still healthy, around 13% YOY. Repo rate cuts to drive further net interest margin contraction in FY26. So the expectation is that 100 basis point of cumulative repo cut that is seen in this cycle will result in 20 basis point of net interest margin compression until 3Q of FY26 and a rebound thereafter in the net interest margin of players. So they expect higher net interest margin contraction for large private banks, followed by PSU banks, followed by mid-sized banks. The microfinance concerns have shifted from asset quality to growth. So on the MFI, they expect FY26 growth to disappoint. They expect earnings degrowth in FY26 followed by a strong rebound in FY27 for the banking sector. DIIs have been raising their stakes, especially in private banks, but FIs have been trimming their overweight position in the banking sector.
Stocks climb after Donald Trump puts off tariffs on EU till July 9th. Auto and IT, as well as utilities, are the big gainers. Financials, realty and consumer discretionary, however, lag.
JSW Steel tells CNBC-TV18 it is pursuing legal options on Bhushan Power and Steel and expects to be eligible to rebid or get a refund in case the company goes into liquidation. The steel maker remains upbeat on prospects for FY26.
MSCI and FTSE indices announced weight reductions for Eternal following the company lowering its foreign ownership limit to 49.5% from 100%. The stock slips on anticipated outflows of over $800 million.
Divi's Labs perks up on inking a long-term manufacturing and supply agreement with the global pharma company. The arrangement will entail a capex of around 650 to 750 crores.
Rain lashes Mumbai as monsoon arrives early in Maharashtra. In the past 35 years, it's the earliest it has arrived. This after its onset in Kerala on May 24th is its earliest since 2009.
Hello and welcome to Halftime Report, live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra, with me is Mangalam Balu. Well, it's turning out to be a session where it is definitely raining green on the screen at this point in time. So we have the EU tariff deadline extension, which has really aided sentiment across markets globally, and that's filtered in or rained down, onto our markets. But nonetheless, stocks in focus. There's a lot to watch out for today. We have JSW Steel, Balkrishna Industries, Glenmark Pharma. All of these stocks in focus on the back of their numbers. And in terms of other stocks in focus on the back of news, just watch out for Divi's Labs, Eternal, Shilpa Medicare, all of these stocks which are buzzing around. And we'll get you all of those updates in the next 60-odd minutes. Hi, Mangalam.
Hi, Ekta. Good afternoon. Quite a precipitous use of rain-related, references out there. But tell you what, today's gain could be on a lot of domestic flows because the US markets are shut on account of Memorial Day tonight. So I will be watching out for volumes very closely, the FI volumes in particular. And typically when that happens, when domestic flows are supreme, you have the mid-caps doing well. And that's exactly what's playing out today as well. A lot of these stocks are spiking as we speak. So nearly 1,700 stocks which are in the green for about 800 stocks which are in the red as well. So we have a bunch of broader market names which are spiking, and most notably some of them from the cash market space as well. So if you look at a couple of these stocks which are notching gains, Cosmo First, for instance, has moved to the high point of trade, up 10%, locked in upper circuit all through today's trading session. We've had Inox Wind pull up some gains as well. Emcure Pharma is the other one, which is up around 9% after gaining post its numbers. All Cargo Gati has recovered from the lows, currently at the high point of trade. But a bunch of result reactions is what we're watching.
Yes, absolutely. It's been very active from the entire hospital space. We have a lot of stocks which came out from the entire hospital healthcare space. So, for example, Narayana also buzzing on the back of their numbers. But we do have Healthcare Global, which we're going to be talking to. They came out with their numbers. It is the first management on the show. The stock is under pressure after reporting what was a tepid set of Q4 numbers. Average revenue per occupied bed was up 3.5%, but the inpatient bed occupancy dipped. To discuss this and more, we have B.S. Ajay Kumar, who's the Executive Chairman of Global Healthcare Global, joining in. Dr. Ajay Kumar, thank you very much for taking the time out. Well, just wanted to start by talking about the ARPOBs, or the average revenue per occupied bed. That's up 3.5%, but occupancies of beds dipped by around 200 basis points in Q4. Is that because the average length of stay is reducing, your outpatient, medical solutions are increasing? Can you give us a reason for this?
Definitely, going forward in oncology, the AOL, the average occupancy is going to come down. And we have XCG, we are very proud that average length of stay comes down and most of it becomes outpatient. So we usually go by footfall and the growth. And we expect going forward, but as we add new beds, obviously, in different areas, our breadth strength is going to increase, but occupancy may be stable or minimally increase as we go forward, because majority of the therapy will happen as an outpatient, which is actually good for the patients. And I think in the long run, it is also brings more efficiency within the system.
Right. That's incredible. Outpatient therapies and the length of stay reducing, particularly in cases like oncology. From a patient standpoint, that's incredible. Let's wonder how that plays out for you in terms of, the financials as well. You're saying that occupancy remains the same or at best declines a couple of percentage points. How much are chemo and LINAC utilization as a proportion of your sales? How much are outpatient as a proportion of your sales? And if occupancies are likely to reduce, then I suppose outpatient revenue will increase, right? So what's the contribution right now? How much does it go to?
Yeah, the outpatient contribution is significant. It may be in the range of about 65-70%. And when you look at even chemotherapy, most of it is done a day chemotherapy. Radiation, of course, is all day therapy. It is only the surgery and people who get into hospital for any complications. And HCG, we are very proud, we don't have that many complications. And that is part of the reason, when you look at our data, our...
Okay, I think there's something gone wrong with the line. Maybe we can just reconnect with Dr. Ajay Kumar. Dr. Ajay
He's
Kumar,
speaking. Yeah, go ahead.
if you could just continue.
Yeah, can you hear me now?
Yes. Go ahead.
What I wanted to say was, particularly in oncology, it's very important to focus on more outpatient, day chemotherapy, even day surgery. For example, even our robotic surgery, 3 to 4 days patients go home. And that is our objective in quality of care when you bring about outcomes are measured. So this is what we are very proud of. But going forward, of course, we are going to increase the bed strength. We are going to add nearly 900 beds coming year because of the new centers and new expansion. But at the same time, our occupancy percentage will not significantly increase.
Okay. All right. Give us a sense in terms of how your specific regions performed. Borivali, South Mumbai. You've set up, operations there. Tell us about what the occupancies, the RPOP growth and the overall performance was in these two centers specifically.
Particularly Borivali and South Mumbai have done extraordinarily well in this year, particularly the quarter also. In fact, South Mumbai, where we had some issues, has grown significantly over 40%. And Borivali also is obviously, it is profitable and the EBITDA margin has improved to over 20%. So these are some of the positive things, but we see a tremendous growth opportunity in Mumbai for us as we move forward. We have taken a lot of measures. And when you look at the time we came into Mumbai and now, we are in a very strong position to take a leadership role in the private sector in Mumbai. And that is how we are even creating hub and spoke model. We are creating outpatient infusion centers. So we have a lot of plans for the Mumbai region to grow because that is a growth opportunity for us. And our RPOP in Mumbai is over 70,000.
So on an overall basis, what is the kind of RPOP and margin along with revenue guidance that you can give us for this year? Because you've said occupancies will remain stable, maybe decline by a couple of percentage points. So what does this do to your overall performance?
It may not decline, but may not grow significantly.
Yes.
But our RPOP is a growth of 3.5-4%. We are at about 45,000 and it will continue to grow. As you can see on the curve, it continues to grow. But the good thing is in urban areas, our RPOP has improved significantly. For example, in Ahmedabad, Bangalore, we have an RPOP of almost reaching 1 lakh. I think these will continue to grow with a good, healthy margin of the established centers have a healthy margin over 25%. And I think even the new centers, so-called emerging centers, will catch up there. And we expect our margin to be in the low 20s this year. At least 20% we hope we will touch.
Okay, you hope to touch 20% margins this year on a blended basis.
Yes.
Okay. The reason I'm asking you about your Mumbai market performance is because the competition is increasing quite a lot in the Mumbai space. For example, we do have hospitals coming up in Thane. Adani Healthcare has launched. They're looking to launch a hospital, Kandivali. In that context, competition, the number of beds is increasing. How are you probably creating a roadmap to combat the competition? How do you view it?
See, our model of HCG, when we started as a focused factory, very specialty oriented, one thing was very clear. We are looked upon as a destination. When you look at oncology care outcomes, as an oncologist, I can very say that outcomes are the best when you go to dedicated oncology centers. So because of that, our referral pattern, our footfall continue to increase in spite of multi-speciality hospitals starting, oncology centers. So we are very confident that our growth strategy is there. If you look at, for example, Borivali, we have a significant growth upside as we move forward in enormous population base and the type of cancer we see as a destination. Because most of our cancer patients who come for our tumor board, second opinion, growth is all big. Majority of them also are recurrences and significant new patients are coming. And when we put out our outcomes, obviously that will also bring in patients. So we feel awareness of cancer is going to increase. And with
Right.
that and the number of cancer patients significantly increasing in the urban areas, I think our growth strategy is very much in place.
Okay. Well, you do have KKR, which has taken over. Any kind of synergy integration that you can talk about, CVC's remaining capital, anything in terms of remaining stake, rather, anything in terms of monetization?
No, I am staying with my percentage. I am not changing that. As far as KKR is, as we have announced, the transition is happening. Hopefully, in the next few weeks, the whole place will happen. And of course, we will make necessary announcement when everything falls in place.
And you are staying at the helm as well, right? Irrespective of what KKR does.
Yes, the chairman. Yes.
Perfect. 10.4% is what you hold. You will continue to hold on to that. KKR comes in sometime next week. You will give us an update on that. And let's hope there is no immediate supply event with CVC holding about that 9% stake as well. Is there one?
CVC will continue with the stake, but again, we have to see how the open offer goes and all that. If any changes will happen at that.
Take that point. Thank you so much, sir, for joining in and giving us the business outlook for this year. 3.5% RPOP growth with blended margins turning 20% is what your guidance for this year is, with occupancies remaining stable at the 58% mark itself as contribution from outpatients increases. With that, let's move on and tell you what we're excited about. We're excited to unveil our brand new global business news channel. CNBC-TV18 presents an all-new CNBC-TV18 Prime. It brings you the insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you an unparalleled insight. Tune into CNBC-TV18 Prime at 12 noon today for the Global Reset and Global Lens at 8:30 p.m.
Welcome back. Well, for the markets, it's steady. So we have the Nifty, which is up around 0.5%. The Bank Nifty, which is trading with a gain of around 0.2% at this point in time, and the advance decline ratio holding quite steady. Around 2,400 stocks advancing to around 1,640 stocks declining. Just watch out for MQ Pharma, because that stock has now gained around 36% this month. Done very well in the past couple of trading sessions. Is up 8% on good volumes today. And giving it company is Dishman. That stock is up around 38% month to date as well. So just watch out for a couple of these counters. But let's get talking on one particular company now. Parent company of Zomato, Eternal, is trading under pressure. Vivek is here to tell us why.
Well, that's right. So Eternal, the shares of Eternal, like you mentioned earlier, known as Zomato. Now, what's actually transpired over here is that on Friday evening, in an ad hoc decision, both MSCI as well as FTSE announced that they would be reducing the weightage of that particular stock in the respective indices. Now, what is the reason for this particular weight reduction? Remember, earlier last week, the shareholders of the board of Eternal voted in favor of going ahead and reducing the foreign ownership limit of Eternal, and they capped it at 49.5%. This ensured that the foreign headroom available for FIs and FPIs to invest reduces significantly. So in line with that, both of the index providers, MSCI as well as FTSE, have gone ahead and reduced their weightage. So what will be the likely outflow? IIFL Capital estimates that on account of the reduction of the weightage in the FTSE indices, Eternal could see outflows of close to $380 million, and this will happen in the trading session of May 27th. The MSCI weight reduction, which is scheduled on May 30th, could lead to outflows of close to $460 million. On account of this overhang of selling, you're seeing the shares of Eternal underperforming otherwise an essentially strong market today.
Take that point entirely, Vivek. Thanks a lot for that. To putting the number, earlier brokerages had estimated about $1 billion worth sales coming in, and that exactly has happened. This was supposed to be a supply event, and that has now come by. Let's see whether, from lower levels we see some purchase here post the event or not. The other concern is that of rising competition and rising losses in the quick commerce space. Ekta, back to you. Shilpa Medicare, it's tied up with a Finnish company called Orion Corp. Tell us a little more about this.
Well, yes. Besides that, it's also coming out with its numbers today. So that's the reason why you're seeing so much interest in the counter. But they did announce on Friday during market hours that the company is tied up with a Finnish company, Orion Corp. This agreement is to basically commercialize recombinant human albumin in Europe. So Orion has an exclusive right to distribute, market and sell Shilpa's particular recombinant human albumin in Europe. So basically whatever Shilpa manufactures, Orion has an exclusive right to distribute it. Now, this particular thing, which is recombinant human albumin, is a key plasma protein. It's used in various therapeutic applications and as a critical component in vaccine and biologics. So there's a potential that, the street is quite bullish on this particular tie-up, but separately, the company is reporting its numbers today. So that's the reason why the stock is also up around 12%. So there's a lot of, the street is watching out on what they could probably report today. But the other one is Balkrishna Industries, which is under pressure. It's in focus on the back of its Q4 numbers. And we have Vamakshi here to give us the details.
Well, Ekta, when you look at the numbers that have come through from the company, the total revenue saw an uptick of 5.2%, out of which the revenue from operations saw an uptick of almost 3%. The rest of the growth actually came in from the realized gain on Forex. This came in at 91 crores this time around as compared to 24 crores in the same quarter previous year. As far as volume and realizations are concerned, the volumes were rather flat at 82,100 odd tons. The realizations actually drove the entire improvement that we saw in the total revenue. The realization saw an uptick of almost 5.3%. The operational performance, though, was quite tepid. The margins have contracted by 115 basis points to 24.8%. The EBITDA is rather flat at 703 crores, and the net profit actually saw a very sharp fall of almost 25%. And this is because there was an unrealized Forex loss of almost 58 crores in the fourth quarter. Now, in the conference call, the management also refrained from giving any growth guidance for its core global
off-highway tire segment. They say that they continue to face demand headwinds in their key global markets, but going beyond that, the company has also given a 5-year roadmap, and they are expecting to scale up their revenue by over 2 times, 23,000 crores by 2030. They will be investing nearly 3,500 crores in capex over the next 3 years. This is in addition to the 500 to 700 crore capex that they had already announced. Now, Investec believes that this accelerated capex is likely to constrain the company's free cash flow. Apart from that, they've also announced foray into TBR as well as the premium PCR segments, which will contribute nearly 20% to the company's revenue by 2030. But again, out here, Nomura believes that this is an entry into a very competitive space, and therefore the midterm ROEs could, come under pressure on account of that. Let's also look at what some brokerages are saying. So Morgan Stanley has an underweight call. They've cut their target price to 2,070. Investec too has downgraded the counter to sell, cut their target price to 1,910 per share, and Nomura also has downgraded it to neutral, target price of 2,644 per share. So overall, doesn't look like a good set for Balakrishna Industries.
All right, take that point, Vamakshi. Thanks a lot for that. Let's take a short break. On the other side, we have Sneha Seth of Angel One joining in on some trading strategies as the Nifty meanders around 25,000. Welcome back. Look at Kalyan Jewellers. That stock's moving higher. So we have a bunch of these mid caps doing well, and keep an eye out on Vodafone Idea as well. It's been beaten out of shape, down almost 50% in the last 1 year. Adverse rulings against the company as well, and now has smidged higher and currently is sitting with the gain. For most part in the day, it was mildly in the red, and now currently has inched back into the green. So we'll keep an eye out on all of this as we watch out for the markets. Key indices in focus today. We have Nifty, Nifty Bank as well as the mid-cap index. The Nifty Bank facing supply at higher levels, as is the Nifty. The mid-cap index is the one which is outperforming. It's volatility in the expiry week. So the India VIX comes up for you up around 5%, back above that 18 mark. So we'll watch out for whether the market sustains at higher levels or not. But today's high on the Nifty as well as the Nifty Bank are telling. We had expected some congestion to come by on the Nifty upwards of 25,050. That's what the option writers were positioning for. And on the Nifty Bank as well, the previous all-time high is 56,000. So support at 55,000, which is the 20-day moving average, comes in, and supply as we move towards 56,000 comes by as well. For options that expire this week, 25,000 seems to be the fulcrum, 25,000 call and the 25,000 put. both of them equally active for a premium of almost 200 to 250 rupees, telling you that the street is bracing itself for a broad range of 24,800 at the lower level to about 25,250 at the higher level itself. Just keep an eye on the advanced decline because, again, it is a domestic institutional investor-led market today because of the absence of FIIs. We have the advances far outnumbering the declines, and that's why the red and green lines are pretty much far apart. It will be very interesting to see where we go in the second half of trade, largely because of the increased volatility and supply at high levels.
Okay, all right, Mangalam. Thanks for that. That's on the F&O space. Sneha Sheth of Angel One now joins in to discuss the technicals of the market. Sneha, hi, welcome to the show. Well, it is turning out to be a stable day. We have the Nifty at around 24,981. We have the Bank Nifty, which is up around 140 odd points. What would your call be at these levels?
So good afternoon. Like if we look at the market, yes, it is quite stable and it is managing to take the supports around the levels, and it is holding those support. That is important. So in case of Nifty, I believe 24,800, 700 is the support zone. In case of banking index, 55,000 remains a support zone. So overall, we are seeing higher top, higher bottom structure in the key indices, and we are also seeing the put writers shifting higher. So that is the overall structure, and it looks positive for now. One can use such dips if we get any dips, and one should be using those dips to go long. Focusing on individual counters would be a apt strategy for now. So that should be the focus for now.
Let's focus on that then. What are the stocks that you have, Sneha?
So I'm looking for Tata Motors. If you see today, auto space is doing quite good, and Tata Motors, if you see, we are seeing decent writing happening in 720 put options. At the same time, we are seeing unwinding and at the money strikes of the call options. So that is a positive indication. I believe one can go long with a strict stop loss of around 717, and the target expected will be around 757. Apart from this, LTI Mindtree looks good. So this is the counter wherein we have seen a strong up move, which was followed by consolidation. And I think looking at the overall chart structure, it looks poised for a breakout. So I would recommend buying at current levels with a strict stop loss of around 5,040, and the upside target would be around 5,250.
Okay, all right, Sneha, we're going to leave it on that note. Thanks very much for joining in and taking us through all of those strategies. Well, that is the technicals of the market. We need to take a short break, but up next we'll be talking to Ramesh Kancharla, who's the management of Rainbow Children Medicare, on their Q4 performance. Stay tuned. Welcome back. Well, let's get talking to one particular company. Rainbow Children's Medicare is the next management that we have on the show. It reported a decent set. The margins came in healthy. Average revenue per occupied bed was up around 7%. We have Ramesh Kancharla, who's the chairman and the managing director at the hospital, joining in to discuss the performance this time. Thanks, sir, for joining in. If you could just start by telling us what took place in the occupancy this quarter. There was a dip to around 46.5%. versus over 53% last quarter.
That's right. There's a slight dip in the occupancy because of, so we've seen unusually kind of the quiet season, especially in the pediatric outpatients and the pediatric admissions and related pediatric intensive care admissions. That was actually brought down the kind of overall occupancy and to an extent some revenue as well.
So what can you guide for the entire year when it comes to occupancy and revenue per bed? And how does that move your margins?
I think if we go back and see that Rainbow has been always a 3 years CAGR or for 5 years CAGR, we've been growing at 16%. I think that now we have added a lot of beds in the last couple of years' time, and we're going to have some more beds coming in, about 250 beds this year. So I would expect a late teens to 20% of growth for the current year. The macro seems to be fine. The monsoon is around, and also we have boarded quite a few doctors, and it all looks good.
You're expecting 20% growth on the top line this year?
Yeah, late teens to 20%. Yeah.
Okay. Are you already seeing a recovery in terms of your occupancies, for Q1?
Yeah. Generally, the Q1 also goes slower, but we start seeing a trend.
Okay, you're seeing a bit of an uptrend. And what about the average revenue per occupied bed?
See, the RPOPs were kind of the last quarter was about 8,000, I think. And so what we've been trying to guide actually is an RPOP is very dependent on the ALOS. So we've been talking about ARPP, average revenue per occupied bed, per patient. So that's been steadily growing. So last year's complete year's ARPP is about 108,000, which is about 5.6 growth. So being a medical business, the RPOP is always a kind of varies with the average length of stay. Being a medical hospital is a difficult kind of a RPOP guidance. Maybe ARPP is probably a more accurate guidance. We've been talking.
So what is it? What is it on that? Average revenue per patient?
108,000. We have grown about 5.6% last year. Last couple of years also have been around 6%.
Right. What about your margins? You had said earlier that you would be expecting 25 to 27% pre-Ind AS margins. If you could, reiterate that for us. And at the same time, Rajamundry, you said that was delayed to the first quarter of FY26. Has that been further delayed, or is this on track?
No, it's on track now. So we'll be kind of opening up in the next, 30 days time, Rajamundry. And also the 2 spokes in Bangalore is going to come by the end of the second quarter. So overall, we'll have about 250 coming into the operations this year.
And margins, 25 to 27%, you hold on to that?
Yes, like last time we discussed a year ago that, whatever the bed addition coming in, still we maintain about north of 25% of the EBITDA. So probably whenever there's a new beds coming in, probably there may be a margin pressure about 1%. That's what actually we have seen last year, about 0.9% of the margin pressure on the EBITDA.
Okay. I just had a couple of questions. Let's start with the international business, because you get a lot of business from Somalia and other regions, but you've seen a lot of disruption there. In fact, what did you close the year with in terms of the international business? How much did it decline compared to FY24, and what are you guiding for?
We're down almost by kind of 11 crores from last year. And we were actually, the budgets were almost, we were able to do only 50% of the budget of international business. So it's looking a bit better now, positive. Still, there are macros of the Bangladesh, Somalia, and Oman. Some of the challenges are there. So we are working on the new geographies, other countries. Hopefully, we do much better this year.
Okay. The other thing which I wanted to touch upon is your IVF clinics. You've got around 12 operating currently, and you've said that you've seen good traction in it previously. So what was the revenue generated from the IVF clinics this quarter, and what are you estimating in it?
There's still a low base, but we've grown about 70% of IVF. I think in a year we clocked about 40 crores of IVF business. So it's a very recent business. The IVF clinics, which we have not done outside the hospitals, they're all within our existing hospitals. So it's a very organic business, which we are trying to focus it based on our reputation and also doctors. And it's like model is a full-time doctors driving the IVF business based on the brand and credibility and reputation.
So, 40 crores is what your annual revenue this year has been. We're just trying to figure out on a low base how much higher can it grow. And alongside IVF, you also have Butterfly Essentials, which is basically mom and child care, which you have also opened in 15 hospitals, right? So what's the revenue of that business this quarter? Together, IVF and, this Butterfly Essentials, what's the scale that you're expecting here?
I think the IVF is clinical business. The Butterfly Essentials is more of retail. And I'm not really... I don't remember how much is exactly the Butterfly Essentials clocked, about an average a crore rupees per month. That's what it's been doing it. We just recently kind of going on online as well. So it's setting up well, and they're all in the store. The stores are within the hospitals only. And we are trying to take some new initiatives and also product ranges and those things. So being a hospital, we're trying to be a little cautious about, the people's expectations and brand, and also that kind of deliverables to the patients. So we are optimistic about the Butterfly Essentials growth of it as we move forward, both on online and offline.
Okay. You also have a hefty amount of cash on books. What's the utilization plan?
So we have a large projects coming up in Gurgaon, which is about almost 450 crores of capex is going to go for the Gurgaon. And also that we have still the current year projects, and also the Coimbatore is another one which is in pipeline. So we have some acquisitions working on it. So probably kind of utilize some of the cash for that.
And what about the acquisition that you were eyeing in the western part of the country? And how long before some of your other geographies break even? Just trying to understand the operational performance here.
And I think the acquisitions kind of work. We are working on that. I think probably kind of a bit early to talk about it. So we will come back to you soon on that.
And what about the break even of all your newer properties?
So the last year we opened about 3 new hospitals in Bangalore as well as Hyderabad and Chennai. So Hyderabad is actually it always breaks even the first year itself. Bangalore is close to it, and Chennai was kind of will take another 6-8 months time to break even. So I think by end of the year, the current financial year, we should be able to kind of even it or have a little positive EBITDA.
Okay, all right. We're going to leave it on that note. Thanks very much for joining in and speaking with us. So that is Rainbow Medicare. Stock is up around 0.2%. They are seeing some challenges when it comes to the international business, which has dipped around 11 crores as compared to the previous year. But separately, they are still guiding for around 20% in terms of margins and an increase in ARPOPs as well. Or average revenue per patient. We'll take a short break. On the other side, the spotlight is on PSU banks and how they performed in Q4 FY25. That coming up next. Stay tuned.
Welcome back. A couple of consumer discretionary names doing extremely well. So we have Trent, which has moved to the high point of trade. FMCG names as well. We have Tata Consumer, Britannia, as well as ITC, all of them moving higher. Perhaps the underlying assumption here is that if monsoons have arrived early and as the Met had predicted, if it's normal monsoon, that bodes well for rural consumption, which was anyway on a gradual recovery path. And urban recovery is what the street is eyeing by the end of the second quarter or in the second half of this year, largely because of all the measures taken by the government with regards to reduction of taxes, etc. But enough about the consumer space. Let's put spotlight on the financial sector. And in our offering, FinStreet, Abhishek Kothari highlights the performance of PSU and private banks in the fourth quarter.
In Q4 FY25, PSU banks have reported their highest ever quarterly profits. The gap to private bank is now the highest ever at more than 6,600 crore rupees. This is largely due to better top line growth than private banks on a sequential basis that they have seen. So the net interest income growth for PSU banks was around 2.2% YOY and about 1% sequentially, while that for private counterparts was about 4.5% on a YOY basis and just 0.1% on a sequential basis. Other income has also helped PSU banks on their operating profit growth this time around. So PSU banks have seen robust other income growth on a sequential basis, which actually helped their operating profit growth as well. They saw an operating profit growth of more than 13% YOY and about 16.3% on a quarter-on-quarter basis. This compares to a 5% decline in operating profits on a YOY basis for private counterparts and about 1.9% sequential decline for private banks on their operating profits front. Now, IndusInd Bank is the only lender to report operational net loss in Q4 FY25. Profit after tax growth for PSU banks was stronger than that of private counterparts. Profit after tax growth for PSU banks was around 13.5% YOY and about 8.7% on a sequential basis, while private banks saw their PAT decline by 6.7% YOY and about 1.5% sequentially. Now, three private lenders, IndusInd Bank, ISAF SFB and Suryodaya Small Finance Bank actually reported a net loss in Q4 FY25. Slippages increased for the sector marginally in Q4 FY25. For the sector, slippages increased by less than 12% on a quarter-on-quarter basis, but this was led by PSU banks wherein the slippages increased more than 36% on a sequential basis, while that for private banks actually declined more than 1% on a quarter-on-quarter basis. So annualized slippage ratio for PSU banks continued to remain below 1% level. Annualized slippage ratio of private banks was around 1.9% when compared to 1.96% in the previous quarter. Asset quality, gross NP ratio of PSU banks has declined to 2.6% versus 3.5% on a year-on-year basis. So gross NP ratio of private banks was around 1.83%, which is flat on a YOY basis. Net NP ratio of PSU banks has fallen below that of private banks for the first time ever. So PSU banks net NP ratio is at 0.5% when compared to 0.52% for private banks. IIFL CAP has released their note wherein they have shared their views. They say that following calendar year to date outperformance and earnings degrowth in FY26, they expect the sector to take a near-term breather. However, as the deposit cost catches up with a lag, they expect high teens EPS growth in FY27 for the banking sector. While banks' loan growth is sluggish, overall credit growth is still healthy around 13% YOY. Repo rate cuts to drive further net interest margin contraction in FY26. So the expectation is that 100 basis point of cumulative repo cut that is seen in this cycle will result in 20 basis point of net interest margin compression until 3Q of FY26 and a rebound thereafter in the net interest margin of players. So they expect higher net interest margin contraction for large private banks, followed by PSU banks, followed by mid-sized banks. The microfinance concerns have shifted from asset quality to growth. So on the MFI, they expect FY26 growth to disappoint. They expect earnings degrowth in FY26 followed by a strong rebound in FY27 for the banking sector. DIIs have been raising their stakes, especially in private banks, but FIs have been trimming their overweight position in the banking sector.
Okay, all right, Abhishek, thanks very much for that. So that's on the entire PSU banking space. We'll take a short break. On the other side, Manisha Gupta will join in. She has with her the president of the Overseas Agro Traders Association of Myanmar. Stay tuned.
Welcome back. Joining us on the show now is Shyam Narsaria. He's president of Overseas Agro Traders Association at Myanmar. Mr. Narsaria, hi, thank you so much for joining in. First of all, your sense on the global pulses availability. We do understand that not just Myanmar, but whether it's about Canada, Argentina, Brazil, many of these producing countries are looking at a higher production.
Good afternoon, Manisha. Thank you for inviting me. And this year's global outlook, as you all are aware, that the supply is on a higher side and demand is not that much because the Indian production been very good. As we all know, the Indian consumption for pulses is around 25 million tons per annum, and Indian production is somewhere around 18 million. But you rightly said that this year in the overseas market, like in Canada, Russia, even Brazil and Argentina coming up with a good numbers, and even Australia, which supported so much with the desi chickpeas, chana, almost 1.5 million tons of chana being imported this year. So the supply side is like a surplus, say 4 to 5%, I would say. So this year the scenario is entirely different if you compare to the last year. So the supply is
Sure. Mr. Narsaria, last year India imported record numbers of pulses. You do not see those numbers continuing in this year, do you?
I think India, this year also the numbers which come to me is somewhere between 6.5 to 7 million tons, because this year yellow peas import is very high, almost 2.4 million tons of yellow peas being imported. And then lentils, around 1.2 million tons of lentils will be imported. And then chana, around 1.5 million, which I already mentioned, 1.5 million tons of chana. Apart from this, the pigeon peas, again, over 1 million tons. Then black mapte, which is again of Myanmar origin, it will be imported around 800,000 tons, somewhere around 800,000 tons. So this year also the numbers will be very good, somewhere between 6.5 million to 7 million, which is a record. Again, it's going to be a record, but the prices are on a lower side. So I feel the consumption will also be higher this year and the import will also be higher. But there is, at present, it doesn't seem that there will be any deficit or gap, demand supply, big gap. Whatever demand in India, the supplier means like countries like Australia, Canada, Russia is always available for supply.
Mr. Narsaria, we've all been privy to that letter that IPGA has written to you. This is to get correction in sense of higher destination shipping charges that Myanmar puts right now, and of course problems around that bill of lading as well. How have you responded to those queries?
Actually, we received the same letter, similar letter from the Tamil Nadu Association almost 3 weeks back. And same 20th of May, we received from IPGA. And these are like very sensitive issues, like the extra shipping charges. As we all are aware that the shipping line incurring heavy losses because of the tariff war between China and US. So because of this, there are so many last moment cancellations from China bound cargo to US and like North America. So because of this, all the shipping lines are suffering, and so many reduction in the freight is seen over the last 1 or 2 months. So I think we call a meeting with all the shipping line on immediate basis, and most of them responded that they are not doing and they are not implementing any extra charges. But we understand there are some agents or like the brokers or the freight forwarders, they are making unreasonable invoices and asking the importers to pay higher charges, and they also like threatening that if you don't pay these charges, and they will not release the delivery order, and that may further result to like detention, which will be very high. So we have tried our best, and still we are following all the shipping lines, and we are trying to resolve this issue as soon as possible.
All right, that doesn't sound so good. But it's good to know that this has come into light and you are looking at, I mean, everybody's working towards it. Yet and again, a question about India now. As you said, the imports are going to be better. The initial sowing numbers seem good. The monsoon seems quite good this year as well. What does India import in sense of pulses right now? And do you see that dependency going down at all? Or do you think the way the origin countries are now producing pulses, India and these countries, the relationship is only going to get better going forward?
See, there was one report from Niti Aayog in February 2024, which says that by 2030-31, the Indian pulses consumption will be around 35 million tons. And the same report says the Indian pulses production will be around 31 million tons. So even the Niti Aayog is counting a 4 million ton shortage. But as we all know, the pulses depend a lot on weather, natural calamities, and the fluctuation in the pulses price is it's very common, very normal. It is based on demand and supply, and it is the essence of commodity trade. So what I feel, dependency, like Indian government always been claiming of self-sufficiency, but I feel it will be happy. I will be happier if India attains self-sufficiency. But I feel our so many countries, like last 2 years, Indian government and so many people visited different countries to Brazil, Argentina, Africa, and even Australia, and boosted the pulses export as the numbers were demand and supply gap was very big. And because of that, the the production in overseas countries, like in Australia, for example, the China production has gone up too much, and that supported India. This year, the China production in India is 8 million tons, whereas the consumption is 10 million tons. So 2 million gap can shoot up the price, but actually Australia helped and around to control the price and food inflation. Again, in the coming to Myanmar side, yes, we see a big demand supply gap in the pigeon peas and the black mape last year, and Myanmar really worked hard. The farmers, the association, the government worked hard and boosted the production. Still, we are meeting like the ministries and Department of Trade. They always say we have to boost the production, we have to boost the supply. So Myanmar is also working really hard in the production, and as a result, this year the black mape production is record high to almost close to 1 million ton, 900,000 to 1 million ton. And like as we can see, the Indian black mape production is around 2 million tons, and the consumption is around 2.7 to 2.8 million ton. So the crop stock availability in Myanmar, say 1 million, and Brazil, say 100 to 150,000. Will definitely work. It definitely worked and reduced the demand supply gap, and the price is at control. If you compare last year, the same time, say May 24, 25, and this year, the black mape price has come down by almost 23%. But for pigeon peas, the price has come down by 43% compared to the price last year in the same period. So we have seen the government initiatives are working, and self-sufficiency is it's nice to talk, but I don't think because of the increased consumption, increased production in India, it will meet the requirements of the consumers. As per the data, around 2.44% growth of pulses consumption is seen in India, and it is predicted. And also, like a lot of people are turning to vegetarian, and the pulses are the best source of protein and nutrition in India.
All right.
So
We do understand, as you put that number out, that
efficiency will be achieved.
We get that number that you said, that 2.4% of our demand growth is what we are seeing in pulses. And I very well take your point where you say that the global pulses availability is higher, demand not so much, and we could be looking at a surplus of 4 to 5%. I mean, that's the headline that I'm taking away from this conversation. Thank you, Mr. Nasaria, as always, for joining in and throwing light at all things important when it comes to Indian agriculture. And of course, pulses therein as a hero there. But with that, that's all the time that we have on the show. With that, it's a wrap on Halftime Report. Business Lunch will take all the action forward.
Stocks climb after Donald Trump puts off tariffs on EU till 9th of July. Auto, IT and utilities are the big gainers, while financials, realty and consumer discretionary lags. JSW Steel tells CNBC-TV18 it is pursuing legal options on Bhushan Power and Steel and expects to be eligible to rebid or get a refund in case the company goes into liquidation. The steelmaker remains upbeat on prospects for FY26. MSCI and FTSE indices announced weight reduction for Eternal, formerly known as Zomato, following the company lowering its foreign ownership limit to 49.5% from 100%. The stock slips on anticipated outflows of over $800 million. Divi's Laboratories perks up on inking a long-term manufacturing and supply agreement with global pharma company. The arrangement will entail a capex of rupees 650 to 750 crores. Rain lashes Mumbai as monsoon arrives in Maharashtra at its earliest date in the past 35 years. This after its onset in Kerala on May 24th, its earliest since 2009. Hello, good afternoon. You've tuned into CNBC-TV18, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala, and thank you so much for tuning in. Quick look at what the market is doing today in terms of that. We're seeing a good day coming in for the markets. It is managing to hold on to good gains in terms of the momentum that we saw on Friday. That is sustained, yes, slightly bit off the day's highest point, below the 25,000 mark. We opened up somewhere and went up to the 25,079, now at 24,972. So yes, as of now, 4/10 to 5/10% of gain is what we're seeing coming in for the benchmark indices. But let's look at what the Nifty Bank is also doing. So Nifty Bank is also managing to hold on to gains today. Mild bit of gains, 1/10 to 2/10% of gain that we're seeing coming in for the Nifty Bank. Went to the red, then saw recovery. Let's see where that's headed. Small cap as well as the mid cap performing in tandem with the benchmark indices. Not much of a difference on that terms as well. Almost 0.5% of gain for the mid cap. Small cap, 0.3% of gain is what we're seeing coming in. The sectors that are doing well, auto, energy, IT, managing to hold on to very good gains. What is not managing to hold on to gains is PSU banks. That is down and out. So yes, that's how the market setup is looking like as of now. But it's raining, it's pouring in Bombay and in other parts as well of Maharashtra. And southwest monsoons have already covered Goa and reached Devgarh in Maharashtra's South Konkan region. Now, the usual date for monsoon to reach Maharashtra is 5th of June. But this year, it has arrived 10 days earlier. Parts of Karnataka also are seeing, including, which is Bengaluru, seeing some bit of a rain. Then there's Andhra Pradesh and remaining parts of Tamil Nadu are expected to witness monsoon over the next 3 days. Heavy showers lashed in Mumbai, especially. Large parts of the city reported severe waterlogging, disrupting traffic, flights as well as railway operations. IMD sees likely spells of intense rain, gusty winds and thunderstorms in the coming hours. We have Santhya who's joining in with us to give us the latest update on this one. Santhya, over to you.
So many monsoon has officially arrived in Mumbai, and while we talk about and why exactly this monsoon is all about records, I would like to show some visuals. I'm right now in Mumbai's Hindmata area. It's a usually notorious area when it comes to water logging, and you can see we're trying to show you that this road which goes towards Dadar, how this entire road is waterlogged. And let's talk about this year's monsoon. As you were mentioning, that the onset in Kerala happened on 24th of May. That is 1 week ahead of its usual schedule. Second, within 24 hours, monsoon travelled and the onset happened in Maharashtra. So before this, it happened only in 1971 and 2012 that monsoon travelled from Kerala to Maharashtra within 24 hours. Another record is that monsoon has reached Mumbai on 26th of May. The usual arrival of monsoon's date in Mumbai is 11th of June. So around 17 days ahead of its schedule. That is another record. Now, let me talk about what has been happening in the city since last night. So the city witnessed heavy rainfall last night, which continued in the morning and now also in some parts of the city it's raining heavily. IMD earlier, that is yesterday, had issued a yellow warning for the city, which was upgraded to orange alert this morning, and now it has upgraded the warning for the rest of the day from orange to red alert. That means heavy to very heavy rainfall is expected to happen in Mumbai. The reason waterlogging is to this extent because the high tide was at 11:24. It was a 4.75 meter high tide, Winnie, which coincided with heavy rainfall that led to waterlogging in your usual low-lying areas, whether it's your Hindmata, the place where I am, Science Circle, your Dada TT, your parts of JJ. In fact, in western suburbs, parts of Andheri subway, Milan subway, all these areas, waterlogging, all these areas are witnessing waterlogging. For the rest of the day, there is red alert for Mumbai. Heavy rainfall is expected in the remaining parts of MMR as well, Winnie, whether it's Thane, Navi Mumbai, other parts of Raigad as well. Other than this is monsoon, one phenomenon. There is another phenomenon which is active in the state. One is a trough which is moving from a low pressure area which has now developed, which has now reduced to a well-marked area towards North Telangana. That is second system which is working in Maharashtra. Third one was a depression which has now reduced to a well-marked area. All these three systems combined, all these three developments combined are leading to heavy rainfall in Mumbai, MMR region, and parts of Madhya Maharashtra and some parts of Western Maharashtra as well, Winnie. The impact, I would once again request my camera person to show you some more visuals of the same area. The heavy rainfall has affected the railway local services also in the city. Central Railway is running at a delay of 20 minutes, and harbour line between Wadala and CSMT remains suspended. Winnie.
Okay, Santya, thank you so much for giving us the latest update in terms of what's happening, especially in Mumbai as well, where we're seeing flooding coming in, as well as the other parts of Maharashtra. But talking about the rains which have disrupted travel as well, 2 flights from Mumbai airport were diverted due to the bad weather, with Air India's Goa to Mumbai flight being diverted to Indore, and Air India's Ahmedabad to Mumbai flight went back to Ahmedabad. Now, officials say between 7 a.m. to 10 a.m. there were 3 windows where no flights arrived 5 to 10 minutes late due to visibility concerns. Officials also say that the low visibility operations procedures has aided departures to continue, and amid the concerns that are going on in terms of the heavy rains that we're seeing in the city. So that's the latest update that we have for you all in terms of the heavy rainfalls that we're seeing in the city. But let's move on and talk about more stock-specific action. And in the latest update that we have, JSW Steel is under pressure despite reporting an inline set of numbers. The Apex Court will also hear the company's plea challenging Supreme Court's early verdict on Bhushan Power's liquidation today. So we do have that update that's come in as well. A big relief for JSW Steel is what the flashes are indicating. Supreme Court directs for status quo for the liquidation proceeding in NCLT. But earlier on in the day, we spoke to the management on this front as well. So listen in to what they had to say.
So I may not be able to comment too much, but I think it's important to note that we have implemented the resolution plan in full compliance with the law, and we have been able to successfully revive the asset to its present condition where it is today, with increasing operational output, with increase of capacities. The second thing is that we have analyzed the judgment along with our legal advisors, and we believe we have strong grounds for availing all legal remedies available to us.
That was the management, and like I was saying before as well, we have that relief that has come in for JSW Steel. The Supreme Court has directed and has said that now for the status quo for liquidation proceedings in the NCLT. What is also coming in that the COC confirms that the review petition will be filed. Supreme Court holds a revenue petition should be filed as per the Supreme Court rules, prescribed deadlines as well. So you saw the flashes at the bottom of the screen as well. That's the latest update that we're seeing coming in for JSW Steel. The stock spiked up as well a bit and then has again come down, again coming back up. That's one important relief that's coming in for JSW Steel. Let's actually watch out for what happens in terms of the details going forward as well. But as of now, that's the latest latest update that we had, and you all heard the management also, what their thoughts were on this front as well. So that is something that we'll be keeping an eye out on. As of now, 1009 is what JSW Steel is trading at. Let's move on, and two IPOs hit the market today. We have a chemical storage and logistics firm, that is Aegis Vopak Terminals, that came out with an IPO, was around 2,900 crores IPO, as well as the other one is the company that runs Leela Hotels, has launched a 3,500 crore rupees offer, IPO offer. Listen into what both the managements had to say in terms of their offerings. What should we watch out for?
Two liquid terminals have just become operational in March, which is a JNP in Newport, as well as Mangalore expansion. And then two cryogenic terminals at Mangalore and Pipavav are getting commissioned in H1 of the current year. So they are like factories. I have 22 working sites. I've developed 225 acres of port land in 6 ports. And these are going to triple my LPG capacity, the two cryogenic which is going to come. The terminal is capable to do 6 million tons of throughput. Okay. My rate of revenue is 1,250 rupees. I have spent only 900 odd crores for that terminal. Okay. Now, as the utilization will ramp up in 5-7 years, I would be reaching that peak. Okay. So you take your take that what a potential that terminal has, because I will not be able to step into that forward.
Proceeds of the IPO, about 2,500 crores, will be, which is the primary issuance. A majority of that capital will be reduced, will be used to reduce leverage or debt on the company's balance sheets. As of March 25, the company had cash of about 1,200 crores on its balance sheet. So post IPO, the net debt position of the company, gross debt minus cash, will be close to zero. Firstly, the focus of the business is on luxury. Now, in the hotel business, a large part of your expenses are fixed in nature, which means if you can command pricing premium and if you can invest back in your real estate or your property business with lower fixed heads, which can be sustained, that contributes to your current margin.
Okay, on that note, we're going to slip into a very short break. Viewers, don't go anywhere. We'll be back with more news and updates on the other side. Welcome back to Business Sunch on CNBC-TV18. Now let's move on and talk about JSW Steel as well as the BPSL case which was going on. And I just read the flashes for you all. A big relief that is coming in on that front. We have Ashmit to give us more details. The stock is trading with gains of 2% now, Ashmit. What is this big relief that has come in for JSW Steel? What does it mean for the company going forward as well? Ashmit, over to you.
Well, bear in mind that just earlier this month, on 2nd of May, is when the Supreme Court had passed a sweeping order whereby it had set aside an insolvency process going back several years, going back 7 to 8 years. The JSW resolution plan had been struck down as being illegal. Now, it is in pursuance of that we saw former promoter Sanjay Singhal moving the NCLT, seeking enforcement of that order, seeking for liquidation of Bhushan Power and Steel. Now, what's important is that as of right now, the counsels for JSW Steel had moved the Supreme Court, whereby they expressed their concern that a review petition is in the works, that if liquidation is allowed at this stage, what that will translate into, what that will mean is that any review petition being filed subsequently will be rendered meaningless, will be academic, that there will be procedural complications, and it is on account of that the Supreme Court very clearly has held that in the interest of justice, to avoid any further complications, it is critical at this stage to ensure that status quo is maintained with respect to liquidation proceedings. So as far as the liquidation is concerned, Bhushan Power and Steel, no further liquidation will take place, at least not as of right now before the NCLT. And what we're very clearly going to understand is that both the COC as well as JSW Steel are contemplating filing of review petitions. That is clearly something that has been recorded. So clearly something that is coming. For now, very clearly, no liquidation is to take place, and that is review is likely to be filed. So that question on how accurate the Supreme Court was in a sweeping judgment dismissing the JSW application, that could very well happen in the Supreme Court once again.
Okay, Ashmit, thank you so much for that. But we do have senior advocate at Supreme Court, HP Radina, joining in with us as well. Mr. Radina, good afternoon. And in this latest update that we have coming in on the JSW Steel case as well with Bhushan Steel, how do you expect and by when do you expect this review to be filed? Is there a timeline for that? Is there any window? If you could start by helping us, giving us that details.
Well, it's a good news for JSW that the liquidation proceedings have been kept on hold. That's very good, because otherwise it would have led to a lot of issues and complications. Now, coming to your question, the question is the Supreme Court is now on vacation. And the Supreme Court will open only in the first week of July. So in the meanwhile, review petition will be can be filed. I don't think the bench which is currently sitting will take up that matter, because that's only in the case of very important matters like criminal law and all that. So the vacation bench will not hear this petition, but they can file a review petition. And as soon as the court reopens in the first week of July, the review petition will be taken up. In the meanwhile, they'll have to give some declaration that they will go by the old scheme, that they will have only the equity issue of shares. Because earlier, they had struck down that scheme on the ground that you have violated the scheme, and therefore we will not allow you to go ahead, because they were going to have optional convertible debentures instead of equity shares. So all that will now have to be considered by JSW. They'll have to review the whole thing and then go on a review petition, saying that we will abide by the scheme which was already approved.
Sure. So then after July also it will be taken up immediately, or will there be some 30-day time period before it is taken, and when we can expect that after the holiday break as well?
Well, I think that is up to the judges. It depends on what are the urgent matters before them. There are hundreds of urgent applications which are filed and which come up at the time of hearing, because after 2 months break, there's always a lot of urgent petitions. So all depends on the workload of the judges. And of course, the bench to which it has been assigned. Depending on the workload of the bench, they will decide. Sure. But obviously, the liquidation proceedings will be kept on hold until the review petition is considered.
And sir, does this, show or indicate as well an easing of the Supreme Court stance going forward as well?
Yes. Sorry, I didn't get your question. What is?
Does this spell an easing of the Supreme Court stance? Is that an indication coming in after this, what we're hearing right now?
Well, it's not easing. It's that they have now been told about the new facts, that what are the facts, what are the consequences if liquidation proceedings are commenced immediately, and what would be the, balance of convenience. So having regard to all these factors, the Supreme Court has now reconsidered its view based on the new issues of liquidation and what are the consequences if you go ahead with the liquidation straight away. So I think the court has taken a fair and equitable view, taking into account the balance of convenience, and they have felt that it is better to keep their liquidation proceedings on hold until the review petition is considered by the bench once the Supreme Court reconvenes after vacation.
Okay, Mr. Ranina, thank you so much for joining in with us and giving us this latest update also on what it means for them and when will the review petition actually be taken. And an easing stance also seems like it is what was coming in from the Supreme Court as well. As of now, JSW Steel holding on to gains of almost 2% in today's trading session. The announcement that came in was in terms of the big relief for JSW. Supreme Court directed a status quo of liquidation proceedings in NCLT. So that is what we are keeping an eye out on. But on that note, we're going to slip into a very short break. More news and updates on the other side. Welcome back to Business Lunch on CNBC-TV18. Now let's move on. US President Donald Trump backed off his threat to speed up 50% tariff on imports from the European Union, agreeing to extend his deadline for trade talks until 9th of July. Listen in to this report.
Donald Trump has delayed imposing 50% tariffs on goods from the EU. The president told reporters he would put back the move until July, after speaking to European Commission Chief Ursula von der Leyen.
And she asked for an extension on the June 1st date. And she said she wants to get down to serious negotiation because I've told you specifically, haven't I told anybody that would listen? They have to do that. And we had a very nice call and I agreed to move it.
Trump had threatened a June start date on Friday. He acted after becoming frustrated by the pace of talks with the EU. The threat sparked fresh turmoil on global markets at the end of last week, sending stocks skidding again. In social media posts on Sunday, von der Leyen welcomed the delay and said Europe was ready to move fast on talks. Trump also addressed the general purpose of tariffs, agreeing with past comments by Treasury Secretary Scott Bessent that the goal was not for the US to start making low-cost items like textiles.
Equipment. We want to make big things. We want to do the AI thing with the computers and the many elements. But the textile, I'm not looking to make T-shirts, to be honest. I'm not looking to make socks.
Now the backtrack on EU tariffs may be welcomed by markets on Monday, but global stocks have been roiled for weeks by Washington's erratic policy-making on trade. Critics say the uncertainty is making it impossible for businesses to plan for the future.
And with that, we're absolutely out of time on this edition of Business Lunch on CNBC TV 18. Thank you so much for tuning in. Up next, your Midcap Radar.
Good afternoon and welcome to Midcap Radar live from the CNBC TV18 Motilal Oswal studio. I am Bamakshi Thoria and with me is Vivek Iyer. Well, a very good afternoon to you, Vivek. The Mumbai rains have actually blurred the line between Monday blues and monsoon grey. But the color that we are focusing on today is green because it's a good start to the week.
It's a wet start, but it's a green start. What we've actually seen is a very, very strong start. Remember, US markets later on today are actually shut for the day, so you can't take too many cues from there for tomorrow. But what we're essentially seeing today is a very strong buying. Actually cooled off a little bit in the last hour or so, but still very much in the green. We have quite a lot lined up on the show, quite a few corporates as well. So let's start off with the top headlines. Stocks climb after Donald Trump puts off tariffs on EU till July 9th. Mid-caps at par, auto, IT and metals are the big gainers, while financials and consumer discretionaries lag.
Transrail lighting gains on the back of good Q4 results marked by strong financials and a 4% growth and a 44% growth in the order book on a year-on-year basis.
Balkrishna Industries falls 6% after its next profit in Q4 declines 25% due to an unrealized forex loss. EBITDA falls almost 10%, while margin contracts to 22% on a year-on-year basis.
GE Vernova is trading 10% higher after posting an operational beat in Q4. Margins come in at 21.9%, the highest among high-voltage transformer peers, and order inflow as well is much stronger than expected.
BEML surges over 11% after Q4 numbers beat street estimates. The company exceeds FY25 margin guidance of 100 basis points expansion. The management tells CNBC-TV18 that they expect 20% revenue growth in FY26 with rail orders firing up.
Well, just shy of 25,000 is where the Nifty is at. It is trading with a gain of almost 0.5%. The mid-cap index too is holding up quite well in trade today. When we look at the advanced decline ratio, we have 1,650 stocks advancing for 970 stocks that are declining. As far as some sectoral movers are concerned, most of them are in the green. Look at the move on Nifty Metal. In fact, when we look at the metal index on a month-to-day basis, it has gained by as much as 9%. So it's one of the top sectoral movers, in the month gone by. Apart from that, look at the moves that are coming in on the auto sector as well. Bajaj Auto, MRF, M&M, all of these counters are also flying high in trade today. Lots of earnings reaction as well. When we look at the numbers that came through from GE Vernova, like I was just mentioning, good set. The stock is seeing an uptick of almost 10% today. It has been locked in upper circuit since the get-go. But apart from that, Sundaram Braking is another counter that is also locked in upper circuit, up almost 10%. So is Exaro Tiles. But one other counter that is in focus on the back of its numbers is Updater Services. The company reported their Q4 numbers. They saw muted growth in the quarter gone by, while revenue and profit after tax increased on a year-on-year basis. Margins also came under pressure sequentially. We now have Raghunandan Tangirala, who is the chairman and managing director at the company, joining us now to discuss more. Well, good afternoon to you, sir. I'd just like to understand from you, when it comes to your growth was muted in the fourth quarter, but what about FY26? How do you look at growth in both your segments, IFM as well as BSS?
Sir, I think you're on mute. If you could unmute yourself.
Yeah, thank you. Thank you for having me.
We can hear you now. Please proceed.
Yes, the last quarter, the growth was slightly muted. But however, the full year, we did about 12% on revenue growth. But profits improved, actually. If we look at full year last year to this year, there's a 80% jump on our PAT.
Understood that, sir. So now going into FY26, in the quarter gone by in FY25, you also added Amazon as a client as far as the IFM segment is concerned. Now, going into FY26, taking into account contribution from key clients, for both of the segments, what is the kind of guidance that you will be able to provide us on the top line, on the margin, as well as on the bottom line?
Yeah, this year we have clear visibility, at least the next 2 quarters in both the segments, the BSS and the IFM segment. We'll do a clear 15% on top line and about 17 to 18% on our PAT. So that will be the guidance for the growth for FY26.
And what would the margins come around to, sir?
Whatever is the margin we have shown for this year, the PAT numbers was about, I think, 4.8% or something like that. We'd like to improve it. We would want to improve it at about 25 to 30 bips.
Sure. And in your BSS segment, in quarter 3, there were some headwinds with respect to the loss of clients in the Athena business. So has this, is this behind us? Has this improved? Where are we at right now?
Yeah, it has. There was a setback with Athena, but the overall contribution of Athena is very small. It's less than 10% for the group, even in terms of revenue, or in terms of revenue, it could be less than 6%. That you can look back. Now we have recouped. This year we should do better, but we'll still not do a 15% growth. In Athena alone, we may do about single-digit growth. But overall in BSS, we'll do a 15% growth.
Understood that, sir. Also want to understand, as far as the guidance is concerned for FY26, you've given a 15% growth on the top line. Does this include the 2 companies that have been merged with UDS? In that case, what will be the organic growth contribution and what will be the contribution after the merger?
These were actually grown. They were not inorganic, actually. They were companies homegrown, very small in size. Both put together should be about 100 odd crores, 150 crores. So when we say growth, it is a consolidated growth, right, including this merger. So earlier they were reported as individual companies. Now they merged into UDS. So overall growth is a 15% on all the companies.
Sure, and earlier on also you've spoken about growth acceleration in your airport ground handling services. In FY25, I understand it's somewhere around 5% of your revenues, but what is the kind of growth that you're expecting out here going forward? And what kind of mix what kind of percentage to the mix could it contribute? And earlier on it was also expected that this business could generate profits this year. So has that happened?
Yes, it's happened. This year we've just about broken even. Next year they could be about 14-15% margin business. So yes, the growth happens there at about 40% compared to last year. But that is still small. Still, it could be less than about 70 odd crores, but it becomes very profitable. So that would add to our PAT margins. So when we said the PAT margin will improve by 15%, it includes that.
Understood that, sir. Mr. Raghunandan, what we want to understand from you is, if we look at FY25, around 65% of the total top line comes in from the IFM business, and the rest of the top line growth actually comes in from the BSS business or the varied allied services that you provide. At this point of time, given the lower base, can we expect significantly higher growth coming in from the business support services part of the business? And ideally, FY26, FY27, what kind of a revenue mix are you targeting?
Largely, it could remain same, but we see an uptick in the BSS, so it could go up by about 10%. That means if their contribution was 35, they may come to close to 40%. So that is the plan, and that's what is happening.
And where do you typically enjoy higher margins? Is it at the IFM business, or is it more towards the BSS part of the business?
The BSS is typically 2 to 3% more than the IFM business. IFM business in the range of 6 to 7. They are between 9 and 11.
Understood that, sir. So, the other thing what we want to understand is on ground, typically we understand that the business is run via the tendering process. So what is the kind of opportunity size that you're seeing? If you could quantify that for us in some form, what is the kind of on-ground competition you're seeing from peers? And within that, what is the kind of win rate that you typically enjoy?
See, the industry itself grows at about 10-11%. So that's what the competition is, right? So we would like to grow much higher than the industry growth. So that's where we take the space. These are not tendering per se. At least 80% of our business are not tendering because that tendering happens only in the government business, which we have less than 5% as government business. So these are actually kind of bids which we put in RFPs, then that's negotiated, and then the right to win is your capability. So that's how we get it.
Understood that. So what is the kind of, if you could quantify the prospect pipeline for us, 10 to 11% is where the industry is going. You are expecting to grow at 15%, but that also includes the BSS side of the business. So if you could quantify in terms of top line opportunity, what is it that you enjoy, and what is the kind of visibility that you're seeing for FY26 in terms of new orders coming in?
All the growth of 15% is if you take it as new orders, but probably you can discount about 2 to 3%, which would be the existing organic business also growing. But largely, it is only the new orders which comes in. So we had, I think, closed this year at about 2,700 odd crores consolidated. So we should be doing about at 15%, about 3,200 odd crores. So if we quantify the numbers, that are the numbers.
Well, thank you so much for that, sir. 15% revenue growth is what we're expecting, along with an improvement in margins. Thank you so much for taking the time and joining us. But time for a short break. Management of Gopal Snacks joins us on the other side to discuss their Q4 numbers and more. So don't go anywhere.
Welcome back to Mid-Cap Radar. Well, even as we speak, the market has picked up some steam. Like Vamakshi mentioned at the start of the show, it's actually the metal pack that's propelling the markets higher. Names like JSW Steel that saw significant relief come by from the Supreme Court. That stock was near the day's highest point, and that has taken along with it some of the other metal names like SAIL as well as JSPL. But the other set of stocks that are doing very well, and this is continuing for the last 3 to 4 trading sessions, has actually been the piping stocks. So, companies that are making pipes, names like Astral, names like Supreme Industries, names like Finolex, all of these stocks are actually doing quite well. This on the back of the fact that despite the company seeing a very muted Q4 as well as what has actually essentially been a very subdued FY25, in the last 10 days, there have been 2 price hikes that have been taken by players across the industry. And on the back of that, a lot of these stocks are picking up steam from the 52-week close they were trading at. The other stock that's doing quite well is actually Trend. This particular stock is up almost 1.7%, and that particular stock too near the day's highest point. But moving on, one company that reported a subdued set of numbers for Q4 was Gopal Snacks. There has been a sharp rise in raw material prices that impacted the gross margin as well as the EBITDA. Do note, Q4 FY25 saw an exceptional loss of 47.2 crore rupees due to a fire incident in the company. We are now joined by Rigan Raitana, who is the Chief Financial Officer at Gopal Snacks. Thank you so much, Rigan, for joining us. First up, Q4 has been a tough quarter for the company. What essentially happened? Do you see some easing out as far as raw material inflation is concerned?
Yeah, so good afternoon, and thank you, Vivek, for giving me this opportunity. Yeah, so our Q4 quarters were largely impacted on account of the fire which happened at our Rajkot factory, which accounted to around 65 to 70% of the sales. So that was largely driven due to that. We had a lower set of Q4 numbers in terms of top line. And in terms of margin, yes, there has been increase in the raw material prices as compared to last year Q4, and also as compared to Q3. So there has been stiff increase in raw material prices on account of duty which was impacted, levied by the government of India in the mid-September from 5% to 25% in the palm oil.
Sure. Hi, this is Vamakshi joining in, and we understand that this time around margins were impacted, but palm oil prices have come off their highs. So where are your margins now headed from here on?
Yeah, so palm oil prices have started cooling off in Q1 of this financial year, and those things are started reflecting in our purchase basket also. So we are getting benefits of lowering of the palm oil prices as well as other raw material products like chana. And that should reflect in good margins in Q1 and the forward financial quarters also.
Can you quantify that for us? FY25, your margins were at 7.2%. So where are they headed from here on?
So I would not be able to quantify at this juncture because it's the starting of the financial year. So, but I would be saying that it should be moving upwards trajectory by another, in terms of absolute value, by another 25% or so.
Understood that. Now, going into FY26, quantify, post taking into account the facility that is now back on track after the fire incident, what will be the full year revenue, EBITDA margin, as well as the profitability guidance? And if you could also quantify, I understand that that particular facility contributed close to 60%. So what was the loss that you saw in the quarter gone by?
Yeah, so for next financial year, that is FY25-26, we are looking at top line growth rate of around 18 to 20% from the base of 24-25. So we should be closing the year somewhere between 1750 to 1800 crores. That's what we are looking at. And in terms of margin, we are looking at 25% or so in terms of EBITDA growth, in terms of absolute value. And Q4, yes, there was a total loss of 110 days. And if you look at something around 80 to 100 crores of the revenue loss which had happened in Q4 on account of fire.
Sure, and core states actually account for almost 70% of your revenue. So what are your plans to diversify beyond the core states that you're located in and where you supply, and what would be your revenue contribution from these non-core states, if I can call it that?
Yeah, so our non-core states, those are that we generally tell as the focus state. So next year, current year, there was a 17% growth, and next year, due to increase in our dealer base over there also, so we are targeting somewhere around 30 to 35% increase in the focus states. And that should help us in penetration outside Gujarat also. And within Gujarat, we are targeting to increase our services within the number of dealers. So that should also help us in increasing Gujarat sales also.
Okay, and the other question is, what is the target share of revenue that you are expecting now from larger packs? We understand that majority of the sales, in fact 65% of the sales, comes in from the lower price 5 rupee pack. So do you see revenue mix improving further?
Yeah, we are absolutely looking in increasing the revenue mix. So earlier, if you see our earlier years, we were around 75% odd or so in terms of 5 rupees packet. Now we have gradually reduced to below 70%, and we are hoping to be in FY 25-26 somewhere around 62 to 63%.
Sure, and you must have heard about this deal that actually happened. CCI has okayed Temasek Holdings minority stake purchase in Haldiram Snacks. So, just like to understand from you, how does this actually impact the overall dynamics of the industry? Is there an impact that you're expecting?
Yeah, so yes, so that deal has obviously, so this snack industry is obviously growing overall as an industry as a whole, and we are expecting the growth rate in the FY 25-26 and in another 3 to 4 years on an CAGR of roughly around 12 to 13%. And yes, that should help overall growth industry coming into the new players chipping into this industry.
Understood that. Now, we also want to understand, as far as marketing and advertising is concerned, what is it as a percentage of total sales? Earlier, you had mentioned that you would be introducing further marketing branding initiatives. So, as far as FY26 top line is concerned, where will that be capped at?
Current year, we have spent roughly around 1% odds of our revenue on sales and promotion. And next year, in terms of increasing our branding endeavors and more of a market presence, we are targeting to spend somewhere around 2 to 2.1% in the FY 25-26 year.
And what about your capacity utilization? It was still quite low at around 30 to 40%. So when will this increase, and what would be your target capacity utilization this year? And when would you be reaching full capacity utilization?
So yes, our capacity utilization has been lower on account of we are yet to reach our 100% capacity. But see, our capacity is mainly in terms of the number of fryers which we have. So as we increase more number of SKUs, that will gradually increase in terms of more than, let's say in current year, we are roughly around 40%, and next year we are targeting to be around 47%, and year on year above 50%.
Understood that. Well, a couple of questions. Post the fire incident, what was the impact as far as the market share was concerned in the last 2 to 3 months for you? FY26, how much of that can you recoup? Secondly, you mentioned that you're looking to go ahead and increase touch points. So targeted distribution expansion, currently we believe you're at close to 852 dealers.
So we are targeting next year to be roughly around 1,000 distribution points in the FY26 financial year. And so we were able to retain all our dealers. Hardly 2 or 3 dealers went out during this quarter wherein our revenue was impacted. So fortunately, there was no dealer meet out from our distribution pattern. So we were able to retain all the dealers, and what we are looking at next year is the progressive trajectory in the dealer segment.
Well, last time around, you told us that you are at close to 8% of the market share when it comes to the state of Gujarat. Where are you currently at? Where do you expect to end FY26 at? Secondly, you said that gross profit margins are expected to increase due to the increasing share of the wafer business. So where does that stand at currently, and the target for FY26?
Yeah, so for gross margins, yes, our wafers business currently accounts of around 11% of our mix, and next year we are targeting to be around 13 to 14%. And that should positively impact our wafers business, overall margin business, because that's a trajectory wherein we have around 30 to 32% of the gross margins.
Sure. Thank you so much for that, Mr. Raithata. Thank you. You gave us quite a lot of perspective. You're expecting 18 to 20% growth in the top line. The EBITDA should also grow by about 25% in FY26. But that's all.
That's led to a spike as far as the stock price is concerned.
Absolutely. But let's slip into a very short break. We'll get you more on the markets and stock-specific action on the other side. Don't go anywhere. Stay tuned. Welcome back. You're watching Midcap Radar on CNBC-TV18. Let's focus in on a few pharma stocks now because they have also been doing well apart from the metal pack. Look at the move on Emcure. The company reported its numbers on Friday. We saw a move of around 5% on Friday itself, and today it's followed up with another 8% rise. Apart from that, keep an eye out on Shilpa Medicare as well. The company is reporting numbers later today, but the news flow that came in on Friday, as Ekta was highlighting to us earlier, was that the company has tied up with a Finnish company, Orion, for a key plasma protein, and this is a very critical component in vaccine and biologics, so that stock is surging higher by almost 13%. Jubilant Pharmova is another counter that is up and away in trade today. But apart from that, let's also focus in on RateGain. The company reported its numbers just a short while ago. We're seeing a very strong spike in the numbers, post the company's reported its numbers. But that's all we have on Midcap Radar. Don't go anywhere because your stocks up next.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in as always. Green day coming in for the markets. Nifty managing to hold on to around that 25,000 mark. Right now, slightly below that level, 24,987 is what it is trading at. The Nifty still managing to hold on to gains of 0.5%. Sensex 2 0.5% of gain. Mid and small cap performing in tandem with the benchmark indices. So not much of a worry on that front. Banks, versus the benchmark indices, that's a bit subdued. 1/10 to 2/10% of gain is what we're seeing coming in for the Nifty Bank. So let's see that as well. It opened up at that high, then came down, and now it's around that 2/10% of gain. Not much of an uptick on that front. So that will be interesting to see where Nifty Bank is also headed. PSU banks today are not doing that great, so that is something to watch out for. But that's how the market setup is looking like. But how is the query segment that we have for you all? We have a lot of queries lined up for you all, and this is what the show will be concentrating in the next 20 minutes. And joining us today to solve all those doubts, we have Ashish Kayal of Wave Strategy Advisors, as well as Gaurang Shah of Geojit Financial Services joining in with us to talk to us about the markets as well as the queries and how what are their suggestions coming in for that as well. Gaurang as well as Ashish, thank you so much for joining in with us. Ashish, Nifty Bank is what I want to talk about before we jump to the queries. Today, it's a bit of an underperformance, right? So what are we watching out for here today, and what are the levels that we should keep an eye out on?
Hi, afternoon to you, all the viewers, and Gaurangji also. If you look at the overall broader market, I think Nifty Bank has consolidated since it formed a high around 23rd April. And then from there onwards, for almost a month, it has been consolidating in a range. There is more like a time correction rather than a price correction. Prior to that, we saw a spectacular rise from 49,000 odd levels to 56,000. That was a very sharp move in just 5 days of time and a 1 month of correction. And that's a very healthy sign, because in this correction, the overbought indicators have been relieved their state, and we are now getting ready to again push back on the upside. Right now, yes, for today, the index has formed a doji candle, which shows indecisiveness, but I am optimistic that if it breaks back above that 55,870, we might be headed towards 56,500 or higher levels. So the overall view for Bank Nifty is bullish. We might want to wait for some kind of a positive traction from here on, and we should see 56,500 or higher levels from here on. And on the downside, support is at around 55,000.
Okay, keep an eye out on those levels over there for Nifty Bank. But on that note, let's get started with those queries. The first query for today we have coming in from LRG Krishnan, who's writing to us from Kerala. He's holding 15 shares of LIC, and this is obviously through the IPO that got in the shares. They want to know that, what should they be doing now? They should continue to hold it for a year or more, or look to sell. Obviously, it was around 950 rupees is what they're talking about. So, Gaurang, your view coming in for LIC. On the insurance side, would you see LIC is the best bet? And should the viewer continue to hold this on the fundamentals? And afternoon to you.
Thank you so much, Vinny, and good afternoon to you. And the color green that you are wearing is all over the market today. So thank you very much for having me on the show.
I wish it was always twinning with me then. That is what then every bull will want, only markets to twin with my green shade.
Yeah, I guess in that case, you, me, and Mr. Kayal, all of us should wear green, right? Maybe more green all over. So anyways, so speaking of LIC, well, we've been positive on the entire life insurance pack for a pretty long period of time. The only problem, Vinny, is that, the sector has been not a great performer. Earnings has been on and off, good, bad, flipping here and there. But our thought process at Geojit Investments Limited is that, as people's thought process change in terms of getting themselves insured with a term insurance, not a ULIP, and that momentum is catching up, that understanding is catching up at ground level. So we are going to see better earnings in terms of overall run rate of premiums, and especially the new premium run rate with higher sum assured. So we've been positive. I do agree that since the time this viewer investor has invested in IPO, by and large, it has been an underperformer. But I think all is not lost. Give it some more time, and I think there should be better shade and color as far as earnings and the stock price is concerned.
Okay, give it some time is the word coming in from Gaurang. Ashish, your view on the charts and technicals, right? What should we watch out for? At one point of time, it did manage to touch that 1,000, around that 1,050 was that high we saw coming in. But after that, again, it went on the decline. So what are you keeping an eye on in terms of levels?
Absolutely, we saw that happening and it showed a decline, but this time it's different because this time it has formed a higher high and a higher low formation. As per simple Dow theory, it shows the overall primary trend has again turned back on the upside, and we can see the entire sector is also showing a green shoot, and I am expecting LIC to outperform from here on. We can expect the stock to again reach towards the level of around 950 or possibly 1,000 from here on over positional perspective. But over short term, we can expect it to go towards 920, which is the previous peak high, swing high. 920 is the target on the upside. Outlook is bullish. And on the downside, one can maintain a stop loss of 845 levels.
Okay, keep an eye out on those levels over there for LIC. Let's move on to the next query for today. This is coming in from Isaac Mohammed, who's writing to us from Pune. He's holding 6,000 shares of Ashok Leyland. Price is 351 rupees per share. He can wait for another 3 to 4 months. Wants to know whether he should look to hold or look to sell. He's making some bit of a loss here on this front. Gaurang, we did have those numbers also that came in from the company. Most of these analysts have highlighted a bit of a beat coming in. Management has maintained their midterm guidance. So it should be good for the viewer to hold it in the shorter term as well. Does it make sense? Or maybe just get out of the stock right now?
No, Vinay, I think, first of all, I am a little bit surprised with the purchase price of 351. I will request my good friend Ashish to help me because I can't find 351, at least as far as my data is concerned. Maybe Ashish can help with it. But we've been positive on Ashok Leyland for a pretty long period of time. The numbers that we saw over the weekend augurs extremely well, not only for the fourth quarter, but even for the third quarter, winning the numbers were in line with what we had penciled down. The management commentary post the fourth quarter earnings is extremely strong in terms of business outlook as we go into the future. So I would say that now the turnaround is picking up speed and you should see better numbers in terms of run rate. Hold on to it. My only point is the investment level of 351 is something that I have a doubt.
Okay, that's a view coming in there. 351, even that is something even I can't find right now when I'm looking at the charts. Ashish, if the viewer is holding, let's forget the buy price. I think they've giving us the buy price. So what should the viewer do now? Should they continue to hold this?
I think the buy price should have been around 255 because the lifetime high that the Ashok Leyland has made is somewhere around 264, 264.60. Having said that, the overall trend, if you look at the weekly and the daily trend, the stock has outperformed. Even in the entire space or the sector it is into, it has outperformed. And I think it is going to break that 250 mark eventually. And once it breaks that, it will go towards the lifetime high levels again. Way above 265 and 275 can be the target. So my suggestion is hold on over here. The outlook, the chart looks good. It has been managing to sustain about that 20 DMA also. Target can be around 275 on the upside. On the downside, the support for the stock is around 230 levels.
Okay. Thank you so much for that. Viewer, I hope your query is answered as well. So as of now, just hold on to Ashok Leyland. But let's move on to the next query. We have Ram Kumar Ratnagiri, who's writing to us from Mumbai, holding 100 shares of PNB. Price is 138 rupees. Wants to know whether to hold or sell at the current levels. Gaurang, your view coming in for PNB. Is PNB the best bet to play right now in the banking space? PSU banking side as well specifically, or should the viewer get out and maybe look at some other name?
Well, there is a loss undoubtedly in this trade as of now as we speak, Vinny, there is no doubt about that. But whether there is a scope of recovery, which we strongly believe. Whether PNB is the best stock, well, we have coverage on PNB and some public sector banks like State Bank of India, Bank of Baroda, Indian Bank, to name a few. Along with that, of course, more than half a dozen public sector banks which have been outperforming private sector banks, which have been outperforming public sector banks. But the numbers, again, if I have to reflect upon the last couple of quarters, there has been a steady improvement, Vinny, on the earnings visibility. And more importantly, the run rate as far as the gross and net NPA, that's coming down, provisionings are coming back, management's effort in terms of recovery is showing results. So first of all, hold on. If you have investable amount from a long-term point of view, maybe, you can add maybe 100 or 50 shares at current levels and then possibly add on more if you get a further dip. But we've been positive. We have a hold recommendation. So hold on to it. And if you have investable amount, average maybe 50% or 100%.
Okay. Hold on to it right now. That's the view coming in from Gaurang. But Ashish, your view on the technicals for PNB?
See, PNB formed a low at around 90 in the recent fall that we saw on 9th of May and showed sharp bounce back from there. Along with Bank Nifty, this stock is also consolidating over past few days. But I'm optimistic that the rally that we are seeing across the board is now going to be more like a rotational rally where a few sector contributes and the few takes a breather and the next sector starts contributing. So I think PSU sector can start contributing, especially the banking side of it. And we can expect PNB to move up towards the level of 108, 109 on the upside. So the outlook is positive. On the downside, the support for the stock is around 98 levels over short term. And eventually, if he is looking from a medium to long term perspective, then maintain a stop loss of around 95. So the trend is positive, expecting a target of 108 on the upside over near term.
Okay, let's move on to the next query. This is also a PSU bank. We have Augustine D, who is writing to us from Kochi, holding 1,000 shares of Bank of Maharashtra. Price is 50 rupees per share, 50.25. Buy price is the same as the right now's trading price for Bank of Maharashtra. The past 3 months is what her holding period has been. Now she wants to know, Gaurang, from here on, what should she be doing? Hold or look to sell? For Bank of Maharashtra, what's the view? Anything different from PNB?
The problem, Vinny, with banks like Bank of Maharashtra and some of the other smaller PSU bank is the consistency in terms of earnings. And that's where the biggest drawback is. If you are not able to deliver consistently on earnings, there is going to be volatile times for the stock price as well. We don't have any specific coverage on Bank of Maharashtra, but just in case if the investor is looking at switching and looking at maybe another a public sector bank, then possibly a Bank of Baroda or a State Bank of India or an Indian bank would do much better sense in terms of investment. Or in private sector banks, you can look at IDFC First Bank or Federal Bank.
Okay. And Ashish, your view for coming in for Bank of Maharashtra?
See, for Bank of Maharashtra, it has been struggling for quite some time. I think it's better to be out. From here, it has failed to sustain even above that 53 mark, reverse back on the downside, and then it's not looking an outperformer. So better to be out at the current levels on the stock. And maybe something like an HDFC Bank that is touching the lifetime high levels, consolidating there, looks to be very attractive at these levels also. Look at HDFC Bank. We can target it around 2,000 or higher on that side and be out of Maharashtra Bank.
Okay, that's a view coming in there for Bank of Maharashtra. Can look at other banking names as well. But on that note, we're going to slip into a very short break, viewers. But here's some good news coming in for y'all. India's business news reader is now a click away. Introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or the Google Play Store, or you can just scan the QR code on your screens. Welcome back to your stocks on CNBC-TV18. Now, let's keep it going with all your stock-related queries. To solve all of that today, we have Ashish Kayal as well as Gaurang Shah, who are helping us do all of that. Let's move on to the next query. Ramesh Jain is writing to us from Mumbai. He's holding 60 shares of Hunasa Consumers. Price is 220 rupees per share. They're making a profit on this one. They want to know whether they should continue to stay invested in this or look to sell and book out their profits. Gaurang, your view coming in for Hunasa Consumers. This quarter was not bad, right? A bit of a turnaround that we're seeing coming in here. What is the growth story expected from here on, and does it merit for the viewer to continue to hold it?
Firstly, I think it was overpriced when the IPO came, to be very honest. And then we know the history. As far as the sector is concerned, I think there's going to be a lot more competition that's going to come in. Survival is going to be extremely difficult. Along with that, there's going to be a huge competition in terms of pricing and eating into each other's market share. Having said that, we don't have specific coverage on Honasa. But I think if you want to stay in with the consumption theme, moving a little bit from the sector where Honasa is associated, I think with the onset of monsoon that we are seeing and a likely possibility of a good monsoon this year, which the Met Department has predicted, ITC would make a lot of sense. Numbers were also much better than what we had expected. And I think ITC should do and fare much better compared to likes of Honasa.
Okay, so you prefer something like an ITC compared to an Hunasa, and given that, what we have in terms of the updates that are coming in on the monsoon front as well. That's the view coming in from Gaurang. But Ashish, what's your view for Hunasa Consumers? Would you prefer any other FMCG name, or Hunasa Consumer has now become attractive on the technical front and one should continue to hold it?
Honasa, I think it's attractive right now because it formed a good base and now it's trying, but only from the short-term perspective. From the medium to long-term, I'm not optimistic. Or short-term, there is a possibility it can move towards the gap area of 350, which it created around in the month of November 2024. So that is possible that it can fill the gap and move towards 350. So 345, 350 is where I would suggest to exit from the stock. Do not hold it from the long-term. Looks like a lot of chaos has happened from the medium to long-term perspective. So 345, 350, that's the target on the downside, and maintain a stop loss of around 290 levels.
Okay, 290 is the stop loss, 340, 350 is where you could look to exit is what the answer is coming in from Ashish. So hope that's also out there, Ramesh. Let's move on to the next query. We have Sulochana, who's writing to us from Bangalore, holding 200 shares of Praj Industries. Price is 500 rupees per share. Slight bit below the buying price right now is what Praj is trading at. And they have it since almost a year. So they want to know if they can continue to hold this for another year, or Praj Industries is not a good bet and one should exit from this one. Your view, Gaurang?
So, once again, no specific coverage when you over here, so I won't be able to give buy, sell and hold. But in case if, again, the investor wants to look at a switch from here, of course, Praj Industries caters to one of the niche segment in terms of the transformation, in terms of cleaner environment, green fuel, etc. is concerned. So its contribution definitely looks very, very strong. But since we don't have a coverage, we won't give a buy, sell and hold. Alternative investment idea, I think Tata Power could be a better option.
Okay. Tata Power for you is a better option than Praj. So that's the view there from Gaurang. But on the technicals, Ashish, Praj Industries, how is the story playing out?
It's not looking good, honestly, because the stock corrected sharply from the levels of 850, 860, made the low of around 450 and still not able to bounce back anything from there. So my suggestion would be it is best to be out from this stock. It is very volatile and has even taken out the previous swing low. So that looks to be bearish. Any break below 465 can again start the negative trend. So be out from this stock. It's better to be invested into Tata Power, like Gaurangji said. It's not looking good at all.
Okay, not looking good at all for Praj Industries, whether technicals or fundamentals. So get out of the stock. That's the answer coming in from both our experts. Next query, Dhamodharan is writing to us from Tamil Nadu. He's holding 200 shares of Coal India. Price is for 34 rupees per share. Wants to know whether you should continue to hold or look to sell this one, and what should be the near-term target as well. Gaurang, your view first on the fundamentals for this one.
So I think one of the best companies in terms of largest natural reserves of coal is what Coal India has. Yes, a shift from thermal to clean and green energy in terms of usage is concerned in form of fuel is something that is entire world is looking at to reduce the carbon footprints. We have a positive coverage. We have a hold recommendation on Coal India. And my sense is that 2-3 things have happened for good, Vinny. One is that the pricing is now much better, and the output in terms of quality and quantity of coal is also much better. By that, e-auctions are realizing better, margins. So long term, if you have a view for long term, hold on to Coal India.
Okay. Have a view for long term, then hold on to Coal India. That's the view on the fundamentals. On the technicals, Ashish, what's your view? The viewer has also asked for a short term and near term target. So if you could help us with that as well.
See, if over short term, Coal India has since past 2 days, it is trying to attempt to move on the upside. But there was some sharp decline from 417 levels to the low of 393. And it's now just retracing that. So over short term, I think it's going to move in a broad range of 412 on the upside, and on the downside, 393 is the support. So that's the range I'm expecting over short term. And if it manages to break 412, then we can expect some momentum to build up in the counter. Right now, hold on to the stock. Maintain 393 as a stop loss, and let's see if it breaks 412, then extend and then trail your stop loss higher.
Okay, keep an eye out on those levels over there for Coal India. Next query for today coming in from Arunachalam, who's Balaji, who's writing to us from Tamil Nadu, holding 6,000 shares of an Indian Overseas Bank. Price is 43.8 rupees per share. Stock is currently trading at 38 rupees. Should they continue to hold or look to sell this one? Indian Overseas Bank, your view, Gaurang? A lot of PSU bank queries that we have coming in today. So this next one, what's your view on this one?
This is the problem, Vinny. Again, a bank which is not a consistent delivery in terms of earnings. Similar to what we discussed, for example, in Bank of Maharashtra. Again, no specific view since we don't have coverage, but we prefer SBI, BOB, PNB or Indian Bank in the PSU Bank universe.
Okay, that's a view coming in there from Gaurang. But that is all the time we have on this edition of Your Stock. So thank you so much, Gaurang, as well as Ashish, for joining with us on the show and helping our viewers solve all their stock-related queries. And viewers, thank you so much for sending us your queries. With that, it's a goodbye from myself as well as the team who put this show together. Don't go anywhere. Up next, you have Closing Bell to take you through the last hour of trade.
to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Kospi is trading with gains of around 1%.
I agreed to your movement. I believe July 9th would be the date.
Resistance for the Nifty is 25,116.
Both FTSE as well as MSCI have gone ahead and announced weight reduction in the indices for eternal.
About 0.25% higher on the Nifty, 24,900.
Any weakness in the dollar will prompt money shifting out of the United States and going offshore.
We believe we have strong grounds for availing all legal remedies available to us.
Post IPO, the net debt position of the company, gross debt minus cash, will be close to zero.
The Nifty is inching towards that 25,000 mark. It's 125 points up at 11 o'clock on the Nifty.
We expect the monsoon to slow down after the initial onset.
PSU banks have reported their highest ever quarterly profits.
Supreme Court has directed and has said that now for the status quo for liquidation proceedings in the NCLT.
What we're essentially seeing today is a very strong buying activity. Cooled off a little bit in the last hour or so, but still very much in the game. Yeah.
Well, that is the day so far, and it is a decent day off the highs of the session, but 130 solid points on the index. Lots of single stocks, very, very stock-specific market actually, and that's going to be the focus here over the next 60 minutes. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Surabhi and Rima with me in the studios, and Nigel is joining in from the newsroom floor. Guys, good afternoon.
Hi, good afternoon, folks. I guess a green day. But we're not alone. I mean, it's a nice green day pretty much across the world, barring the Hong Kong market today. Most of the other markets, Europe right now is surging, relief rally, because that 50% tariff threat, at least it's been pushed back to some extent. So it's a risk-on kind of a day globally as well.
Indeed, I think the CAC is out 1.25%. The DAX is higher by 1.8%. The FTSE, that's the UK market, is shut on account of a public holiday, and US is shut closed today on account of Memorial Day. But rest of Europe firmly higher now.
What does it say when the mice have fun when the cat is away or something, right? What is it?
Yeah. The mice are at play when the cat is away. Which is the US market, just in case you're wondering what is it we're going on and on about. US market is shut for the Memorial Day holiday today. Hi, Nigel.
Well, that's right. Just concentrate on the market for the next 60 minutes and then focus on getting home, because it's going to be quite interesting as well, going by the weather forecast as of now. I believe it stopped raining for around half hour or so. But it's back. So, guys, let's get straight to the market action, and post the 60 minutes, then we can find our way home. Let's get started on the show, though. We have Rahul Sharma, who joins in of JM Financial. Hi, Rahul. Good afternoon. Good to see you in. It'll be interesting to see what kind of institutional participation we're going to have by the end of today, Rahul, because, as we mentioned, the US and the UK markets, both of them are shut. That said, it's been a pretty good trading session. What's the trade on the Nifty, and what is the level you're looking for a bit of a breakout from here on? 25,000 what?
Yeah, very good afternoon. So for a change, we are actually a bit optimistic around this 25,000, 25,100 mark. Last week, we've seen increase in short positions by FIs in index futures. We've seen them going net short in the cash segment as well, around 10,000 odd crores being sold, around 50,000 contracts short on the index futures. Plus retail has 5x their positions on the long side in index futures. So all this is summing up to a situation where there might be a brief period of volatility just before the monthly expiry happens. So we are maintaining a cautious stance unless and until Nifty decisively does not take out 25, 100, 120 is the resistance area. Unless and until that level is not taken out, we expect the Nifty to be range bound or a bit of volatility, something that can that is very much possible. Like you said, I think this is a very stock specific market. There are pieces segments in the market which are doing good. Two ideas for today's session. One is on the real estate pack. Bodhish Properties looks pretty solid. The stock has formed a formidable base around this 2,000, 2,200 area.
and now seems like it is ready to shift gears. So reality index being positive, Godrej Industries expected to head all the way up to 2500, 2600, possibly in the next series, and can be bought at these levels. Second stock which looks good is Hudco. This stock has given a big breakout, or rather it is on the verge of a big breakout at 243, which is the April high. So 243, 244 is where we expect major short covering to come into the stock. And overall, we feel that the stock can head towards 280 to 300 on the upside. So Hudco and Godrej Properties are our top two picks for today's session. And overall Nifty, I think it's better to be cautious, or rather stay hedged, because some bit of volatility is something that we are expecting as a team.
Okay, all right, got that, Rahul. Thank you very much for the calls. We'll come back to you after a little bit. By the way, just to talk about the market, I mean, there's a 0.5% gain across the Nifty. Mid-cap index is doing slightly better, gain of about 0.6%. The Bank Nifty is the one that's been slightly disappointing, because it started the morning with a flourish, but then it's kind of not been able to hold on to those highs. That's what I'm talking about. That's the Nifty Bank. But today is a day of really outsized stock-specific moves. And I'll just give you some examples. We'll be talking about a lot of these stocks as we go along. BEML, and we spoke with the management as well. Right now, it's clocking gain of 13%. BEML after the fourth quarter outlook, and of course what they've said about the current financial year as well. Phenolics Industries, another result reaction, 8% higher. GNFC, Anupam Rasayan, these are all positive result reactions playing out. GE, Vernova, TND. I mean, today is a day where a lot of mid caps, and this is the fag end of the earnings season. The typical pattern is that you have all the tail enders coming in with bad numbers, but this earnings season is turning out to be different. You've got some, look at that, I mean, 10% circuit right from the time the market opened today, and that continues on a GE Vernova as well. So, keeping in the spirit, keeping in with the tradition of some good mid-cap earnings, let's look at RateGain as well. Stocks up almost 5%. It's cooled off from the peak, but nonetheless, it seems to be a good quarter. Rima, what did you make of it?
Well, it's an okay quarter in line with expectations. Now, RateGain, just to put it in context, began the year with a 20% revenue growth. It moderated it to 15%, and then last quarter it said revenue growth will be 12 to 13% for the full year. So that's, the revenue guidance for the year. The company achieved the lowered revenue guidance. They ended FY25 with a top line growth of 12.5%. But Q4 was muted. I mean, it's met the guidance. The company was expecting a weak performance in Q2 on account of delayed deal wins. So Q4 revenue growth was just about 2% on a year-on-year basis. What the street liked is the margin performance. EBITDA margins went up by 120 basis points and has come in at 23.2%. And the picture, or the annual margin picture, is actually a more telling story. In FY21, the margins of the company were 2.5%. FY22, 8.3%, expanded to 15%, then further to about 20%, and FY25 margins were at 21.5%. So this year, while the top line growth was nothing to write home about, just 12.5%, the margin expansion story is strong. And second positive thing is the cash in the books. We don't have the updated cash. The conference call is at 5 p.m. today, but as of Q3, the cash in the books was close to about 1,200 crore rupees. And plus, remember, the stock is corrected. I think year to date, RateGain share price is down close to about 27-28%. So it's also gotten beaten down as the company kept moderating its top line guidance. But today it's bounced back. Strong margin performance is what the street likes. Dipan Mehta is now with us on the show. Dipan, is RateGain a stock that you've looked at? And your thoughts on the Q4 numbers? And in the conference call, what is it that you would look for?
Hey, good afternoon, and thank you for having me on your show. If I would show you my screen, it is there on my watch list over here. And I really miss that stock because we love such platform companies and we love the travel space as well, but always thought it was very expensive. And now the numbers have come through and management has sounded very positive. There was a period in between where there was some concern around a large client moving away from the company, or there were some delays in revenue booking, but I think those seem to have been resolved. And maybe at a correction, this is the stock which is on top of my list in terms of acquiring, because it's a great business, very easily scalable, and they keep on adding new clients. And within the travel space also, they are focused more on small hotels and on smaller travel operators who really need the services of RateGain in order to grow their business.
So Dipan, in April, the stock was available at what, 410, 420? That's a good, 20% lower than the current market price. So that 400 level was also not attractive for you?
Yeah, there was that uncertainty around their revenue growth at that point of time. I don't recollect the exact reason, but there was some issue with one of their largest clients. it had moved away the contract from rate gain. So that's something that was a kind of a red flag at that point of time. And the management was guiding towards slower growth. But I think those seem to have got resolved, which is apparent from the way the results have come and the way the stock price has gone up.
Did they give a guidance, Reema, this time?
No, the conference call is at 5 p.m. So perhaps in the conference call we'll get
Because if you remember, that was the problem, right? They used to say 60-70% type of growth.
It was also including the Adara acquisition.
The
that
acquisition.
they had done. So last year growth was very strong.
Yeah.
The acquisition. This year, they began the year with 20%, brought it to 15%, and lowered it to 12 to 13%, which they achieved.
But yeah, growth rates have fallen quite a bit.
Yeah.
And I think they've also raised money. They're sitting on cash, but they've not made that acquisition.
Because they've
Almost
always
for about
said,
a year and a half.
Yeah, the cash as of Q3 was 1,200 crore rupees. And at that time, when asked, they said that we're looking actively, but all the companies are very expensive. So, and you're right, just going back to the growth numbers, FY24 top line growth 69%, FY23 54%, FY22 was 46%, but then there were these acquisitions also which boosted. But things slowed down in FY25.
Okay, all right, that is rate gain, got that. Let's move on. Another stock in focus. Edelweiss is in focus. Sources are now telling us that the company could be looking at selling 25 to 30% stake in its mutual fund business. And apparently it's in talks with a number of asset management companies as well for this. Yash is joining in with exclusive details. Yash, what exactly are you picking up?
Well, Surabhi, so there are two parts in terms of updates that we've picked up from our sources. First is with respect to the mutual fund business. What we've been given to understand is that Edelweiss Financial Services is looking to sell about 25 to 30% stake as far as its mutual fund arm is concerned. Now, the names to which the company has been talking to with respect to the sale of this particular stake makes this transaction very, very interesting. They've been speaking to large mutual fund houses based out of the US. These include Fidelity, Capital Group, Northern Trust, State Street Global, as well as Legal and General. As far as its equity AUM for Edelweiss Mutual Fund is concerned, a fairly large size, about 70,000 crore rupees out of the total AUM of about 1.5 lakh crore rupees. So that is the first part of the transaction. The second part that we've been given to understand is with respect to the entity called EAAA or Edelweiss Alternative Asset Advisors. Remember, the company had filed its DRHP papers with SEBI last December. This was returned in March because there was some accounting difference with SEBI wanted to see in the papers. The company is expected to refile its DRHP papers by the end of next month itself, that is June end, and launch the IPO by December. Edelweiss Alternative Advisors, as I said, first filed the papers in December, and now, of course, it was returned back in March. The company and the IPO will be a complete OFS, which means Edelweiss Securities and Investments, which is a wholly owned subsidiary of the listed Edelweiss Financial Services, will be raising about 1,500 crore rupees as far as this particular IPO is concerned.
Just for clarity, Yash, how much stake does Edelweiss? I mean, it's a 100% owned business, or are there other partners as well? You're saying they're looking to sell up to 30%, right?
Correct. So, of course, there are different, it's a 100% owned business, but there are different schemes where there are different owners. So, the shareholding is a little blurred in terms of the mutual fund business with respect to the direct holding of Edelweiss Financial Services. But as far as the EAAA business is concerned, there it is 100% holding by Edelweiss Securities and Investments, which again is a 100% subsidiary of Edelweiss Financial Services.
Okay, all right, got that. Thank you very much for that, Yash. So Edelweiss also in focus. By the way, by the time we were talking about the Edelweiss numbers, look at what's happened to Gillette. And what numbers from Gillette? That's what I was saying. Today is such a day where you've got amazing, positive, pleasant surprises on the earnings front. Look at that stock. My goodness, it's like the Burj Khalifa there. Almost 12% higher. The EBITDA line has ballooned. I mean, the margin, I think we'll get the flashes up if we can. The margin has gone up from the early 20s to 29%, if I quickly cut the flash correctly. Deepan, come in on this. It's such a pleasant surprise, right? Earnings season in its last lap, and then you get these positive surprises, whether it is, like I was saying, GNFC, Gillette. People seem to be really liking BEML's commentary as well. What do you make of it? Any of the weekend earnings that really stood out for you? Maybe a word on Gillette, if you've had a look at it recently?
Well, I think Gillette seems to be an outlier because the entire FMCG pack was a very big disappointment. So one needs to go a bit deeper whether something has changed structurally in the company because of which we are seeing these kind of numbers, or it's just something which is a one-off that we need to see. But broadly, I think that this old phobia we had that towards the end of the earnings season all the disappointments come, that seems to have been at least addressed in this particular earnings season. But nonetheless, I think it's been a mixed set of earnings season, and very disappointed with the banks and BFCs and some of the software companies as well. And even within cement pack, we were bullish. So I think that we exit this earnings season with fewer ideas than we thought we would enter in with. But nonetheless, I think it's stable. And let's see going ahead how these tax cuts and lower interest rates, how they pan out. And of course, a great monsoon also is underway.
Okay, all right, Deepan, stay on. Let's address JSW Steel. The stock is higher in trade because there was some relief that did come in there, but the relief could be temporary in nature. Ashmit joins us to break this piece of news for us. Ashmit?
Well, what we understand is that clearly there's a big relief that's come as far as JSW Steel is concerned. What we're given to understand is that the Supreme Court, in very clear terms, has directed for a sense of status quo, no liquidation as far as Bhushan Power and Steel is concerned. That's the core concern that had been raised by the COC, that had been raised by JSW Steel. Now, bear in mind that former promoter Sanjay Singhal had moved the NCLT and had sought for an expeditious liquidation of Bhushan Power and Steel. Now, what JSW Steel, as well as the COC, when appearing before the Supreme Court, told the highest court is that, look, there is still some time left as far as filing of the review is concerned, that if liquidation takes place, that will leave JSW, that will leave the COC high and dry, that the COC themselves are facing questions of how this return, if the Supreme Court order is to be complied with, how the return of funds is to work, how the return of securities from JSW back to the lenders will work, what legal options there are before the lenders, before the JSW. And these were questions basis which the Supreme Court said that in the interest of justice, it's best advised that at this point status quo is maintained. There is no further movement, there is no liquidation that takes place, and that is the best way to ensure that if and when the review is filed, there will not be any further liquidation. Having said that, speaking of a review, the Supreme Court, as a part of its order, does record indicating that both JSW Steel as well as the COC are contemplating relief measures like filing of a review petition. Just a small caveat there. As per the Supreme Court rules, there's a 30-day window for filing of review petitions. Given that this judgment came on 2nd of May, 2nd of June naturally would translate into a deadline, a 30-day deadline. So that's the window that JSW Steel and the lenders are looking at in terms of filing of a review petition. But for now, status quo, no liquidation to happen as far as Bhushan Power and Steel is concerned.
All right, thanks a lot for that, Ashmit. For the time being, status quo. So JSW Steel continues to own and operate the asset. So for the time being, it's good news. And all eyes on the review that they'll be seeking by June 2nd itself. So that's all the details that are coming in there. Deepan, what's your view? JSW Steel, Tata Steel, all of the majors, they have indicated that Q1 will be an improved performance. Is it already baked into the price? JSW Steel, when this negative news came out, the stock was ballpark around 1,000 rupees. And now, though things are still not very, very clear, it's actually recovered all of those losses that we saw on the day of that liquidation verdict. Your take?
See, Najil, as soon as the steel company result comes, the first thing I see is the volume growth. The volume growth is really quite stagnant when it comes to all the steel companies in the listed space. And that's a bit disappointing. And that's one of the reasons why we don't look at steel companies per se in positive light in terms of investment. So I would like to avoid all the steel companies. And the valuations are also very expensive. Even if you consider historical basis, they are trading at expensive valuations. And it's not that earlier the thought process was as soon as they set up the new steel plant, the profits will start to roll in for the companies. That's not happening because per se volumes are stagnant. And then this entire threat is there of imports and tariffs and so on and so forth. And it's a very internationally traded product, so that affects domestic prices as well. So when I look at the full picture, it's something which is an avoid for me. We are better off buying the steel consumers than the steel makers.
Deepan, hi, afternoon. Have you tracked a stock or a company called Share India, which is, I think, Gurgaon based? Do you track it? Have a view?
I know the management very well, so wouldn't want to comment on it. But it's a typical stockbroking company getting into a lot of other wealth management and related businesses. But the core revenues do come from options trading, which is what I understand. And I think that's the reason why its performance gets impacted by the actual options volume traded in the exchanges. But beyond that, I wouldn't want to comment.
They do prop as well on their own books. I mean, I'm just thinking, I don't know, you must have seen that story, Jane Street's $2 billion haul last year.
Yeah, absolutely. I had to read the story twice, Prashant. They made $20 billion in trading Jane Street, of which $2 billion came from India.
Yeah.
That's really, I mean, in a way, it's disappointing because here all the local traders are making loss after loss, and there's this foreign company which has taken $2 billion out from the country as profits for them. So it doesn't feel right. But look, it's a capitalistic society, and I think they have done everything which is as per the rules of the land. So, but it's not the right, I would say, right signal or trend for the capital market where such a huge foreign proprietary trader makes such huge gains at the expense of Indian traders.
Well, zero sum, right? As they say, Deepan, right? And markets, somebody's loss is somebody's gain. It's a story. It's incredible, actually, over the last couple of years, what they've managed to do. Of course, points taken on, and of course, I mean, a lot of, as of now, of course, there's nothing to say, well, they're doing this wrong or that wrong, although there are always murmurs and chatter and all of that, but I don't think we should sort of go down into that. But the point is, they've done exceedingly well. It's not just that. The Citadels, the Jump, all these guys it's a big market now, the options market here in India. Deepan, thank you very much for joining us.
Prashant, is this transfer of profit from India, from Indian traders to these highly sophisticated algo high-frequency traders? I think, what can one say? They are permitted to do it, so they are doing it. And Indian traders are at an unfair advantage as compared to these people. I have heard stories that they invest in servers which run into lakhs of rupees, and they have so much of space at the co-location data centers of the exchanges. And it's not an equal fight, as I understand, but those are my personal views.
No, it is not an equal fight. I mean, there's no fight. It's you're talking about highly sophisticated systems, etc. Actually, Deepan, and for our viewers as well, those who if you remember, there's FTX, the exchange, which was run by Sam Bankman-Friedman. There was a book about FTX which was written by Michael Lewis. Now, that book, of course, was spanned because Michael Lewis came out in support of Sam Bankman-Friedman, who, of course, was committed a fair bit of fraud. But the interesting part of that book is there are a few pages devoted to how these, how the Jains of the world work, because they're highly secretive. But there are a few pages in the book which describe, I guess, inadvertently, the strategies they use, etc. So it's quite actually fascinating. But that's we can maybe go into the details at another time. Thank you very much, Deepan, for joining us. Great to have you with us here. Appreciate it, as always. 130 points on the Nifty, 24,985. We'll take a quick commercial break here. We're going to come back with Rajesh Kothari on the other side.
we get from all this?
Welcome back. You got the market, which is up 140 points, 24,000, actually 25,000. Let's round it off. It is at 25,000. Rajesh Kothari is with us, Managing Director at Alpha Accurate Advisors. And this is Rajesh's kind of market, very, very stock specific. And for the for the discerning investor. Rajesh, good afternoon. Good to have you back.
Good afternoon.
So since the last time we spoke, Rajesh, tell us a little bit about what has been on your radar? What have you done? Stocks have all come back in a powerful way. Tell us.
I think, like last time we discussed at length that, whenever there is uncertainty, that's the time correction happens. And whenever such correction happens, take it with two hands. Don't worry too much about macros because macros keep changing. And you have seen, in fact, the good things, whatever has been happening in last 3-4 months in Indian economy in specific, I think are getting ignored because of Donald Trump tariff tantrum and of course India-Pakistan. These two things actually grabbed the headlines, and all the good things which was happening simultaneously in the economy, they were actually not talked about. So inflation is coming down, interest rates are coming down, RBI is taking all the necessary steps to improve the liquidity in the system. I think everybody forgot Finance Minister gift, the tax cut, which will likely to boost consumption from second half onwards. And all these things put together, simultaneously, there is some time correction and there is some price correction, making valuation kind of a reasonable. Of course, it is not cheap, but at the same time, it is not too expensive. And that's, I think, a very good setup for the market to do well over next 12, 18, 24 months. One important thing from the result season, if you look at the BSE 500, I think except probably 40, 50 companies, most companies have announced their results. And the results have been quite satisfactory. The EBITDA growth is now double digit in the fourth quarter. If you exclude the oil and gas and metals, because that's the right way to look at it, to compare the underlying strength of economy. And that is 13, 14, 15%. And I think that's a very, very, very good number. As we move into 1Q and then more importantly from second quarter, I think the Nifty earnings growth will also turn double digit because of the base effect, number one, and number two, overall improvement in economy. So net, I think the market looks reasonably good. And if anybody who has a 2-3 years view, I think it is a good, decent money to be made in the market.
Rajesh, that's the top-down outlook on India and India's macros. What about individual ideas? What is it that you like? And incrementally, have any new trends emerged, say in the last 1 or 2 months, say from the earnings, any interesting ideas that have propped up that you're investing in?
Well, what typically we do is that we a little bit try to do 6 months ahead of time, correct? So whatever numbers now getting announced, which are good, probably that's what we have been looking for from last 6-8 months. And today, if you ask me what we are looking for is that where do we see the incremental growth 6 months down the line, correct? Like for example, if you remember last 18-24 months, we have been talking about capital goods companies. We have been talking about a power grid capex. We have been talking about a capex into the HVDC technology. And look at the 2-3 companies. There are only 2 companies in this HVDC space. And of course, one company what we own is Hitachi Energy. Please put a disclaimer. And this company, look at the order book, look at their execution, look at the revenue growth. It has been a super duper kind of numbers. So now what we need to look at is incrementally from here, how do we see the new trends emerging in the sectors?
So tell us about that.
2-3 quarters for those companies to get reflected, but that's where you make a bigger alpha. As far as management commentary goes, I think across various sectors, there are winners and there are losers, and I can go on and on, but I think there are a few winners in the capital goods space, which we continue to like. I already talked about 1 or 2 names. Same thing is probably going to happen in the consumer space, where right now it's a little bit slow, but as we move into September quarter, you will see consumer trends also to improve, particularly on the discretionary side. And we hold here one or two very large companies in the consumer discretionary space. And same thing, I believe, is going to happen in pharma, because currently people are a little bit skeptical, too much of noise on US tariff. But as and when that noise gets over, I think the pharma will again probably come back, because the growth is going to be very strong in a few pockets within pharma, not the entire pharma space, but the few pockets within pharma.
Okay. So pharma is something that you're looking at. Rajesh, hi, good to have you on. I must talk to you about defense, right? Because the last couple of months, especially the last, 6-7 odd weeks for obvious reasons, the sector has definitely come back on the limelight in a big way. Today we were talking to BEML and, that stock also, they're looking at building up the defense exposure. We know that. Stocks up 12 to 13% right now. But what is your assessment and your approach? Given the huge run-up in stock prices, the question is, yes, the order book opportunity could be good, but is it all substantially already captured in the stock price, or can someone still take a 2-3 year view and hope to make money here?
Well, frankly speaking, if you ask me, then it is a part of my stocks missed in last 3 months. That's what figures, because that figures are because we have not adequate exposure to this entire space in general. But I think what we look forward is the more sustainable kind of a thing, rather than narratives. Ultimately, what we need to look at the numbers, and that's why there is always a gap between narratives and numbers, and as you rightly say, what the valuations are already factored into. So we have very selective exposure to 1 or 2 names within this entire defense theme. But no regrets if you ask me, because we are holding few companies which have a much stronger visibility compared to defense. And much stronger business moat compared to defense, and of course the best of the customers, no working capital issues and no receivable issues, unlike many defense companies. Please understand, the defense it takes 10-12 years for any approval. So
absolutely, it's a long gestation period. It can be lumpy, absolutely. So let me ask you to play the manufacturing theme, engineering or manufacturing, or basically the whole capex cycle theme. If not defense, how else? What are the micro sectors or the sub pockets? How are you playing it?
So one category is HVDC technology, and we've been talking for that for last almost 2 years. The name of company what we own, Hitachi Energy, is one of our largest holding in that. The second space to look for is the pump segment. Now, for example, the nuclear power is going to be a very big opportunity. And there is only probably, I think, in my view, there is only one company which is an approval to supply the nuclear power plant. It's a multinational company. We like that space. Very good company, debt-free balance sheet. So that's second category. Third category is the compressors. And as the capex goes up across the various sub-segments, be it a mining, be it a defense, be it a steel, or across various subcategories, the compressor category also can do significantly better. And the fourth space is the EMS space. And this entire manufacturing, be it a Apple doing outsourcing or Vivo is doing outsourcing, whichever name you want to talk about, the overall EMS space will also get tremendous benefit out of this. So these are the 3-4 sub pockets within the capex theme on which we are bullish on from quite some time.
Rajesh, with full disclosure, why don't you tell us those 3-4 those names specifically? Full disclosure, just to for our viewers, if you're comfortable.
Yeah. So in pumps we own KSP Pumps. That's the company what we own. In compressor we like Kirloskar Pneumatic, and EMS space we own 2-3 names, all market leaders companies, starting from Dixon to even Avalon and Sirmas of the world. So that's basically the overall capex theme. But kindly please put disclaimer. I repeat, we own these companies for our clients, across the PMS plants.
No, absolutely, and I think it's a clear, absolutely clear disclaimer, no doubt about it. The nuclear one that you were talking about, MNC company, which one was that?
There's a company called KSP Pumps.
Okay.
KSP Pump. This is a company which is a German subsidiary and one of the largest company in KSP. I think the third largest in the pump category, and very high-end technology. That's their moat. So they don't do too much of solar pump and all that stuff, but they do more of a critical technology where technology and applications are getting more.
Rajesh, you also spoke about 1 or 2 large consumer discretionary plays and how pharma may make a comeback. What would your stock holdings be with the disclosure?
So in consumer discretionary space, we own Trent. Trent has been our largest holding from last 3.5-4 years. And I think the company is doing exceedingly well in terms of even the quarterly results. If you look at it, I think that they have done extremely well compared to any other retail category, or forget retail, even the FMCG, non-FMCG, discretionary. If you put the entire growth, then it's the fastest growing company in that entire universe. So that's one company what we continue to like. And there are another 2-3 companies which we are still adding to our portfolio. So I would not like to disclose at this point of time. But it's an interesting discretionary spend on which we are playing. because we believe that the tax gift will boost the consumption from second half onwards, and that can lead to improvement in the overall discretionary space.
All right, Rajesh, we'll leave it there. Thank you very much for joining us. It's a pleasure and good conversation. Actually, great conversation, as always. Thank you. Well, I think we're up 150 points, 25,000 on the dot, as we, I think, hit the 3 p.m. mark now. 30 minutes to go for close. We'll take a quick commercial break here. D-Street chatter with Nimish coming up in terms of what he's picking up. So that's lined up next. And, of course, we'll go back to our technical analysts for some short-term trading ideas as well. Stay tuned.
Fully.
Welcome back. It's turning out to be a good, steady afternoon of trade. No complaints there. The Nifty is cruising along 150 points higher. Mid-cap index also doing pretty well. And even the Bank Nifty, a shade below the Nifty, but again, it's tracking gains of about 0.3%. Now, it's a pretty busy week for the primary market as well, because two IPOs have opened out for subscriptions today. There's chemical storage and logistics firm AG's Vopak Terminals, which has come out with a 2,800 crore rupee issue. And this is, entirely fresh money that's going to go towards the company. Then there is also Schloss Bangalore, which runs the popular Leela chain of hotels. And this is a 3,500 crore issue. Some of it is an OFS, and 2,500 crores is the actual money being raised by the company. Let's listen in to what both of these managements had to say about their issues and about the company prospects.
Two liquid terminals have just become operational in March, which is a JNP in Newport, as well as Mangalore expansion. And then two cryogenic terminals at Mangalore and Pipavav are getting commissioned in H1 of the current year. So they are like factories. I have 22 working sites. I've developed 225 acres of port land in 6 ports. And these are going to triple my LPG capacity, the two cryogenic which is going to come. The terminal is capable to do 6 million tons of throughput. Okay. My rate of revenue is 1,250 rupees. I have spent only 900 odd crores for that terminal. Okay. Now, as the utilization will ramp up in 5-7 years, I would be reaching that peak. Okay. So you take your take that what a potential that terminal has, because I will not be able to step into that forward.
Proceeds of the IPO, about 2,500 crores, which is the primary issuance. A majority of that capital will be used to reduce leverage or debt on the company's balance sheets. As of March 25, the company had cash of about 1,200 crores on its balance sheet. So post IPO, the net debt position of the company, gross debt minus cash, will be close to zero. Firstly, the focus of the business is on luxury. Now, in the hotel business, a large part of your expenses are fixed in nature, which means if you can command pricing premium and if you can invest back in your real estate or your property business with lower fixed heads, which can be sustained, that contributes to your current margin.
Well, interesting conversations from those that are raising some money from the equity markets. For the time being, though, it's around 3 p.m. Nimesh joins us to tell us what he's picking up on D Street Charter. Well, Nimesh, I think participation could be relatively lower because US markets, UK markets are shut. But what are your sense on the flows?
Well, decent outcome, Nigel, given that there was a marginal disappointment in terms of the RBI dividend. Remember, on Friday, we rallied pretty hard in anticipation of a very large number. That didn't turn out to be, and even then, the Nifty is up, buzzing in trade. And I guess, the bigger story is the broader markets. Look at the kind of stocks which are rallying in the broader market names. Various themes are now getting played out. The pipes theme, the insurance theme, those themes are now getting attention from the investors. So clearly, it's a market where the broader markets are relatively outperforming. That's been the trend today as well. What on the flows? It's quite mixed and not great. Either on the buy side or on the sell side. So it's relatively muted is what I understand from a larger institutional activity point of view. As I said, it's largely the mid caps and to some extent, it's also helped by very strong numbers. For a lot of the companies have reported better than what Street was anticipating in Q4 for the broader market companies. So that's also helping at the margin for them to outperform. We have an expiry this week, so it'll be a bit volatile over the next couple of days. But broadly today, on the Nifty, there is not much participation. And the broader market outperformance continue.
All right, but there's obviously a few stocks that you have picked up with some news in focus. So tell us which are them.
Right. So in terms of the individual stocks, the first is the theme on the block deals. I track very closely that. So I understand there are going to be large blocks in few names. One is ITC Hotels, PG Electro Plus, and Angel One. So expect large blocks in these three names. In fact, PG and Angel One both are under pressure today. The second name is Apollo Pipes. I spoke about pipes as a theme doing good. Apollo Pipes was up 20% on Friday. It's buzzing in trade on large volumes in today's market as well. And I understand a large HNI investor was an active buyer in the last couple of days. So entire pipe theme seems to be doing good. Astral, Supreme, and so for that matter, Apollo Pipes as well. The third stock is Max Financials. Within the insurance name, this one stock which has relatively outperformed post the earnings as well. Again, I understand there are very strong buy bids from large institutions, and one long-only FI has been an active buyer in Max Financial. That's the reason why we've seen a relative outperformance within the insurance pack. And the last is Balkrishna Industries. We spoke extensively about weak numbers and the capex that companies foraying into, but there are aggressive sell-offs as well from large institutions in Balkrishna Industries.
So yeah, no, absolutely. Nimesh, lots of blocks, right? And that first one was ITC Hotels, right?
Yeah, that's right.
That you mentioned.
So,
and here,
yeah.
Are we looking at some more promoter selling stake? I mean, any idea?
Prashant, it's basically a strategic investor who's going to sell stake in ITC Hotels. Remember, post the demerger, there was an equal shareholding, right? So that entity owns close to 15% stake, and it's a non-core asset for them. So they have actually disclosed, last quarter as well that they will eventually sell that stake. So it looks like that large block is coming in ITC Hotels. But interestingly, I understand a very large influential investor, HNI investor, has shown some sort of an interest in that block. So very interesting as to how much they sell and who's the large investor who buys in. But for ITC Hotels, the buzz is that it could be a large block deal coming very soon.
Okay, all right.
I hope I gave enough hint on who the seller is and potentially who the buyer is.
Yeah, without naming.
Without naming, and rest let the market gossip and predict.
So Nimesh has given us the likely seller and the counterparty also.
Yes.
But counterparty, we'll see as it comes. Nimesh, thank you very much for that. So that is ITC Hotels, but that's one among a few companies where there are blocks which are expected. Now, let's go back to Rahul, who's with us with what he'd want you to buy or sell today for a reverse trade. We'll come back tomorrow. Rahul, good afternoon. What do you have? Rahul, I think you're on mute. You'll have to unmute yourself, please.
Yeah, beg your pardon. So Bharti Airtel is a trade that can be looked upon for BTST. The stock has seen a sizable build-up in the open interest on the future side. Plus, the stock is also technically looking very robust. One can also look to buy the call options of 1860 strike price around the 43.45 price. Have a stop loss placed at 36 and about 60.65 is a possible target in the same. So Bharti Airtel looks pretty solid for a BTST trade.
Thank you very much for that. Let's talk about BEML. That's surging after reporting the Q4 numbers. Ria joins in with the details. Ria.
Well, yes, BEML has been trading higher in today's session on the back of very strong commentary from the management. They've said that they're expecting a 20% revenue growth in FY26 with rail and defense orders firing up in this year. In terms of revenue contribution, rail and defense are expected to contribute to over 60% of the revenues in FY26, while mining will account for the remaining 40%. They're also eyeing an order book of around rupees 22,000 crores by the end of this year, which will be an increase of over 50% from the current levels. Margins are also expected to expand by around 150 basis points to 14.5% in the next fiscal. Now, on the defense front, here's where the commentary has been quite positive. They're optimistic about landing some large defense procurement orders, particularly in the land system platform segment. Now, overall defense is expected to contribute to over 20% of the FY26 order book, with the revenue contribution from the segment going up to 30% from the current 27% levels. They've also said that they're diversifying into the maritime and aerospace segment as well. And while the aerospace order book contributions will reflect in FY26, the execution for this will start in FY27. So overall, the outlook remains quite positive. The stock is up over 13% on the back of this. And this is despite the fact that the company has missed their FY25 revenue and order book guidance.
All right, got that. Thanks very much for that, Riya. Well, earlier we did speak with the CMD of the company, Shantanu Roy, on BEML's revenue and order book estimates for FY26, both of which are looking better than what the company delivered in FY25. Take a look.
Order book, as far as the current scenario, what it looks like, with some spillover orders in the rail and metro. So the current order book of 14,600 crores as of 31st March, we should be hoping to double it in the current financial year. Again, it will be led by rail and metro. 60% contribution will come from the rail and metro. A lot of metro projects which we have already bid for, it will be decided in the current financial year. Some of the rail projects also, like the track machines and all, which we have already bid for, it will be decided in the current financial year. And 20% each from defense and from mining. That is what it looks like currently. I said doubling it. So doubling it should be around 28,000, and from 28,000, we'll be executing some as well. So we should end up the year at around 22,000.
Let's move on and talk about Camlin Fine. That's in focus. Lots of brokerages are writing on this company. Upasana joins in.
Certainly, Rima. Well, the company has reported a strong set of numbers in FY25, and the stock is also up 35% this month. Now, coming to the brokerages, Incred has given a buy rating with the target price as high as 428 per share. It says that the company is one of the largest suppliers of catechol to Chinese markets. However, with increasing captive consumption, its exports have declined, contributing to rising catechol prices globally. As a result, vanillin RM cost in China expected to increase further. Now, brokerages also reiterated that with the marginal cost of supply in 70% of the global market now at minimum $23 per kg, India's vanillin export prices are likely to rise at least by $20 per kg by H2 FY26 is what they have highlighted. Now, Phillip Capital has also given a buy rating with a target price of 255 per share. It says that the company has seen a turnaround in its core earnings in FY25, led by sustained strong performance in company's blended business, ramp up in vanillin operations, and also closure of its loss-making Italy and Chinese plant, which has led to this growth. Now, going ahead, it expects the company to deliver a strong, profitable growth ahead and a good performance as well, led by various factors such as elimination of company's hidden losses in its Europe and China plant, as highlighted earlier. Also, volume and value benefits will kick in as vanillin operations will be led due to anti-dumping duty on China by both US and Europe, and also integration of two strategic blended business acquisitions by the company. All these factors will lead to a strong profitable growth is what the Phillip Capital has highlighted. It has also raised its FY26 EBITDA estimates by 7% and FY27 EBITDA estimates by 3% respectively. So all in all, a strong commentary from brokerages, and we can clearly see the stock surging in trade today.
Okay, all right. Thanks a lot for that, Upasana. Been a while since I saw Camlin spike up in that manner, but thanks for giving us that detail. Pipe stocks, they're in focus. Astral, Supreme, Prince Pipes, Finolex, all of them are gaining in trade after a while, after a few months of soft resin, PVC resin prices. We have seen prices move up. Ria joins us to tell us why. Ria?
Well, yes, pipe companies have been buzzing in trade today, and this is largely due to the fact that PVC resin prices have reversed after 5 consecutive months. Now, as per PL, this reversal in PVC resin prices is positive for plastic pipe players like Astral, Supreme Industries, Prince Pipes and Phenolics Industries as well. What they've said is that the sustained price correction has led to a sharp reduction in channel inventory levels, and with this price reversal now, plastic pipe distributors and channel partners are expected to begin restocking, and the normalization of channel inventory is expected to lead to a growth of around 8 to 8.5% for the industry in FY26. They've also said that larger players are expected to gain market share and also achieve or even exceed their volume growth guidance for FY26. So on the back of this, all of these companies have been trading higher in today's session despite posting a weak set of numbers for Q4. But in terms of valuations, all of these companies are trading below their 3-year average PEs. And if you look at the stock prices as well, for Phenolics, Supreme and Astral, all of these are down around 38% off their respective 52-week highs, and even Prince Pipes and High-Tech Pipes are down around 54% off their 52-week highs.
All right, okay, got it, Ria. Thank you very much for that. We have Sudeep Bandyopadhyay, Group Chairman of IndiTrade Capital, now joining in. Sudeep, thanks very much for being with us. Good to have you on. So let's actually talk about some of these pipe companies, Astral, Phenolics and the likes. What's your sense with this change in the resin pricing now? What's the outlook? Do you like any of these stocks to begin with?
Well, I think it's an interesting opportunity for some of these players. And, definitely, I think restocking is a reality and that will happen, which will benefit pretty much all these players, particularly the more established players. But looking at the valuation, I think Prince Pipes does look good to me because you have to also factor in the valuation at which they are quoting. Well, Astral is a fantastic company, but the valuation is rich. So if I am a little, prone to, willing to take a little bit more risk, I think I'll go for Prince Pipes at this stage.
You had a look at Balkrishna's numbers. Street is disappointed. The stock is down 6%. What next for the company?
Well, I think numbers were definitely disappointing, and I think the market price correction is on account of that. But I think there is one bit of a silver lining because raw material prices are coming down, and the way things are poised, I think the cost coming down will help them improve their margins going forward. But having said that, I think this trade war and tariff issue will affect Balakrishna one way or the other. So we'll have to it's better to wait and watch how this entire tariff thing settles before I will recommend position or buying into Balakrishna even at current levels.
All right, that's Balakrishna. Definitely, it's been one of the result disappointments of the day. We'll take a very quick break on that note. Come back. We'll have more on the markets for you in just a bit.
Welcome back. Well, the broader markets continue to hold with good gains, and the Nifty is up around 150 points. Sudeep Bandyopadhyay is still with us. Sudeep, I wanted to ask you about Camlin Fine. You know, Upasana just joined us and explained to us why the street is now optimistic on prospects and why a couple of brokerages as well believe that, you know, the part of the business that was making losses, in fact, that material will be used in-house, and that's where things could turn around. Any view on Camlin Fine? So the other one I'm looking at is Subros. It came out with a set of numbers last week, and the stock is now up close to around 10%. Your view on any of these two?
Well, I think Camlin definitely deserves attention. I think, a lot of interesting things are happening in this entire space. And I think the opportunity size for them is growing. They were already well entrenched in China, and yes, the use of the loss-making part of the material in the in-house consumption definitely gives them an edge, and margin improvement is a distinct possibility. So yes, I think significant value appreciation possible. Also, the valuations are not that rich. If you compare with many other segments of this same industry. So I think it is definitely worthwhile looking at Camlin. As far as Subros is concerned, while performance was interesting and definitely worth looking at, the challenge to me remains the entire tariff issue. So the global OEMs and their acquisition going forward will, to an extent, definitely depend on how the tariff thing settles. So I'll be a bit cautious. Performance was undoubtedly good, and the price also has moved up consequent upon that.
Sudeep, Dream Folks, it's trading well below its issue price of 326. It was providing a lot of services when you're traveling at the airports. Now they've diversified into highways. The stock is down nearly 4-5% post-earnings. Is it a company you've looked at?
I did look, and I don't think I will recommend a buy. I think the valuation was rich to begin with. And, to justify that kind of valuation, performance has to move up significantly. I'm not saying the business model is not good. Business model is good. And definitely there is scope for significant scale up. And pretty much that's what they're trying to do by diversifying out of airport premises. That's the right thing to do. But I think it'll take time before, the fundamentals catch up with the valuation.
Okay. Gillette, GNFC, Transrail Lighting, Rate Gain, Kolte Patil, all up 5, 6, 7% on the back of Q4 numbers. Any of these on your watch list where you'd recommend a buy?
Well, I was very positive on Rate Gain for quite some time. Then, of course, the company disappointed by continuously lowering the guidelines. Guidance actually, and they were at 20. From there they came to 15, and finally around 12. Of course, finally they have met the revised guidance, and that's good. I think fundamentally the business has potential to grow significantly. Travel and tourism is one segment which is definitely booming, and they cater to this segment. So opportunity is significant. They grew through acquisition last year. Right now they have a lot of cash in the books, but no acquisition has come. So we'll wait for how things move in the near future. But if you have a little long-term view, I think Rate Gain is definitely a good hold or a good buy even at current levels.
And finally, Sudeep, in some senses, I guess the stock of the day, BEML. I think looking at the Q4 numbers, nobody would have imagined it will end up 15% higher. I'm not quite sure. But the commentary was fine, and they're talking about obviously a better execution, better revenue growth, and a bigger order book as well by the end of FY26. But your thoughts?
Well, I think the commentary was pretty good. And I think what is interesting is now about 60% of their business is coming from metro rail and rail segments, and 20 and 20 each from defense and mining. So yes, defense also is an interesting area, but I think the work they're doing in metro execution is key. And if execution improves, I don't think there'll be a dearth of orders. So the management is talking sense. There's absolutely no problem in them getting order. We'll have to wait and watch the execution. I still remember BHEL, how they used to continuously get orders and performance used to disappoint. Execution used to disappoint the market time and again. Then subsequently in the last few quarters, they have started performing well on the execution front. We'll have to wait and watch how BEML does on the execution front going forward. I am positive on the stock, but I don't think I will buy or recommend a buy still.
You know, there is a stock, Sudeep, called Concord Enviro Systems. Have you? I don't know if you tracked it. It's a fairly recent listing. Water treatment.
No, I haven't, Prashant, but I think treatment is an interesting area.
Very small company, 1,200 crore market cap. Numbers have been good. Actually, last quarter was a disaster. This quarter has been good. B2B in terms of water doesn't deal with the government or multilateral institutions, etc., like VA Tech does. Anyway, I mean, it's one of those stocks which has not done well since listing at all. But as I said, it's very, very small. So keep that in mind. 145 points, by the way, on the Nifty is what you have. There's about 2 minutes to go for close. And it's a pretty good session all told this Monday. You know, so many individual bottom-up names which did quite well. It's not like, you know, one or two sectors. It's really from everywhere. And in that sense, all were called. Cosmo first, I mean, oh boy, what a move it has seen. And it's an absolute disaster. It used to be, at least till about 6-7 days back, an absolute disaster over a long period of time, that is, by the way. But from under 600, it's now it's leaped above 1,000 rupees, 1,050 nearly on Cosmo first, very, very quickly. So that's come up with humongous gains, but you know, so many others. Shilpa Medicare, for example, I think about 5-6 days back was about 600. Stocks are almost 900 rupees now. Of course, there was news flow with regards to Shilpa, which Ekta highlighted on Friday. So there is that. NetWeb is up 6%. We had Nilesh Shah with us on Editors Roundtable on Friday, who was talking about this one. Again, I mean, the recent low was about 1,250, 1,900 now on NetWeb. ITT Cementation, which of course now I think is there was a Adani open offer, which I think has now come up. Low was about 500 recently. Stocks back above 700. I could go on with many of these names. Vaibhav Global, by the way, is another one. Again, we discussed this on Editors Roundtable on Friday. Stock, by the way, up 8% after a while. You know, big volumes as well on this one. So yeah, it's a pretty good-looking screen, all told, overall, as far as broader markets are concerned. Sudeep will, of course, stay with us and take you through what to watch out for in markets forward. It's a wrap on this edition of Closing Bell from all of us here. It's goodbye. Markets forward picks up the action in just a bit.
A range-bound session sees the Lal Street end higher. Nifty ends near 25,000. Auto and IT stocks gain the most. Banks underperform the blue chips.
Relief for JSW Steel over its acquisition of bankrupt Bhushan Steel. Supreme Court orders status quo on liquidation proceedings. JSW and lenders confirm that review petitions will be filed. JSW management is upbeat on getting a refund if Bhushan Steel goes into liquidation.
MSCI and FTSE indices announced weight reductions for Eternal following the company lowering its foreign ownership limit to 49.5% from 100%. The stock slips on anticipated outflows of over $800 million.
You're watching us here on Markets Forward, your go-to show where we aim to get you all the key data points to get up for the next trading session while telling you a lot more about the trading session that took place. I'm Manglam Malu, with me, Ekta Batra. Ekta, good evening. It's been a good day today. Give and take everything. We managed to conquer that 25,000 mark on the Nifty. The broader market's doing a shade better. We had nearly 60% stocks advancing, 60% more stocks advancing than the number of stocks that declined.
Hi, Manglam. Yes, absolutely. You know, it turned out to be a good session for us today. We had, it was a steady start to the week. We had no problem in terms of the key indices and the Nifty hovering around 25,000. The mid caps, like you mentioned, marginally outperformed, giving indication that the advanced decline ratio was in positive terrain. But we do have you covered for the next 20 odd minutes with all the big news and the key developments on the Lal Street, top corporate voices, and the events to track ahead. So let's kick off the day with the market action. Manglam, what a great day it was, start to the week.
What a great day it was, right? You know, for starters, we did see the GIFT Nifty indicating a 50-point uptick. The market opened higher. Thereafter, we went all the way up to 25,070, 80. Thereafter, we saw a bit of a sell-off back below the 25,000 mark. And thereafter, it's been steady as she goes for the frontline index, barring the volatility that we saw in the first hour of trading session. What did well today? We did see the return of a lot of these global-facing names on account of maybe some sort of tariff relief coming in for Europe. So we had the metals do well. We had the IT index, which gained about 1%. And we also saw FMCG do well because of the early onset of monsoon. So all these indices doing a lot better. What did not do as well as the other parts of the market was the Nifty Bank. And that's largely because maybe it saw a bit of a sell-off as we saw it move closer to its previous high of closer to 56,000. The other things that we'll be watching out for through this week. One, today we will keep an eye out on the flows that come in, especially from the FIIs, largely because it was a low volume market. When it came to FIIs, the US markets are shut because of Memorial Day. So a lot of the market today was pumped higher by the domestic institutional investors. The second thing that we'll be watching out for, how the market moves as we progress towards the week because of it being the May series expiry week. So we expect a bit of volatility, and that was actually reflected in the way the India VIX moved as well. So the India VIX actually went above that 18 mark, telling you that maybe the street believes there could be some volatility in sight.
Yes, absolutely. So that's what really took place in the markets. I just want to point out that the broader markets did see quite a bit of traction. So the mid-cap index did marginally outperform with a gain of around 0.67%. But we had the BSE small-cap index, which picked up a little bit as well. So it was up around 0.5% by the close of trade. So just watch out for this kind of outperformance to probably pick up a little bit of pace going forward. And like Bangla mentioned, we do have a lot in terms of cues to watch out for in the next couple of days. We do have a couple of numbers, the fag end of the earnings season, and let's see what the global cues throw up, considering the kind of commentary and what's taking place in Russia and Ukraine. But let's get to our first segment of the day then. Hormuz joins in now from the big wall with the top stocks and movers of the day. Hormuz, over to you.
Well, earnings reactions continue in both sides of the spectrum actually, with good and bad reactions to results. And Gillette was the number that came out just a few minutes before market closing. At one point was up 11% as an earnings reaction, ending the day 7.25% higher. A strong operational performance coming in from Gillette. GE Vernova, of course, results came in after market hours on Friday. The stock remained in a 10% upper circuit through the day. Panama Petro rate gain numbers came in during the day. The mixed reactions coming in on both
both of these companies, and Sarda Energy, of course, an earnings reaction with the margins narrowing compared to the previous quarter, and that resulted in the stock ending 5% lower. Some of the newsmakers in today's session, and they are kind of earnings reactions as well, with BEML 15% higher after some strong management commentary coming in earlier in the day when they spoke to us. Balkrishna Industries, of course, after the downgrade that came in from Nomura, was down in a 10% circuit, but later recovered to end 7% lower. Honasa giving up some of Friday's gains, was up almost 18-20% on Friday, gave up some of that. And Eternal, of course, bracing for outflows of close to around 900 million over this course of this week, ending 4.5% lower. And Camlin Fine, of course, after that very strong brokerage note coming in today, 15% higher on that stock. PSUs did well in today's trading session, most of them at least, with HUDCO leading the pack, 4.5% higher on that stock, and similar gains seen from RVNL, Concor, BHEL and IRFC as well. And lastly, stocks that did well on the back of strong volumes, and of course GNFC continuing to move higher, 6.5%, and Emcure Pharma, the third day of gains, now another 9% surge, adding to the gains seen on Friday and Thursday. Phenolics, Linde and Timken too seeing gains on strong volumes. And lastly, stocks that bucked the trend in today's session, the names like Hitachi Energy, Dalmia Bharat, losses there anywhere between 3% to 5% in today's session. Back to you guys.
At that point, a bunch of stocks on our radar. Those were the top stock movers. Thank you, Hormaz. Let's cut across to our guests now. We do have Sudeep Bandyopadhyay of IndiTrade Capital and Jay Thakkar of ICICI Securities joining in. Jay, the Nifty seems to be fulcrumed around the 25,000 mark. If you look at the option action, tells you that maybe, over the next couple of days, we're looking at a range between 24,800, 24,650 to 24,700 in terms of support, and on the way up, maybe 25,100 and 25,200 as the congestion zone. Would you concur with the same, or you have a different view?
Good afternoon to you, Mangalam, and good afternoon to you, Ekta. Absolutely, as you rightly said, that's been the pretty much, the range for the Nifty, 25,200, 24,800. And in fact, Mangalam, I would say that Nifty, in fact, managed to bounce back quite sharply, last week, despite, it, reversed from 25,000 on multiple occasions. It went to 24,500 odd levels, probably, and 300 odd levels, either 3 to 4, 500 levels, and reversed from there very sharply, and it's back to 25,000 and above. But then it's not able to sustain higher above those levels, despite good amount of put writing both on Nifty and Bank Nifty. So Bank Nifty too is struggling, Mangalam around 56,100 levels, that is his all-time high, and Nifty as well. So according to me, the fresh long position should be now created on Bank Nifty above its previous swing high, as well as on Nifty. Those highs are taken off. I mean, you might get a swift move towards 25,500 on Nifty, and probably 57,000 to 57,500 on Bank Nifty. Most of the private sector banks, Mangalam, are stuck within a range. Probably you say either Kotak Bank, Axis Bank. One is quite evident, that's HDFC Bank, which has a higher weightage as well. So they are all stuck in a range, and if those range breakout comes, probably then you'll get a breakout, else it can continue to consolidate. One thing interesting to notice, the last part which I have to make, is the India VIX, Mangalam, which has been bouncing back since past couple of days, and which is acting as a hurdle, or probably is one of the reason why Nifty is not able to sustain the high levels. If at all we see VIX going up, there can be some further consolidation to correction. If VIX cools down, probably you might get a breakout.
Okay, well, Sudeep Bandyopadhyay also joins into this conversation. Sudeep, welcome to the show. If you could just give us a sense in terms of how you approached the broader markets today, any stock-specific trades?
I think there were a lot of interesting pockets in the market, and one interesting pocket which I continue to monitor is cement. I mean, it's got nothing to do with today's what happened in the market, but I think there are opportunities in cement, and this is completely Trump-proof segment, so one can look at opportunities in cement. The other interesting thing in today's market, at least I noticed, is Gillette numbers. I think, while we have seen and heard from multiple FMCG companies that there are challenges in urban demand, at least semi-urban demand in pockets, but Gillette's numbers actually completely contrary to that, and it probably gives us the initial rays of hope that things are improving, and probably next few quarters we'll see much better numbers from FMCG companies as well. Monsoon definitely should give a boost, and we'll wait and watch what happens there. The last but not the least is the pipe companies. I think there are a lot of interesting things happening there, and the restocking is happening and will continue to happen. That gives a significant bump up. Though the Q4 numbers were not good, but I think going forward, the pipe companies' performance and pipe companies' even market performance should be better.
We take that point entirely, Sudeep. Just a word on Gillette as well. The large part of the revenue growth was on account of them having expanded their market. Up until now, Gillette was the best that a man could get over the last couple of years. They've started to ramp up their portfolio on the female side as well. So Venus, which is one of their strong arms, which has been growing at 2x the pace of men's shaving units, has actually led to this growth, and lower steel prices helped them as well. So while the company saw revenue growth of 13%, the net profit actually grew by 60%, and that was the big driver out there. The stock obviously has seen a big rally already, and the street believes that there is room for more. Let's talk about the other important story now. In a big relief coming in for JSW Steel, the Supreme Court has ordered a status quo on the liquidation proceedings of Bhushan Power and Steel. The Apex Court has allowed JSW Steel and its committee of creditors to file review petitions in the case as well. It said that the 30-day period to file a review wasn't over yet. Ashmit joins in with the details on that one. Ashmit.
Well, what we understand is that clearly there's a big relief that's come as far as JSW Steel is concerned. What we're given to understand is that the Supreme Court, in very clear terms, has directed for a sense of status quo, no liquidation as far as Bhushan Power and Steel is concerned. That's the core concern that had been raised by the COC, that had been raised by JSW Steel. Now, bear in mind that former promoter Sanjay Singhal had moved the NCLT and had sought for an expeditious liquidation of Bhushan Power and Steel. Now, what JSW Steel, as well as the COC, when appearing before the Supreme Court, told the highest court is that, look, there is still some time left as far as filing of the review is concerned, that if liquidation takes place, that will leave JSW, that will leave the COC high and dry, that the COC themselves are facing questions of how this return, if the Supreme Court order is to be complied with, how the return of funds is to work, how the return of securities from JSW back to the lenders will work, what legal options there are before the lenders, before the JSW. And these were questions basis which the Supreme Court said that in the interest of justice, it's best advised that at this point status quo is maintained. There is no further movement, there is no liquidation that takes place, and that is the best way to ensure that if and when the review is filed, there will not be any further liquidation. Having said that, speaking of a review, the Supreme Court, as a part of its order, does record indicating that both JSW Steel as well as the COC are contemplating relief measures like filing of a review petition. Just a small caveat there. As per the Supreme Court rules, there's a 30-day window for filing of review petitions. Given that this judgment came on 2nd of May, the 2nd of June naturally would translate into a deadline, a 30-day deadline. So that's the window that JSW Steel and the lenders are looking at in terms of filing of a review petition. But for now, status quo, no liquidation to happen as far as Bhushan Power and Steel is concerned.
The matter is sub judice, so I may not be able to comment too much, but I think it's important to note that we have implemented the resolution plan in full compliance with the law, and we have been able to successfully revive the asset to its present condition where it is today, with increasing operational output, with increase of capacities. The second thing is that we have analyzed the judgment along with our legal advisors, and we believe we have strong grounds for availing all legal remedies available to us.
Okay, all right. Well, Sudeep, have you been tracking this story, and what would your would your outlook be on JSW Steel?
Well, JSW Steel, otherwise everything else is fine. I think they're doing the right things, but this is such a confusing scenario that a lot depends on how things move in the Supreme Court. Yes, today's was definitely a relief, because immediate liquidation would have created utter chaos in the entire system, I would say. So this is definitely a relief, and hopefully their review petition will be considered. The way I look at it, some penalty, some fine can be imposed, but unwinding the transaction which has already happened years back, I think it will set a bad precedent and create a lot of confusion. So in JSW's interest, I think this transaction should continue. Otherwise, absolutely fine. JSW and overall steel industry, we are positive.
All right. Chartically, how does it look? if I had to ask, the other guest, Jay.
Yeah. Well, Mangalam, see, I would say that JSW still the overall trend technically is definitely positive. I mean, the stock has been, moving higher in an upward sloping parallel channel. I mean, since past couple of trading weeks, the stock has formed a kind of a symmetrical triangular pattern, which is a continuation pattern, and the range has been 940 on the downside to 1050, 1060 on the upside. So it's been of around 100 to 120 points kind of a range. I think the probability of a breakout on the upside is higher as the momentum is favorable, for the bulls. It's well in the buy mode, as well as Mangalam. Since the overall rise, we have seen as far as derivatives data is concerned, the futures OI had come down continuously, clearly indicating long liquidation. But since past couple of trading sessions now, there has been a sharp uptick in the open interest with the price moving up, indicating that there's a long build-up and a higher chance of a breakout from this range, 100, 120 points range on the upside. So I would say that until 940 levels are not broken on the downside, the trend remains bullish. And if breaks out, I mean, it can go to 1200, 1250 levels as well.
All right. Thanks a lot for that. Let's talk about the other stock on our radar then. Zomato's parent company, Eternal, fell nearly 5% after the MSCI and FTSE announced weight reductions for the stock. The move came after Eternal lowered its foreign ownership levels. Vivek Iyer joins in with the details. Vivek.
Well, that's right. So, last week you did see the news flow come about where, the board and the shareholders had gone ahead and approved reducing the investment limit as far as foreign ownership was concerned to 49.5%. Earlier it was 100%, as high as 100%, and they went ahead and reduced it to 49.5%. So along expected lines, quant analysts had expected that this particular move or reduction as far as the foreign ownership limit is concerned would go ahead and trigger reduction as far as weightage of both MSCI as well as FTSE indices as far as the treatment of Eternal was concerned. So on Friday, you did see an announcement come about both from FTSE as well as MSCI. FTSE said that they would be reducing the weight of Zomato or Eternal on May 27th. The expected outflow is close to $380 million. These estimates are as per IIFL Capital. Now, MSCI, remember that particular outflow is quite higher. On May 30th is when this particular outflow is anticipated, and outflows of close to $460 million. Again, the estimates are as per IIFL Capital. This proved to be an overhang on the stock today, given the fact that significant passive outflows are expected during the course of the week.
Okay, all right, Vivek. Thanks very much for that. So that's the update coming in on Eternal. But Divi's Labs is one of the stocks that I looked at. It was one of the top gainers on the Nifty today. Now, the reason is that they've signed a long-term manufacturing and supply agreement with a global pharma company to manufacture and supply advanced intermediates. They say that they're expecting meaningful revenue contribution from this particular agreement, and the company is not permitted to disclose the name of the customer or any quantitative information, but the cost of the capacity addition for manufacturing under this agreement is estimated to be 650 to 750 crores, which is going to be paid by the customer phase-wise under the agreement. With this, the company has now signed 3 long-term supply agreements. They've signed 2 long-term supply agreements earlier, and both those contracts were related to custom synthesis projects. One was with advanced intermediates and the other was with an active API. Morgan Stanley is bullish on Divi's Labs. They have an overweight call, target 7185. According to them, both orders imply incremental revenues of 1690 to 1890 crores versus FY25 revenues of 9,300 odd crores. But Sudeep, have you looked at Divi's Labs, and what do you think? Where do you think the stock could go from here, considering that it's so expensive and it has punchy valuations?
Well, it was always expensive and it continues to remain expensive. But I think all these new contract signing definitely gives them a good runway going forward. And, if their top line can go up by about 15-20% based on these contracts, new contract, I think that's pretty interesting from this company's point of view. If you're a patient investor and can allocate money for 1 year plus, I think definitely even at current level, Divi's look good. I think we are looking at about 15% upside from current levels.
All right, 15% upside from current levels. Thanks a lot for that. In fact, we'll take a short break, come back, get you more on the markets and top corporate voices along with the key market events to watch out for on the other side. Stay tuned.
order.
Welcome back. Well, you're still tuned into Markets Forward this Monday afternoon. Two IPOs have opened for subscription today, Aegis Vopak and Sklosh Bangalore. Well, tell us more, Mangla.
You know, after a very long time, Ekta, the IPO market is back, and it started with a couple of fresh issues. So we have Aegis Vopak, which has a 2,800 crore fresh issue. Schloss Bangalore has a 3,500 crore issue, of which 2,500 crore is fresh issue as well. What does Aegis Vopak do? It's the largest Indian third-party owner and operator of tank storage terminals. So all the liquid and gas storage that takes place, they're the ones who are responsible for storing that and transporting that. Well, the management has said that with the money that they are raising, they will, use about 2,000 crores to repay their debt, and their bank borrowings will become zero, which will save them 160 crores in interest cost, which will flow straight to the bottom line. They have two liquid terminals for the company, which have recently become operational, and H1 will also see two cryogenic tanks, which will come on stream. So all of this would mean that FY26 will be a marked jump in performance. The post-issue market cap that they're seeing is close to 26,000 crores. So even if they more than double their net profit from here, 85 crores to about 300 crores, still trading at around 85, 87 times one-year forward earnings. Not particularly cheap, but that's the market that we're in right now. The other one, Schloss Bangalore, you would better know it as the company that owns and operates the Leela Palaces, the Leela Hotels and the Leela Resorts. Remember, HLV was sold to Brookfield earlier, and now Brookfield has come back with Hotel Leela. The portfolio comprises of 13 operational hotels with 3,500 keys. They are the EBITDA margin leader with nearly 50% as compared to Indian hotels at 33%, Chalet Hotels at 38%, and Lemon Tree at 45%. They say that they are, in the luxury segment, and they will continue to sustain their margins. They too are using these funds to become debt-free, and they will save about 200 to 210 crores in interest costs. Hospitality segment, they say, will grow much faster than the GDP growth. Leela's market share in luxury is about 10%, will continue to grow. So what we'll do is, we'll hear out the management bites on what they had to say, both Aegis Vopak and Schloss Bangalore.
Two liquid terminals have just become operational in March, which is a JNPA new port, as well as Mangalore expansion. And then two cryogenic terminals at Mangalore and Pipavav are getting commissioned in H1 of the current year. Yes. So they are like factories. I have 22 working sites. I have developed 225 acres of port land in 6 ports. And these are going to triple my LPG capacity, the two cryogenic which is going to come. The terminal is capable to do 6 million tons of throughput. Okay. My rate of revenue is 1,250 rupees. I have spent only 900 odd crores for that terminal. Okay. Now, as the utilization will ramp up in 5-7 years, I would be reaching that peak. Okay. So you take your take that what a potential that terminal has, because I will not be able to step into that forward.
Proceeds of the IPO, about 2,500 crores, which is the primary issuance. A majority of that capital will be used to reduce leverage or debt on the company's balance sheets. As of March 25, the company had cash of about 1,200 crores on its balance sheet. So post-IPO, the net debt position of the company, gross debt minus cash, will be close to zero. Firstly, the focus of the business is on luxury. Now, in the hotel business, a large part of your expenses are fixed in nature, which means if you can command pricing premium and if you can invest back in your real estate or your property business with lower fixed heads, which can be sustained, that contributes to your current margin.
Okay, well, now let's go across to the key voices of the day. First up on the list is BEML. The management guides its order book to reach 22,000 crores in FY26. That's not all. It expects revenue growth to be 20% with an EBITDA improvement of 150 basis points. The company is anticipating a phenomenal growth in its defense business this year. The management says it's quite optimistic about large defense emergency procurement orders. The defense revenue contribution is set to increase to 30% in FY26.
Next up on the list, we have Ashok Leyland, the management optimistic about FY26, saying that growth rate should be very healthy from the second quarter, as decline in interest rate and macroeconomic activities will actually drive growth in this FY26 bus segment. That's the one where they will see healthy growth, while medium and heavy commercial vehicles will see mid-single-digit growth in FY26. They continue to focus on margins, but claims that it may take 2 to 3 years to achieve that mid-teens sort of EBITDA guidance that they have. On Hinduja Leyland Finance, though, management of Ashok Leyland says it will be able to list that very soon once the approvals are in place. Lastly, we had Indigo Paints on our radar as well. The company has witnessed gradual improvement in demand, further improvement in the first quarter. Margin, the management believes, is likely, with the industry just months away from demand normalization. They are aspiring for 5% market share over the next 3 years, with 3% right now, and margins will remain steady as they grow more than 20% as the industry normalizes.
Okay, and before we wrap, let's bring you some key market events to watch out for. Ria is standing by with the key events for tomorrow.
Well, yes, let's take a look at the most important events to watch out for tomorrow. We'll have a lot of companies reporting their quarter 4 numbers, which will include LIC, Bharat Dynamics, DCX Systems, Gujarat Fluorochemicals, Hindustan Copper, JK Lakshmi Cement, NMDC and NMDC Steel, PNG Health and Techno Electric as well. We'll also have Hindustan Copper holding a board meeting tomorrow to consider a fundraise of up to rupees 500 crores. Going on to the economic cues then, in Europe, the economic sentiment will be important tomorrow, as well as the consumer confidence data in the US. And we'll also be watching out for the Bitcoin 2025 conference that is going to be starting tomorrow in Las Vegas.
All right, with that, it's a wrap on this edition of Markets Forward. We'll be back with more news and updates on the other side. Thank you so much for watching CNBC-TV18.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Sensex and Nifty end a range-bound session with minor gains. Nifty reclaims the 25,000 mark. Auto and IT stocks are the top gainers. US President Donald Trump pushes back his 50% tariff deadline for the European Union by over a month till the 9th of July. The de-escalation comes after a call with the European Commission President. Global markets inch higher. President Trump says Russia's Putin has gone absolutely crazy and hints at possible new sanctions. This after Ukraine's Zelensky questioned America's silence on the Russian air raids targeting Ukrainian cities. Trump also slammed Zelensky, says he's doing his country no favors by talking the way he does. Relief for JSW Steel over its acquisition of bankrupt Bhushan Steel. Supreme Court orders status quo on liquidation proceedings. JSW and lenders confirm that review petitions will be filed. JSW management is upbeat on getting a refund if Bhushan Steel goes into liquidation. Relief for SpiceJet in its arbitral dispute with former promoter Kalanidhi Maran. Delhi High Court rejects Maran's claims of 1,300 crore rupees in damages, calls it a case of deliberate and willful concealment of facts. Maran has the option of challenging the order in the apex court. The Supreme Court questions Maharashtra government's decision to disqualify L&T from the tender process of two projects worth 14,000 crore rupees, says it's difficult to believe that the company that built Central Vista in New Delhi did not qualify, seeks the state government's response by Thursday. The new invoice management system under GST irks India Inc. Sources say industry has told the government the new system is causing additional compliance burden. Kerala government issues a warning to coastal areas after containers from a capsized ship carrying oil and hazardous chemicals wash ashore. State government tells the public to stay away from the beached containers. Heavy rains lash Mumbai, disrupting road and rail traffic as the monsoon arrives early. An underground metro station, which recently opened in Worli, has been flooded. All right, let's start with the day's market action. The Indian market ended with minor gains in a range-bound session. Nifty ended above the 25,000 mark. Market with the auto and IT stocks as the top gainers. Mid-cap index outperformed. US President Donald Trump has extended his 50% tariff deadline for the European Union from the 1st of June to the 9th of July. The de-escalation comes after the European Commission President asked for more time to reach an agreement. The EU chief has said the bloc is ready to advance talks swiftly and decisively. Staying with international news, the EU has begun to court Vietnam to strengthen trade ties with the export-dependent nation. This comes soon after Chinese President Xi Jinping's bid to attract business from the nation that is grappling with threats of crippling US tariffs. French President Emmanuel Macron's first visit saw France and Vietnam signed a deal on Monday for 20 Airbus. Now, deal signed during Macron's visit also covered cooperation on nuclear energy, railways and satellites. Vietnamese President Luong Quoc said that the countries pledged to work closely to maintain and strengthen free trade. Oil prices surged in early Asian trade after US President Donald Trump extended the deadline for a trade deal with the European Union. The move eased concerns over tariffs hurting global demand. Meanwhile, gold prices fell marginally, giving back some of the last week's gains. Right, in what comes as a big relief for JSW Steel, the Supreme Court has ordered a status quo on the liquidation proceedings of Bhushan Power and Steel. Now, the apex court has allowed JSW Steel and its committee of creditors to file review petitions in the case, saying that the time period for review isn't over yet. Ashmit Kumar is here with the details. Ashmit, please take us through the apex court's order.
Well, what we understand is that clearly there's a big relief that's come as far as JSW Steel is concerned. What we're given to understand is that the Supreme Court, in very clear terms, has directed for a sense of status quo, no liquidation as far as Bhushan Power and Steel is concerned. That's the core concern that had been raised by the COC, that had been raised by JSW Steel. Now, bear in mind that former promoter Sanjay Singhal had moved the NCLT and had sought for an expeditious liquidation of Bhushan Power and Steel. Now, what JSW Steel, as well as the COC, when appearing before the Supreme Court, told the highest court is that, look, there is still some time left as far as filing of the review is concerned, that if liquidation takes place, that will leave JSW, that will leave the COC high and dry, that the COC themselves are facing questions of how this return, if the Supreme Court order is to be complied with, how the return of funds is to work, how the return of securities from JSW back to the lenders will work, what legal options there are. before the lenders, before the JSW. And these were questions basis which the Supreme Court said that in the interest of justice, it's best advised that at this point status quo is maintained. There is no further movement, there is no liquidation that takes place, and that is the best way to ensure that if and when the review is filed, there will not be any further liquidation. Having said that, speaking of a review, the Supreme Court as a part of its order does record indicating that both JSW Steel as well as the COC are contemplating relief measures like filing of a review petition. Just a small caveat there. As per the Supreme Court rules, there's a 30-day window for filing of review petitions. Given that this judgment came on 2nd of May, 2nd of June naturally would translate into a deadline, a 30-day deadline. So that's the window that JSW Steel and the lenders are looking at in terms of filing of a review petition. But for now, status quo, no liquidation to happen as far as Bhushan Power and Steel is concerned.
Right, thank you, Ashmit, for that. JSW Steel's joint MD and CEO Jayant Acharya had said that the company has strong grounds to avail all legal remedies with respect to Bhushan Power. Speaking with CNBC-TV18, he also said that JSW Steel expects to receive refunds from Bhushan Power if it's headed for liquidation.
I think those are under various stages of discussions with our advisors, and we'll be taking appropriate steps at the right time. I may not be able to give you exactly what the status is in the court as of today. Yeah, so two things. On the downside, as per the Supreme Court judgment as well, we are protected from the fact that the refund would come back to us, number one. Number two, the capacity expansions in BPSL have been done from the internal accruals which we generated at BPSL as per the resolution plan.
Right, Ashmit, let's also talk about SpiceJet, whose shares rose in trade after the Delhi High Court dismissed Kalanidhi Maran's plea seeking damages of more than 1,300 crore rupees from the airline. Could you take us through what the court said and what does this mean for Kalanidhi Maran?
Well, big reprieve coming in for SpiceJet, the airline. The Delhi High Court on Friday, we understand, has rejected an application by Kalanidhi Maran seeking damages of 1,300 crore rupees. Now, bear in mind, this goes back nearly a decade and a half. 2010 is when Kalanidhi Maran had acquired a controlling stake as far as SpiceJet as the airline is concerned. In 2015, handed the control back to Ajay Singh, and since then, there's been a dispute over a transfer of preference shares, a transfer of warrants, a transfer of cash. There's been an arbitral dispute. Now, the arbitral dispute first went in favor of Kalanidhi Maran. The arbitral tribunal had directed for payment of 579 crore rupees from SpiceJet to Kalanidhi Maran. However, after a spate of litigation in 2024, which is just last year, the Supreme Court had sent the matter back into arbitration. And at the arbitration center is when Kalanidhi Maran had raised claims of 1,300 crore rupees. The arbitral tribunal rejected it. Kalanidhi Maran then moved to the Delhi High Court. The Delhi High Court, we now understand, has also rejected it. In fact, the Delhi High Court used strong language that this was, quote-unquote, a calculated gamble being used by Kalanidhi Maran in terms of way they've gone about filing this entire petition, challenging the arbitral award, and also going on to say that certain key facts were in fact held from the Delhi High Court. The Delhi High Court saying we're not impressed with this conduct. So on that ground, sending it aside, dismissing this petition. But bear in mind that Kalanidhi Maran does have the legal remedy, the legal option of appealing this Delhi High Court judgment before the Supreme Court.
Right, thank you, Ashmit, for that. The Supreme Court has questioned Maharashtra government's decision to disqualify L&T from the tender process of two projects. The road projects are worth 14,000 crore rupees. The apex court said it's difficult to believe that the company that built Central Vista in New Delhi did not qualify. It also sought the state government's response by Thursday. All right, moving on. JSW Paints is likely to take over AkzoNobel's India business. Sources tell CNBC-TV18 that JSW Paints will buy out AkzoNobel's promoter stake of 75% for 10,000 crore rupees. Rachna Dhanrajani joins us with more. Rachna, take us through the contours of the deal.
Right, the battle for AkzoNobel India is heating up and JSW Paints may hold the edge. Sources tell CNBC-TV18 that JSW Paints is set to acquire 74.76% stake in AkzoNobel India in a deal that valued around 10,000 crore rupees. The deal is expected to be completed by the end of June. This would mark the complete exit of AkzoNobel's Dutch parent from the Indian market. But that's not all. The deal is also being struck at a discount. AkzoNobel India's current market capitalization is at about 16,000 crore rupees. But the deal values the company at about 13,000 crore rupees. Now, Indigo Paints and Berger Paints had also thrown their hats into the ring to buy AkzoNobel's asset, but JSW has emerged as the front runner. CNBC-TV18 had first reported in January that these three companies will battle it out for AkzoNobel's India assets. Earlier this year, Parth Jindal spoke to CNBC-TV18's Shireen Bhan, where he promised to give everything to seal this deal. Let's take a look.
I think there's no choice. If JSW and the ambitions we've shown that we want to be a top 3 player in whichever sector we play in, if I have to do that, then I have to give it everything that I've got for Akzo.
How will you fund it?
It's going to be a mix of the family investing, and private equity.
The 3,500 crore rupees IPOs of Clos Bangalore, the owner of luxury hotel chain, the Leela, saw a tepid response on the first day. As of 4 p.m, the company's overall issue was subscribed 6%. The portion allocated for retail investors was booked 18%. The portion for qualified institutional buyers was subscribed 3%. Storage solutions provider Aegis Vopak's initial public offering opened for subscription today. 25% of the public issue had been subscribed so far, with the retail portion booked 18%. Meanwhile, qualified institutional buyers have subscribed 39% of the portion allocated to them. The price band of the 2,800 crore rupee issue has been set at 223 to 235 rupees a share. Investors can bid for a minimum of 63 shares. The new invoice management system under GST has irked India Inc. Sources tell CNBC-TV18 that industry has flagged its concerns about additional compliance burden to the government. Now, Timsy Jaipuria is here with more. Timsy, tell us about the industry's concerns.
Well, that's right. Sources have told CNBC-TV18 that the new invoice management system, or the IMS, under the GST regime is causing additional compliance burden for the taxpayers. Industry, in a detailed representation, has mentioned that the new system design assumes auto-replication, reconciliation of transactions across GSTR forms, and considering that most companies' processes are through manual operations, the new system would not just mean additional infrastructure, a minimum requirement of a qualified CA, a 24-hour software and internet connection, and basic backbone, that is the IT backbone, which will be required, adding to the burden. Also, the representations outline that most companies use basic accounting software that don't allow auto-matching of sales, purchases, ITC transactions across GSTR forms. And as per the new invoice management system and the design, if it sees any mismatch or break in the transactions in the GSTR forms, it will raise a red flag, which will alert the GST and income tax authorities for action, and it could lead to companies and taxpayers getting not just a GST but income tax notice as well. That is for the transaction reconciliation mismatch due to the new invoice management system and design. Further discrepancies have been flagged by the industry due to the new IMS design system, which says that it compresses correction window, blocks ITC credit, and thus problems arising due to the new IMS design are adding to compliance burden, hitting working capital, along with the most harming impact, which is that the assumptions that will be made by the authorities during these mismatches, which will be noted, and it increases the risk of dual taxation. Now to be seen is how the government and the industry battle this out.
Right, thank you, Timsy, for that. India is on track to overtake Japan to become the 4th largest economy by 2025. However, according to the International Monetary Fund, the numbers indicate that while India is very close to Japan in nominal GDP, as of 2024, it is still slightly behind as per IMF's current estimates. Ritu Singh joins us now with the details. Ritu, take us through IMF's data.
Well, the big question, has India really become the world's fourth largest economy? Because, on Saturday, we had the CEO of Nifty making a statement that quickly drew a lot of attention, saying that India had overtaken Japan to become the fourth largest economy with a $4 trillion GDP, citing IMF data. So we decided to take a closer look at the numbers. And as per IMF's projection, India is indeed set to overtake Japan later this year, but it has not happened just yet. Now, as per the most recent official figures, and that is for 2024, India's economy stood at $3.91 trillion, while Japan was still slightly ahead at $4.03 trillion, and that makes Japan the fourth largest economy in the world currently, but things are expected to change this year. IMF data shows that India's economy is projected to reach $4.187 trillion in this year, just ahead of Japan's $4.186 trillion, and that will make India the fourth largest economy. But beyond that as well, the gap is expected to grow, with India forecast to hit $4.6 trillion in 2026 compared to Japan's $4.3 trillion. Of course, keep in mind, these are still projections and they're based on various assumptions, and things can always change. Also keep in mind, RBI has projected India's growth rate at 6.5% for FY26, while the IMF's forecast is slightly more conservative at 6.2% in FY26 and 6.3% in the next fiscal. Still, what is clear is the overall trend that India continues to be one of the fastest growing major economies in the world. In fact, by 2028, IMF expects India to even overtake Germany, becoming the third largest economy in the world, only behind the US and China. So while India isn't the fourth largest economy just yet, it is right on the brink. And if IMF's projections do hold true, that milestone should be crossed within 2025.
All right. Thank you, Ritu, for that. On that note, we'll slip into a short break. But before that, we are excited to unveil a brand new global business news channel. CNBC-TV18 presents an all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. So tune into CNBC-TV18 Prime at 12 noon for the Global Reset and at 8:30 p.m. for Global Lens. All right, time for a short break. We'll be back in 2 minutes. Welcome back. Containers from a capsized ship carrying oil and hazardous chemicals have washed ashore in Kerala's Kollam. The Kerala government has issued evacuation orders for parts of the district's coastal areas. The government has told the public to stay away from the beached containers. The cargo ship, which was on its way to Kochi, sank after encountering heavy weather. Heavy rainfall and thunderstorm battered Mumbai and neighbouring districts, marking the region's earliest monsoon onset in over 70 years. The Met Department has issued a red alert for Mumbai, Thane, Raigad and Ratnagiri, which will remain in place at least until tomorrow morning. Local train and metro services were disrupted. The newly inaugurated Acharya Atre Chowk metro station at Mumbai's Worli area has been waterlogged, and it was only 4 out of the 6 water pumps were operational there. Santiagora reports from the flooded metro station.
Once arrived in Mumbai on Monday, bringing heavy rains to the city. And let's talk about what's happening to Mumbai's much talked about Aqua Line, Mumbai's Metro Aqua Line. So let me tell you this, that when this line was promoted by the state government, it was claimed, the state government would claim that this line is virtually completely flood-free. And let me now tell you what has happened now. With the post-span of crave itself, the line is disrupted. The trains are running only up to Worli station and not to the final stop of Acharya Atre Chowk at Worli Naka. Why? Because there is flooding as the Acharya Atre Chowk. Right now, I am at the Worli station. So trains are running up to here, but let me still show you how the Worli station are pleased to look in like. This how the station of a metro line which was supposed to be to. This had raised serious concern about the reliability for Mumbai Metro and commuting by Mumbai Metro during these.
Right, the Indian government is working on a new policy to support small hydroelectric power projects in the country. According to sources, the draft policy largely focuses on feasibility, finance, storage and distribution of these projects. Abhimanyu joins us now. Abhimanyu, what are you picking up from your sources?
A new policy for small hydel projects is being prepared by the Union government. The Ministry of New and Renewable Energy has already held several review meetings, and the draft policy is going to be tabled before the Union Cabinet for due approval. Now, currently, there is no policy which exists from the Union government side for small hydel projects. That is, the projects which are lower than 25 megawatts in capacity. Higher projects in terms of megawatts are handled by the Ministry of Power, and an assessment which had been conducted by the government had earlier indicated that there are over 7,000 sites for small hydel projects across India, and these potential sites have a potential of 21 gigawatts of hydel power which can be generated. It remains to be seen how early this policy is going to be decided and finalized, since it's going to act as a guiding light. It's going to decide the contours for financing, storage, diversion of water, and also for preparation of such projects in far-flung areas. Also, this may aid several villages and hamlets which are located in far-flung areas and lack grid connectivity. And now, with suspension of the Indus Water Treaty, several areas in J&K, Himachal Pradesh and Punjab may also witness such small hydel projects coming up, which of course is going to add not just to the base load but will also reduce the dependence on thermal power.
Right, thank you Abhimanyu for that. In international news now, Israeli forces have bombed a school in Gaza, killing 36 people, including many children. Forces have also arrested at least 11 Palestinians during raids carried out by Israeli forces across the occupied West Bank. Now, in a post on X, the Israeli military said it intercepted a rocket launched from Gaza before it crossed into Israeli territory. US President Donald Trump has called Russian President crazy for launching one of the biggest airstrikes on Ukraine since the start of the war. Trump also warned Moscow that any attempt to take over Ukraine will lead to the downfall of Russia, warning further sanctions. And with that, it's a wrap on this edition of Business 360. More news and updates continue right here on CNBC-TV18.
Hello and welcome to the very first episode of the Global Reset right here on CNBC-TV18 Prime. This show is not about the headlines, but the shifts behind them. Shifts which will drive the next decade of global money and global capital. And there's no better guest to launch this conversation than a man who's made big, bold, and often contrarian bets, backed not just by conviction, but by billions of dollars in actual deployment. From that dramatic move into stocks at peak volatility to doubling down in India when the world turned cautious, his capital has spoken louder than most commentary ever could. Today, he manages over $150 billion in assets. In India, he runs money north of $24 billion, making him the largest foreign investor. It's a blueprint for how the global capital map is being redrawn. In a world where geopolitical fault lines, inflation pivots, and election cycles drive investor behavior, he brings a rare mix of clarity and edge. He is the founder and CIO of GQG Partners, Rajiv Jain, our debut guest on the Global Reset. Rajiv, delighted to have you with us here.
It's great to be here with you guys.
Rajiv, it's been a year, I think, maybe a little more since we last spoke, and how the world has changed. I think at that point we were talking about, the potential of Mr. Trump becoming president. Well, he is president, and he's unleashed change at a rate, I think, which you and I have never seen. Just a quick initial thought on that, Rajiv, and then we'll dive into some of the individual specific themes.
Yeah, Prashant, I think we feel that the changes are still not being fully appreciated because the changes are these changes happen once in decades. And this is something similar to people have compared, in my opinion, rightly so, with what happened early 70s when the Bretton Woods went away in 71. So I think if Trump administration is able to make even a slight bit of sort of shift over the longer term trajectory in terms of where the manufacturing is, outsourcing, and so on and so forth, I think it will be quite seismic changes. And we're seeing the geopolitical changes on top of that. So I think they are meaningful changes. I personally feel the markets are not fully comprehending because nobody knows for sure, but I think changes are there.
Rajiv, but many thought, like what you're saying, till before, for example, last weekend when you had the US-China trade deal, 2 days worth of talks, and tariffs are brought down to much lower levels than what the most optimistic scenario really called out for. So in a way, many are saying that Trump and the administration blinked and gave in. So are they really serious about these big, once in 50-year kind of changes which you were referring to?
We have a slightly different opinion. First of all, there was no deal. It was, as the Treasury Secretary said, they had good discussions. Okay, this is not even a framework. I think it was just basically sort of lowering the initial foray of tariffs. So if you look at, for example, the US, at this point, the tariff is 50%. Why? Because the 20% from the prior term. So obviously that's in the prices, but there's 30% on top of that, and China's agreed to go to 10. Okay, so that's the first part. But it is not really a deal at all. I think both have said, particularly the US side has said that this was a good start to lower the temperature a little bit. And even with the US-UK, by the way, that was again a framework. It is not a deal. I mean, as you know, trade negotiations typically take a long time, and this is not even a term sheet which both have agreed to. This is a very broad framework, and I think that from a business perspective still remains very, very unclear. Should be if you're a business manufacturing, let's say in China, I want to move to whether India, Vietnam, what have you, or back to US. Now the tariff, is it going back to 0 or is it going back to 100% or not going? I think the amount of uncertainty from a business perspective still remains fairly high. So we don't believe there's a deal at all.
I mean, not even a MOU in that sense, not even a framework deal, essentially. And absolutely, you think, China remains the number one, if I can call it that, target, which needs course correction according to Trump and his administration. That very much remains the objective?
So look, I think there's obviously a long discussion, but if I have to summarize, the real crux of, and there was a document released by the White House a few days before the quote-unquote Liberation Day, where they went into detail for every country, what are the real issues in which are impacting U.S. Exports or trade. And they talked at length about non-tariff barriers. So I think even if China, and Chinese tariffs are actually not very high, they are like mid to high single digits, so they can easily go to zero. The real issue, non-tariff barriers. The problem is China started with this Made in China policy 2015, which identified certain key industries, okay, which they would support with incentives, subsidies, and so on and so forth. And now they are leader in the numbers I've seen in more than half of those already. That thing, by the way, is not going to change because those are essentially a lot of non-tariff barriers. For example, technology transfer. China, I don't believe, would ever agree to not sort of having this forceful technology transfer, which was negotiated in the last term also. So non-tariff barrier is the real crux of it. In fact, if you look at, I'll give you one small data point, that Switzerland does not have any tariff on U.S. goods, but we have put 30% tariff and now 10% tariff on Switzerland too. The question is, Switzerland doesn't have a tariff. Why tariff? And I think that what that tells you is that the idea is to bring jobs back. We feel the underlying desire, and there's a good reason for that, because look, industrial base has been hollowed out over the last 30 plus years, and the idea is to bring jobs back. And if that's the case, then Switzerland has very low taxes, right? So a number of large corporates have moved their headquarters to Switzerland to save taxes. So I think it's a whole combination of tariff, non-tariff, taxes to make US more competitive, which is why I feel that China will not remove non-tariff barriers. Both sides are buying time. We shall see what happens in 60, 90 days.
Point taken. So in that context, Raji, what is your sense? So China and US, from what I'm hearing, are not kissing and making up. China plus one is an important theme for many countries, right? I mean, countries like Vietnam, Cambodia, etc., benefited during Trump 1.0. India hopes to benefit this time around. Where does that China plus one kind of theme play around in your mind? How do you think about that?
See, if you look at Vietnam, Vietnam obviously is playing the same playbook that has worked very well for East Asia in general. So Japan was the first one after the Second World War, then Korea, Taiwan, Singapore, Malaysia to a little bit till late 90s, early 2000s, till China came along, and obviously China, and India and Vietnam more recently. I think India is slightly different. While India is trying to get the manufacturing side, and I think they have succeeded in a quite remarkable manner. By the way, it's quite remarkable how fast they've been able to, with the right policy mix, to attract manufacturing base, because that helped China tremendously to incentivize and attract these large sophisticated manufacturers. I do feel that India is part of the solution from a U.S. context. Particularly if you look at Vietnam, Vietnam has kind of become they do a lot on their own, but it's also become a transshipment hub, which the U.S. trade representative talked about a number of times, which is why we feel that Vietnam would not be sort of scot-free because it is a big transshipment hub, and hence if you look at the 46% that was announced was higher than a lot of other countries. Second thing is Vietnam also a big current account surplus. So our framework is as following. We feel that we have to look at countries that have that don't have huge current account surpluses. Countries that have huge surpluses with the US are far more vulnerable. And Vietnam fits the bill, so does Korea and Taiwan. India doesn't have a huge surplus, which means it also shows that it's a huge domestic economy. So we feel from our vantage point, India should be a net beneficiary. There'll be hiccups. There'll be 2 steps forward, 1 step back. But I think direction is clear. India would be on the positive side. Actually, Brazil would be, and Indonesia would be too, versus, let's say, Vietnam or others.
We've seen a massive sort of move from the lows. Where do you stand with your views with regards to U.S. assets? We got a brief period where people were really worried about this big sell-off in U.S. assets. I mean, everything was getting sold, bonds and stocks. That's changed a little bit now. There was talk of U.S. unexceptionalism. I'm not sure if exceptionalism is back in the, but what's your sense, Rajiv?
Well, I think the U.S. exceptionalism, the discussion of that was frankly, in my opinion, kind of based on the stock price movement rather than anything else, because the US remains the hub for innovation. There's no question about it. I mean, there's not much of innovation in Europe. And even when it comes to some of the, like China, for example, the cutting edge innovation is not really there. I mean, DeepSeek came 2 years after the OpenAI in US. So I think from a US asset perspective, few important sort of contextual issues in our opinion. If you look at the global trade surplus of these Asian countries, I mean, China has $1 trillion plus. They cannot recycle that. There are two ways: either you recycle that in US, or you have to basically sort of recycle back in China. You can't do that anywhere else. So I think a lot of these countries, if you look at Europe, where can they recycle? The currencies will go through the roof if they sort of truly bringing back as such. Gold is a tiny market, so we feel the U.S. assets from a global perspective, there's really no choice. You cannot recycle trillions of dollars anywhere else. Okay, the depth of the markets, etc., it doesn't exist anywhere else. So we feel that the whole discussion, people not invest in the U.S., I think is not very factual based. However, I think the rest of the markets, from a pure investing in equity markets, etc., perspective, valuations in U.S. are on a higher side compared to its own history, compared to where interest rates are, more importantly, than where have been. For example, if you go back to when Trump came to power in 2017, U.S. was around 17 times earnings, S&P was 17 times earnings, with the bond yields around 2%. But now bond yields are 4.5%, and S&P is almost 23, 24 times earnings, depending on the estimates. That's hardly a bargain, and particularly the gravitational pull of higher bond yields is pretty meaningful. So we feel that it is a time to be a little bit cautious. But valuations in non-US world are attractive, and if US doesn't do well, the capital will go into other places where the growth outlook is still okay. And India again actually looks fairly attractive, along with some of the some selective European and other emerging market countries too.
But it's not a sell U.S. assets kind of a thing. It's basically recalibration, which happens all the time in phases. I mean, something becomes too hot, too expensive, and money finds more attractive places to go into, which with steady growth prospects, etc. That's the kind of thing you're talking about. Nothing.
Exactly.
Got it.
Because I think I'll give you another data point. I mean, India has been one of the best performing markets within emerging markets over the last decade.
Yes.
Foreigners have hardly been involved. Okay. And multiples, if you look at broad sort of index over the last 6, 7 years, multiples have not expanded that much. Some obviously stock by stock, some have gone up and some have gone down. But if you look at broad indices, they've been rebalancing and so on and so forth. But the multiples have not gone up dramatically. So why has the market done well? Well, because the corporate earnings have been good. So we feel that at the end of the day, corporate earnings matter. And if the corporate earnings are coming through and the valuation is sensible, I think you should get rewarded. And in that context, US looks a little bit expensive. Europe does look a little bit cheaper. But you're also assuming in that the Europe will probably not do well if there's a true global recession, because a lot of those industries are cyclical, right? Banks, industrials. So when you look at valuations, I think you have to look in context of how dependable the earnings stream would be if there's a true recession.
Where does India fit? I mean, to use that sell-side analogy, overweight, underweight, market weight, within your sort of mental makeup, Rajiv, where does India figure?
Look, I think there was a little bit of frothiness last summer because and you were seeing a lot of new paper coming through, selling by promoters, but also IPOs, so on and so forth. And we think that 6-7 months, there was a very healthy correction, which is sometimes what called for, kind of what people call pause that refreshes. We have been net buyers in India this year, and in fact, far more aggressive in the first quarter than last year. I can give you data. I think last year we bought maybe just under $2 billion of net new money in India. This year, in the first quarter alone, we put around $2 billion to work in India, new money over our existing exposures, by the way. We feel that Indian corporate earnings remain fairly resilient, particularly in the area that we are sort of more exposed to or looking to get more exposure. And the valuations are kind of fine. I mean, they're not super cheap, but I wouldn't expect that either because the outlook is very good. So why would the valuation be super cheap? So I think, in our opinion, it's still overweight because if you look at the Chinese corporate earnings, that started to slow down quite a bit in 2018. What happened in 2018? Well, that was the first US-China trade war. So the impact of this trade war will be not insignificant because China has twin engines. One is the real estate. Second is export machinery. Real estate has been soft for a while now. Soft is an understatement, as you know. And exports. So if the exports continue to slow down, unless the tariffs go to zero, if the tariffs go to zero again, or let's say 10%, I think this all would have to be revised. Corporate earnings have been very soft in China. So I think in that context, in the Asian context, so if the corporate earnings are fine, we quite upbeat actually on what's happening in India.
So it's quite interesting. You're saying you already this year, this calendar year, put in about $2 billion new money to work in India, right?
Yes.
And just to sort of for our viewers, you bought into Bharti in a big way. I think that's a newer bet, Rajiv. And I think one name which we discussed in a very different context the last time we spoke, HDFC Bank. I remember you telling me that you've been, you held that stock for years. I mean, long back, and then of course you didn't own it for a long period of time. You didn't have it last year. This is in that sense a new addition. You want to talk to us about that, Rajiv?
Yes. So HDFC Bank, we thought was going through a sort of integration transition period as such between the two, HDFC and HDFC Bank. So since last September or thereabouts, last quarter last year till first quarter, we put almost $2 billion in HDFC Bank. And Bharti we started buying early last year, and then we have doubled down again this year. We've added a little bit to some of the other names too. Nothing meaningful, but they're like a few $100 million here and there. Nothing meaningful. So these are the two big positions. The other ones we quite like. I mean, you have public information on that. So because we're still very bullish on the utility/infra type assets, we still like real estate. So. And what's interesting, we feel this time around is that seems like, and for good reason, the rally seems to be led far more by large cap than mid cap. Mid cap are fine, but the valuation is less supported than a large cap. And large caps are now transitioning from, they've digested, last few years for different reasons. And a couple other names, by the way, we just started, we recently initiated, so we are active, we can't talk about those. Again, large cap. So we feel that the large cap space looks fairly interesting, actually.
Your Adani,
global context, not just Indian context.
Your Adani stock exposure remains largely similar, and no changes.
Yeah, So look on the Adani part, on Adani, we are still very bullish on the group. I think longer term, we've been at the overall level, we've sort of added to our exposure over the last 12 months. Nothing meaningful, by the way. This is more rebalancing. I think it's important to mention that our assets have also grown quite a bit. So part of that is simply deploying the new capital that we're getting to keep the position size flat rather than sort of increasing actively. So a lot of the existing positions is more of that. I mean, as you know, our asset base has almost doubled in the last 3 years. So we continue to see overall flows. So part of this is just rebalancing. But look, the earnings picture has been very strong across all the infra type names. And this is a long-term story whether I look at this group or some of the other ones. So no change. In fact, some of the names are probably cheaper than when we first bought them 2 years ago.
Okay. And the way the portfolio here in India is constructed, it's still, I mean, the trust is still industrials, infrastructure. I mean, if you were to sort of look at it by weightage, would that be correct?
Yeah, so if you look at it, it's not exactly precise, but banks is a big exposure, as you know, with now 3, ICICI, HDFC, and State Bank of India, so all 3, they're pretty meaningful. And then you get the infrastructure / utilities, because one thing I found fascinating is that utilities globally tend to be defensive. For some reason, these stocks are less defensive. I mean, I don't know why, but they're less defensive in India, but they have far more predictable growth because the rollout is happening, and that's probably half of our book. When I say utilities, infra combined, and then you get then you get 2 staples. I mean, ITC and Patanjali,
right.
And then rest is sort of mixed match of some smaller positions.
Two specific sectors I want you to thoughts on. One is IT services, which is still a large part of the constituency. And I mean, mid-cap IT has done much better than large-cap IT over the last few years. And pharmaceuticals, Rajiv. Again, a lot of talk about tariffs, etc. But it's much cheaper making here. I mean, and that's the general consensus here now, even if, because of national security considerations, they try to move a lot of the manufacturing into the US. It's the innovator companies which perhaps get impacted, not generics, which is what Indian companies largely do. Your thoughts on IT services and pharma?
So IT services has been in a crosshair, nothing to do with tariff, but much more around just the natural cycle, because there was a big ramp up during COVID. And which is why we have been cautious that we thought that the markets were too optimistic. And not just, when I say this, by the way, it's not just Indian IT service, I'm talking global IT services space as such. And there was a lull, and you're still sort of digesting the spike of growth that you saw during COVID and just after COVID. But thereafter, the AI-led, there's a fear of disruption AI, which has sort of impacted multiples, particularly last few months, last 6-9 months. And recently, I would say the tariff fear has impacted some of these names. But I think if you look at historically, changing technology creates more friction, and IT services has been a winner, not loser. So I think the outlook is far less worse. We don't have exposure, by the way, just to be clear, but the outlook, we were fairly cautious maybe 2.5 years ago in this space. But I think the outlook is improving because there's far more pessimism. Numbers have come off now, but the disruption risk is what people are fearful of. And that's a call you have to make, whether they'll be disrupted or not. The pharma side,
yes.
Look, pharma side, I think it's very name by name. I think US, a lot of the generic stuff will not shift to US, but there will be some shifted. Like Novartis has already announced that they will manufacture within 5 years, 100% of the needs will be met by manufacturing in US. Okay. But then they're still going to have stuff for other countries produced for other markets. But that's one company. So we feel that some companies would be winners still in this environment because, as you said, the cost difference still enormous. We do have one exposure, Sun Pharma, which we own for a long time now. And look, we haven't done anything. So we feel that I think it's wait and watch. Market sentiment changes, I mean, from day to day. But I think as this dust begins to settle, and frankly, I don't know when and if that ever happens, there'll be some things that will be shifted to manufacturing here, and a lot of large pharma companies have announced that. But it doesn't mean that it'll be completely out of India or other places.
I got that. The other space which has attracted a lot of attention lately is defense. And it's a relatively newer sector in that sense. Lots of companies now listed. And global defense spending is at an all-time high. I think as that Stockholm Peace report, I mean, the report which came out a few weeks ago showed. In India here, of course, there's a lot of focus on, making in India what we were importing so far. And there are targets for 2028, 2030. Have you looked at the space, Rajiv?
Look, we looked at the space we used to own before years ago, but I mean, look, we've completely missed it. And I think the recent events in the India-Pakistan, I think the defense industry has a tremendous headroom. So one cannot be but bullish. Our issue is that we tend to be conservative, so the valuation and so on and so forth. But if you take a 5-10 year view, there's tremendous headroom. I mean, I think the India-Pakistan issue reflected that how. I mean, it's in very solid footing. So I think there's a structural bull case to be made. It doesn't mean it'll go up tomorrow, by the way, but structural bull case to be made. We completely missed it.
Any thoughts as we start to wrap up, Rajiv, on industrial metals, oil and gold?
Look, gold, I mean, everybody has an opinion on gold. I'm no expert on gold, but I think the central banks have begun buyers for last, 7-8 years. That continues because if you want to diversify away from US dollar, where else would you go except gold becomes an important part of the mix. And I think that's well underpinned. Doesn't mean it can go down from 3,200 or wherever it is to 2,500. But I think the structurally bullish case to be made for gold.
Oil, Rajiv, do you have a view? Because that's, again, something which is the number one macro variable for India. Do you have a sort of big view here?
So, as you know, in 2021, we turned pretty bullish on oil. And at one point in our books, we had almost mid-teen to 20% exposure to oil stocks. We feel oil is will be in 50s handle for a while. The two reasons. One, it's actually three reasons. Number one is Chinese demand has slowed down dramatically. One, because of EVs, second, the economy. And there might be structural sort of slowdown in Chinese demand growth. That was one of the biggest demand growers, growth factors in demand for oil was China, obviously along with India and others. So that is a big change. And it's hard to say how much is structural and how much is cyclical, but it feels more structural because of EV and so on and so forth. Number two is the oil supply from OPEC. Look, that changed. It seems like they're again ramping up, they're opening up taps a little bit further, maybe to make them disciplined, maybe to inflict more pain in shale. I don't know.
Rajiv, we leave it there. I think exhaustive conversation, and I think we touched upon so many things here. And it's so wonderful to have you as the inaugural guest on the Global Reset, our brand new program here on CNBC-TV18 Prime. And I think the one thing that you said really sticks with me, which is India is part of the solution, not part of the problem. And I think that's a big one for the longer term here. Thank you very much from all of us. Thank you for joining us here.
Thank you. It's great to be with you.
Hello and welcome to News Centre. I'm Parikshit Luthra. The top government think tank Niti Aayog has released a report on crafting a policy for medium enterprises. The MSME sector contributes 29% to India's GDP and is the biggest employer with a 60% contribution to the overall workforce. But the disparity is stark. Only 0.3% of the MSMEs contribute to 40% of all MSME exports. The Niti Aayog wants to leverage the untapped potential. The report focuses on tailored financial tools, technology integration, skill development, and creating a centralized digital portal. India's economy continues to grow even as the pace of growth has moderated. India is poised to overtake Japan as the fourth largest economy by the end of this year, according to estimates by the IMF. But there are some growth pangs. Growth in core sector slowed to a mere 0.5% in April, according to government data. Net foreign direct inflows also declined to just 353 million in FY25 compared to more than $10 billion in FY24. I spoke to noted economist, former CEA and member Niti Aayog Arvind Virmani on the state of the economy and the report on designing a policy for medium enterprises. I began by asking him about the India's current policy structure to support MSMEs and why it is inadequate.
The budget, one of the important points in the budget was that focus on MSMEs, among other things, and particularly the emphasis on labor-intensive exports to generate employment. So, in Niti we had commissioned a study. So of course, we talk about MSMEs, which includes micro, small, medium enterprises. So Niti wanted to drill down further into these somewhat diverse elements of industry. They are all most of them are informal, some of them are part of the formal sector. So for that purpose, this study was launched on the kind of medium size enterprises, as they are called, and in particular to see what are the schemes, how are they performing. There are a whole bunch of schemes, in terms of technology adoption, credit, and skilling, etc. But the aim of the study was to drill down and see which of them were applicable to the medium enterprises and what they were used, etc. And then further recommendations to that effect. So the study found that about 8 schemes are applicable, and it's made some other recommendations.
Okay. When it comes to incentives that are needed, according to you, what are the targeted incentives needed for the future?
See, there are general things which apply to everybody, and we've been talking about those, the ease of doing business, the basic infrastructure, skilling, etc. Skilling is always very important. So what is special? Yes, I think what is special about the medium industries is that they do a large part of the exports. So in some sense, they are closer to the frontier. They have to compete in terms of quality and cost in the international markets. And secondly, they will also play an important role. We've been talking a lot about supply chains recently, in the context of mobiles, mobile phones, etc. So medium industries are important for both those purposes, to link in for backward integration of the supply chains, etc. So I think the focus on skilling, for example, skilling, when we talk about textiles, or simple thing like, let me give you an example, like stitching. Now, the stitching skills which are needed for cotton may be very different from leather, and they may be different from mixed fabrics, etc. And there are all these many variants of fabrics, etc., which are used, which are exported, etc. So there's a need for finding out and meeting these requirements. So skilling is very important and special, and it's not high skills. When we think of skills, we think, what are the highest skills? That's not it. It's the medium skills, the actual skills which will be used by these medium industries to export, to supply high quality goods to the supply chains. So there are elements like that which may be common among industries, but you have to have a special focus and differentiate the kind of stuff which is needed.
Shifting focus to certain economic issues right now, sir, which concern us. One would be about the sharp fall in FDI in 2025. What would be your outlook going forward? We've seen a sharp drop in FY25 to a record low of $353 million in FDI. Why do you think this happened, and what would be your outlook for the months ahead?
Right. Yeah, this is a very good question, because I think not many people look closely at this issue. And when we look at FDI inflows, there is a gross amount of FDI inflows and a net amount, and I will discuss the difference. But what has fallen, what has not fallen, is the gross FDI. That fell a little, that reduced a little bit, but is almost back to the peak seen earlier. What has indeed reduced quite substantially is the net FDI inflows. Now, there are two elements, if we subtract gross from net, there are two elements which constitute that, which implicitly have increased actually, because it's a minus. So one is remittances, that is retained earnings of foreign invested enterprises. When they are remitted back, that is a negative. It's subtracted out of gross FDI. And the second element, of course, is what you might think of normally, the disinvestment. So some very preliminary investigation that we have done, I have done, show that one of the important factors was a kind of collateral effect of the removal of the DDT. I don't know if you remember the DDT. It was the dividend deduction tax. So when any company gave dividends, they would have to pay a tax. So if foreign company remitted dividends back to its equity owners, they would have had to pay a tax. So when the DDT was abolished, that provided an opportunity. So a part of that was just using this opportunity to remit the retained earnings which they had held in the companies. So clearly that is a temporary phenomena which will go away. There were some other which will not be there in future years. Then there were a number of other elements, and the exact proportion is not clear, but I can just mention them. One of them was the strong growth of the U.S. economy, after that period, let's say for the last 3 years, not necessarily now in 25, but previous years, and the higher equity returns, the foreign exchange appreciation, etc. That is one of the, that's a second factor which kind of encouraged foreign companies to remit their equity or even the retained earnings. And the third factor was this diversification. For example, again, this is slightly speculative, but not 100%, that there were the same companies which are here were also looking to diversify to Southeast Asia in terms of supply chains which were relevant there. For example, you heard of shoes in Vietnam, etc. So some of this may have also been using Indian funds because Indian stock markets are very strong, so it's easier to sell and use this money for diversification. They already had enough money here for diversification internally. So those are some of the factors, and my own judgment would be that most of these are temporary, and we should see a return to more normal even in the net FDI flows over the next few years. That does not mean we must not, we must still, of course, aim to increase the gross FDI much higher and not rest on the laurels that we had some peak 2-3 years ago.
Okay, so when it comes to an investment-friendly charter, because the Prime Minister and the Governing Council meeting also said that we need an investment-friendly charter, what do you think the focus should be for FY26 right now, sir, considering we've had a record low in terms of FDI, but if you want to push things, want to make India a more attractive destination, what more needs to be done?
So, all these things, you may have heard that the Nifty has been working on an index of investment attractiveness. Why is that? because, you know, India has 28 states and some of them are getting more FDI in manufacturers, others are getting less. And I think our aim is to help the lagging states to attract more FDI. So on the directions of the Honorable Prime Minister, we have been making an index which is now in phase 2 and should be completed in the next few months, which will give an idea of how attractive each state is in terms of manufacturing investment, including to FDI investors. And secondly, given that the details or the sub-indexes will help these states in seeing what needs to be corrected. So you know, in Nifty, we can't really, in a sense, direct states in any way to do something, but to kind of promote competitive and cooperative federalism. These indexes which we have developed help the states who want to improve, identify where they may be lagging and improve that. I think that is one important factor which will help improve their performance of the relatively lagging states. There are also, you know, we are the skills we mentioned. You talked about skills. Some of the problems vary across states. So all these things, you know, I have traveled to 3 or 4 states to find out where the differences are. You know, when we make a scheme, we make for all states, and it's important to kind of drill down. Of course, the states themselves are doing and trying to identify. So whether it's skilling, whether it's infrastructure, of course, we have these schemes on centers, sector-specific centers, but we sometimes forget that there are legacy industrial estates within urban areas. Some of those need to be improved and so on. So there is the general policies, of course, are all there, infrastructure improvement, etc., etc. But the states themselves have to kind of focus and see what is special about their own states, where the special problems are. And in Nifty, we try to help and as much as we can to identify and correct these or reform these.
Sir, I would also like to ask you about the core sector growth, which slowed down to an 8-month low of 0.5% in April. How do you think things would be here onwards?
You know, don't mind my saying, but you know, when I was CA, I think 20 years ago, I actually never used this core index. Why is that? Now, I'm not saying people should not use it, but I did not find any correlation between the core index and the IIP. So frankly, in my personal analysis, I did not find this very useful. So I don't know. I think it's better to look at the individual items in the core index, whether it's railways, etc., and not really and use that to diagnose and maybe focus on the specific things. But frankly, you know, as I said, I don't find the core index very useful for my own analysis.
Right. My final question, sir, would be about the state of India's economy and where we will be in the next 1 or 2 years. Now, there has been a lot of reportage over the last 2 days how, based on IMF data, it is being said that India is set to become the 4th largest economy by 2025. When do you think this can happen, and are we on the road to achieve that soon?
Yeah. Right. As you know, we are kind of in May of the year, so less than half the year has gone by. And again, as you know, when we talk about large economy, we always use the public, I mean, not me personally, we always use US dollar values to determine who is larger, who is smaller. Now, of course, the data for 2025 will take 7 months or more to come out. But there is a number of forecasts. I myself, I have an index which is called VIP, which I measure the economic power of different countries. And the 24 index had already told me several months ago that India's economic power is now ahead of Japan. And on that basis, I forecasted that the dollar value, which we all discussed, would exceed that of Japan most likely in 2025. Subsequent to that, as you have just mentioned, the IMF gave a very specific number for this likely GDP in current US dollars of India as being likely to be a little higher than Japan this year. Of course, we will have to wait till the end of the year to see whether that's confirmed or not, but I am reasonably confident that this will happen, and that in 25, when we have the entire data, will be larger than Japan. Now, looking forward, again, my projected index is indicating that the index economic power would be larger than Germany by 26, and therefore, in terms of US dollar value, I expect in India's economy to be larger than Japan by 27 or 28. Again, the IMF says 28. So I think by 2029, India will be the third largest economy measured in current US dollars. This is economic power. And of course, raising the per capita income of the country is a continuous effort, which we are all making. I think it's good to know that we will be the third largest economy in 28, but our goal is to sustain fast, inclusive growth over the next 10, 20 years. And so I think our goal, our job here in Nifty is to continuously improve or think of ways to improve the policy environment and the macro environment to sustain inclusive growth.
All right. Thank you very much, Mr. Virmani, for joining us on the program with your view on India's growth outlook and also the Niti Aayog's latest report on MSMEs. On that note, we take a short break, but don't go anywhere. When we return, we will get you an interview with the former Israel National Security Advisor on Israel's latest offensive in Gaza. Welcome back. You're watching News Center. Israeli forces have bombed a school in Gaza, killing 36 people, including children. Forces have also arrested at least 11 Palestinians during raids carried out by Israeli forces across the occupied West Bank. Since dawn, I spoke to former National Security Advisor General Yaakov Amidror to understand more about Israel's new ground offensive. Listen in.
First of all, we have to remember that this war was not initiated by Israel. Hamas terrorists coming from Gaza killed 1,200 Israelis, including 400 in a music festival. We're not speaking here about war between soldiers and terrorists. We are speaking about terrorists who came to butcher families in their houses, celebrating civilians in a festival. And now Israel is making what is needed to distract and to eliminate this terror organization. And this terror organization is fighting within its own civilians. So the only way to kill these terrorists and to achieve the target of eliminating this terrorist organization from Earth is fighting inside Gaza. There is no any patent out of but fighting within Gaza to destroy this organization. And I have to everyone has to remember again, this war began after butchering of 1,200 Israelis, most of them civilians, some of them in their houses, some of them in a music festival, women, children, old people, and so on. So the question is not why these people in Gaza had been killed, but why these people in Gaza allowed Hamas to flourish in Gaza and then to attack Israel.
Right. I would also like to ask you about the larger operation that is underway to take over the Gaza Strip. It is being called Operation Gideon's Chariots. Could you give us a sense of what Prime Minister Netanyahu is setting out to achieve with this operation, and by when do they expect to achieve it?
This operation will have two stages. One, Israel will gain military control all over Gaza, or almost all over Gaza, because there are some areas in which they are keeping our hostages. They have around 20-something hostages in their hands alive, and we don't want that they will be harmed by our attack. So it will not be totally 100% of Gaza, but it will be the majority of Gaza will be under full military control of the IDF, and then we will clean the whole area. We will go down to the tunnels. You know, they have 100 kilometers of tunnels, of miles of tunnels. We will go down and destroy all of them. We will fight on the ground to kill all these members of Hamas that's still alive inside Gaza, and there are a few thousands of them. We will destroy all the facilities that they built. And this school, for example, called school, but that was an headquarters of Hamas. Hamas is fighting behind civilian shields. This what they call a school was in headquarters of Hamas, and we tried to kill the terrorists, and probably there were some civilians around the terrorists. But the only way to kill the terrorists is to bomb those shelters of Hamas, those places that Hamas is building again. And at the end of I think it will take few months of this stage, the IDF will remain controlling the area militarily, but probably a third party will come in to take responsibility for the civilian life, because we don't want to be responsible for the civilian life of the Palestinians.
Israel is now getting cornered diplomatically because of its offensive in Gaza. Its plans to take over Gaza has not gone down well with France, UK and Canada. They've condemned Israel's actions in Gaza and what Netanyahu is doing. Do you feel that there is now a risk of diplomatic isolation and falling foul of the US as well?
I don't see isolation. I see countries in Europe, not the European Union, but countries in Europe, which condemn Israel. They forgot the beginning of the war, the atrocities of Hamas, and the decision of Israel to destruct Hamas, which was at the beginning was very well agreed by those countries after it was clear what Hamas tried to achieve and what Hamas did on the ground, including raping women and killing babies. Now everyone in Europe is forgetting it. Israel doesn't, and Israel will fight not because, with all respect to the European Union, to European countries, and all these leaders which are condemning Israel. Right. The responsibility for the security of Israel is not in the hands of the European countries. It is in the hands of the Israeli government, and the decision of the Israeli government up till now is very clear. We are continuing the operation to destruct totally Hamas military capability in the Gaza Strip. All right. And we always remember that war was imposed on Israel by the atrocities of this terrorist organization that should not continue to exist in Gaza.
General Yarov, thank you for joining us on the program, giving us your views on the operation, the stage at which it is right now, and what Israel sets out to achieve.
A range-bound session sees Dalal Street end higher. Nifty ends near 25,000. Auto and IT stocks gain the most. Banks underperform the blue chips.
Relief for JSW Steel over its acquisition of bankrupt Bhushan Steel. Supreme Court orders status quo on liquidation proceedings. JSW and lenders confirm that review petitions will be filed. JSW management is upbeat on getting a refund if Bhushan Steel goes into liquidation.
MSCI and FTSE indices announced weight reductions for Eternal following the company lowering its foreign ownership limit to 49.5% from 100%. The stock slips on anticipated outflows of over $800 million.
You're watching us here on Markets Forward, your go-to show where we aim to get you all the key data points to get up for the next trading session while telling you a lot more about the trading session that took place. I'm Mangala Malu, with me, Ekta Batra. Ekta, good evening. It's been a good day today give and take everything, we managed to conquer that 25,000 mark on the Nifty. The broader market's doing a shade better. We had nearly 60% stocks advancing, 60% more stocks advancing than the number of stocks that declined.
Hi, Manglam. Yes, absolutely. You know, it turned out to be a good session for us today. We had, it was a steady start to the week. We had no problem in terms of the key indices and the Nifty hovering around 25,000. The mid caps, like you mentioned, marginally outperformed, giving indication that the advanced decline ratio was in positive terrain. But we do have you covered for the next 20 odd minutes with all the big news and the key developments on Dalal Street, top corporate voices, and the events to track ahead. So let's kick off the day with the market action. Manglam, what a great day it was, start to the week.
What a great day it was, right? You know, for starters, we did see the GIFT Nifty indicating a 50-point uptick. The market opened higher. Thereafter, we went all the way up to 25,070.80. Thereafter, we saw a bit of a sell-off back below the 25,000 mark. And thereafter, it's been steady as she goes for the frontline index, barring the volatility that we saw in the first hour of trading session. What did well today? We did see the return of a lot of these global-facing names on account of maybe some sort of tariff relief coming in for Europe. So we had the metals do well. We had the IT index, which gained about 1%. And we also saw FMCG do well because of the early onset of monsoon. So all these indices doing a lot better. What did not do as well as the other parts of the market was the Nifty Bank. And that's largely because maybe it saw a bit of a sell-off as we saw it move closer to its previous high of closer to 56,000. The other things that we'll be watching out for through this week. One, today we will keep an eye out on the flows that come in, especially from the FIIs, largely because it was a low volume market. When it came to FIIs, the US markets are shut because of Memorial Day. So a lot of the market today was pumped higher by the domestic institutional investors. The second thing that we'll be watching out for, how the market moves as we progress towards the week because of it being the May series expiry week. So we expect a bit of volatility, and that was actually reflected in the way the India VIX moved as well. So the India VIX actually went above that 18 mark, telling you that maybe the street believes there could be some volatility in sight.
Yes, absolutely. So that's what really took place in the markets. I just want to point out that the broader markets did see quite a bit of traction. So the mid-cap index did marginally outperform with a gain of around 0.67%. But we had the BSE small-cap index, which picked up a little bit as well. So it was up around 0.5% by the close of trade. So just watch out for this kind of outperformance to probably pick up a little bit of pace going forward. And like Bangla mentioned, we do have a lot in terms of cues to watch out for in the next couple of days. We do have a couple of numbers, the fag end of the earnings season, and let's see what the global cues throw up, considering the kind of commentary and what's taking place in Russia and Ukraine. But let's get to our first segment of the day then. Hormuz joins in now from the big wall with the top stocks and movers of the day. Hormuz, over to you.
Well, earnings reactions continue in both sides of the spectrum actually, with good and bad reactions to results. And Gillette was the number that came out just a few minutes before market closing. At one point was up 11% as an earnings reaction, ending the day 7.25% higher. A strong operational performance coming in from Gillette. GE Vernova, of course, results came in after market hours on Friday. The stock remained in the 10% upper circuit through the day. Panama Petro rate gain numbers came in during the day. The mixed reactions coming in on both these companies. And Sarda Energy, of course, an earnings reaction with the margins narrowing compared to the previous quarter, and that resulted in the stock ending 5% lower. Some of the newsmakers in today's session, and they are kind of earnings reactions as well, with BEML 15% higher after some strong management commentary coming in earlier in the day when they spoke to us. Balkrishna Industries, of course, after the downgrade that came in from Nomura, was down in a 10% circuit but later recovered to end 7% lower. Honasa, giving up some of Friday's gains, was up almost 18-20% on Friday, gave up some of that. And Eternal, of course, bracing for outflows of close to around 900 million over this course of this week, ending 4.5% lower. And Camlin Fine, of course, after that very strong brokerage note coming in today, 15% higher on that stock. PSUs did well in today's trading session, most of them at least, with HUDCO leading the pack, 4.5% higher on that stock, and similar gains seen from RVNL, Concor, BHEL and IRFC as well. And lastly, stocks that did well on the back of strong volumes, and of course GNFC continuing to move higher, 6.5%, and MCure Pharma, the third day of gains, now another 9% surge, adding to the gains seen on Friday and Thursday. Phenolics, Linde and Timken too seeing gains on strong volumes. And lastly, stocks that bucked the trend in today's session, the names like Hitachi Energy, Dalmia Bharat, losses there anywhere between 3% to 5% in today's session. Back to you guys.
Take that point, a bunch of stocks on our radar. Those were the top stock movers. Thank you, Hormaz. Let's cut across to our guests now. We do have Sudeep Bandyopadhyay of IndiTrade Capital and Jay Thakkar of ICICI Securities joining in. Jay, the Nifty seems to be fulcrumed around the 25,000 mark. If you look at the option action, tells you that maybe, over the next couple of days, we're looking at a range between 24,800, 24,650 to 24,700 in terms of support, and on the way up, maybe 25,100 and 25,200 as the congestion zone. Would you concur with the same, or you have a different view?
Good afternoon to you, Mangalam, and good afternoon to you, Ekta. Absolutely, as you rightly said, that's been the pretty much, the range for the Nifty, 25,200, 24,800. And in fact, Mangalam, I would say that Nifty, in fact, managed to bounce back quite sharply, last week, despite, it, reversed from 25,000 on multiple occasions. It went to 24,500 odd levels, probably, and 300 odd levels, rather 3 to 500 levels, and reversed from there very sharply, and it's back to 25,000 and above. But then it's not able to sustain higher above those levels, despite good amount of put writing both on Nifty and Bank Nifty. So Bank Nifty too is struggling, Mangalam around 56,100 levels. That is his all-time high, and Nifty as well. So according to me, the fresh long position should be now created on Bank Nifty above its previous swing high, as well as on Nifty. Those highs are taken off. I mean, you might get a swift move towards 25,500 on Nifty, and probably 57,000 to 57,500 on Bank Nifty. Most of the private sector banks, Mangalam, are stuck within a range. Probably you say either Kotak Bank, Axis Bank. One is quite evident, that's HDFC Bank, which has a higher weightage as well. So they are all stuck in a range, and if those range breakout comes, probably then you'll get a breakout, else it can continue to consolidate. One thing interesting to notice, the last point which I have to make, is the India VIX, Mangalam, which has been bouncing back since past couple of days, and which is acting as a hurdle, or probably is one of the reason why Nifty is not able to sustain the high levels. If at all we see VIX going up, there can be some further consolidation or correction. If VIX cools down, probably you might get a breakout.
Okay, well, Sudeep Bandyopadhyay also joins into this conversation. Sudeep, welcome to the show. If you could just give us a sense in terms of how you approached the broader markets today, any stock-specific trades?
I think there were a lot of interesting pockets in the market, and one interesting pocket which I continue to monitor is cement. I mean, it's got nothing to do with today's what happened in the market, but I think there are opportunities in cement, and this is completely Trump-proof segment, so one can look at opportunities in cement. The other interesting thing in today's market, at least I noticed, is Gillette numbers. I think, while we have seen and heard from multiple FMCG companies that there are challenge in urban demand, at least semi-urban demand in pockets, but Gillette's numbers actually completely contrary to that, and it probably gives us the initial rays of hope that things are improving, and probably next few quarters we'll see much better numbers from FMCG companies as well. Monsoon definitely should give a boost, and we'll wait and watch what happens there. The last but not the least is the pipe companies. I think there are a lot of interesting things happening there, and the restocking is happening and will continue to happen. That gives a significant bump up. Though the Q4 numbers were not good, but I think going forward, the pipe companies' performance and pipe companies' even market performance should be better.
We take that point entirely, Sudeep. Just a word on Gillette as well. The large part of the revenue growth was on account of them having expanded their market. Up until now, Gillette was the best their man could get. Over the last couple of years, they've started to ramp up their portfolio on the female side as well. So Venus, which is one of their strong arms, which has been growing at 2x the pace of men's shaving units, has actually led to this growth, and lower steel prices help them as well. So while the company saw revenue growth of 13%, the net profit actually grew by 60%, and that was the big driver out there. The stock obviously has seen a big rally already, and the street believes that there is room for more. Let's talk about the other important story now, and a big relief coming in for JSW Steel. The Supreme Court has ordered a status quo on the liquidation proceedings of Bhushan Power and Steel. The Apex Court has allowed JSW Steel and its committee of creditors to file review petitions in the case as well. It said that the 30-day period to file a review wasn't over yet. Ashmit joins in with the details on that one. Ashmit.
Well, what we understand is that clearly there's a big relief that's come as far as JSW Steel is concerned. What we're given to understand is that the Supreme Court, in very clear terms, has directed for a sense of status quo, no liquidation as far as Bhushan Power and Steel is concerned. That's the core concern that had been raised by the COC, that had been raised by JSW Steel. Now, bear in mind that former promoter Sanjay Singhal had moved the NCLT and had sought for an expeditious liquidation of Bhushan Power and Steel. Now, what JSW Steel, as well as the COC, when appearing before the Supreme Court, told the highest court is that, look, there is still some time left as far as filing of the review is concerned, that if liquidation takes place, that will leave JSW, that will leave the COC high and dry, that the COC themselves are facing questions of how this return, if the Supreme Court order is to be complied with, how the return of funds is to work, how the return of securities from JSW back to the lenders will work, what legal options there are before the lenders, before the JSW. And these were questions basis which the Supreme Court said that in the interest of justice, it's best advised that at this point status quo is maintained. There is no further movement, there is no liquidation that takes place, and that is the best way to ensure that if and when the review is filed, there will not be any further liquidation. Having said that, speaking of a review, the Supreme Court, as a part of its order, does record indicating that both JSW Steel as well as the COC are contemplating relief measures like filing of a review petition. Just a small caveat there. As per the Supreme Court rules, there's a 30-day window for filing of review petitions. Given that this judgment came on 2nd of May, 2nd of June naturally would translate into a deadline, a 30-day deadline. So that's the window that JSW Steel and the lenders are looking at in terms of filing of a review petition. But for now, status quo, no liquidation to happen as far as Bhushan Power and Steel is concerned.
The matter is sub judice, so I may not be able to comment too much, but I think it's important to note that we have implemented the resolution plan in full compliance with the law, and we have been able to successfully revive the asset to its present condition where it is today, with increasing operational output, with increase of capacities. The second thing is that we have analyzed the judgment along with our legal advisors, and we believe we have strong grounds for availing all legal remedies available to us.
Okay, all right. Well, Sudeep, have you been tracking this story, and what would your would your outlook be on JSW Steel?
Well, JSW Steel, otherwise everything else is fine. I think they're doing the right things, but this is such a confusing scenario that a lot depends on how things move in the Supreme Court. Yes, today's was definitely a relief, because immediate liquidation would have created utter chaos in the entire system, I would say. So this is definitely a relief, and hopefully their review petition will be considered. The way I look at it, some penalty, some fine can be imposed, but unwinding the transaction, which has already happened years back, I think it will set a bad precedent and create a lot of confusion. So in JSW's interest, I think this transaction should continue. Otherwise, absolutely fine. JSW and overall steel industry, we are positive.
All right. Chartically, how does it look? If I had to ask, the other guest, Jay.
Yeah. Well, Mangalam, see, I would say that JSW Steel, the overall trend technically is definitely positive. I mean, the stock has been, moving higher in an upward sloping parallel channel. I mean, since past couple of trading weeks, the stock has formed a kind of a symmetrical triangular pattern, which is a continuation pattern, and the range has been 940 on the downside to 1050, 1060 on the upside. So it's been of around 100 to 120 points kind of a range. I think the probability of a breakout on the upside is higher, as the momentum is favorable for the bulls. It's well in the buy mode, as well as Mangalam, since the overall rise we have seen, as far as derivatives data is concerned, the futures OI had come down continuously, clearly indicating long liquidation. But since past couple of trading sessions now, there has been a sharp uptick in the open interest with the price moving up, indicating that there's a long build-up and a higher chance of a breakout from this range, 120 points range on the upside. So I would say that until 940 levels are not broken on the downside, the trend remains bullish. And if breaks out, I mean, it can go to 1200, 1250 levels as well.
All right. Thanks a lot for that. Let's talk about the other stock on our radar then. Zomato's parent company, Eternal, fell nearly 5% after the MSCI and FTSE announced weight reductions for the stock. The move came after Eternal lowered its foreign ownership levels. Vivek Iyer joins in with the details. Vivek.
Well, that's right. So, last week you did see the news flow come about where, the board and the shareholders had gone ahead and approved reducing the investment limit as far as foreign ownership was concerned to 49.5%. Earlier it was 100%, as high as 100%, and they went ahead and reduced it to 49.5%. So along expected lines, quant analysts had expected that this particular move or reduction as far as the foreign ownership limit is concerned would go ahead and trigger reduction as far as weightage of both MSCI as well as FTSE indices as far as the treatment of Eternal was concerned. So on Friday, you did see an announcement come about both from FTSE as well as MSCI. FTSE said that they would be reducing the weight of Zomato or Eternal on May 27th. The expected outflow is close to $380 million. These estimates are as per IIFL Capital. Now, MSCI, remember that particular outflow is quite higher. On May 30th is when this particular outflow is anticipated, and outflows of close to $460 million. Again, the estimates are as per IIFL Capital. This proved to be an overhang on the stock today, given the fact that significant passive outflows are expected during the course of the week.
Okay, all right, Vivek. Thanks very much for that. So that's the update coming in on Eternal. But Divi's Labs is one of the stocks that I looked at. It was one of the top gainers on the Nifty today. Now, the reason is that they've signed a long-term manufacturing and supply agreement with a global pharma company to manufacture and supply advanced intermediates. They say that they're expecting meaningful revenue contribution from this particular agreement, and the company is not permitted to disclose the name of the customer or any quantitative information, but the cost of the capacity addition for manufacturing under this agreement is estimated to be 650 to 750 crores, which is going to be paid by the customer phase-wise under the agreement. With this, the company has now signed 3 long-term supply agreements. They've signed 2 long-term supply agreements earlier, and both those contracts were related to custom synthesis projects. One was with advanced intermediates and the other was with an active API. Morgan Stanley is bullish on Divi's Labs. They have an overweight call, target 7185. According to them, both orders imply incremental revenues of 1690 to 1890 crores versus FY25 revenues of 9300 odd crores. But Sudeep, have you looked at Divi's Labs, and what do you think, where do you think the stock could go from here, considering that it's so expensive and it has punchy valuations?
Well, it was always expensive and it continues to remain expensive, but I think all these new contract signing definitely gives them a good runway going forward. And if their top line can go up by about 15-20% based on these contracts, new contract, I think that's pretty interesting from this company's point of view. If you're a patient investor and can allocate money for 1 year plus, I think definitely even at current level, Divi's look good. I think we are looking at about 15% upside from current levels.
All right, 15% upside from current levels. Thanks a lot for that. In fact, we'll take a short break, come back, get you more on the markets and top corporate voices along with the key market events to watch out for on the other side. Stay tuned.
Welcome back. Well, you're still tuned into Markets Forward this Monday afternoon. Two IPOs have opened for subscription today, Aegis Vopak and Sklosh Bangalore. Well, tell us more, Mangala.
You know, after a very long time, Ekta, the IPO market is back, and it started with a couple of fresh issues. So we have Aegis Vopak, which has a 2,800 crore fresh issue. Schloss Bangalore has a 3,500 crore issue, of which 2,500 crore is fresh issue as well. What does Aegis Vopak do? It's the largest Indian third-party owner and operator of tank storage terminals. So all the liquid and gas storage that takes place, they're the ones who are responsible for storing that and transporting that. Well, the management has said that with the money that they are raising, they will, use about 2,000 crores to repay their debt, and their bank borrowings will become zero, which will save them 160 crores in interest cost, which will flow straight to the bottom line. They have two liquid terminals for the company, which have recently become operational, and H1 will also see two cryogenic tanks, which will come on stream. So all of this would mean that FY26 will be a marked jump in performance. The post-issue market cap that they're seeing is close to 26,000 crores. So even if they more than double their net profit from here, 85 crores to about 300 crores, still trading at around 85, 87 times one-year forward earnings. Not particularly cheap, but that's the market that we're in right now. The other one, Schloss Bangalore, you would better know it as the company that owns and operates the Leela Palaces, the Leela Hotels and the Leela Resorts. Remember, HLV was sold to Brookfield earlier, and now Brookfield has come back with Hotel Leela. The portfolio comprises of 13 operational hotels with 3,500 keys. They are the EBITDA margin leader with nearly 50% as compared to Indian hotels at 33%, Chalet Hotels at 38%, and Lemon Tree at 45%. They say that they are, in the luxury segment, and they will continue to sustain their margins. They too are using these funds to become debt-free, and they will save about 200 to 210 crores in interest costs. Hospitality segment, they say, will grow much faster than the GDP growth. Leela's market share in luxury is about 10%, will continue to grow. So what we'll do is, we'll hear out the management bites on what they had to say, both Aegis Vopak and Schloss Bangalore.
Two liquid terminals have just become operational in March, which is a JNP in Newport, as well as Mangalore expansion. And then two cryogenic terminals at Mangalore and Pipavav are getting commissioned in H1 of the current year. So they are like factories. I have 22 working sites. I've developed 225 acres of port land in 6 ports. And these are going to triple my LPG capacity, the two cryogenic which is going to come. The terminal is capable to do 6 million tons of throughput. Okay. My rate of revenue is 1,250 rupees. I have spent only 900 odd crores for that terminal. Okay. Now, as the utilization will ramp up in 5-7 years, I would be reaching that peak. Okay. So you take your take that what a potential that terminal has, because I will not be able to step into that forward.
Proceeds of the IPO, about 2,500 crores, which is the primary issuance. A majority of that capital will be used to reduce leverage or debt on the company's balance sheets. As of March 25, the company had cash of about 1,200 crores on its balance sheet. So post IPO, the net debt position of the company, gross debt minus cash, will be close to zero. Firstly, the focus of the business is on luxury. Now, in the hotel business, a large part of your expenses are fixed in nature, which means if you can command pricing premium and if you can invest back in your real estate or your property business with lower fixed heads, which can be sustained, that contributes to your current margin.
Okay, well, now let's go across to the key voices of the day. First up on the list is BEML. The management guides its order book to reach 22,000 crores in FY26. That's not all. It expects revenue growth to be 20% with an EBITDA improvement of 150 basis points. The company is anticipating a phenomenal growth in its defense business this year. The management says it's quite optimistic about large defense emergency procurement orders. The defense revenue contribution is set to increase to 30% in FY26.
Next up on the list, we have Ashok Leyland, the management optimistic about FY26, saying that growth rate should be very healthy from the second quarter, as decline in interest rate and macroeconomic activities will actually drive growth in this FY26 bus segment. That's the one where they will see healthy growth, while medium and heavy commercial vehicles will see mid-single-digit growth in FY26. They continue to focus on margins, but claims that it may take 2 to 3 years to achieve that mid-teens sort of EBITDA guidance that they have. On Hinduja Leyland Finance, though, management of Ashok Leyland says it will be able to list that very soon once the approvals are in place. Lastly, we had Indigo Paints on our radar as well. The company has witnessed gradual improvement in demand, further improvement in the first quarter, the management believes is likely, with the industry just months away from demand normalization. They are aspiring for 5% market share over the next 3 years, with 3% right now, and margins will remain steady as they grow more than 20% as the industry normalizes.
Okay, and before we wrap, let's bring you some key market events to watch out for. Ria is standing by with the key events for tomorrow.
Well, yes, let's take a look at the most important events to watch out for tomorrow. We'll have a lot of companies reporting their Q4 numbers, which will include LIC, Bharat Dynamics, DCX Systems, Gujarat Fluorochemicals, Hindustan Copper, JK Lakshmi Cement, NMDC and NMDC Steel, PNG Health and Techno Electric as well. We'll also have Hindustan Copper holding a board meeting tomorrow to consider a fundraise of up to rupees 500 crores. Going on to the economic cues then, in Europe, the economic sentiment will be important tomorrow, as well as the consumer confidence data in the US. And we'll also be watching out for the Bitcoin 2025 conference that is going to be starting tomorrow in Las Vegas.
All right, with that, it's a wrap on this edition of Markets Forward. We'll be back with more news and updates on the other side. Thank you so much for watching CNBC TV 18.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Sensex and Nifty end a range-bound session with minor gains. Nifty reclaims the 25,000 mark. Auto and IT stocks are the top gainers. US President Donald Trump pushes back his 50% tariff deadline for the European Union by over a month till the 9th of July. The de-escalation comes after a call with the European Commission President. Global markets inch higher. President Trump says Russia's Putin has gone absolutely crazy and hints at possible new sanctions. This after Ukraine's Zelensky questioned America's silence on the Russian air raids targeting Ukrainian cities. Trump also slams Zelensky, says he's doing his country no favors by talking the way he does. Relief for JSW Steel over its acquisition of bankrupt Bhushan Steel. Supreme Court orders status quo on liquidation proceedings. JSW and lenders confirm that review petitions will be filed. JSW management is upbeat on getting a refund if Bhushan Steel goes into liquidation. Relief for SpiceJet in its arbitral dispute with former promoter Kalanidhi Maran. Delhi High Court rejects Maran's claims of 1,300 crore rupees in damages, calls it a case of deliberate and willful concealment of facts. Maran has the option of challenging the order in the apex court. The Supreme Court questions Maharashtra government's decision to disqualify L&T from the tender process of two projects worth 14,000 crore rupees. Says it's difficult to believe that the company that built Central Vista in New Delhi did not qualify. Seeks the state government's response by Thursday. The new invoice management system under GST irks India Inc. Sources say industry has told the government the new system is causing additional compliance burden. Kerala government issues a warning to coastal areas after containers from a capsized ship carrying oil and hazardous chemicals wash ashore. State government tells the public to stay away from the beached containers. Heavy rains lash Mumbai, disrupting road and rail traffic as the monsoon arrives early. An underground metro station, which recently opened in Worli, has been flooded. All right, let's start with the day's market action. The Indian market ended with minor gains in a range-bound session. Nifty ended above the 25,000 mark. Market with the auto and IT stocks as the top gainers. Mid-cap index outperformed. US President Donald Trump has extended his 50% tariff deadline for the European Union from the 1st of June to the 9th of July. The de-escalation comes after the European Commission President asked for more time to reach an agreement. The EU chief has said the bloc is ready to advance talks swiftly and decisively. Staying with international news, the EU has begun to court Vietnam to strengthen trade ties with the export-dependent nation. This comes soon after Chinese President Xi Jinping's bid to attract business from the nation that is grappling with threats of crippling US tariffs. French President Emmanuel Macron's first visit saw France and Vietnam signed a deal on Monday for 20 Airbus. Now, deal signed during Macron's visit also covered cooperation on nuclear energy, railways and satellites. Vietnamese President Luong Quoc said that the countries pledged to work closely to maintain and strengthen free trade. Oil prices surged in early Asian trade after US President Donald Trump extended the deadline for a trade deal with the European Union. The move eased concerns over tariffs hurting global demand. Meanwhile, gold prices fell marginally, giving back some of the last week's gains. Right, in what comes as a big relief for JSW Steel, the Supreme Court has ordered a status quo on the liquidation proceedings of Bhushan Power and Steel. Now, the Apex Court has allowed JSW Steel and its committee of creditors to file review petitions in the case, saying that the time period for review isn't over yet. Ashmit Kumar is here with the details. Ashmit, please take us through the Apex Court's order.
Well, what we understand is that clearly there's a big relief that's come as far as JSW Steel is concerned. What we're given to understand is that the Supreme Court, in very clear terms, has directed for a sense of status quo, no liquidation as far as Bhushan Power and Steel is concerned. That's the core concern that had been raised by the COC, that had been raised by JSW Steel. Now, bear in mind that former promoter Sanjay Singhal had moved the NCLT and had sought for an expeditious liquidation of Bhushan Power and Steel. Now, what JSW Steel, as well as the COC, when appearing before the Supreme Court, told the highest court is that, look, there is still some time left as far as filing of the review is concerned, that if liquidation takes place, that will leave JSW, that will leave the COC high and dry, that the COC themselves are facing questions of how this return, if the Supreme Court order is to be complied with, how the return of funds is to work, how the return of securities from JSW back to the lenders will work, what legal options there are before the lenders, before the JSW. And these were questions basis which the Supreme Court said that in the interest of justice, it's best advised that at this point status quo is maintained. There is no further movement, there is no liquidation that takes place, and that is the best way to ensure that if and when the review is filed, there will not be any further liquidation. Having said that, speaking of a review, the Supreme Court, as a part of its order, does record indicating that both JSW Steel as well as the COC are contemplating relief measures like filing of a review petition. Just a small caveat there. As per the Supreme Court rules, there's a 30-day window for filing of review petitions. Given that this judgment came on 2nd of May, 2nd of June naturally would translate into a deadline, a 30-day deadline. So that's the window that JSW Steel and the lenders are looking at in terms of filing of a review petition. But for now, status quo, no liquidation to happen as far as Bhushan Power and Steel is concerned.
Right, thank you, Ashmit, for that. JSW Steel's joint MD and CEO Jayant Acharya had said that the company has strong grounds to avail all legal remedies with respect to Bhushan Power. Speaking with CNBC-TV18, he also said that JSW Steel expects to receive refunds from Bhushan Power if it's headed for liquidation.
I think those are under various stages of discussions with our advisors, and we'll be taking appropriate steps at the right time. I may not be able to give you exactly what the status is in the court as of today. Yeah, so two things. On the downside, as per the Supreme Court judgment as well, we are protected from the fact that the refund would come back to us, number one. Number two, the capacity expansions in BPSL have been done from the internal accruals which we generated at BPSL as per the resolution plan.
Right, Ashmit, let's also talk about SpiceJet, whose shares rose in trade after the Delhi High Court dismissed Kalanidhi Maran's plea seeking damages of more than 1,300 crore rupees from the airline. Could you take us through what the court said and what does this mean for Kalanidhi Maran?
Well, big reprieve coming in for SpiceJet, the airline. The Delhi High Court on Friday, we understand, has rejected an application by Kalanidhi Maran seeking damages of 1,300 crore rupees. Now, bear in mind, this goes back nearly a decade and a half. 2010 is when Kalanidhi Maran had acquired a controlling stake as far as SpiceJet as the airline is concerned. In 2015, handed the control back to Ajay Singh, and since then, there's been a dispute over a transfer of preference shares, a transfer of warrants, a transfer of cash. There's been an arbitral dispute. Now, the arbitral dispute first went in favor of Kalanidhi Maran. The arbitral tribunal had directed for payment of 579 crore rupees from SpiceJet to Kalanidhi Maran. However, after a spate of litigation in 2024, which is just last year, the Supreme Court had sent the matter back into arbitration. And at the arbitration center is when Kalanidhi Maran had raised claims of 1,300 crore rupees. The arbitral tribunal rejected it. Kalanidhi Maran then moved to Delhi High Court. The Delhi High Court, we now understand, has also rejected it. In fact, the Delhi High Court used strong language that this was, quote-unquote, a calculated gamble being used by Kalanidhi Maran in terms of way they've gone about filing this entire petition, challenging the arbitral award, and also going on to say that certain key facts were in fact held from the Delhi High Court. The Delhi High Court saying we're not impressed with this conduct. So on that ground, sending it aside, dismissing this petition. But bear in mind that Kalanidhi Maran does have the legal remedy, the legal option of appealing this Delhi High Court judgment before the Supreme Court.
Right, thank you, Ashmit, for that. The Supreme Court has questioned Maharashtra government's decision to disqualify L&T from the tender process of two projects. The road projects are worth 14,000 crore rupees. The apex court said it's difficult to believe that the company that built Central Vista in New Delhi did not qualify. It also sought the state government's response by Thursday. All right, moving on. JSW Paints is likely to take over AkzoNobel's India business. Sources tell CNBC-TV18 that JSW Paints will buy out AkzoNobel's promoter stake of 75% for 10,000 crore rupees. Rachna Dhanrajani joins us with more. Rachna, take us through the contours of the deal.
Right, the battle for AkzoNobel India is heating up and JSW Paints may hold the edge. Sources tell CNBC-TV18 that JSW Paints is set to acquire 74.76% stake in AkzoNobel India in a deal valued around 10,000 crore rupees. The deal is expected to be completed by the end of June. This would mark the complete exit of AkzoNobel's Dutch parent from the Indian market. But that's not all. The deal is also being struck at a discount. AkzoNobel India's current market capitalization is at about 16,000 crore rupees. But the deal values the company at about 13,000 crore rupees. Now, Indigo Paints and Berger Paints had also thrown their hats into the ring to buy AkzoNobel's asset, but JSW has emerged as the front runner. CNBC-TV18 had first reported in January that these three companies will battle it out for AkzoNobel's India assets. Earlier this year, Parth Jindal spoke to CNBC-TV18's Shireen Bhan, where he promised to give everything to seal this deal. Let's take a look.
I think there's no choice. If JSW and the ambitions we've shown that we want to be a top three player in whichever sector we play in, if I have to do that, then I have to give it everything that I've got for Akzo.
How will you fund it?
It's going to be a mix of the family investing, and private equity.
The 3,500 crore rupees IPOs of Clos Bangalore, the owner of luxury hotel chain The Leela, saw a tepid response on the first day. As of 4 p.m, the company's overall issue was subscribed 6%. The portion allocated for retail investors was booked 18%. The portion for qualified institutional buyers was subscribed 3%. Storage solutions provider Aegis Vopak's initial public offering opened for subscription today. 25% of the public issue had been subscribed so far, with the retail portion booked 18%. Meanwhile, qualified institutional buyers have subscribed 39% of the portion allocated to them. The price band of the 2,800 crore rupee issue has been set at 223 to 235 rupees a share. Investors can bid for a minimum of 63 shares. The new invoice management system under GST has irked India Inc. Sources tell CNBC-TV18 that industry has flagged its concerns about additional compliance burden to the government. Now, Timsy Jaipuria is here with more. Timsy, tell us about the industry's concerns.
Well, that's right. Sources have told CNBC-TV18 that the new invoice management system, or the IMS, under the GST regime is causing additional compliance burden for the taxpayers. Industry, in a detailed representation, has mentioned that the new system design assumes auto-replication, reconciliation of transactions across GSTR forms, and considering that most companies' processes are through manual operations, the new system would not just mean additional infrastructure, a minimum requirement of a qualified CA, a 24-hour software and internet connection, and basic backbone, that is the IT backbone, which will be required, adding to the burden. Also, the representations outline that most companies use basic accounting software that don't allow auto-matching of sales, purchases, ITC transactions across GSTR forms. And as per the new invoice management system and the design, if it sees any mismatch or break in the transactions in the GSTR forms, it will raise a red flag, which will alert the GST and income tax authorities for action, and it could lead to companies and taxpayers getting not just a GST but income tax notice as well. That is for the transaction reconciliation mismatch due to the new invoice management system and design. Further discrepancies have been flagged by the industry due to the new IMS design system, which says that it compresses correction window, blocks ITC credit, and thus problems arising due to the new IMS design are adding to compliance burden, hitting working capital, along with the most harming impact, which is that the assumptions that will be made by the authorities during these mismatches, which will be noted, and it increases the risk of dual taxation. Now to be seen is how the government and the industry battle this out.
Right, thank you, Timsy, for that. India is on track to overtake Japan to become the fourth largest economy by 2025. However, according to the International Monetary Fund, the numbers indicate that while India is very close to Japan in nominal GDP, as of 2024, it is still slightly behind as per IMF's current estimates. Ritu Singh joins us now with the details. Ritu, take us through IMF's data.
Well, the big question, has India really become the world's fourth largest economy? Because, on Saturday, we had the CEO of Niti Aayog making a statement that quickly drew a lot of attention, saying that India had overtaken Japan to become the fourth largest economy with a $4 trillion GDP, citing IMF data. So we decided to take a closer look at the numbers. And as per IMF's projection, India is indeed set to overtake Japan later this year, but it has not happened just yet. Now, as per the most recent official figures, and that is for 2024, India's economy stood at $3.91 trillion, while Japan was still slightly ahead at $4.03 trillion, and that makes Japan the fourth largest economy in the world currently, but things are expected to change this year. IMF data shows that India's economy is projected to reach $4.187 trillion in this year, just ahead of Japan's $4.186 trillion, and that will make India the fourth largest economy. But beyond that as well, the gap is expected to grow, with India forecast to hit $4.6 trillion in 2026 compared to Japan's $4.3 trillion. Of course, keep in mind, these are still projections and they're based on various assumptions, and things can always change. Also keep in mind, RBI has projected India's growth rate at 6.5% for FY26, while the IMF's forecast is slightly more conservative at 6.2% in FY26 and 6.3% in the next fiscal. Still, what is clear is the overall trend that India continues to be one of the fastest growing major economies in the world. In fact, by 2028, IMF expects India to even overtake Germany, becoming the third largest economy in the world, only behind the US and China. So while India isn't the fourth largest economy just yet, it is right on the brink. And if IMF's projections do hold true, that milestone should be crossed within 2025.
All right, thank you, Ritu, for that. On that note, we'll slip into a short break. But before that, we are excited to unveil our brand new global business news channel. CNBC-TV18 presents an all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists, shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. So tune into CNBC-TV18 Prime at 12 noon for the Global Reset and at 8:30 p.m. for Global Lens. All right, time for a short break. We'll be back in 2 minutes. Welcome back. Containers from a capsized ship carrying oil and hazardous chemicals have washed ashore in Kerala's Kollam. The Kerala government has issued evacuation orders for parts of the district's coastal areas. The government has told the public to stay away from the beached containers. The cargo ship, which was on its way to Kochi, sank after encountering heavy weather. Heavy rainfall and thunderstorm battered Mumbai and neighbouring districts, marking the region's earliest monsoon onset in over 70 years. The Met Department has issued a red alert for Mumbai, Thane, Raigad and Ratnagiri, which will remain in place at least until tomorrow morning. Local train and metro services were disrupted. The newly inaugurated Acharya Atre Chowk metro station at Mumbai's Worli area has been waterlogged, and it was only 4 out of the 6 water pumps were operational there. Santiagora reports from the flooded metro station.
Once arrived in Mumbai on Monday, bringing heavy rains to the city. And let's talk about what's happening to Mumbai's much talked about Aqua Line, Mumbai's Metro Aqua Line. So let me tell you this, that when this line was promoted by the state government, it was claimed, the state government would claim that this line is virtually completely flood-free. And let me now tell you what has happened now. With the post-span of crave itself, the line is disrupted. The trains are running only up to Worli station and not to the final stop of Acharya Atre Chowk at Worli Naka. Why? Because there is flooding as the Acharya Atre Chowk. Right now, I am at the Worli station. So trains are running up to here, but let me still show you how the Worli station at least is looking like. This is how the station of a metro line which was supposed to be to. This had raised serious concern about the reliability for Mumbai Metro and commuting by Mumbai Metro during these.
Right, the Indian government is working on a new policy to support small hydroelectric power projects in the country. According to sources, the draft policy largely focuses on feasibility, finance, storage and distribution of these projects. Abhimanyu joins us now. Abhimanyu, what are you picking up from your sources?
A new policy for small hydel projects is being prepared by the Union government. The Ministry of New and Renewable Energy has already held several review meetings, and the draft policy is going to be tabled before the Union Cabinet for due approval. Now, currently, there is no policy which exists from the Union government side for small hydel projects. That is, the projects which are lower than 25 megawatts in capacity. Higher projects in terms of megawatts are handled by the Ministry of Power, and an assessment which had been conducted by the government had earlier indicated that there are over 7,000 sites for small hydel projects across India, and these potential sites have a potential of 21 gigawatts of hydel power which can be generated. It remains to be seen how early this policy is going to be decided and finalized, since it's going to act as a guiding light. It's going to decide the contours for financing, storage, diversion of water, and also for preparation of such projects in far-flung areas. Also, this may aid several villages and hamlets which are located in far-flung areas and lack grid connectivity. And now, with suspension of the Indus Water Treaty, several areas in J&K, Himachal Pradesh and Punjab may also witness such small hydel projects coming up, which of course is going to add not just to the base load but will also reduce the dependence on thermal power.
Right, thank you Abhimanyu for that. In international news now, Israeli forces have bombed a school in Gaza, killing 36 people, including many children. Forces have also arrested at least 11 Palestinians during raids carried out by Israeli forces across the occupied West Bank. Now, in a post on X, the Israeli military said it intercepted a rocket launched from Gaza before it crossed into Israeli territory. US President Donald Trump has called Russian President crazy for launching one of the biggest airstrikes on Ukraine since the start of the war. Trump also warned Moscow that any attempt to take over Ukraine will lead to the downfall of Russia, warning further sanctions. And with that, it's a wrap on this edition of Business 360. More news and updates continue right here on CNBC-TV18.
and welcome to Startup Street. I'm Ritu Singh and with me is Arundhati Ramanan. Here are the top headlines from the startup space. Online investment platform Grow has filed confidential IPO papers with SEBI. The IPO size is likely around $700 million up to $1 billion, comprising a mix of fresh issue and an offer for sale, according to sources from CNBC-TV18.
Drools claims to have become India's first pet food unicorn after minority investment from Nestlé SA, the parent company of Nestlé India. The details of the investment and the valuation of the company remains unknown.
Online gaming firm Nazara Technologies posts a 95% year-on-year jump in operating revenues to 520.2 crore rupees for the fourth quarter of the fiscal. The company reports a net profit of 4 crore rupees for the same quarter.
O2P, a grocery subscription startup, shut down operations last week, leaving around 300 employees and numerous delivery gig workers without jobs. Founder and CEO Varun Khurana tells staff of the decision during a town hall meeting. Reports indicate the startup has delayed payments to both employees and vendors.
Chinese e-commerce giant Alibaba's Taobao instant commerce portal, which delivers items within 60 minutes, surpasses 40 million daily orders within a month of launching. The portal brings merchants from Alibaba's food delivery arm, Loma, onto its main domestic shopping app. Those are the headlines that we're tracking for you today. Now, in what's brewing, wealth tech unicorn Grow has filed confidential papers with the market regulator SEBI for an initial public offering in what is said to be one of the most closely tracked issues in the space this year. We learned from sources that the IPO size could be between $700 million to $1 billion and is going to include a mix of fresh issue as well as an offer for sale component. The proceeds from this IPO are likely to be used for technology development and business expansion as well. Now, some of the notable investors in Grow include Peak 15, Ribbit Capital, Y Combinator, Iconic, Tiber Global, and even Microsoft CEO Satya Nadella. The merchant bankers who are managing the issue include JP Morgan India, Kotak Mahindra Capital, Citigroup Global, Axis Capital, and Motilal Oswal Securities. Now, during a recent conversation with Shireen Bang, Grow co-founder Lilith Keshre tried to explain the complex nature of raising capital and the company's journey when it comes to changing domicile. Take a look.
Of course, you're one of the companies that reverse flipped and moved your domicile to India, ostensibly, of course, with the hope and the possibility of IPOing. But what was that like? Because, you know, it's few companies have gone down that road at this point in time, and it also comes with a pretty hefty bill. But what was the experience of reverse flipping?
Well, it was like grueling experience. We in 2018. So I told, right, we started in 2016, we raised some angel, but we needed more capital. Because we were thinking of moving to direct mutual funds, which is like zero revenue for next, I don't know how many years. We needed capital. And YC was one good kind of option for us.
Yeah.
So we applied to YC, we got in. And based on...
And for those of you who are watching, YC is Y Combinator. Yes.
Y Combinator, right. And what we got feedback from a lot of seniors and from YC, and that, you know, better to incorporate in US because funding is easy, right? You know, raising money in the US. So us time pe, like, you don't think about 5 years down the line, 10 years. No, I mean, you think about from your purpose perspective, but first you need to, so I say, right, in long term, everybody is dead, but, you know, to think long term, you need to keep doing short term.
Yeah.
So we incorporated in the US at that time, and then we paid for that, and we could afford also because a company has been profitable for so many years, and this was also right time. Where typically, if you're raising capital, then it becomes tough because the process itself is very long. You go through NCLT process and those kind of things.
Yeah. Moving on, the competition in quick commerce space has taken a new turn. This after Zepto CEO Adit Palicha alleged that a smear campaign is being run against the company by the CFO of a rival firm. Shilpa Ranipeta is here to take us through Palicha's remarks and tell us all about this heightened competition in the space.
Well, the battle in the quick commerce space is escalating beyond just numbers now. Now, Zepto's co-founder and CEO Adit Palicha has alleged a smear campaign is being run against the company by the CFO of a rival firm. Now, in a LinkedIn post late last night, Palicha claimed that this rival CFO is calling up investors to make what he calls a wild allegations, is sharing false financials and is even paying social media bots to spread negativity about Zepto. While Palicha says he's all for aggressive competition but not lies. And he wrote that he hopes that this executive in question puts an end to this. Now, in the post, Palicha also laid out Zepto's latest financial performance numbers, which he called was his response upfront in case stories go out with inaccurate information. He claims that Zepto's monthly gross order value surged to 2,400 crore rupees in May 2025, up from just 750 crore in the same month last year. EBITDA improved 20% and cash burn was down 65% between January to May this year. He further claimed that the company expects most of its dark stores to be EBITDA positive by the next quarter, with overall profitability also not being far behind. He added that the company is doubling down on dark store launches with no large-scale rationalization in sight. Now, Palicha's remarks come at a time where competition in quick commerce space in India is heating up. Not only are new entrants like Flipkart and Amazon ramping up their presence, Zepto's direct competitors, Blinkit and Instamart, both of them alluded to widening losses, and this they alluded to heightened competition in the fourth quarter. Now, Eternal's Blinkit saw its adjusted EBITDA loss grow nearly 4 times in Q4, but the company has said that it will focus on market share even if it comes at the cost of short-term profitability. Real estate, marketing and last-mile delivery costs have also surged and margins have come under pressure as per the company's commentary. Now, Swiggy's Instamart also took a hit, with Q4 adjusted EBITDA loss nearly doubling to 840 crore rupees in the fourth quarter. Swiggy has now pushed its contribution margin break-even target to 3 to 5 quarters from now, citing sustained competition, which it expects will remain intensive in the near term, and it is so ramping up investments. Now, as deep-pocketed players fight for dominance, the battle for quick commerce is no longer just about who delivers groceries faster, but who can weather the burn and the bruising.
Shilpa, many thanks for those details. Now, in a big boost to India's electric mobility push, EV financier Mufin Green has raised $18 million in long-term debt from a US-based institution. Now, the funding will help the company expand financing and leasing of electric vehicles, especially for small businesses and first-time borrowers across India. With a $100 million loan book and operations in 26 states, Mufin is aiming to deepen its reach in Tier 2 and Tier 3 cities and support the shift to cleaner transport. Joining us now to discuss this further is Gunjan Jain, the CFO of Mufin Green Finance, and my colleague Ritu. Gunjan, thank you so much for taking time out and being here with us on Startup Street. You know, Mufin Green has secured $18 million in debt funding. What does this capital mean for your short-term and long-term growth plans? Where will these funds go?
Thank you so much for getting us connected for briefing about this $18 million, which we have just received from USDFC. So this $18 million is specifically dedicated towards the EV mobility space, and which includes, as you have said, which includes financing to the SME categories in the individual as well as corporates. So this loan is for 10 years, so it gave us the ample ALM positive side, and apart from that, this landed to us at 6% only. With hedging, it is only 9%, so we get a cheaper fund at 10 years from USDFC, which we will be utilizing solely for the Tier B, Tier C towns, people who are new to CIBIL, who are not able to get funds from the other NBFCs, big NBFCs, or from the banks, and we'll be catering to the startups who are getting entered into this EV space for the aggregator services or last mile delivery.
All right. Gunjan, hi, this is Ritu just stepping in. You know, a large portion of funding, as we understand, is also going towards MSMEs in underserved areas. How large are you planning to grow the book in this segment versus where it's at currently?
So currently also we are having the portfolio of around $100 million, out of which 80% is into the green and mobility space. And we have funded entire of our green portfolio is into the SME category. So we are planning to enhance our portfolio to somewhere around 1,300 crore by next financial year, and we are expecting that 70% of our portfolio will be into the green space, which will be for sure into the underserved and unserved segment of the society itself.
Right. You know, 84% of your borrowers are new to formal credit, yes, right? So yes, how are you balancing financial inclusion with risk management in the EV lending space? How are you ensuring credit cost stays in check at this point?
So credit cost is for sure there. That is a challenge which we are also facing because we are getting funds at a comparatively higher rate of somewhere around 13% average cost, for which we got a rating upgraded to A minus. Now we are approaching our PSU banks to get the funding at a reasonable rate, which will be somewhere around 10%. So this will help us to manage the OPEX. So we are not facing that much of credit cost because we are having our own staff, all field staff who are getting the collection done from this e-rickshaw or L5 or the auto drivers. But yes, the requirement of us to scale up is the funds at a cheaper rate. So DFC is lended to us at somewhere around 9.25%, including hedging. Apart from that, we have approached almost all the PSU bank, which we will close in next 6 months. So afterwards, our like the credit cost will reduce for sure.
All right, credit cost will come down, but Gunjit, could you give us a sense of what your current margins that you're working with in the EV space and this underserved MSME space are like? And going ahead, do you expect this cost of funds to fall as we see further rate cuts from the central bank?
So the margin which we are getting is higher in the e-rickshaw space, where we are getting the good spread of 15%. But I will also like to highlight that a major OPEX, 80% of my OPEX belongs to this e-rickshaw space only. The field staff which I am having is majorly, my 70% of the employee base is dealing with this e-rickshaw space because they are not used to the banking channel. We are supposed to get our EMI collected on cash basis. So on an average, on each and every vertical, whether it is my wholesale lending, which is to the corporates or to the individuals, I'm getting 3 to 4% net. It depends upon the OPEX which I'm dealing with each and every segment. And as and when my borrowing cost will reduce, when we'll get funds from PSU Bank, we are hoping to pass on that benefit to our borrowers who are underprivileged.
Sure, and you're already present in 26 states and over 150 cities, right? Will this funding sort of accelerate expansion into newer geographies or deepen presence in existing ones, especially tier 2 and 3 cities?
So we are present. We are the largest in terms of the retail portfolio in this EV mobility space. We are present in almost all the states. So for the EV mobility, we are present in 11 states only. For the other states, we are having one more product, which is the Mediclaim Premium Financing, which we are financing through digital mode. So that is how we are having the pan-India presence. So if you'll say for the south side, we are not expecting the e-rickshaws with a low speed. They can work over the area where there is slopes. So we are not expecting so much of EVs in the south side, but yes, as and when the technology will evolve, which will help EV adoption in the south side, we'll be available for financing option.
Gunjan, quick final word. Apart from vehicles, of course, in the electric space, you're also supporting charging infrastructure and battery swapping. Yes. How large of your portfolio is that going to be?
So if we'll not finance the infrastructure, for sure the EV mobility will not expand so much, because if we want to commute from one state to another, there is a challenge at present for the EV charging station and the batteries, swappable batteries. So at present, I am having portfolio of around 10% in this space, and it will expand along proportionate to my EV mobility space. We are open for funding the entire ecosystem, starting from two-wheeler to buses.
All right, Gunjan. Thank you so much for taking time out and being here with us on Startup Street. And we wish you all the best going forward with your journey.
Thank you so much.
And moving on, as digital transactions surge and financial fraud becomes more sophisticated, AI-driven risk detection is now mission critical. Mumbai-based Data Sutram has just raised $9 million in a Series A funding round, backed by global investors B Capital and Lightspeed. The company helps banks, fintechs, and insurers detect fraud, ensure compliance, and reduce risk using its proprietary Trust Core technology. With over 110 million identities screened, Data Sutram is now eyeing global expansion. Joining me now to discuss this further is Rajit Bhattacharya, the founder and CEO of Data Sutram. Rajit, thank you so much for taking time out and being here with us on Startup Street. You know, as I just mentioned, your proprietary Trust Core analyzes millions of digital footprints to flag risk. If you could sort of break that down for us and tell us how it works and what makes it different from traditional fraud detection systems. So sort of tell us what you have on offer.
No, absolutely. I think firstly, thank you so much for having me here. It's a pleasure to come here and share our experience in terms of what we are doing. So, in fact, we all know about credit score, right? Now, what is a credit score? A credit score is fundamentally something that's built on borrowing history or borrowing records, and that's something that today a lot of banks and lenders are relying on in terms of taking decisions. Right. What we realized today is that when we started off today, all us as individuals, we have so much presence on digital history. We constantly use our phone, we shop online, we play games online, we are constantly transacting and creating our digital identity. Now, in the last few years, why fraud has increased and why there's been, we've been hearing about scams, phishing, mule accounts, and so on, is the reason is because with the increase of digital infrastructure, with the increase of lending, obviously there has been loopholes in terms of what fraudsters have identified and have very rightly come in. To quote a banker, right? I think the chore had reached the cloud and the police was still on the ground, right? And that gave us the opportunity. What we did is we, as a proprietary company, we created technology, a product that for the basic foundation assumed that we don't know what fraud is. And we built machine learning and AI-based models that looked at a footprint of an individual over their digital and social behavior and was able to understand algorithms and hence come up with our own score that proprietarily captures what is fraud. And this was a huge move for us because especially in a segment like financial services, for large banks and large lenders to come in and trust indigenous made in India proprietary tech and to trust it for its core decision making and to solve for fraud was a big win for us.
Absolutely. And you've raised this $9 million in a Series A funding round from B Capital and Lightspeed. If you could quickly tell us, how do you plan to deploy this capital across product development, hiring, and international expansion?
Absolutely. So, in fact, firstly, the funding from two of the largest global funds in the world also, is a huge boost for the economy and also a huge boost especially in the fintech segment because market size has always been a concern in this area. So it also shows that this is a big space. We are planning to expand our team aggressively, build a great talent. We are looking to get people from the go-to-market and product perspective. I think from an expansion perspective, we're looking at both breadth and depth. From the depth perspective, of course, we're solving for fraud at an onboarding level, but we eventually want to go into transaction. We want to go into, looking at payments and multiple aspects. From a breadth perspective, obviously today, lastly, our work is restricted to banks and NBFCs, which is liability and lending. But eventually we want to go into insurance, we want to look into crypto, we want to look into gaming. So wherever there is a money trail involved digitally, there can be potential risks of fraud. And that's where we plan to expand our product portfolio and to ensure that we live in a secure environment. I think the idea is tomorrow, every time there's a transaction, there should be a score generated to check whether that transaction is a fraud or not.
Sure. And if you could sort of, give us a sense of your current revenue model and what you're currently clocking, what's the kind of growth that you've seen so far and how do you plan to scale monetization?
Absolutely. So our billing today is on a per inquiry basis. So we charge a customer every time there's an inquiry, that the enterprise makes on the end customer, right? For us today, last year we clocked around, we've seen 4x growth. We've hit $3 million of run rate. And today, I think we're going forward to this year to hit, grow 4x forward and reach $10 to $12 million in the next 12 to 15 months.
And you're already, as we mentioned, working with leading banks, NBFCs, and fintechs. Can you share how your client base has grown over the past year and what kind of demand you're seeing from new sectors? Like you said, you're looking at insurance, crypto, and e-commerce. Are you seeing any leads there? Are you seeing any kind of growth there? And what are the kind of threats that your clients are most worried about?
I think what has happened over time, is that in the initial days, right? I think when you looked at fraud, if I go back to, previously people used to have secure physical spaces. Then as it moved into digital, right? I think the volume of, fraud online increased because right now anyone with a SIM card can really, clock a system and game it and do a potential fraud. I think the risk has become that if you see most of the fraud that's happening in the country, the age profile is between 25 to 28 or 24 to 28, right? It's a young population that's going out and using the internet to find loopholes. So when we speak to risk professionals, when we speak to anti-fraud solution professionals, previously this used to be a profession where it's always very collaborative. Where people come together, share, this is what we are seeing. Are you seeing it there? Right? And we are seeing the same trend here. I think what we are seeing is a community-based approach, a knowledge-sharing-based approach, where everyone's coming together. Whether I'm a bank, I'm an NBFC, I'm a crypto, I'm an insurance. I think the risk everyone has today is that when there is a money trail involved, because see, what's the fraud that's happening? It's identity theft, it's stolen identity, it's synthetic identity. Because at the core, what has happened is today, if I have 2-3 phone numbers and 4-5 email IDs, I can become 12 individuals on the internet, and hence it's very difficult for a enterprise on the other side to understand who am I really and when am I looking at. So contact risk is a major problem. And today, this problem of identity theft, synthetic identity has really taken over. And that has led to major challenges. So what we are seeing today, when we started off last 1 year, right, I think mule account was a huge trend. I think the regulator was looking at it very aggressively, and hence very large banks, banks came in. And now we are seeing it in other segments.
Absolutely. So you've outlined there what it is that clients are most afraid of and what you do to help them out. All right, Rajit, we're completely out of time, but thank you so much for taking time out and being here with us on Startup Street.
Thank you so much. Pleasure.
Well, on that note, we have to take a break, but don't go anywhere. Up next, AI-powered cybersecurity platform CloudSec has raised $19 million across its Series A2 and B1 funding rounds. We'll continue that conversation after this break. AI-powered cybersecurity platform CloudSec has raised $19 million across its Series A2 and B1 funding rounds. This capital is going to fuel its continued product innovation and global expansion. Now, founded in 2015, the platform now serves more than 250 enterprises across banking, healthcare, tech, and the public sector. The company says it will now soon be announcing a Series B2 as an extension of B1, both to onboard new investors and facilitate partial exits for some of its early backers. For more on this, joining me now is Rahul Sassi, the co-founder and CEO of CloudSec. Rahul, welcome to Startup Street. Many thanks for your time here. We were just speaking to Data Sutram about the mule accounts and the kind of work they're doing. It's a space that's clearly very active. You've got this $19 million. Tell us how you're going to deploy this to begin with.
Ritu, I think when we started the company and we started in India, a lot of people used to say that this because in the early days, in the first few years, most of our customers from India, right? And people used to say that this product has been made for India and it might not see an international traction. Fast forward today, in the last 2 quarters, what you have seen is that more than 50% of our revenue comes from, actually 65% of our revenue comes from the international market, net new. In fact, in that, 30% of the revenue is coming from the US market. So the thing is that you can build here and you can now sell it to the world, because cybersecurity problems are not regional. Cybersecurity problems are global. So that's the opportunity we are tapping. And that's what we're trying to go after as well.
Well, yes, the problem truly is global. But Rahul, you mentioned a forthcoming Series B2 round that you're looking to do as an extension. Which investors are you in talks with? And, is this primarily to facilitate exits, or how much would you be raising?
So in fact, one of the investors which came in this current round was actually a customer, right? And a space customer, Homeworld, who came on board as a investor. And it's actually so strong validation when your investors are your customers. So we wanted to actually prioritize and close the deal. In fact, we closed this deal from the date of receiving the term sheet within a month. And at that same time, there were a bunch of investors who were interested in being part of the round. I'll give you some of the names. One of them was the CTI Ventures. It's the state fund of Connecticut. It's a US state fund who put money into the company. So there are a bunch of similar funds who expressed their interest. But because we wanted to facilitate secondary asset and then we would lose time trying to do both, we kind of said we'll do B1 and then we will do B2 later, and which will accommodate some of the other folks who are actually waiting. We have a bunch of folks who are waiting on the wait. We are trying to facilitate for them to bring them to the cap table.
I see. CloudSec, you say, has grown its annual recurring revenues by 3 times in the last 2 years. And 60% of your net revenues, like you said, of course, is still coming from global markets. What has driven this kind of traction, and how do you plan to sustain this momentum? If you could give us some projections for the coming year.
Yeah, absolutely. So we're clocking upwards of 100 crores in revenue this year. We're growing at 60%. And interesting factors, like the Data Sudram guys were saying, but India itself lost actually 2.6 billion to cybercrimes. That's the official record. And this is just the reported figures, right? The unreported would not be there. So what is happening is that cybercrimes used to be done or operated by human beings is now going to be or started getting operated by AI. What is happening is that AI has is going to or already started bringing down the cost of everything. When cost of everything is coming down, what would happen is it'll disrupt the economy. And when an economic disruption happens, economy goes down, cybercrimes always goes up, right? When economy is down, crimes are always up. So is cybercrime. Now, not only cybercrimes, the need to do cybercrimes goes up. It will be super easy to facilitate cybercrimes for cybercriminals because they could deploy an LLM and do pretty much any sort of attack, which previously required very sophisticated hackers. So this is what we intend to prevent. You need AI-powered solutions to defend, and our technology actually predicts the cyber threats before a cyber attack happens. That's what we do in the company.
All right, predicting the threat even before the cyber attack can happen. Rahul, thank you very much. That's all the time we had, but we wish you the best, and we'll wait to hear more as and when you raise that extended round. Thanks very much. On that note, we're going to wrap up this edition of Startup Street, but stay with us. More news and updates will come up on the other side.
Hello and welcome to the Young Turks Reloaded podcast. I'm Shireen Bhan. Entrepreneurship is about creative destruction. It's about creating new categories, but it's also about reinventing existing categories. My guests today are attempting to do that in the gems and jewelry business. They started Angara, which quite literally means the fire within, a company started in 2005 to cater to the online jewelry market in the US. Today, they've got revenue of over $100 million and the aspiration of touching $1 billion by 2030. They've just launched in India and they're hoping to make India a big part of their global growth plan. To talk to us about bringing color back into the jewelry business, as well as the disruption that we are seeing in the gems and jewelry business because of the growth and the rapid rise of lab-grown diamonds, Ankur and Aditi Daga join me on the podcast today. Ankur and Aditi, many thanks for joining us here on the Young Turks podcast. It's great to have you join us on the program. But, I want to start with the two of you. Both of your families have been in the gems and jewelry business for centuries. In your case, centuries. In your case, how long?
Decades.
Decades, okay. And you didn't want to do anything with the jewelry business, but yet in 2005, both of you decided that it sparked the fire within. What happened there?
Yeah, so I think both of our stories are slightly different there. Aditi's always loved jewelry. I grew up watching my dad in wholesale gemstones, and I always thought it was a sleepy, antiquated business, so never really wanted to get in. But life, of course, comes full circle. So my first brush with jewelry was in college. Kind of crazy story. Ratan Tata came to speak to campus for us.
Right.
And
this is Wharton.
This is at Wharton, correct. And then he just mentioned that he's going on a train to New York. So I went to the train station, tried to catch him there. And I introduced myself and I said, I'm such a big fan, but I just want to let you know that when I go from Delhi to Jaipur, I'm behind a Tata truck. And the exhaust is coming straight into our car and I fall sick. And so if you can fix that, that would be great. And we had a couple of minutes of conversation. He said, give me your details. And so when he got back to India, he then wrote me a letter saying, next time you come to Bombay, I would love to meet you there, which is insane. So go to Bombay, and we had a 3-hour conversation. And he's like, why don't you visit Tanishq? Tell me what you think. And that was my first brush with jewelry retail. And I said, wow, this is amazing. This is organized retail. I'm seeing what they're trying to do. Thereafter, I happened to join McKinsey after undergrad. And fortuitously, my first project was, or my longest project was with McKinsey, with Tanishq in India. And so I said, I clearly see this way to organize jewelry retail, and that's the future for me. So life ends up coming full circle.
So Tanishq inspired the Angara story.
That's right.
And what did you think when he decided that this was what he wanted to do?
The next time he says, I'm never doing something, I'm going to bet against it, because he said, I'm never coming into the jewelry industry before. So yeah, I learned my lesson.
And you never considered getting into the jewelry business either.
I didn't initially, but I don't know. I always had a love for jewelry, and I don't know when I fell in love with it first. Whether it's, going as a child to the temples and you see the deities adorned, and it's glowing, everything's glowing, and it looks so beautiful, and kind of I fell in love without knowing, or like seeing my mom kind of decked up in the holidays, and I'm one of 4 sisters, so like always waiting for us, that if there's an occasion, we're going to take something from her jewelry box and wear it, and hearing, seeing my father design so passionately, or my grandfather hearing his stories for their legacy, seeing him sit with the karigars and really kind of making sure that the jewelry is perfect for that custom piece, Nahi usko wapas todo, make it again because the customer wants it this way, it doesn't sit properly, and that attention to detail,
old school.
it was in my head, I guess at some point. And then his charming brothers, at the front and sales, but they weren't selling, they were building lifelong relationships, it felt like. And then it felt like this treasure trove, and like, how do we scale this? Somewhere at the back of my mind, it was there. And then kind of when we met fortuitously and wanted to start something together, we kind of put all those pieces together.
And the two of you actually met and got married when you were 22, and that was an arranged thing.
That's right.
Yes.
Yeah.
And so you didn't know each other at all.
No, not at
previously.
all.
Nope. So what was that? What was that like when you first met Aditi?
Yeah, so we were introduced, as you mentioned, and it took me 2 months to figure out, can someone be so perfect? So I was like, kuch to gadbad hai. And what you see is what you get. But I think what I ended up doing is I used all my karma points from my previous lives, went all in, and luckily she said yes, and I'm super thankful for that.
And so you have grown together. I mean, 22 and then setting up a company together and watching it grow into a $100 million enterprise today with the aspiration of $1 billion in sales by 2030. You kind of built this together. What's that been like?
I mean, it's been an amazing journey. Like you said, we grew up together. So we went to grad school together. Then we started this together. You know, all those points of disappointment and, shared experiences. We love doing things together, but we also find time to pursue our passions independently. And I think that's the key, that we grow independently and together.
I'll get to the passions in just a second, but let's talk about starting up. So in a way, the gems and jewelry business has been in your blood, but actually starting up, that experience, and I want to go back to 2005, the decision to bootstrap, not get any venture money on board, that's because you saw a friend of yours go through a bad experience, I believe.
That's right. Yeah. One of my best friends raised a lot of industry capital or venture capital at that time. And everything for him went right for the first 4 years. But the markets in 08, 09 turned and everything changed. All of a sudden, he was able to sell the company. The board took him out of that position. And I never wanted to go through that. Ours is a 50-year journey. It's not like a 5 years, let's build it, let's sell it type of play. And so venture capital, 5 to 10 years fund cycles versus what we were trying to do was completely different. And honestly, I would have been fired in the first 2 years if there was a VC funding us. I did everything wrong. So graduated in 05, we raised some amount of industry capital at the onset. We hired a lot of very good people without product market fit. So we had huge burn, but very little in terms of sales. We were trying to do everything. We were trying to do diamonds, color stones, all sorts of product categories, which was trying to attack too much with limited amounts of capital. And the people that we hired, even though they were amazing, a lot of ex-De Beers, LVMH, very senior talent, but we were a startup with no revenue. So it was not the right person at the right time. And so I went through 90% of our capital very quickly. We were 4 months away from running out of cash. And we would have gone under in that case. Luckily, a few things happened. One is we shifted all of our operations from New York to India. And our operating cost structure went down by 90%. We focused all in on colored gemstones. And all of a sudden, things started taking off. And our team there and in India, we were all in. We were 24/7. We lived it. This was our life. And the only thing that we're thinking about is how do we make the company survive? And that focus that resulted from that, even till today, we're trying to be as focused as possible. But, we have PTSD from that time, right? So that's why no further capital raises. We will grow it on our own. We will reinvest capital. And we'll get to $1 billion without any external funding.
I'll talk about the PTSD in just a second. But, many of the decisions that you were forced to take, shifting operations to India or doubling down on the colored gemstone side of the business, were perhaps not conscious decisions as much as you were forced to take them because of your circumstances. As you look back today, I mean, that was probably the biggest bet that you made, which has taken the company from where it was, which was on the brink of not being able to make it to where it is today. So as you look back, what made you focus on the gemstone side of the story?
So I think it really making our customer the true north. I think that was the key. Customers would call us and say, we love the design, but can you give us a bigger carat weight, or can you give us a higher quality? And we said, there's something to this when enough customers started calling in. So when we introduced the good, better, best heirloom, no one else had done that before. So we pioneered in introducing different qualities, different sizes, different metals all together. And so no matter who the customer was, you could get exactly what you wanted, provided you liked that design sensibility. And that's really helped us take off.
I'll talk about personalization as well, but going back to that difficult period, the first 5 years of the business where, you were still figuring things out. Selling jewelry online to start with is a difficult proposition because trust has been so crucial as part of this transaction. And it's taken a while, even in India. I mean, in India, it's taken a long time for people to get used to the idea of e-commerce to start with. But what was that like? I mean, when you put the business plan together, how concerned were you about the acceptability of this?
Yes, so the numbers on the business plan or in the Excel sheet were actually super exciting. But in reality, so what was happening is 2% of jewelry in the US was sold online back in 2005, but it was growing at 50% per year. So we're like, oh, this is amazing. We always wanted to be a color stone oriented company. And kind of the backstory there is that these family's been in the business for 300 years. And 300 years ago, it was all about color.
Right.
So for hundreds of years, color was the majority of studded jewelry. And we said, can we bring that back? And my parents were in wholesale gemstones also. So I kind of saw it happening. And I was like, there's an opportunity here.
Why
but
do you think we lost on the color side of the story?
So De Beers and A Diamond is Forever was the single most brilliant marketing campaign of all time. So in 1947, they launched 75 years ago, roughly, with the idea of A Diamond is Forever, with a 2-month salary for an engagement ring. That's how you show your love. This idea, the singular idea of perfection. So a D flawless, which is colorless and flawless, is what we should all aspire to. And that's the ultimate idea of success. And all of a sudden, color stones went from majority of the industry to 10%. And in that process, can we revive that? Can we bring the industry back to that? It was much easier said than done.
Right.
And so if e-commerce is 2%, if color stones are 10%, so that's 0.2% of the market.
Yeah.
That's what we were dealing with. And we had to create the entire category, which was a gargantuan task. And it took us a lot of time and effort and luck to get out.
Well, luck is crucial, but what were the key ingredients, the key levers that you decided to play on to take on the De Beers of the world and, in a sense, reclaim share?
I think there was a lot of education involved, as Ankur said, and no one knew about the different qualities of gemstones that were available. So, for example, in India, when you say opal, people could be selling Ethiopian opal, which has a beautiful color play to begin with, but as you begin to wash your hands, it loses it over time, versus a higher quality Australian opal, which is the one that should be sold because that's what lasts for a lifetime, or as long as as it can. And I feel like those things are critical, educating the customer about the different qualities. And, I have a background in education. So it's really about scaffolding. On every page, it's like, okay, what information does the customer need? What's a rollover telling them that this quality exists in this space? What does good mean? What does better mean?
Yeah.
And I think that was key. Education was really key. And in the e-commerce space, reviews are pivotal.
Yes.
So really building that trust over time, it took a lot of time and effort, to do that for the customer.
So when do you believe you felt that you had been able to survive this storm and then you could put together a plan to thrive and scale the business?
Yeah, so 2010 was a turning point. We were cash flow positive in 2010, and that's when we also jumped back into color stones. And because the business started taking off, we said, you know what? We have something here. And what was fascinating for us is the awareness initially was so low. So even if you go to Tiffany and Fifth Avenue, right, the largest retail store in the US, you would only see 3 to 5 sapphire rings. So, and citrine, peridot, amethyst, those were not even there. So we had to first show customers that, hey, this is the entire world of gemstone jewelry. And back then, Google and search engines in general were the primary way to get traffic. So somebody had to actually type in sapphire engagement ring for us to show up. So building awareness, I think, was step one. But what was interesting is we were the only ones in that market. So because there was no competition, the cost per clicks were very low. And the economics started working, and we started growing very quickly as a result of that, thankfully.
let's talk about 2025. I mean, what we're seeing in the jewelry market worldwide today is this big takeoff as far as lab-grown diamonds are concerned.
Yeah.
And now, people are asking the question on what actually happens to a company like De Beers. In fact, you believe that this is the Kodak moment for the diamond industry. Why do you say that?
So I'll give you some data that we're seeing live. So De Beers is interesting because it was 6.6 billion in revenue in 2022. It halved. 2024 was 3.3 billion. In a high fixed cost business, it's just very difficult to survive in that. But the reason that happened is in 2018, the FTC, so Federal Trade Commission in the US, said a lab-grown diamond is a diamond. They're chemically, physically, optically identical.
Okay.
So all of a sudden, it legitimized the entire industry for everyone. And now, you fast forward 7 years, you can get a lab-grown diamond for 90 to 95% cheaper.
Yeah.
And it's chemically, physically, optically identical. So the whole use case that for natural diamonds...
So if it's identical, then what's the difference then? If it's certified as being identical.
Yeah, so one comes out of the earth,
Yeah.
one is grown in a
Yeah.
lab. So the interesting thing is, so historically, diamonds, the way De Beers created that whole industry, there were two primary reasons you would buy diamonds. So one is financial flex. If you're wearing a 1 carat, 2 carat, 3 carat solitaire, it says something about your socioeconomic status.
Yeah.
Right? The other is it's an inflation hedge. It outperforms inflation by 2 to 3% per annum. So it's a great investment while you get to wear it. Now with lab grown, the financial flex goes away because it's 90 to 95% cheaper. And no one can tell if you're wearing natural or lab.
Right.
And the investment case goes away because diamonds have gone down in price anywhere from 40 to 45% in the last 3 years.
So it's not a safe haven bet.
No longer.
No
It
longer.
used to be historically.
Yeah.
Last 10 years, that's not the case. Almost every other asset class has outperformed. Sensex obviously has. Gold has performed better than that. Gemstones have performed better than that. So because both of the primary use cases are gone, it's going to be very difficult for natural diamonds. You'll have like a Tiffany, Graf, Harry Winston, and 20% of the market will survive, but everything else, in our opinion, is going to be left.
So you believe this is irreversible, the change that we're seeing today?
It's a better product.
But you can afford to be agnostic because it's still 20% of your business is between lab grown as well as natural diamonds at this point in time, and the bread and butter continues to be gemstones for you. But do you see this changing? Do you see yourself shifting more towards lab grown if you believe that that's going to be the market that's seeing this kind of explosive growth?
Yeah, so the lab grown, so the color stone market in India is very interesting. So 2% of India's market is color gemstone based. That's it. But
and given the history of India, why do you think that's the case? Again, a lack of choice, especially on the organized side?
So it's choice and it's education both. And this idea of Indians look at jewelry as an investment. That's the primary use case, right? And in that, there was never this idea that gemstones would hold value, whereas diamonds were perceived to hold value. So I think that's fundamental to it. 90% of the market is gold jewelry, 10% is diamond studded, and then 2% is... But what's really interesting is if you look at Sotheby's, Christie's, Phillips auctions world over, color stones are way outperforming. They're 2 to 3 times the high estimates for all of the auctions, right? So as an asset class, they're starting to take off. And I think as soon as people start realizing that, and diamonds, so if you look at kind of appreciation, diamonds have lost value over the last 10 years. Sensex has gone up by 11%, gold by 14%, gemstones anywhere from 15 to 21% per annum. As soon as people start understanding that, I think the market starts to turn. There's already an affinity. So we were surprised at how savvy the Indian customer already is. We're selling aquamarine, citrine, sapphire, emerald, ruby, with a lot less need for education than we had in the US.
Okay.
So like you were saying, the market already knows the Maharaja Patiala wore color, the Nizam wore color.
Yeah.
It's been a part of our culture for centuries. But there is a slight need for re-education now, which is part of our objective.
And just to add to that, I think it's really interesting how in colored gemstones, it's the opposite of diamonds, where 80% in India want natural color. And I think this is natural affinity, ki the astrologer told him to wear this. And, things like that, and color is such a big part of our DNA, where, the energy that comes from natural gemstones is very attached to the Indian DNA as well.
So you've got lab-grown diamonds taking off, but you've also got a preference as far as natural gemstones, colored gemstones are concerned. So both running on parallel tracks. But let's talk about India, because it's taken you a while to get here, to launch operations here. You finally decided to launch in India. What's the India plan?
So we've started 6 months ago with an alpha launch. We've way surpassed our expectations so far. So we've done 10 crores in revenue thus far with minimal marketing. We're already profitable in India. India is roughly 22% of the world's jewelry market. I think by 2030, I think we get past 1,000 crores. And I think it grows from there. So we're super excited about the market. It's ripe for color right now. Just some rough numbers just to kind of show India versus the world. 400 billion is the overall market size for jewelry.
Right.
India's 85 billion, as is the US. What's insane about that is the US GDP is $30 trillion.
Yes.
India's GDP is 4.2 trillion.
Yeah.
Right? It's 7 times more valuable here. 2% of India's GDP is jewelry, and is growing at 10 to 15% a year. This is, in my opinion, the most exciting gemstone or jewelry market in the world, and it will be for the decades to come. So we're super bullish. We're excited. Yeah.
Well, so clearly the headroom for growth is what you're betting on as far as India is concerned. But what have been some of the initial learnings? You said you launched in India 6 months ago. What have been some of the initial learnings of having launched in India?
That the e-commerce customer is very savvy in India and they're very mature. So our average order value is over 50,000 rupees, which is really high for jewelry online. Like Ankur mentioned, that the Indian customer is very sophisticated in terms of knowing about color. There's been less education. They've leaned towards blue stones a lot, which is surprising to me. That has been a key learning. And then the lab versus natural in diamonds, that 80% want lab. And on the color side, like I mentioned, 80% want natural color. I think those have been the key learnings.
We've had a couple of startups here in India do online jewelry. And of course, you talked about Tanishq, we had Carrot Lane. And I believe you have a personal link to Mithun Sacheti at Carrot Lane, and he managed to sell that business
brilliant job.
to Titan. But how do you see the evolution of the e-commerce market, and specifically the jewelry market? What surprised you about the way that it's going in India?
I think so. What's idiosyncratic about India versus the US? I think India will go very much the way of the US. This is still today a offline market. So even the e-commerce players that you're talking about, most of their sales happen offline. I think that will start to change. I think people are much more comfortable. We're talking about Zepto, for example. They're just much more comfortable ordering online, buying online.
Yeah, difference between a coffee and a 50,000 piece of jewelry.
That's right. That's right. And in that 50,000 rupee piece, I think, so it's interesting. 3 fundamental differences are happening for us in India versus the rest of the world. One is 80% of the customers that have called in are saying, "Aapka store kahan par hai?" Right? And that doesn't happen anywhere else in the world.
Kahan pe hoga?
Yes. Or kahan par hai? Right? So they're already thinking we have offline retail.
But are you going to do offline retail?
So our first store worldwide will be in Jaipur.
In Jaipur?
Yeah.
That's home.
That's
quite literally for you.
That's for both of us.
So we're super excited about that. But we're going we're completely customer-led in terms of what's needed. Our store experience, I think, will be fundamentally different than what you see here at a Tanishq or Carrot Lane or Bluestone or so. There'll be much more experience centers. Everything we do is bespoke. So if you order right now, the piece will be built after you order.
Okay. Every single piece is done that way?
Every piece is bespoke. And let's say you're a ring size 5. It will be made in that. So kind of the manufacturing process for us, we're completely vertically integrated end to end.
Right.
Except for mining, we kind of do everything else. So we cut and polish gemstones, we cast jewelry, we manufacture jewelry, we retail over the web. So that piece, kind of the life cycle of that piece is really interesting. So if you order now, let's say it's a ring size 5, it's a 3-stone sapphire ring. It will be cast, it will take 8 hours to cast it.
Okay.
Then we'll hand pick the diamonds and color stones. We'll set that. We will then polish, rhodium, QC thoroughly, and then ship out. So by the time you wake up tomorrow morning, it's already on a flight somewhere to you. But that whole 6-month process from 300 years ago, we've compressed down to 24 hours.
How do you do that? How do you compress what took 6 months to 24 hours?
We had to vertically integrate. So we started with manufacturing jewelry. Then we went into product development and design. Then we started cutting and polishing gemstones. And so we'll buy rough all over the world. We'll go to Western Australia for opal. We'll go to Thailand for ruby and sapphire. A lot of gemstones are cut and polished in Jaipur. So we have that as well. And so we'll source...
manufacturing is all here?
So manufacturing, we have a center in Thailand, a center in Los Angeles, and a center in Jaipur. And so we have now offices all over the world. We have supply coming from all over the world. Everything is centralized. Depending on where the customer is, we will make everything in-house. But then it gives us the ability to really cater to whatever the customer wants, which is back to our original mission. It took us a lot of time and effort to do it. But now we feel like the experience is what it should have been from the get-go, which is you could have whatever you want. And I'll give you kind of an example of ring size. So most jewelers across the world will stock in a ring size 6.5. And let's say if you're a ring size 5, they will
resize
modify and resize. Now the problem is structural integrity is harmed and the shape of the ring is harmed. But it's convenient because they have inventory. Right? And they want to sell that inventory. For us, we're making it from scratch, so we'll do it right the first time. We have 40 different gemstones, multiple qualities, shapes, sizes, budgets. To do all of that in one physical store is very hard. But what our customer is looking for is, are you guys legit? Do you actually exist? If a problem happens with the product, can I come in and return it? And that's where I think the experience center concept for us will be key. This is our quality. You compare our quality to the best in the world, a Tiffany or Harry Winston or so forth, and we'll be up there. These are the natural gemstones. We'll have an example of a ruby, sapphire, tanzanite, so forth, and all of the various qualities we offer. And we'll have an example of lab also. And then you tell us what you're envisioning, what the design is, and we'll craft it and ship it to you, which is a fundamentally different model than anything else.
So it's already personalized, but are we now heading into an era of even more personalization or hyper-personalization, if I can use that term, especially with the AI tools that are now available? I mean, how much of that is already being incorporated into plans for you?
Yeah, so it's a fundamental part of what we're trying to do. So the original mission is to bring the industry back to its roots. AI will make that possible. So we're developing something as a chatbot right now where it's like you're sitting in front of your jeweler. And you would say, hey, I'm dreaming of a pendant that's a 5-carat sapphire pendant, or I met my fiance in Venice, and so I want that to be a part of the ring. And in real time, the piece will be created and priced out, and you could choose the gemstones as part of that process. So we're super excited about that.
And you can change anything along the process as well. So it is hyper-personal.
And so, you know, are we starting to see results already of this? I mean, is this already in execution?
It's still in testing phase right now, but we're excited to launch it pretty soon.
But to be able to do this at scale, I mean, what are your concerns? Because it's great as an idea. I mean, everybody would want as customized a solution as possible, especially when we're talking about jewelry, because it's not just about the piece, but it's also the emotion linked to it. But to be able to scale that, what are some of the challenges?
I think making sure that, and that's why we're in testing phase right now, that all the details are there. You know, we don't want to miss anything, and I think that's critical.
So I think for us, a couple of things. So there's a front end, which is easy to do. The back end is the structural integrity of the piece needs to be maintained. It needs to look and feel right